on a one-year basis. Premier Energies also saw a strong set of numbers, and company has announced aggressive capex for capacity expansion targets for FY28. Revenue saw an uptick of 44% on a one-year basis, and margins stood at 32.6 versus 16.4. And company has also said that it has a total estimated capex of 1,250 crore. BEL is the next one on our counter. On the back of the order win, the company secures additional orders worth 572 crore since 7th of April. DRL will also be in focus as US FDA has issued Form 482 with 2 observation for company's API Middleburg facility in New York. KC International will also be in focus on the back of additional order wins worth 1,100 crores. And lastly, GSK Pharma will also be in focus as fire incidents has occurred at a contract manufacturing facility of the company. Hence, operations are halted temporarily. So, all in all these are the key stocks in focus on our radar today.
Okay, Upasana, thank you so much for that. But finally, Mangalam is also waiting by to tell us what's going to be happening in the world of FNO this morning. What are we watching out for? Good morning, Mangalam.
Good morning. There was a sharp rise that we saw on Thursday. Thereafter, there was consolidation that was expected on Friday, and that's exactly what took place if you look at the frontline indices. But typically, after a big move, we have consolidation on the front line, but it's the mid-tier stocks that see a big move, and that's what we saw in broader markets. Nifty Next 50 up 1.5%, Nifty Mid Cap Index up around 1%, Small Cap Index up 2% as well. If you look at the cash market flows, you'd be a little flattered to deceive. We had 5,000 crores buying from the DIIs, 8,800 crores by the FIs. But remember, this was a function of a couple of large trades that took place on Friday. We had Bharti Airtel and we had JSW Infra as well. So all of that is impacted in the cash market flows. What you need to look at is index futures. After a big purchase in the previous trading session, the FIs unwound some long positions. They sold about 1,800 crores in index futures and they added mild shorts. So if you look at it, on May 14, the FI short exposure was 62%, long exposure 38%. The next day there was short covering rally. It jumped all the way up to 46% on the long exposure and now just moderated down to about 42 odd percent itself. 25,000 remains the fulcrum for our market. 25,000 call writers fairly active for a premium of 200 rupees. Put writers equally active for a premium of around 150 rupees. So put these together, you're looking at a premium of roughly 350 rupees, and 350 points on either side is what we're looking at on the Nifty in terms of a broad range. For the Nifty Bank, it's the 20-day moving average where it took support and bounced back from, and that remains an important support on the way down as well. Just keep an eye out on T-Target Wagons. It's entered FNO ban, and CDSL on Friday exited FNO ban.
Well, thank you so much for that, Mangalam. But let's slip into a very short break. Up next, we get you latest updates on the Operation Sindoor and the India-Pakistan situation. Don't go anywhere. Stay tuned.
Welcome back, and you're tuned into Power Breakfast on CNBC-TV18. Now let's keep it going, and in some national updates coming in for you all. Amidst the ongoing Operation Sindoor against Pakistan, the Defence Acquisition Council grants the Indian Armed Forces to procure necessary artillery under emergency procurement. Parikshit is joining you with us to give us more details on this front. Good morning, Parikshit.
Yes, this is going to be an important order for loitering munitions, counter UAV systems, anti-tank guided missiles as well, and other artillery shells for the Indian Army. So these orders will be both for the Air Force, the Army, and also for the Navy. The vice chiefs have been empowered to go in for emergency procurements. Now, as far as the emergency procurement budget goes, it is 15% of the defense modernization budget. So for FY26, the defense modernization budget was around 1,60,000 crore. So therefore, the upper limit of this acquisition that will be done under emergency provisions would be around 24 to 25,000 crores. We're told that the actual expenditure for this year may be lesser because deliveries have to be assured within a one-year period. But it remains to be seen how much is procured. According to certain industry estimates, we've been speaking to a number of people in the industry, and they tell us that the Defense Ministry, the services have drawn up a list of procurement of at least 39,000 to 40,000 crore worth of equipment. However, government sources whom we've been in touch with, they said that upper limit for the procurement is 24,000 crores. The actual numbers will be lesser because the deliveries have to be made within 1 year. But it is clear that within the next 40 days to 6 months, we are going to see a lot of procurements being made by the three services, and this is going to be a positive for certain defense companies.
Well, thank you so much for that, Parikshit. We'll definitely be keeping an eye out on all of those defense counters in today's trading session as well. But let's in fact also listen into defense industry leaders and their take on the government's push for defense sector.
With the policies that the Honorable Prime Minister put into place for the last, let's say, 10 years in the area of defense, and all enabled by our Honorable Defense Minister and the whole user industry collaborative effort that is going on between industry, DRDO, and the users, that is the services, we are all moving forward at a very rapid pace. I mean, there are a lot of things that you don't see that are happening in industry. But I can tell you and assure you that we are moving forward at extremely rapid pace. And this is not only good for our defense, but is also good for our overall economic and industrial development.
Air defense is something that we are looking at quite strongly. We have been associated with the Akash program, and many of the ground equipment for the Akash we are involved with. We are looking at close-in weapon systems, given the thrust on drone warfare. So we have our own close-in weapon systems, which we are now contracted with the Air Force for. And that's one area that we would like to scale up and speed up.
And sky is the limit for Indian defence stocks after Operation Sindoor showcased the might of Made in India arsenals. Top companies, including PSUs, private players, have added over 1.5 lakh crore rupees to their market capitalization since May 7th, with their stock gaining anywhere between 15 to 40%. My colleague Surbhi Upadhyay joins us now. Surbhi, is self-reliance now the war cry now?
Operation Sindoor has literally announced the coming of age of the Indian defense manufacturing ecosystem. And it's an ecosystem that has a lot of private sector players and, of course, the big PSU giants. Let me start by telling you about some of the weapon systems that were deployed in Operation Sindoor. We're talking about, of course, the missiles, the medium-range surface-to-air missiles, MRSAMs as they're called. Bharat Dynamics is a very key player here, not only when it comes to manufacturing these missiles, but it's a full systems integrator, and it played a huge part. The Akash weapon system, which we all know, which was critical in Operation Sindoor. This is a weapon system that has suppliers, across a long supply chain. So when it comes to the outer shell, it was manufactured by a company called Paras Defense. When we're talking about the warheads and the initiating systems, then Solar Industries was the name that was in play. And once again, Bharat Dynamics was the key systems integrator over here. The Nagastra loitering munitions, this was a war that was fought in the sky with drones, and the anti-drone systems came into play as well. And here, Nagastra 1 and 2, which is what Solar has been manufacturing, that was, in key play. I want to talk about some numbers as well, the size of the opportunity in the industry. The projected estimated output by the Indian defense sector for FY25 is 1.75 lakh crore rupees. That number is expected to swell, or was expected to swell, to 3 lakh crore rupees by FY29. But a lot of analysts that we've been speaking to say that these targets will be hit much earlier now because the production is being ramped up, because companies are running on double and in some cases triple shifts. So all of this is getting accelerated. 193 contracts signed by the Ministry of Defense in FY25, and a whopping 92% of those actually went to domestic suppliers. By value, this is number of contracts. By value, 80% of the contracts by value actually went to local manufacturers. So that's really saying something about the extent of our Atmanirbharta. I just want to quickly talk about some of the names here. Many of them you already know. Bharat Dynamics, like I said, when it comes to missile systems, and it's right up there. It's also a key systems integrator. BEL, when it comes to defense communication and electronics. It's a big player in of course, in the Akash new age weapon system, land-based radars, naval systems, tanked armored vehicles, and all the electronic systems that go there. BEL plays a part. HAL needs no introduction, whether it's the Su-30s or the other aircraft. It recently won a massive order, HAL, 62,700 crore rupee order for the light combat aircraft that it will deliver both to the Indian Air Force as well as to the Army. And then, of course, Mazgaon Dock, Garden Reach Shipbuilders, Cochin Shipyard, the frigates, the destroyers, the corvettes, all of them being manufactured locally right here in India. But it's not just the PSUs. The private sector players are really, notching up the game as well. Of course, there are giants like Tata Advanced Systems, which are, into a range of weapon systems, whether it's launchers, artillery gun systems for the Akash surface-to-air missile systems. There's also the, advanced towed artillery gun systems, the ATAGS as it's called. And of course, a range of other optronics, radars, etc. Solar Industries, like I mentioned, when it comes to warheads and bombs, then this is a key emerging player. In fact, whether you talk about missile systems like, BrahMos or many of the others, the Pinaka multi-barrel rocket launchers, Solar is a big player in a lot of these projects, and it's a big supplier. Astra Microwave, big name when it comes to radars and electronic, warfare systems. And then there is Paras Defense as well. Again, the rocket and missile programs, warfare, surveillance, naval systems, tanks, and armored vehicles. This is not a fully exhaustive list, by the way. There are many other companies, many other SMEs as well. But the entire ecosystem, when it comes to defense, self-reliant manufacturing, indeed thriving now in India.
Well, thank you so much for that, Surbhi. Now, moving on, Commerce Minister Piyush Goyal and a team of senior Indian officials are in Washington for discussions with their US counterparts on the proposed bilateral trade agreement. Abhimanyu Sharma joins us now. Abhimanyu, take us through what we can expect from the Commerce Minister's Washington visit.
India's Commerce and Industry Minister Piyush Goyal is in the United States, where he's going to meet the US Commerce Secretary and the US Trade Representative. Government sources have indicated that the political level meetings are going to assess the developments between both the countries with respect to the talks which have taken place since the past 2 months for a potential bilateral trade agreement which both the countries intend to sign. Also, the ministerial meetings intend to provide some political steer to the discussions which are going to be held after the ministerial level meetings, since India's negotiating team led by Chief Negotiator Rajesh Agrawal is also headed to the US, and from the 19th to the 22nd of May they are going to hold talks with their American counterparts. It remains to be seen what all is going to be on the table. Of course, issues pertaining to goods are going to be discussed for the first tranche of a bilateral trade agreement. It remains to be seen whether issues like technical barriers to trade or even non-tariff barriers are going to figure in the discussions, even as both the countries intend to utilize the window of opportunity between the 90-day pause which has been effected on the announcement of tariffs by the United States till the 9th of July.
Thanks so much for that. But on that note, we're going to slip into a very short break. Up next, we'll get you the cues from the world of commodities, so don't go anywhere.
Welcome back. You're watching Power Breakfast on CNBC TV18. As promised, we now have Manisha Gupta joining us with all the updates from the commodity market. Good morning, Manisha.
Morning, and thank you for that. I'll start with the gold prices, where after steepest fall in 6 months and a 3% decline in the previous week, we have seen some gains come back in case of gold. This is because Moody's has cut U.S. credit rating from AAA to AA1, and the U.S. consumer sentiment also has declined, the most near record lows, by the way, and this is a fifth monthly decline, and that really seems to be supporting gold prices yet again. Not just gold, but silver is trading on a firmer note. We also have copper prices trading firm. The short-term truce between U.S.-China and the fact that China is buying a lot of copper, producing record refined numbers as well. But copper concentrate imports into China have surged quite strongly for the month of May, have been supportive as well. If you look at the crude oil prices, well, here as well, after 2% of gains in the previous week and a second weekly gain, we are looking at crude oil prices also holding firm, the gains from the previous week. Well, the possible U.S.-Iran nuclear deal is something that the street will watch out for. And the other thing is the IEA report, which says that the supply surplus in 2025 could be because of higher OPEC output. So the statement that would come in from OPEC on 5th of June is something that the street will keep an eye on. In the meanwhile, the strength in U.S. dollar is also supporting markets. So across sector, we are looking at most of these commodities trading in the positive.
Well, thank you so much for that, Manisha. Now, moving on to some updates from the world of sports. India's golden boy, Neeraj Chopra, crosses a landmark milestone at the Doha Diamond League, reaching the 90-meter mark in javelin for the first time with a throw of 90.23 meters. However, despite his personal best, the athlete had to settle for the second position after Julian Webber stole the show with a throw of 91 meters.
Okay, that's all the time we have on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motira Oswal studios. Start of a fresh new week. Lots of triggers, lots to talk about. We're coming to you, of course, after 5 weeks of straight non-stop kind of gains. I mean, the Nifty is up from the lows of 21,743, up somewhat 15-16% or so. It's been one way. Where do we go from here? That's the question. I'm Prashant with me, my colleagues Nigel and Survi. Guys, hi, morning.
Morning.
Hi, morning. Well, yes, cues are a little more somber as we look at, whether it's the US Moody's downgrade, whether we look at Asian markets this morning. But guys, it's all, grey and black, lovely skies in Mumbai.
Monsoons, yeah.
The pre-monsoon activity has picked up, though I know that there are reports that I think in some parts of Maharashtra, it's, a little bit of an issue with the crops because it's ahead of time. But nonetheless, I mean, monsoon bounty, looking forward to it.
Well, indeed, the heat, though, post it rains, it gets a little too much. But that said, it's going to be an interesting trading session. As Prashant said, we've had a good run. Let's get straight to the action.
Yeah, now it will be not pause, but will be kind of, there is enough to pause for consolidate. I think that's broadly, the way I'm looking at things. And I'll tell you why. There are basically two themes I want to touch upon this morning. There's not too much day on day, and there's not too much to pick up on Friday in terms of what happened or what's happening this morning in Asia to really sort of, in that sense, read the tea leaves. So the markets continued their rally, and there have been two 90-day pauses, right? I mean, so much has happened in the last 1 month. It's kind of incredible. But you've had 90-day pause on the 9th of April for reciprocal tariffs. The rally started then. And that continues. You had another 90-day pause, this time between US and China, which came last weekend. And that, right out of it, I said, well, this is tactically risk on for markets. And, markets have just continued on. And they've done very well. So last week, if there was, if you need evidence, Nifty was up 4%, Nifty Bank was up 3%, mid-cap index was up 7%, and the small-cap index was up 9%. That is just last week, 1 week. And this kind of is after that weekend. We came out like a Monday, this Monday. This was, of course, the last Monday. And unexpectedly, US-China tariffs would drop down to 30 and 10% respectively, much better than anyone thought. Now, most markets, after the rally we've had, I mean, for example, the S&P 500, the biggest, the most diversified index in the world, the most tracked index in the world, is rallied 24% from the April lows. It's 3% away from its February highs. So most markets around the world are pricing in little to no damage from Trump's tariff policies. Could this really be true? That's the point. Now, I think that this assumption that there'll be little to no damage is perhaps wrong. But it's just too early to fight the trend. I mean, if you're trading, if you're in the markets, you may have a view, but what you do has to be sort of timed correctly as well. And maybe it's not just still the time to fight this trend, this broad uptrend that we have been seeing. But it's time at least to wait and watch and maybe lighten up a little bit if you're aggressively sort of been trading and riding this up move. The question to ask is this: has the good news on tariffs peaked? Now, the good news was the last big tariff good news was US-China. So is that kind of the top as far as this entire tariff news flow, good tariff news flow is concerned? We'll have to see. No one thought that the US-China thing will happen the way it did at the rates it did. So it's a question we'll just have to wait for answers. Now, but remember this, even after what has been done, and there's nothing new, US effective tariff rate for China began this year in 2025 at 11%. And even after the drop, what we have now is 39% effective US tariffs on Chinese imports. It's still massive. It's still very, very large. And is it really the case that there won't be any impact whatsoever? Now, just two other things, right? One is the US bond market. Will that start to come into focus again? Are US treasuries vulnerable once again? And I'll give you two reasons why. One is Moody's downgraded the US sovereign rating from AAA to AA in line with other rating agencies. It's not earth-shatteringly a big market-moving kind of an event, but it does point to the fact that this is still a thing, right? The House Budget Committee rejected the reconciliation spending bill on Friday. There was supposed to be another bill Sunday night, the point is this will get passed at some point. Maybe not now, by the time you sort of in the autumn session, as some are saying on the outside. But the point is this will get done. But again, the thing is, there's a organization called the Committee for Responsible Federal Budget. They estimate that the current bill, this bill, which they're trying to pass, this would add 3.3 trillion to the debt, US debt, by FY 2034. So if you remember Scott Bessent and his threes, right? I mean, 3% inflation, 3% growth, 3% bond yields, and I think I don't remember what are the other 3%. But I mean, what is being proposed now, this is completely away from any of those 3% kind of levels. You're actually talking about $3 trillion in additional deficit by 2024. So I think the question once again is, will bond markets start to wake up and kind of reassess what they need to do, how they need to price some of these spending plans? It's very different from what they began by saying in terms of they want to cut spending, reduce the size of the US government, etc., etc. Just quickly wrapping out things with just two levels. On the Nifty, support stands at 24,738, the 40-hourly exponential moving average. And the Nifty Bank support stands at 54,442. And one is the 40-hourly, the other is the low that we saw on Friday last week. Upside levels are well understood, well known. I'm not getting into it. GIFT Nifty will give you a quick sense of how we are likely to start. It's about 11 points lower. So it's a measured and slightly flattish kind of start this morning. Surabhi.
Yeah, absolutely. And, for what it's worth, this whole talk of Moody's downgrading, and now they're in line with the other rating agencies, that is kind of putting a lid on the enthusiasm this morning across Asia as well, because a lot of the Asian markets are tracking red, whether it's the Nikkei or whether it's the Chinese markets. The Chinese markets, by the way, in addition, are looking at data, and data points are mixed. So the retail sales number that came in for April, that has missed estimates. It's also lower than the March number. Retail sales in China are at 5.1% growth for April. The industrial production number is also slowed down. The April number is lower than the March number, but it's not as bad as the market had expected. So the industrial output number is 6.1% in China. So the numbers are keeping markets fairly range bound. And then, of course, there is the US bit as well. In the US, by the way, this widely tracked sentiment indicator, the University of Michigan Consumer Sentiment Index Survey, that indicator fell to 50.8, the print that came out, versus 52.2 in April. And that's the second lowest reading on record for that indicator. But anyway, on Friday, the market was in a good mood till this Moody's downgrade news came in. In fact, for the week as a whole, if you talk about it, I mean, the US market, S&P 500 is 5.3% higher, Dow 3.4%, NASDAQ 7.2%. Those are the kind of gains we're talking about just last week in the US market. On the trade front, never a dull moment. Let's pull up the latest tweet or post from Mr. Donald Trump. Now he's saying that Walmart should eat the tariffs. That was the weekend headline. He's saying both China and Walmart, between them, should eat the additional tariffs and not charge valued customers anything, he says. He says, I'll be watching, and so will your customers. And this is in response to Walmart indicating, the Walmart management indicating that prices are bound to go up as these tariffs kick in. So this is, a never-ending saga that continues. On trade, by the way, this week is very, very critical for us here in India. What is the future shape and, form of the India-US bilateral trade agreement? Will it get done? What happens? Because there's been a lot of back and forth. The Commerce Minister is, of course, in the US, and he will be meeting both Commerce Secretary Lutnick as well as USTR Jameson Greer this week. And then the official level talks will continue through the rest of the week, right up till Thursday, Friday. And we know what's happened because, on social media and on public forums, when he was in the Middle East, Donald Trump, the US president, was indicating that India has offered zero tariffs, all is okay. Then the external affairs minister came in, our external affairs minister, that is, saying that nothing is done till it's done. It needs to be a mutually beneficial deal. So this is very, very crucial in terms of the progress on this deal as we go forward. On the markets, the Nifty got into a bit of a consolidation patch by the end of the week, by Friday. But the mid-cap market has been, up and about, lots of flair out there. So let's see. The flows picture is still very, very strong. So if you need that push to come in, the bulls have that ammunition with them. And look at the kind of buying. FII buying of 8,800 crores on Friday, and domestic buying worth 5,200 odd crores. So pretty solid numbers, no problems when it comes to foreign or domestic participation. Lots of stocks in focus and some very interesting developments in the telecom space that I'll watch out for. Bharti Airtel seems to be indicating, why leave us behind? If you're talking about any kind of an AGR relief from the government, why shouldn't we get it? That's exactly the point that they've raised, saying that the relief should be granted in a non-discriminatory manner to all license holders. They're also saying we'll also have operational difficulties if the interest in the penalty is not waived off. And today, the Supreme Court could be taking up Vodafone Idea's plea, another plea of reviewing the AGR due. So let's watch for this space. Divi's Laboratories, pretty good numbers, and Zen Tech Defense has been the theme and the flavor. We'll have the management, by the way, join us today as well. And it's been a blowout number for Zentech. The profits have moved from 30 crores to 100 crores. Revenue has doubled, so on and so forth. Margins are soaring. So lots more coming up with that management. Plenty to keep us occupied and busy. Nigel.
Well, that's right. In terms of flows and the liquidity in the system, it's actually very, very healthy. Because I was looking at the equity mutual funds and the holding that they have equates to around 2.15 lakh crore. I'll tell you what, that is 7% of the equity AUM. So good amount of ammunition is what the domestic mutual funds are sitting on, which will hold us in good stead in case there is a lot of supply of paper and also in case the world gets a little bit jittery as well. So this actually is a positive from an India market perspective. What did the FIs do in Friday's trading session? They unwound some longs. 5,000 contracts were down out there on the long side. They, we had some addition in terms of, short positioning as well. And now, in fact, they continue to remain net short with close to around 58% positions on the short side. Even if you look at it in absolute terms, the FIs are net short, while the clients, well, they are net long. And actually, that combination is not such a bad sign. When you have the FIs that are net short, 23,000 contracts on the short side, the clients at around 11,000 contracts on the long side, that's been actually a winning combination. So let's see how that goes this time around as well. The options data comes up for you, and the PCR last week had moved to around 1.3. And at that point of time, we said maybe there could be some kind of cooling off, and there was some kind of cooling off. So the PCR is now in the middle of the range, 0.6 on the downside. On the upside, it's around 1.5. So it's holding around that 1 odd mark. And two strikes are very active. The 25,100 call, close to 28 lakh shares getting added there. The 25,000 put as well, that as well as added close to around 24.5 lakh shares out there. And you punch in the premiums and you get the broad levels. So on the upside, the Nifty is expected to see some kind of resistance at around the 25,250 odd mark. That's the important mark. On the downside, this range actually is very, very important because the Nifty took some time to get past the 24,800 odd mark. Now, on the downside, that becomes the first level of support. And if you break that, then you're looking at the 20 DMA, which is a few hundred points lower from there. The Nifty Bank, that's been taking support at around the 20 DMA. We saw last week as well, it went to that level and then it bounced up. But now the 20 DMA has moved up a little bit. So it's at around that 54,950 odd mark. So this is the crucial range, 54,400 to around 54,900. You don't want the Nifty Bank to break this range. And as I've been saying the last many times, this 56,000 mark on the Nifty Bank remains elusive. We need to decisively conquer this to start the next leg of the up move. Remember, in the last 1 month or so, we have gone there numerous times, but we couldn't conquer that mark. So the GIFT Nifty is suggesting some kind of volatility, but I think the liquidity in the system is something that will hold us in good stead.
Absolutely, a lot of liquidity, especially with domestic mutual funds, and Nigel has been highlighting that on the program here. Well, Ed Yardini is president at Yardini Research. He's with us. Ed, good morning. Good to have you with us here. Thank you for your time. Just a quick word on the U.S. Treasuries and this bill, and then the Moody's action. Ed, will we start to talk about U.S. Treasuries once again in a vulnerable kind of a way? What's your sense?
My sense is that there's no surprise here. Moody's was the third rating agency to lower the credit rating of the United States. S&P did it first back in 2011. Moody's was just telling us what we all know, is that the government, U.S. federal government deficit is too large and there's too much debt. But I keep pointing out that the bond market seems to have no problems. I mean, the bond yield is at basically 4.5%. That's where I thought it should be. That's kind of the new normal. Which is kind of the old normal that we had before the great financial crisis. So all in all, I'd say it's a non-event.
What about this bill, Ed? It's more also the signal, right? That this is, is there anything new? Is there a shift? Everyone seems to be okay with it. You're front-loading tax cuts. Any of the spending cuts are loaded for later. It's typical what any administration would do. So,
yeah.
In that sense, that realization, is there a shift to be had in markets because of that?
But there could be. I think the bond market is watching Washington very, very carefully, and the assessment of how this bill will have, what impact this bill will have over the next 10 years on the deficit, on the amount of debt relative to GDP is very important. But keep in mind that the U.S. has the largest sovereign debt capital market in the world. There's obviously demand for treasuries. If the bill turns out to be disappointing, then we will see the bond market indicating that with a increase in the bond yield. I don't think we're ever going to get a situation where just nobody's going to show up at a bond auction. I think it's just a matter of the extent to which yields are pushed higher to levels that create a possibility of a recession. We don't have that right now. I've often said that I'll worry about the deficit and the debt when the bond market worries about it. So I was somewhat worried in 2023. I was not worried back on August 8th when the bond yield went from 4% to 4.5%. I think that was sort of a technical aberration with regards to a basis trade. But if I see the bond yield going back to 5%, that would be an indication that the bond investors are not happy with this bill. But at the same time, they might be very happy with 5%, just the way they were in 2023, and they may just jump to buy these things at that level.
Ed, hi, morning. Great to have you on.
Thank you.
What sense do you see around you, hear around you on now both India and China in terms of, taking some money out of the US and putting it in other markets? Because on China, of course, there's the deal. But on India, the geopolitical overtures, the tone, the tenor, the talk, it's not been all bonhomie, so to speak, because of what's happened with Pakistan. And now we have the trade deal, US president saying India's offering zero tariffs, Indian officials saying it's not done till it's done. So, I mean, the commentary between the US and India has not been the best, should I say, in the last 2 weeks. Your thoughts?
That's correct, but everything's relative, right? I mean, on a relative basis, the conversations that the United States has had with other countries has been even worse than anything we've seen with India. So on a relative basis, things look pretty calm versus between the U.S. and India. And India, I think, still stands out as the country that's probably going to have less of a trade war issue in the United States than other countries might have, particularly China. I don't know that this China trade war is going to go away. It's the Chinese aren't going to be all that flexible in the demands that the United States is imposing on them. The United States isn't making anything like these kind of demands on India, and I think as we saw, the Chinese retail sales were somewhat disappointing. The industrial production is strong, but that's also disappointing because that much means that they're just continuing to deal with their weak economy by pushing their manufacturing sector. And a lot of that goes into exports, which creates deflationary gluts around the world. So I think to the extent that global investors are looking at where to invest, India obviously looks better than China. Didn't do so a few months ago, but I think now it does again.
All right, Ed, very quickly before we let you go, S&P 500, I recall the last time we chatted, you said, you're lowering the target, I think, from around 6,500 to around 6,000. Well, post that big bump up that we saw last week, we're almost there. Do you want to revise the S&P 500 target? And also, what about gold? After a while, gold cooled off.
Right.
Where is that asset heading?
Well, I wasn't the only one on a week ago Monday that decided that with the Chinese deal, at least reducing at least de-escalating the war with the trade war, I raised my target for the S&P 500 from 6,000 back up to 6,500. I mean, it's conceivable I'll be regretting that I ever lowered it from 7,000, which is what my target was at the beginning of the year. But the earnings picture is starting to look a little bit tired in the United States. And so what we've seen here is sort of a valuation-led melt-up that is kind of bringing us back to where we were at the beginning of this year, with more concerns about the trade war, more concerns about at least the temporary inflation surge. So that's where we are right now. But next time you interview me, you'll probably tell me that we're awfully close to 6,500. So what do we do next?
All right, Ed, Thank you very much. Absolutely. We'll look forward to that. Thank you for joining us here on CNBC TV18. Well, let's just quickly run you through the interactions which are lined up here over the next 2 hours or so. So you'll hear from the management of Zen Technology. Stock's done phenomenally well coming into this week. 9 o'clock, you'll have Galaxy Surfactants on their fourth quarter numbers. Sanjeev Prasad of Kotak will be with us at 9:20. 9:30, Keynes will be with us on their fourth quarter earnings. Data Patterns at 9:40 on their performance. And of course, we'll have Vinati Saraf of Vinati Organics to talk about their earnings and outlook, more importantly. Towards the end of the show, it's the economy. Lata in conversation with the SBI Mutual Fund and Bank of Baroda to discuss how big will RBI's dividend be and what will the likely impact be. Stay tuned.
Well, we'll slip into that short break. You come back, we'll get straight to our top 10 segment. For the time being, I give you a sneak peek into the list. We're looking at Divi's, HAL, Delivery, Premier Energies, Hyundai Motor India. All of them will be reacting to positive news flow. Add to the list Zentech and BEL. On the flip side, Credit Access Grameen and Protein eGov will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. Like we've been saying, the cues are a little cautious across the Asian sphere as well. This is back because of the Moody's downgrade, and in general, some profit taking seems to be the order of the day. There you see the Hang Seng is down about 0.5%. Most of the markets, even Japan, slightly lower. The implied open will come up. The question is whether bulls can continue their charge given the strong performance last week. 9 points down, at least for the time being. Lots and lots of stocks in focus. So let's straight away get to our list of stocks to watch today with our team standing by. Guys, morning to all of you. Ekta, let me start off with you. Divi's numbers, how do they look?
Well, Divi's numbers, looked in line except for the operational performance, which was a beat. So the revenue came in with a growth of around 12% in line with estimates. Margins 34%, Street was anticipating 32%, and a profit of around over 660 crores, which was definitely a positive as well. Now, a couple of key takeaways from the company. They are looking at double-digit growth in FY26. They didn't specify what number they're working with. They're seeing a little more in terms of requests for proposals as well as requests due to the Biosecure Act as well as China Plus One, which is a positive. They are not working on generics in the GLP-1 space, so semaglutide might not be an opportunity for them. They're working with innovators, so that's something interesting to watch out for. Cash on books remains high at over 3,600 odd crores, always a positive. But the valuations might cap the enthusiasm today. It's trading at around 65 times FY26 and over 50 times FY27. So that might water down the expectations. But otherwise, operationally did well.
Okay, all right. Ekta, thanks a lot for that. Well, let's hop across to Ria. She's here to tell us about HAL. Ria?
Well, yes, good morning. HAL is expected to be in focus once again today after very strong commentary from the management in their earnings call on Friday. They have said that their order book now stands at rupees 1.89 lakh crores versus just about 94,000 crores that we saw in last year. Order inflows have also been very strong at 1.25 lakh crores, and going forward they have an order pipeline of 1 lakh crores which is expected to materialize within the next 1 to 2 years. In terms of the outlook, they've said that the revenue growth is expected to be at 8 to 10% for FY26, but they are going to revisit this guidance after 6 months, and the double-digit revenue growth that they are expecting FY27 onwards may happen in FY26 itself. Margins are expected to be maintained at 31% over the next 3 to 4 years. And another important update on the LCA Mark 1A aircrafts, 12 of these aircrafts out of the total 83 are expected to be delivered in FY26 itself after the engine deliveries from GE have started flowing in. So overall, very strong updates for HAL, and the stock is expected to open in the green today.
All right, Ria, thank you very much for that. Delivery is the next one we want to focus on. Mangalam has got details on this one. Mangalam, morning.
Morning. So it's a good operational performance that is coming from delivery this time around, and the bottom line continues to improve. Remember, 3 quarters ago, they had changed their depreciation method, and that continues to reflect on their bottom line now as well. It's the part truckload business where operating leverage was likely to play out, and that exactly has happened. So overall revenues grew about 5.5%, but the EBITDA jumped from 45 crores all the way up to 119 crores. So that's a near 160% jump, and that's reflecting in the margins and the bottom line as well. So the part truckload business has seen a revenue growth of 24%, volume growth of 19%, and margins jumping all the way from 3.2% to 10.8%. That's been the growth driver this time around. Express parcel, however, has been slightly short of expectations, grew by just 3% on the revenue, 1% on volumes, and that's reflecting the weakness that we're seeing in e-commerce as a channel, even as quick commerce continues to do well. They have a cash balance of 5,500 crores, and the next big trigger for them would be the growth of e-com express that they acquired. So to that extent, see some green on delivery today.
Okay, all right, got it. Thanks for that, Mangalam. Let's talk about Premier Energies. Vivek is joining in. It's been a string of actually good earnings over the weekend, Vivek. Premier Energies joining that club?
Well, absolutely right. So, especially when talking about the solar cell, solar module makers, both Waaree as well as Premier, they've actually had a very, very good FY25. Premier has been no different. Just have a look at the Q4 numbers, and along with that, given the fact that the company has also given very strong capex as well as capacity addition guidance. Revenues higher by 44% on a year-on-year basis. We are talking about Q4 consolidated numbers. Operationally, on the back of significant reduction in debt, the EBITDA, core EBITDA, has jumped up 2.9 times on a year-on-year basis. EBITDA margin has almost doubled, coming in at a little over 32.5%. Profitability higher by 2.7 times. The order book quite strong at 5,303 megawatt, giving it a revenue visibility of close to 8,445 crore. Now the order books split modules, solar modules at 73%, cells at 27%. Now the company has also gone ahead and envisaged a significant capex plan of close to 1,250 crore. Now this is an FY28 capacity addition target, which is what the capex will be used for. Cells, the company expects capacity at 10 gigawatt, modules 11 gigawatt, ingots and wafers 10 gigawatt, aluminium frames 36,000 metric tons, and battery storage cell pack at close to 12 gigawatt hour. The management will be joining us later in the day today at midday. It will be important to ask how are the spreads actually panning out, given the fact that there's expected to be significant competitive intensity ramping up in FY26.
Okay, all right. Vivek, thank you very much for that. Hyundai is the other one we want to address. Sudarshan has got details on this one. So, good morning.
Morning, Pradhan. So, after reporting slightly better than expected Q4 earnings in conference call, company believes that export growth especially will be better in FY26, and here growth range is seen in the range of 7 to 8%, and for domestic it believes that it will grow growth would be in line with the industry. On the launches by FY30, it's expected to launch 26 products, and out of that, 6 will be from EV. Also, on the margin front, it believes it will continue to report margin in double digit. Most of the brokerages remain positive on Hyundai. CLSA maintains outperform call and target is rupees 2,155 per share. It believes that company will gain market share in FY27. JP Morgan too maintains overweight call and target is 2,060 per share. And Nomura has a buy call and target is 2,291 per share.
Okay, all right. Thanks a lot for that, sir. Well, let's go back to Ria. She's here to tell us about data patterns as well as Zen Technologies. Ria?
Yes, good morning. We have two more defense stocks expected to be in focus today on the back of their Q4 numbers. The first one is Data Patterns, for which the revenue has gone up by around 117% on a year-on-year basis. EBITDA and net profit have both seen increases of over 62% on a year-on-year basis. Margins, however, have come down to 38% versus 51% that we saw in Q4 of last year. For FY25, for the full year, they've surpassed their revenue guidance of 20 to 25%, and the margin guidance of 30 to 35% has also been exceeded. On the order front, that has been a little weak. The order book is now at rupees 730 crores versus the 1,883 crore order book that we saw in FY24. The order inflow has also missed the full year FY25 guidance of 700 to 800 crores, coming in at just about rupees 355 crores in this quarter. Going forward, the company expects a revenue growth rate of around 20 to 25% and EBITDA margins to be in the range of 35 to 40% in FY26. Moving on to Zen Technologies, good results on this front. The revenue has gone up by around 130% over the previous year. EBITDA and net profit have also seen increases of 174% and 189%, and margins have also expanded to 42.5% versus 35.6% that we saw in Q4 of last year. For FY25, they've surpassed their guidance on all fronts for the revenue, EBITDA margin and net profit as well. And going forward, they do expect to execute the order from the Ministry of Defence for integrated air defence combat simulators for the L-70 gun and FY26 itself. So overall, positive updates for Zen Technologies, and expecting the stock to open in the green today.
All right. Thank you very much for that. Ria, of course, we will be connecting with the managements of both Zen Technologies and Data Patterns in just a bit from now. So stay tuned for that. Very, very interesting conversations coming up with both of those companies. All right, let's now look at Credit Access Grameen. Abhishek is joining in with the numbers for this one. Abhishek, how do they look?
Well, Credit has missed most of the guidance that they had given, which was revised twice in the last fiscal. And despite that, it's a massive miss. Take a look at loan growth. They earlier guided for 23 to 24%, brought it down to 7 to 8% in Jan of 25. However, the actual is minus 3% on a year-on-year basis. Credit cost guidance, which stood at 6.7 to 6.9%, ended at 7.7%. The return on asset, the guidance was about 2.3 to 2.4%, but it ended up at 1.9%. Even the return on equity, which they targeted about 10%, is less than 8% for them. So asset quality is the key reason our gross NPA has increased by almost 25.7% on a sequential basis. So gross NPA ratio is now at 4.76% versus 3.99% in the previous quarter. The net NPA ratio has increased as well to 1.73% versus 1.3% in the previous quarter. They have given FY26 guidance wherein they have mentioned that the loan growth will be around 14 to 18%. Net interest margin will be around 12.6 to 12.8%. However, the credit cost will remain elevated at 5.5 to 6%, which will impact the return ratios. So return ratios like ROA expected at 2.9 to 3.4% and ROE, that is return on equity, to be around 11.8 to 13.3% in FY26. So expect the stock to be under pressure on account of increase in credit cost guidance and the deterioration in asset quality seen in Q4 FY25. Back to you.
No, absolutely. And you know, those tables, those rows give you a clear sense of the many changes and of course the actual number across a range of parameters, and certainly don't look all that great. Abhishek, thanks very much for that. Protein, eGovern and BEL are the other two we want to focus on. Vinny's here with details. Vinny, morning.
Good morning. So starting with Protein eGov, firstly, this stock is going to be under pressure today, what we're expecting. The company has now been shortlisted for the PAN 2.0 by the Income Tax Department. Obviously, they had filed for this request for proposal somewhere around in August. Now, they've got that, they've come to know that they will not be a part of this plan. Now, according to sources, what was said before as well, that government had planned to spend as much as somewhere around 1,440 crores as a budget for PAN 2.0. Equirus says that this is a negative impact that comes in for the company because 50% of their services are actually PAN related services, the revenue contribution. Now, apart from that also, this was a free cash flow kind of a generation that came in from PAN services that led to new initiatives by the company. So this is surely going to impact the initiatives going forward as well. And that is why a red is what one could watch out for. Equitas have have downgraded the stock to a sell, and from a previous ad rating, cut the target price to 900 as well. Even Anand Rathi has said that this will see a sentimentally negative opening today as well in terms of the near-term outlook, but limited impact because offline business is still intact for the company. Now, BL on the other hand, we're expecting green coming in for the stock. They've secured additional orders of around 572 crores, and this is since April 7, 2025 that they've secured this order. This is mainly for drone detection, software-defined radio, as well as some data communication for attack guns, some jammers, stimulators, and AI-based solution also is something that they're working on. So important to watch out for this one.
Okay, all right, got it. Thank you very much for that, Vinny. Let's quickly recap our list of stocks to watch. The ones that have positive news flow are Divi's Laboratories, Hindustan Aeronautics, Delivery, Premier Energies, Hyundai Motors, Data Patterns, Zentech, and Bharat Electronics. Stocks with negative news flow are Credit Access Grameen and Protean e-Governance Tech. All right, let's continue and now talk about commodities as well. Manisha is joining in with a roundup of all the commodity market action. Manisha, hi, good morning.
Morning, and thank you for that, Survi. Well, it started as a stronger note for commodities for the Asian markets right now. Well, gold, after a steepest fall in 6 months, a 3% decline in the previous week and hitting a 5-week lows, has seen some rebound come in right now. That is because the U.S. consumer sentiment has declined for a 5th monthly decline, and it's trading at around record lows right now. Also, Moody cutting credit rating for U.S. Also has supported the gold and silver buying, so 0.5% to 1% of gains coming in for the precious metals right now on the back of safe haven buying. The investors also closely are watching developments in the Iran-US nuclear talks. 4 rounds of conversations already have been done, and Iran president said that the country will continue talks with the U.S. over its rapidly advancing nuclear program, but will not withdraw on its right. So this conversation is far from over. After precious metals, if you look at the energy markets, we are trading positive on that as well. We've seen 2 weeks of gains, 2% of gains in the previous week, and we seem to be continuing extending those kind of gains right now in the Asian markets. And same goes for many of these metals as well. Can't say that for aluminum, which is down 1.5% right now. But copper, steel, zinc are trading in the positive. Markets are anticipating better, improved demand coming in from China going forward, and that's keeping the prices higher.
All right. Manisha, thank you very much for that. So that's commodities in focus. We take a quick commercial break here. We're going to come back with the management of Zen Technologies on their 4th quarter earnings. Stay tuned. Coming up in just a bit from now.
Welcome back. Well, like we promised, in a short while from now, we will be discussing the quarterly updates and, of course, the P&L with Zentech. Before that, let's get you an update with Parikshit as well amidst all the ongoing issues at the border and, of course, Operation Sindoor. The Defence Acquisition Council has granted the Indian Armed Forces the right to procure necessary artillery under emergency procurement powers. Parikshit is joining in with more. Parikshit, morning. So tell us, I think replenishment is what everyone is talking about. So what does this really imply in terms of the procurement by the Army or the Air Force?
Well, yes, the focus would be on procuring loitering munitions, anti-tank guided missiles, artillery shells, counter-UAV drones, which have been used in Operation Sindoor recently. And the government is now looking to fill this gap up in the next 6 to 8 months. Now, as per the rules, emergency procurement can happen to the extent of 15% of the defense modernization budget. Now, for FY26, the defense modernization budget out of the total outlay for defense was 1,60,000 crore rupees. So we're looking at an upper limit of 24,000 crores immediately in the near term. But government sources tell us that the actual expenditure may be less than that. This is because the deliveries have to be made within a year period. So we're looking at finalization of contracts within the next 40 days. Deliveries within the next 1 year is what the Army, Air Force and Navy are looking at. And this is for all three services. Industry sources have been telling us that there have been regular meetings with the Ministry of Defense. And there is an expectation, there is a belief that the government would be placing orders worth 40,000 crore rupees in the next few weeks. Now, how is that structured? That remains to be seen. But this is what the industry is working with. This is what we learn. And currently, these are the orders which have been given to the three services, empowering them to go for emergency procurements.
Okay, all right, got that, Parikshit. Thanks very much. Very helpful information. And we'll keep this in mind as we have our conversations with a lot of the local defense suppliers. In fact, let's get to one such conversation immediately. As promised, we have the management of Zen Technologies joining in. Mr. Ashok Atluri, Chairman and Managing Director of the company, is with us. And it's been a really good quarter and a pretty decent year for Zen. I'm just recapping the numbers. In the fourth quarter, revenue is up 130%. The margin has zoomed up to 42.5%. And the profits, they've soared from about 35 crores in the Q4 of last year. The profit now is at 101 crores. And even for the year as a whole, 121% top line growth and profits, also moving up substantially. Congratulations on a good year and a good quarter, Mr. Atluri. Now, let's talk about this. Exactly what Parikshit was saying, that I guess the procurement timelines are getting crunched. And there is major ordering that's going to happen. Talk to us about both your anti-drone part of the business as well as the flight simulators. Anti-drone, I don't know if some of your equipment was already used in the last 2 weeks or not. But basically, what kind of growth can we look at? Some numbers will help. We all know the opportunity and the environment around us.
So, our anti-drone systems were used in the operation, and, we are very, very happy that, all the investment, self-funded R&D paid off for us, and we have got very good feedback from the armed forces. And we as Zenith, we feel very proud that this happened. And with respect to the, the orders that we may expect, we, as the industry, whole of the industry has been discussing with the armed forces. We have also been very much engaged with them. And we do expect, some fast action to happen in this regard. But the quantum and the time is unknown at this point in time. And, we currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. I think they're simulator related, but again, they are also reasonably large. And so, yes, the order book orders seem very, very likely in the short term, yes.
On drones, let me start with that part of the business. It's a smaller part of your business right now. I think it's about 25%. That's the split. Yeah, 27%, I believe, of your order book.
Yeah,
on drones, yeah, please continue.
Yeah, on the total, almost it was, the simulators were a little more than for the year last year, the execution. But these keep moving as we keep getting the orders. They're very, very, but as of now, we're almost like, 50-50 in both the segments.
So I'm just trying to understand in terms of fresh procurement, I'm talking only about the anti-drone part of the business. Can you tell us how many, orders, what are the conversations in terms of quantum? What's the pipeline looking like?
So this is the ongoing conversation, and we are definitely not aware what will be the size of the thing. but the feeling is that it could be very large, and to exactly pinpoint and tell that this is the figure is very difficult at this point in time.
Mr. Alduri, two questions. One, would you want to give us a guidance? Morning, Prashant here. Guidance for F5. I think your long-stated guidance has been, it should be about 2,000 crores in top line by F527. That you maintain that?
So yeah, what we have said is that, on a cumulative basis, we should be going at a CAGR of 50%. And for the financial year, this financial year, next, and then up to FY 26, 27, 28, we should be growing at that pace. That would be a little more than 6,000 crores of cumulative turnover. We still stick by that. And but this year, we feel that it may be a bit muted because of the delay in orders. But I think things are improving very fast as we speak.
Mr. Alduri, you said 6,000? Because you're at...
Cumulative over the next 3 years, 6,000 crores,
So you're at 900 odd crores now.
That's right, yeah.
about actually closer to 1,000 crores. You're saying this number should move up to 6,000 crores cumulative
over 3 years.
Yeah, over 3 years. It's 900, 1,350, and 2,000, and then 3,000. Yeah, that's how we are trying to do that with a 50% cumulative growth rate.
So for this year, we are working with roughly around a 50% growth at least, right? So
that's what I'm saying. It's cumulatively it will be there, but this year it's going to be a bit muted, Nigel. Yeah.
Got it. All right. But the cumulative number, that is on an average, if I take an average for the next 3 fiscals, it should be roughly around 2,000 crores. Because 1 year you could do 3,000 crores, another year you could do around 1,500 crores. Are we getting that point correct?
Yeah, it will be
the summation of the revenue. Got it.
Overall, it should be growing only, yeah. But I think that's what the whole point is, yeah.
All right. Got it. A quick question then. Last time we chatted, you said you're expecting good amount of order inflows. And your order book for the kind of growth you're looking at, well, it's a little bit subdued, at least as of now. But you said that there is good amount of inquiries. And in the pipeline as well, there could be some orders that will be executed. For the year, what kind of order inflow are you looking at? And for the first half of the year, I think you were hinting at roughly around 500 crores of order inflow. Is that on the cards?
Yeah, so we were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. We should be getting those orders, but with the new situation, I think the order book position will be substantially higher.
Okay, all right. And Mr. Alduri, at least for the year, you're saying it'll be a little softish here, but year and now is what the market's interested in, right? So for the year, you want to give us a broad range. What kind of... we take that on board. FY26 could be a little bit subdued in terms of execution. And then 27 and 28 will be better. But you want to give us a rough range?
So Nigel, the thing is that once we get the order, things are under our control and we are able to predict. That's how the order book position was. But the orders have to be given by the government. Unless we get the order in hand, the total execution for the year will be very difficult for me to...
All right, Mr. Alduri, very quickly. This year, the numbers look good. But the OCF is still negative, operating cash flows. Next year, you'll fix the problem? Will we have a positive number?
Yeah, it will definitely be a positive number, but this is being, the cashes are coming because the government, there is a little delay.
Yeah, receivables have moved up.
Yeah, absolutely, yes, yeah. Yeah, they'll get corrected. That's just a matter of time.
So a positive OCF number we look forward to in FY26.
Right.
Any new acquisitions? You've done a few smaller acquisitions in your space. Anything else we should expect, Mr. Alduri?
We are on the lookout, and we expect that something may happen during the year, but not immediately. But during the year, the discussions are going on with a couple of companies. But till they happen, they don't happen, kind of thing. So we'll just hold it till we actually finish the acquisition.
Just one thing I want to clarify: what we began with, what Surabhi began with, when we talk about replenishments in your business, on the anti-drone side, there's no replenishment in that sense, right? Or is there? Because those would be on the munition side, drones carrying munitions, etc. Am I correct?
Yeah, the thing is that first we have to acquire. The acquisition has to be completed, to fulfill the requirement. That itself isn't completed. Once it is completed, then for companies like Zen Technologies, we get annual maintenance contract for about 8 to 9 years after the warranty period, and then after 10 years life cycle is over, they replenish the equipment again.
Okay, all right, got that. Thank you very much for joining us. Good speaking with you, and good luck to you and your team as you continue to execute. So, things coming in from Zen, stocks done very, very well. over the last 5-6 days. Actually was one of the best performing names last week in a sector which of course has really done very well. Deepan Mehta is with us, Director at Elixir Equities. Deepan, good morning, good to have you here. Sorry, coming to you a little late, but you heard the management of Zen, and again, defense is a kind of a constant theme with us. We are later speaking with data patterns. What do you, what to do with the space, what to do with stocks, Deepan, in your assessment? Big run-ups.
Yeah, Prashant, good morning and thank you for having me on your show. I remember going to Zen Technologies plant in Hyderabad 20 years ago, and I had bought the stock also, but then it was not going anywhere for so many years. And then I, threw in the towel and sold the stock. I wish I had held it. It's been a fabulous multi-bagger, and it's in a super space to be in, the right place, right time at least for the company. And I think great prospects. Very good interview. He's targeting 50% turnover growth, which is fantastic. Parat may justify the very rich P multiple it is trading at. So very positive on the stock, but would look to buy at declines because valuations are certainly on the higher side. Also, one needs to remember that if you look at the history of the company, there's a lot of volatility in the earnings because of the government procurement plans, and order book position may change quite a bit quarter by quarter. But nonetheless, I think great prospects for the company. And even with data patterns, I think across the board, we are seeing very good interest in defense. I know it's a great story for next 2-3 years, but look, valuations are on the expensive side. So I'd wait and watch and try and buy at declines.
Just to make that point, Deepan, we are at CNBC-TV18, we used to put out a mid-cap mania, a segment long time ago. And I recall covering the stock at around, explaining the stock at around, I think, 100 rupees or thereabouts. And then I got so much of this feedback, even I was wondering, what's happening. But at that point of time, the story was more about the simulators. Yeah. And then it seems the bull sat on the drone and, that's what took off. So, something else played out. And that's why the stock has done. But I remember that period when there was no orders that came in for multiple years as well. So it'll be just, to alert our viewers. We had explained the stock long time ago.
Well, and look at it today, fully discovered. Actually, still not at its, 52-week high. It's still off. The high was
at 1,000 crores, we explained it. At 1,000 crores.
Yeah, I was like 100. Wow.
at 1,000 crores, the share price was 100.
Oh, at 1,000 crores market cap,
yes.
And the share price was 100. Whoa! And look at it today, 1,700 plus.
A viewer just told me, that's why I remembered it.
All right, we need to take a very quick break on that note. Come back on the other side. We'll just keep discussing more fundamental ideas and also get you the technical setup of the market today. Back with our technical experts in just a bit.
Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to our technical experts. We have Sudarshan Sukhani and Shilpa Rao to join us for a technical check on the market. Good morning, lady and gentlemen. Thanks a lot for joining in. Shilpa, you go first. Tell us what's your take with regard to the Nifty. We've had a very, very good run. We're holding at around 25,000 odd. What would your trade be?
Good morning, Nigel, and thank you for having me on the show. Talking about the indices setup, we see definitely a bullish setup that is happening. Nifty has surged above 25,000, and this sustenance here will definitely see the next levels of 25,500 coming in very soon. So any declines towards 24,800 should be a buying opportunity and go long till 25,500. Talking about Bank Nifty is definitely heading towards 56,300 zones. So again, a decline towards 55,000, 55,200 should be again a good opportunity to go long and stay for targets till 56,300.
Okay, got that, Shilpa. Sudarshan, morning to you as well. What would your approach be? Trading bias for today?
Yeah, good morning. See, after a big move, the Nifty normally consolidates. And that's exactly what happened on Friday. And the chances are that process will continue today also. So for the Nifty to buy at current levels for a short-term trader is not a good idea. You have to either wait it out, let the consolidation be over, it will be done in 1 or 2 or 3 days. Or if you get a sharp intraday dip towards 24,800, that's an approximate zone. If you get a dip to that zone, go and buy it. Your stop should be 24,500. If you don't get that dip, just step aside, focus on stocks.
Okay, let's get straight to stocks then, Sudarshan. Tell us individual stocks, what are you looking at?
Well, ACC is a buy with a stop under 1880. Bata India is a buying opportunity after many months. It's with a stop under 1220. Maybe it's putting its act together, maybe. Colgate is another buying opportunity, same FMCG pack, stop under 2630. And Hoodco from the NBFCs is a buy with a stop under 229. It's a variety of sectors, but not the index.
Okay, all right, got that. And Shilpa, what about you?
I have a buy in Titagar. Titagar is having a splendid run, and the sustenance above 900 is definitely showing that it has more strength to see. So 960 to 980 levels can happen in coming days. So keep a stop at 880 and stay long in Titagar. The other one would be a buy in Hoodco. Of course, Hoodco already the levels have been given. So I will also stick to 220 levels as a support and look for targets of 260. And the third one would be a buy in Tube Investment. Tube Investment also is looking very positive. It has sustained above 3,000. And from here, the levels of 3,300 should come.
Okay, all right, got that. Thank you very much, both of you, for giving us some of the trades. We'll come back and get to more ideas in just a bit. Right now, I have to take a very quick break. Back on the other side, we'll have the pre-opening rates, and also we'll have the management of Galaxy Surfactants joining in to talk about the fourth quarter performance.
Okay, welcome back. There's a minute to go for the pre-open session, and there is a fair bit which we got to track and discuss. Deepan Mehta is with us with what he thinks of the markets, stocks, etc. Deepan, thanks for waiting. You know, towards the end of last week, one of the names which came under intense focus once again was IndusInd Bank for the wrong reasons once again. Any thoughts here with that newfound accounting problem in the bank? I mean, markets, if you look at the stock reaction post that, there was a knee-jerk reaction, but that was bought into. Markets are looking ahead. What's your sense?
Yeah, Prashant, very disappointed as a shareholder of IndusInd Bank that the bad news keeps on coming in. And really, I think from an investor's perspective, I would like to say that the trust factor is lost with the bank. I'm not sure it is going the Yes Bank way, or there are even more frauds or something like that. But the way the bank has been managed over the last few years or so certainly is very disappointing. And I do hope this is amongst the last of the negative disclosures which they have. Look, you buy into the bank because it has distressed valuations, and still the core operating model, the brand, the middle level management team, the technology platform, all of that is state of art. I mean, it's pretty decent compared to its competitors. And investors have in mind that, other banks like Axis, ICICI, also they had their own situation when there was a lot of turmoil in the management and as well as in the business of the company. But then they recovered very well under a new CEO. Something similar could play out in IndusInd Bank also. Let's see who the new CEO is and what their vision is and how they rebuild the top level team. Because the foundation of the bank is strong. It's just that it seems to have lost its way for the last few years or so.
Oh, yes. And those hits keep coming, as they say, right? That's the problem with IndusInd Bank. Take your point, Deepan, on this. I want to draw your attention to Bharti Airtel, because Bharti is doing something very interesting, right? I'm sure you've seen the weekend news flow. Now they've gone and told the government that relief should come to everybody on AGR. Why just one company? Why just Vodafone Idea? And they're saying that even our operations will be impacted because of the penalty and the interest. At least waive that off. Not sure how this plays out, but how are you watching this space? On Friday, Vodafone said that we cannot continue operations beyond FY26. The government needs to do more. Your thoughts on these telecom stocks?
Yeah, I think whatever the outcome of this is, it's going to be positive for Bharti Airtel. And on the whole, I think I was very impressed with the set of numbers. 17% increase in the ARPUs, that's the yield for the company, is very impressive and still at a low level and considerable scope for increasing. Free cash flow also will start to move up. And I think that next 2-3 years, it can still go at a compounding rate of about 15-16% or so. So very positive on Bharti. It's a company in which we and our clients have an investment. And I think if Vodafone is going to get impacted, then a lot of the subscribers can flow to Bharti and Reliance Jio. So they'll take even more advantage of the duopoly which they are in. And any relief from the Supreme Court will be more than welcome. So very positive for Bharti Airtel, amongst the few Nifty stocks which have been able to sustain a high teens compounding growth for the last 10 years.
By the way, check out Protean in the pre-open. The stock is down 19%. The news is that the company has not been shortlisted by the Income Tax Department for the PAN 2.0 project. And this obviously is going to be a big blow if this is how it plays out. Let's see if this is the final word on it or not, because Protean has been doing a lot of the back-end architecture for PAN and for other things like ONDC as well. And this could be a bit of a blow. Very quickly, Deepan, your thoughts? Otherwise, the stock was doing really well, an institutional ownership, etc. But this has come as a rocket out of nowhere.
Well, I think, this is client concentration at its best for you. Those risk factors exist. And Protean per se also was trading at very expensive valuations for a company where growth for last 5 years have been pretty much stagnant. So I think perhaps the move is justified, but let's see, understand exactly what the outcome of this is from the management, I guess.
Any other sort of stocks, etc., come your way? Anything which is still a little out of whack, dislocated valuation-wise, Deepan?
No, these markets are priced to perfection over here, and we are really struggling to find good quality stock ideas. My understanding so far is that this earnings season has not been that great. It's not been across the board better for all the companies. Even within the sector, you have outperformers and underperformers. So I think life for the next 1 year or so is going to get a bit tough for fund managers and investors, where they have to find selectively good quality stocks to invest in. It won't be across the board. So I'm just kind of analyzing what numbers have come through so far and trying to make out a shopping list, but it's not ready as yet, and I'll share it once I have something interesting to discuss.
All right, Deepan, we leave it there. Thank you very much for joining us. It's always a pleasure having you here on CNBC TV18. Nigel, we have the management of Galaxy.
Well, that's right. Let's focus on Galaxy Surfactants. They reported their Q4 numbers. Last year, it had various challenges. But let's find out what's the path ahead. We're joined by Mr. Natarajan, the Managing Director and CEO at Galaxy Surfactants. Hi, Mr. Natarajan. Good morning, and thanks a lot for joining in. Well, let's get two of the key numbers out of the way first. What kind of volume growth are you looking at for this year? I recall last year you were aiming for around 6 to 8%. This year, what kind of a number are you looking at? And the EBITDA per unit, that's the other one. I think around 20,000 is what you were guiding for last time around. So let's get both these two numbers out of the way first.
A very good morning. Thanks for having me on your show. As regards the volume growth, we would want to maintain the momentum that we have generated in Q4 and probably be still at the lower end of the guided range. We grew by almost 4% last year. We should be targeting doing that. And with regard to EBITDA per metric ton, there was a good momentum that picked up in Q4 compared to Q3. And we would want to be in the guided range of 20,500 to 21,500 per metric ton.
Okay, all right. Could you give us a broad sense in terms of your mix as well? Last year's specialty care revenue, well, that in fact saw volumes that were more or less flattish. Well, you had a mid-single digit, I think, in the performance surfactant. For this year, what kind of a revenue mix are we looking at, sir?
In fact, see, India has been, from the second half of this year, India has been a challenge, as all of us know. And the masthead specialties in India, majorly, and to some extent in Africa and Middle East, Turkey got impacted. India was more because of the demand momentum decelerating. Whereas for Africa and Middle East, Turkey, it was more to do with the sort of supply chain challenges that we had. Moving forward, we expect the growth to pick up in specialties, masthead specialties as well. India, yes, we would want to be a little bit cautious as most of our customers are expecting the momentum to build up only from H2 of this current financial year.
Speaking of various geographies, sir, what is your mix between India, rest of the world and the other key markets? And also, I mean, what is the exposure you have to the US?
Yes, so India typically is about 35 to 40%, and your Africa, Middle East, Turkey at about 30%. And the balance is rest of the world. US is about 10 to 12% of our revenues.
And what are the conversations? I'm sure the last 1 month or so, you would have been in discussions with clients, sourcing, supply chains, all of that, because of what's going on. What's the sense? If the tariffs, I mean, they were announced at 26% blended. We still don't have individual product tariff lines. But what is the increase that you're baking in that you think that your customers will be willing to pay for? Will it impact your operations or not, specific to the US?
No, we see with regard to the US, the most important stuff is not about what are the sort of reciprocal tariffs that kick in. We are still into the 90-day suspension period. But all the customers whom I met over the last about 60 days are pretty apprehensive about the implications it will have for the demand growth. They expect that there'll be no choice but for them to pass on the increase to their consumers. And that certainly is going to be having a huge implication on the demand growth. But as regards the products that we supply into the US, there are some products that we do import from China, but then that's not something significant into our US operations. Whereas what we export into US from India and is nothing that is going to be significantly impacting us. Whereas from Egypt, there are no reciprocal tariffs. So that leaves us in a good spot.
Okay, all right. Just a quick question on fatty alcohol acid prices. That doubled in the past year, right? And there were hints that maybe that will cool off from here on. In the first quarter, what kind of a range are you working with on this pricing? And do you expect it to correct as the year progresses?
Yeah, so as we are talking, I think the prices are closer to $3,000 per metric ton if India. More than that, there have been huge issues in terms of on the supply side because Many of the plants are shut down. There has been some gas outage in Malaysia due to the issue at Petronas. It's just limping back to normalcy. So we have, on one end, you have the prices which are elevated pretty significantly high. And on the other hand, you also have supply side challenges that have come into the last 2 months. The prices we do expect with the high harvesting season now, I think should start cool down. And that hopefully should be able to give some strength to demand momentum building up in India, because India is pretty challenged in terms of high inflation on the commodity front.
Okay. All right, so we'll leave it on that note. Thank you very much for joining in. Appreciate you telling us more about the business. That's Galaxy Surfactants talking about the outlook ahead. Let's also look at the pre-open rates. It's very quiet right now on the market. Nifty is not doing much. It's more about individual stocks. Protean, like I mentioned, Protean has to be on our radar, and we'll try and touch base with the management as well and see what they have to say. With this income tax department googly coming in, that PAN 2.0 will not include this company, which has been a huge part of the back-end infrastructure so far in services like, tax and PAN. Anyway, for the rest of the market, it's still the same theme. Some of the defense stocks, they're still running. The ones that have come out with good numbers, Zentek, Data Patterns, they're up 4-5%. BEL, the bigger names, are also up to 2.5%. But aside of that, it's a pretty quiet sort of an opening. That's the indication that we are getting in right now. Let's quickly get to our technical experts then. Sudarshan, 9-10 call?
Well, it's Hudco. Consider buying Hudco with a stop under 229.
Okay. All right. Got that. Let's quickly move on. Thanks for that, Sudarshan. Let's quickly move on and address some specific stocks as well. Mangalam is here. Mangalam, delivery. Let's recap the performance once again.
Well, the margins delivered this time. Let's put it that way. Because if you look at the numbers, good operational performance coming in. They had changed their depreciation policy a couple of quarters ago. So that continues to reflect on their bottom line as well. If you look at it over the, last year, the revenues grew just around 5.5%. 2191 crores is what they, reported. But if you look at the EBITDA, that's jumped from 45 crores all the way up to 119 crores. And this has been led by their part truckload business. And that's exactly where the big change has been. If you look at the part truckload business, which is not their biggest vertical, but definitely the one that caused the most amount of growth, 24% jump in revenues, led by 19% jump in volumes. This has now, stabilized after the increase that we've seen in their business through the spot-on acquisition. Margins have jumped all the way up from 3.2% to 10.8% itself. We have the express parcel business, which is the mainstay of the company, that has seen some slowdown, but that's in line with the slowdown that we've seen in e-commerce as a channel itself. We've seen growth in quick commerce, but not so much in e-commerce. And total cash balance at close to 5,500 crores makes them a lot more stronger than what they were earlier. And remember, scaling up of their acquisition of Ecom Express will be the next big trigger for delivery. So to that extent, see the stock to be in the green today.
Okay, all right, Mangalam, thanks a lot for that. Well, let's go across to Ria. She's here to tell us about HAL. Ria?
Well, yes, good morning. HAL is expected to be in focus once again today after very strong commentary from the management in their earnings call on Friday. They have said that their order book now stands at rupees 1.89 lakh crores versus just about 94,000 crores that we saw in last year. Order inflows have also been very strong at 1.25 lakh crores, and going forward they have an order pipeline of 1 lakh crores, which is expected to materialize within the next 1 to 2 years. In terms of the outlook, they've said that the revenue growth is expected to be at 8 to 10% for FY26, but they are going to revisit this guidance after 6 months, and the double-digit revenue growth that they are expecting FY27 onwards may happen in FY26 itself. Margins are expected to be maintained at 31% over the next 3 to 4 years. And another important update on the LCA Mark 1A aircrafts, 12 of these aircrafts out of the total 83 are expected to be delivered in FY26 itself after the engine deliveries from GE have started flowing in. So overall, very strong updates for HAL, and the stock is expected to open in the green today.
Absolutely. It's still defense focus that continues. Ria, thanks very much for that. And some of these stocks are actually holding out fairly positive. Delivery, Data Patterns, NBCC, these are some of the names. Newsmakers on the upside. Then there's, of course, Zen and, the others that are still holding up. But other than that, it's extremely quiet. You can actually argue that this would be a better opening than what the global markets have been indicating, remember, because US futures are down between 0.5% to 1%. because of this Moody's downgrade, general sense of profit taking, a little bit of a pause after the rally. Asian markets have been a little downbeat as well. So compared to all of that, maybe, a flat opening is par for the course. We've also had a good run. Remember, the Nifty is just about 4.5% away from the all-time high. The cap index is about 6.5% away from the all-time high. So it's been a very solid showing. Slow and steady wins the race, as they say at times, right?
Well, that's right. We'll see how a few of these companies go as well. Credit Access, Grameen, one of the casualties, I think, this morning, besides Protein E-Govern. Protein E-Govern is down 18-19%, but Credit Access, Grameen as well, down close to around 5%. But the final 10 seconds, we've got the pre-open rates up for you on the screen, but now, in fact, the markets do open. So let's get straight to the action, Prashant.
Let's do it then. Let's just have the first rates, which will come up on your screens. It's 25,000 on the Nifty. It's Nifty Bank, which is starting at about 55,357. It's absolutely quiet, nothing. The Sensex is down about a quarter. The small cap index is up 0.6%. So broader markets, at least at the word go, at least in terms of open, looking a little higher as compared to the large cap indices. A quarter and 0.6 on the mid and small cap indices, respectively, is what you have. What is coming up on the Nifty heat map? So nothing big, I'm assuming. It's mostly evenly split between what is up and what is down. I can already spot the lone defense name on the Nifty stock index, which is at the other one end of the gainer spectrum. It was all defense. I mean, there is only actually, it's of course great news for the sector, but it's also quite telling for the market that actually that was the only sector which really has been standing out actually the last, 5, 6, 7 days now. Infi is at the other end, but I can spot TCS as well, and HCL Tech and Tech Mahindra. So it's a bit of a IT on the other side of the spectrum. So that's the Nifty heat map, which is coming through right now.
It's like a one-trick pony, as they say, right? And for the market, defense has become that over the last 2-3 sessions. Even this morning, Mazgaon Dock, Cochin Shipyard, Garden Reach Shipbuilders. There's still some, trailing momentum left in these stocks, 4 to 5% higher, 7% for instance in Cochin. But other than that, it's extremely quiet. Let's talk about the Nifty now. IT is down. TCS, Infosys, HCL Tech, all of IT is lower. Tech Mahindra, all of these stocks are lower. So that's one problem. IndusInd Bank is falling more. IndusInd is down about 0.5% right now. By the way, in the last 1 year, IndusInd is down 45%. That's the kind of wealth destruction that has happened over here. So these are some of the weaker spots. The Bank Nifty is very flat at this point in time. If you talk about the majors like HDFC Bank, totally flat, directionless. Ditto for ICICI Bank as well. Let's look at Reliance. Reliance is about 0.5% lower. I'm looking at all the heavyweights right now just to get a sense of direction. Flat to negative, that's what you're getting. L&T down about 0.25% as well. So let's see then what's up. What is, the little bit of green that we have. BEL, JSW Steel. Again, it's more of the material commodity kind of plays. JSW Steel, ONGC, these are some of the stocks on the upside. There's still some buying on auto, by the way. This is what we saw last week as well. So Bajaj Auto, Tata Motors, Eicher Motors, some buying over here. But other than that, it's very, very quiet. Not even 1 point up or down on the Nifty. Nigel.
Well, that's right. From the broader markets, but there are stocks that are moving around. You have Banco products. There's one of the big volume movers. You just have to check what is the market cap. But for the time being, that one, in fact, has opened up. Gap up. It is up close to around 20%. 7,000 crore market caps are not too small. Those results look pretty good. So that explains why that stock is flying away in today's trading session. A couple of other big movers. Data Patterns is up 6.5%. We'll get the management shortly. Mangalam said delivery delivered this time around after a while. So the stock is up 6.5%. Good move out there. KRBL, we'll try to get the management in, later on in the show, or maybe in the next hour or so. So that one, in fact, is up close to 6.5% post its numbers. Good up move is what we're seeing out there. PNC Infra is well up 5.5%. So smart move on that particular counter as well. So there are a fair bit of winners out there. Zentech, I think, should be already mentioned that. That stock, in fact, is moving from strength to strength. So the markets as we speak, well, the mild dip has got bought into. Stocks are moving to their own tune, it seems. And we made this point last week, right? The Nifty is at around 25,000, but portfolios are not feeling like 25,000. Well, now, in fact, we do see the broader markets in the last few trading sessions have actually been doing an outperformance. A couple of stocks are under pressure. JG Chemicals stock is down close to around 4% as we speak. In reaction to its numbers, I recall one of those stocks that rallied big time in the last week. It seems the street wanted something more out there. So that's why that stock is seeing some correction.
There's a bit of a PSU play. I just want to mention that over here. Railways and PSUs in general, little bit of gains here and there. So Aircon, RVNL, NBCC announced some orders as well. They've, I think, sold off some apartments in Noida. So that, things like SJVN, NALCO, IRFC. It's a bit of a PSU play. Even the PSU Bank, Central Bank of India, IOB, UCO Bank, all of them seeing a little bit of green.
I think this is the railway stocks actually. When I looked at Friday to Friday towards the end of the week last week, some of these RITES and Aircon, etc., showed up as the big gainers last week as well. So maybe some continuing momentum here. Big volumes, 2 million shares on names like Aircon. But by the way, it is still all defense, I have to say. The top 3 stocks on the volume-led gainers list on the NSE are all, there's Cochin Shipyard, which is up 6%. Number one sort of volume-led gainer right now, 2150. It's gone up like a rocket. 100 rupees a gain now, 2.6 million shares traded. Data Patterns is up 8.5%, and you'll hear from management shortly. And then there is Paras Defense, which is up 5%, so 1880. So these are the 3 largest volume-led gains coming through. And Premier Explosives, 14% on that one. So that is coming up with very large volumes as well. Not Premier Energies, Premier Explosives, that's 562 with very, very sharp gains at this point in time. Astra Microwave is up about 4%. So it is, again, not just in the top 3, but outside of that top 3, top 5 list, there's a fair bit of defense smattered around with regards to gains that we have on our hands. Let's actually start with that, right? And let's get somebody on who is really a keen observer of course, businesses, cycles, but also, doesn't take his eye off valuation. Sanjeev Prasad is our guest on the program, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Good to have you with us here on the program. Thanks for your time. So let's just, if you allow me, defense, Sanjeev. It's a large space now. It's not a small space in terms of market cap, etc. What are your thoughts? What is your view? What's to be expected that after Operation Sindoor, there would be a sharp spotlight on this entire space, indigenization, replenishment, etc. But when you're investing, you've got to have an eye on what you're paying as well in terms of valuations. So that's my question to you, Sanjeev.
See, first of all, defense theme is great. Obviously, given whatever is happening in the world, geopolitical uncertainty has clearly increased a lot of risk of more conflicts, etc. Obviously, the government of India also needs to do the necessary and invest more in defense. Having said that, there are 3 important things to keep in mind. The nature of future warfare is going to be very different from what we have seen in the past. So whether India should be investing in conventional, weapon systems or completely new weapon system, that is up to the government to decide. But one thing is becoming more and more clear, war is going to be very, very different in the future. And as you would have noticed, some of the hardware, which was very, traditional hardware, which was used in, let's say, most of the traditional wars, they have all proven to be rather useless in the new kind of warfare that we are seeing. Biggest example is tanks, as an example. They got badly exposed in the Russia-Ukraine war. One precision missile, even from a shoulder-launched rocket, can take out a tank now, and you're wasting so much money over there. Similarly, if you look at aircrafts, they're really as useful as they used to be in the past, given the fact that you have drones, which seem to be a lot more, useful, much more cheaper. Battleships, again, a big question mark. They are very slow moving, and again, given the nature of warfare, could be badly exposed, against missiles and drones and missiles, So there has to be rethink in the kind of equipment that India needs to have, obviously, and accordingly, investors also need to take a call, whether they should be investing in the traditional hardware type companies or in the newer, companies which have, weapon systems which are more, designed for the modern warfare, which could be very, very different from the conventional war. So that number one.
Yeah, Sanjeev, and by the way, we should have all the defense stocks at the bottom of the screen because, or maybe on the side, if we are already showing it, because that once again is the sector of the day by far. And many new names have now joined the leaderboard here. What should investors do though, Sanjeev? Again, it's come down to what company, what are you paying? So what should investors do, viewers who are watching?
It's a very, very tough call. People are simply buying into narratives. See, first of all, what will the government, who will the government give orders to? How do you know, first of all? People just buying in anything and everything without looking at, whether the nature of what's going to the same as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make, really, very little sense to me, at least. If I look at, let's say, something like a potential shipyard, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores. Once again, and the profit which it had done, not much this year. So that's the whole struggle for me. When I look at many of these companies, that kind of valuation these companies are starting to get now doesn't make really much of a sense, to be honest with you. Sorry, Cochin Shipyard.
800 crores. Sanjeev, 800 crores in profits.
800 crores profit, 55,000, so that's 70 times, right? Net worth is about 50 billion, so 5,000 crores, 55,000 crores market cap, so that's 11 times, net worth. Is that really such a valuable company? I don't know. Maybe in the future we get a lot more orders, and it needs a lot of orders to justify the kind of market cap the company is trading at in the context of the net worth or the PAT, whichever way you want to look at it. There are many such examples, Musgao Dock, 1,40,000 crores market cap, 5,600 crores net worth, that's it. I don't know, I only have the 9-month numbers. PBT was about 2,700 crores. Investors can take the call on valuations, and decide whether it makes sense or not.
So what is a reasonable valuation to pay in that sense, Sanjeev? Or is there one? Or how do you assess?
It depends on the type of company, and I can't make a generic,
No, you have coverage on anything, Sanjeev, here? I think BEL, etc. you would.
BEL and Cochin Shipyard.
No, if I could just, ask a final question on this and then we'll move on, Sanjeev. Again, one of the narratives or one of the talking points that I heard in the last couple of weeks was that you need to go beyond just looking at P&L and traditional price to earnings while looking at the defense opportunity. These are very large order books, and the money will come, but it'll take time for the order books to translate into P&L. So this gentleman was talking about not ignoring the large order book while deciding on whether the stock is overvalued or not. Your thoughts?
Sure, you can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Cochin Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores here. To take 10% PAT margin, you will make about 5,000-6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier, and that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PV of the 5,000 crores of PAT opportunity which Cochin Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there's no way you can justify this kind of valuation.
That's a strong argument and absolutely one that we've taken on board. And I think investors need to hear all sides before they decide what they want to do, because the stocks have indeed run up big time. Okay, that's a lot of defense, Sanjeev. Now let me broaden this out. Let me ask you about the market as a whole. The thing is that I think in an environment where not too many sectors are giving you growth, maybe that's why people are latching on to wherever they see opportunity. Overall, how do you rank the earnings season and what lies ahead? Do you see at least 12% earnings in FY26 and then tie that with the market valuation?
12% looks too optimistic, I would say. We have only 10% now for FY2026. That's for the Nifty 50 index. And that is also at some risk because we don't know what happens to many of the global sectors eventually, in terms of growth, given the challenges which many of the countries are facing. You have a lot of uncertainty on the trade tariff issue, which I will talk about later on. So in that context, 22p for the market on March 26 looks on the higher side. The more important thing is not to look at the index as a whole, because anyway you're not going to buy the Nifty. We are going to buy individual stock. The bigger problem still remains. I made this argument several times. So in most cases, multiples are significantly higher than historical levels, or far lower growth and a lot more uncertainty, far higher global interest rates. So in that context, many of these stocks don't really make any sense. When we look at India Consumer Staple Company, most of us are trading between 40 to 60p. The kind of volume growth this company reporting is, Lever is down to 2% now. Nestle had hardly any growth last year. I mean, hopefully things will recover. But even if they go to 4-5% volume growth, some inflation, some premiumization, it is very tough to justify 50 PE multiple now. If you look at when they were trading at 50 PE multiples, they were going much faster. So that is the whole challenge, and this is true pretty much across the board. Every sector you're seeing the same problem of very high valuation. Coming to the market, obviously sentiments have changed very dramatically. In the last 1 month or so, we have gone from absolute despair around when the reciprocal tariffs were announced to some amount of relief when the reciprocal tariffs were suspended to complete euphoria now. Now, if you look at the reality, what has changed? All we know is that the reciprocal tariffs have been postponed. They have not been removed. And I think investors need to really appreciate this basic point that we are on hold for 90 days, 40 days already over. We need to see, where tariffs settle finally. All tariffs will be higher than wherever they were before this whole saga started. Yeah. So that is not good for growth. That is not good for inflation. That's for sure.
At the beginning of this year, and this is the point we put out in the morning, the beginning of the year, US effective tariffs on China were 11%. They are 39% now, after the deal, which happened last weekend.
And this is a lot, by the way. Right? The prices will go up a lot in the US, so inflation will be there. Some investors simply not bothered about any of this facts. People assume that all the problems we saw, which is what worries me a little bit over here. That incremental news has been positive. If I take it from April 8th, let's say, which was just before the tariffs were suspended, but incremental news, if I compare with the beginning of the year, is very negative. So how do the two things, right?
Sure. Sanjeev, very quick two-part question. First part is, so you're saying 10% earnings growth this year. Nifty is already at 25,000. So flat for the rest of the year? I mean, just in terms of a market move?
Earnings will be, I'm not somebody who forecasts prices. All I know is that, valuations are expensive. Fair value of most of the large cap names are near, current prices or, the current prices are well above value in many cases. That's a struggle as of now. On any bottom-up first principle basis, it's tough to justify the current market caps of pretty much, I would say, 90-95% of the market.
Wow, tough to justify the market cap of 95% of the market. That's saying something. So then my second part of the question now.
I can have any debate with anybody on this point. So
I would love to have that. I think we'll do that in one of these days. But the second part of my question is that are foreign flows the only risk to the narrative, to the whole very strong and very logical argument you've made? Because those dollars have started coming in for other reasons, because of growth concerns in the US, tariffs in the US. Could that be an upside risk, maybe a pleasant upside risk from the investor's perspective?
Everybody is taking the call that US will not do well. US is up significantly, by the way.
That's
US
true.
Index, S&P index is up 19% from April 8th, by the way. India is up only, I think, 11 or 12%, something like that. Yeah? So this whole belief that somehow US will not do well and India will do well, I don't know where that feeling is coming from, right? Actually, the S&P is far higher. It's almost close to its peak. So is the Indian market. So what has changed? Nothing has really changed. So there's an assumption that India will get a lot of money. I don't know where it is coming from. And ultimately, foreign investors do look at valuation, right?
Yeah.
Valuations are high. I think there is no debate in this. Second view about that. Anybody is saying that valuations are cheap needs to get his or her head examined, in my view.
Point taken, Sanjeev.
To be honest with you now, yeah.
Yeah, just very, very briefly, Sanjeev, you put out a note essentially looking at the retail investors and what they are doing, right? You said that they've increased redemption in mutual funds, they've increased selling in direct equities, increased SIP contributions, but they stay invested in narrative stocks, which makes for a heady, for an interesting cocktail and possibly a hangover. So, which is the weak link in these four things? The last one?
Retail investors' flows, not that I'm a great believer in flows as a driver of market, ultimately changing expectations matter a lot more. for whatever it is worth, anybody who believes that retail has been the driving force of this market, which it has been some extent, at least until recently, they were price agnostic buyers. Their sentiment has started to weaken for sure. If I look at the data of direct, that is activity of retail investors in the market, that number has been negative for the last 3 months now. That is, they've been selling, and FPIs and DIs and others have been buying. Second thing, look at mutual fund flows. They have started to slow down compared to, let's say, the 6-month average of October 24 to March 25. The April number was about 1/3 lower. Main numbers from whatever we can track seem to be not looking very good, and that's the input we're getting from other some of the mutual funds also. So the whole point is, is a section of retail investor community getting a bit concerned about the market for whatever reason? Market has gone up sharply. Maybe some of them are using that to exit, etc., etc. At the same time, we are seeing a lot of action once again in what I call the narrative stocks. Some of the names which you talked about. So I don't know. On the one side, a section of retail investors seem to be getting cautious, looking at the flow data. Other side, if I look at the activity in some of the narrative stocks, which honestly have struggled to justify valuations of, one set of investors seems to be pretty bullish or very bold, in fact. So I don't know how to reconcile the two things. Obviously, retail investors is not one uniform mass. We have different types of people, different risk-taking abilities, and so on and so forth. One set seems to be getting more cautious. Another set seems to be getting a lot more bullish. Let's see.
All right, Sanjeev, appreciate you joining in. Thanks a lot for giving us that commentary. We look forward to having a chat with you as the year progresses. Well, keep an eye on a couple of stocks. Actually, the graphite electrode companies, that's both HEG and Graphite India, both of them are bursting higher in trade. We have Resonec Japan, which was the erstwhile Showa Denko. They have halted graphite electrode production in China as well as in Malaysia. The reason that they're citing out there is margin pressure. Keep in mind, Resonec, well, they have a rough capacity, as per their website, of around 210,000 capacity. That's approximately 30% of the global market share. So that's the reason, in fact, we're seeing these stocks spurt up, because there could be some kind of a shortage in the global graphite electrode market, which explains why, these stocks, in fact, they are currently moved to the high point of the day. We'll have to see how things pan out. But remember, the margins had come down. If there is a shutdown globally for the large player, which has 30% of the market share, that could mean that, in fact, pricing at least gets a bit of a fillip. We'll have to check out to see how exactly the needle coke availability as well moves up. But that's clearly playing on it. Back of an envelope calculation suggests that the total global market share, ex of China, is around 30%. So around 30% of their production, which equates to around 8 to 9% of the global capacity, ex of China. So let's see how that goes. For the time being, both these two stocks are moving up, because over the weekend, this news flow did come about with regard to Showa Denko, or Resonec, so to call it so. We know these stocks the way they move, just highlighting it for our viewers.
Obviously, yeah, that's a great one to pick that up, and it explains that in an otherwise lackluster sort of a market.
We'll have the management of HEG actually in the next couple of days when they come out with their numbers. So we'll understand exactly what kind of a shortage it can create globally. But we know these stocks, they react to this news flow very, very violently. So we'll have to look through the fine print. But some kind of shortage globally will definitely support pricing.
Absolutely. All right. So we'll keep an eye out on these stocks. For the time being, back to some earnings and back to some defense plays as well. Data Patterns is the next company on our radar. And we have Mr. Srinivas Gopalan Rangarajan with us now. Thank you very much, sir, for joining in. And it's been a very good quarter as we get this conversation started. I'm just pulling up the numbers as well. For the fourth quarter, your revenue is up 117%. Your margin is at 38% versus 51% year on year. But the profit has grown very smartly, about 61% as well. Can we start by talking about the order book? The order book declined quite a bit, 33%. I mean, clearly you're executing. But what's the visibility, sir? This year, FY26, what is the visibility on the order book growth? And then we'll talk about revenue as well, the revenue growth that you are looking out for. Please.
Yeah, thank you. Our last year order intake has been quite lower than expected. It's got postponed, but they are intact. So we expect the contracts to happen this year. We expect more than about 1,500 crores contracts to happen this year in terms of new orders. So our revenue guidance remains 20-25% on top and bottom line growth.
Okay. Revenue guidance for FY26, 20 to 25%, both on top and bottom line. But order inflow, your guidance in FY26 was about 700 to 800 crores. Now, wherever you fell short, what is the timeline? When do you expect the orders to finally flow through? And for this year, what is your, your expectation? Say by first half, where will the order book be? And by the end of the year, if you could give us some idea.
Yeah, we expect in the first half, we should get probably 600 to 800 crores of contracts. And the rest, about 1,000 crores of orders we expect during the course of this year. So the contracts have got delayed, but this is likely to happen in the next 5-6 months' time.
So if you could just give us a number, the order book as of 31st March FY25 versus where do you see it by the end of FY26?
We expect about 1,200 crores FY26, end of FY26 is what we're expecting after executing contracts during the course of this year. There are a number of products which have started development ahead of time, and these are coming to some level of completion. And if these contracts also happen, it will be a big boost to our order book.
Okay. What about margins, sir? Again, I'm talking full year margins. In FY24, you were at 43%. That number came down to 39% in FY25. Obviously, it will depend on the kind of projects you're executing, the product mix as well. So just tell us what happened here. And as you talk about building up the order book again, what will be the margin profile for these new orders that you're awaiting?
Last year, or year before last, we took some strategic contracts, very large contracts, which involved just not the electronics, but the full system. We took this as an important step towards moving from only electronic systems to complete equipment. And that was very important to us from a data patterns capability upgrade point of view. So we've done that, and that has given us a lot more competency in addressing big markets and big contracts going ahead. So we took this strategic decision, and those contracts were of lower margin. However, we were able to compensate that with other contracts with a normal margin. That is why you see a dip in overall margin. At the same time, the bottom line business has gone up, maintained the 20% growth which we committed to the market last year. Going ahead, I think we continue to keep it's a bottom line business. We are IP-driven business. So we will retain our bottom line as we go ahead. We may take some 1 or 2 strategic contracts with lower margins, but that is to build the competency in the company and large markets going ahead.
It's interesting that these strategic contracts are actually coming at lower margin versus the specific product contracts, is it?
Yeah. See, what I mean by strategic is that we've never done complete systems like building, construction, all of them, which goes into the complete radar.
Okay.
We've taken up these things because when you look at opportunities, they're coming not just for electronic parts and subsystems and radars, but all the conglomerate systems which go along with that.
End to end.
End to end.
End to end. But end to end is slightly lower margin. Got that. Versus just the radar or just the equipment that you would be supplying. Understood that. Thank you.
All right, sir. Let's focus a little bit on the international opportunity then. The international order book, I think, is currently mid-teens of a total order book. How much is expected to increase, say, in FY26, international business as a percentage of your mix? And what are the markets you're targeting? Europe, East Asia, if you could name a few. And also clarify on margins of export business in comparison to domestic business. Is it better? How much better?
Last year, we did very good export business. We did about 15% of overall revenue was in export. This is mainly to Europe, East Asia, as well as UK. We continue to have order of about 100 crores from UK. So the order is there, and we're also getting more orders from there. So we delivered a system called transportable radars, transportable precision approach radars for flight guidance and for aircrafts. Now that we've sold the first systems to NATO country, we've got other inquiries coming from the rest of the world. Maybe this will also pick up as we go along in the course of the year. The focus, but however, has to be in India. There are a lot of large opportunities in India. I think we need to address those opportunities. And parallelly, we should start looking at export business. What we do development here can also be exported because what we're designing is our world-class systems.
Okay, and margins of exports, I missed that point. Is it better than India?
No, it'll be around similar range. Some systems where we separate OEMs will be lower, but still reasonable margins. And going as a complete system, if we sell it, then the margins will be similar to what we do in India.
Okay, got it. What about your capex plan, sir? Since you're indicating that there's a big potential out there for your company as well as for the industry, what kind of a capex plan do you have? What is the turnover that you're looking at, asset turn out there? And by when do we see this?
See, capex is going to be in two parts. We raised about 500 crores 1.5 years back. This is essentially to do product development and build capex. We spent more than 150 crores on product development in the last 1.5 years. Those products are at a very near stage of completion and going into trials. This is to really enhance our TAM going ahead, because we need to be a 5-10,000 crore company. We need to have at least a TAM of 30,000 crores. These products will address a very large market. That is that some world-class equipment we designed with in-house IP. So that is coming up. Second, we're also going to spend about the next 1.5-2 years about another 150 crores, which will be spent on building and infrastructure and test equipment. This is to address the large opportunities. If we get the contract, we should be in a position to address and deliver on those opportunities. So we're moving ahead, seeing that everything is, the foundation is maintained and kept. We're also recruiting more. We're now really about 1,100 engineers working with us. So all around, we are building competencies and capability to address the larger opportunities we expected to happen in the coming years.
Okay, all right. Thanks a lot, sir, for joining in. We look forward to chatting up with you as the year progresses. For the time being, you're sounding quite optimistic on prospects. Well, let's focus on another company, Kaynes Technology. They actually reported a good quarterly performance, healthy margin expansion as well, and strong order book. They've also completed an acquisition to expand in North America. To discuss this and more, we have Mr. Jairam Sampath, the whole-time director, as well as the chief financial officer at Kaynes Technology. Hi, sir. Morning, and good to see you in as always. Well, the numbers look good. Order book is good, but it seems valuations have got a little bit stretched after the 30% run we have seen in the last few months itself. And that's why I'm reading a few notes today. There are a couple of downgrades on the stock. That's from the market perspective. But let's get a couple of numbers out of the way. On this sort of a base that you've delivered for the past year, what kind of a revenue growth you're looking at, what kind of margin expansion, and also export contribution, you're expecting it to go up, I think, from high single digit to mid-teens. Tell us more.
Sure. So as far as the guidance for this year is concerned, FY26, the existing business, which is excluding some of the acquisitions, will grow at about 60%. So we get about 4,350 crores of business we estimate for this year. And on top of it, we have acquired a company called August Electronics, and shortly we'll be consolidating that company's results into us. So we expect about 6 months worth of consolidation. So that would add about another 175 crores. So roughly, total what we are looking at is about 4,525 kind of number. Based on our order book and kind of businesses that we plan to execute, there will be an expansion in margin by about 50 basis points. So maybe we get to about 15.6% kind of an EBITDA number for FY26. As far as exports is concerned, FY26, you can see when we say exports, we're talking about exports out of Indian facilities. So it will go a tad increased because we will have some US major company orders getting executed. We've got a significant amount of business that has come in. So we will start doing additionally about 200-300 crores of exports. So this is US-based as well as Europe-based companies that are in both aerospace and in automotive area. So you can see an uptick on the percentage of exports too by 26. And of course, at the end of the year, I think our businesses in OSAT and PCB is also going to fire up. And so they're also export-oriented businesses mostly.
Okay, all right. So from OSAT as well as PCB project, what kind of revenue contribution will we see in FY26? I think it comes towards the later part of it. And I think majority of it will come in FY27. So for both these two businesses, what kind of revenue contribution we'll see in 26 and 27? And also your capex plan is 1,000 crores, right? Break it up for us, EMS, OSAT as well as PCB.
Sure. So I'll answer the second question. Firstly, whatever money we raised during last QIP would suffice for managing the capex spend for both OSAT as well as PCB. As far as the EMS business is concerned, about 200 to 300 crores of capex will be required every year to cater to the growth, which we expect it to be excess of 50%. And that would entail some kind of investments in the factory infrastructure and all that. Now, as far as the OSAT and PC board business are concerned, being fourth quarter, right now the factories are under, let's say, construction. And while we have LOIs from customers and so on, and a lot of strong customer pull available right now. So once the factory is ready, then there is a process of approvals. So in the fourth quarter, we don't expect huge amount of revenues, maybe 50 to 100 crores kind of revenue you can expect from each of these businesses at the end of the year. But we would maintain our guidance based on whatever existing businesses that we already have. That's EMS and one more acquisition that we have done in North America so far. So you can see a full-fledged year for these two businesses in FY27. Because by September, probably the factories will be ready. Then there is a customer approval process, which probably will happen by December. So January, February, March is the time frame when we will do some little business in these areas. So it's too early to say exactly how much, but yeah, it won't be a very huge number, but at least it will cover all the major customers, like a couple of customers in OSAT, and then in PC board there are.
Jairam, if I can come in, morning, Prashant here. So for FY27, could you give us a sense of what could revenues be from these two businesses, OSAT and PCB?
Yeah, OSAT and PCB, probably both of them put together will be 1,000 crores plus kind of business. Maybe earlier we were thinking that FY28 we would get about 1,500 crores from these businesses. Maybe we'll do that in FY27 itself.
Okay, that's 27.
Yeah.
Which is between 1,000 and 1,500 crores. And what margins here?
Okay, so right now all drawing board margins right now, because we have to yet establish costs and all that. But they'll be more than our current consolidated margin. They'll be in 20s. EBITDA margins will be in 20s. Yeah.
And there are no changes per se, Jairam, because of all the there is so much movement happening, right? With regards to news flow, make here, make there, don't make here. I'm talking about what the news flow with the US, and these are all considered. I mean, of course, we are talking about packaging, etc. for now, but also building the ecosystem as the first step. There's no. Are there anything you're hearing from clients in that sense, or is it a fluid situation?
No, this is something that we had anticipated. That's how we acquired this Canadian business of August Electronics. I think going forward, you will have more and more of what I call the insularity in manufacturing. Whatever best they can do within their country, they would, again, I think, rededicate themselves toward developing a manufacturing base so that no country has strategic importance in terms of their entire economic value chain. So we've been talking about our geography footprint increasing to North America, Europe, and of course, at some point in time in future into South Asia too. So this has not come as a surprise to us. We also know that the business's growth vectors cannot be based on protection by the government. Of course, we do use all the different types of benefits that government gives us in terms of capital subsidy, MPLI, etc. But at some point in time, that will be available to most companies in the world, right? So, so we do understand that, and so we are taking steps to make sure that we give technology as the key differentiator. Since we are investing now, so we can always choose to invest the high-tech infrastructure. And also we look at more value-adding propositions like ODM and all this, our own design and so on.
Mr. Sampath, just very quickly, so you gave us a sense of FY27. That's where PCB and OSAT kick in, and you get in about 1,500 crores of revenue from those businesses.
Yes.
Now, specifically for FY26, the current year that we're in, you're guiding for a 60% growth on the top line and an improvement, about a 50 basis points improvement in margin.
Correct.
I just want to understand how that will come about. And what's happening with the base business, with the EMS business itself. Your order book is at about 6,600 crores as of the end of the year that just closed. Just give us a sense on the base business and the projections that you've put out.
So the 6,600 crores of order book represents orders for 5 years time frame from today, right? There are orders in our books beyond 5 years too, which we don't consider for projections of these order books. Having said that, typically the next 12 months would represent about 60 to 70% of this order book. And so that means that for the coming year also, some orders will come in because many customers do not give you orders beyond 12 months. So they would give it as and when. So 6 months to 10 years is the time frame in which different customers give us orders. So from the order book perspective, we can always compute what is the kind of EBITDA that we can make, assuming other things are being equal. So that's what tells us that this year, because of course, we can't tell you sector-wise, but broadly, the uptick is in industrial and in aerospace and in railways and in IT, etc. So these sectors are typically pushing this entire margin profile up a little bit. And also, I think this year some more operating leverage will kick in. Last year, we kind of deleveraged because we are spending more money than we ought to. And this year, we will probably utilize those, and even asset utilizations will improve. So we are expecting at least 50 basis point expansion in our margins at EBITDA level.
Okay. All right, Mr. Sampath, thank you very much. Lots of details there. Good luck with your plans.
Thank you.
We look forward to the next call soon. We'll take a break on that note, come back on the other side, and we'll be in conversation with the management of Vinity Organics to talk about their fourth quarter performance.
Welcome back. Well, Vinity Organics, that's the next company on our radar. The performance was largely in line, but what's the way ahead? That's what the street would like to know. Well, we're joined by Vinity Saraf Mutreja, the Managing Director at Vinity Organics. Hi, Vinity. Good morning, and thanks a lot for joining in. Well, let's focus on the largest part of your business, the ATBS segment. What kind of volume and revenue growth are you working with for this year? And you had an expansion that was due, right, at the first half of the year itself. I think in the first quarter, it was expected to go live. Could you tell us if that is on target, and how do you see capacity moving up as well from here on?
Yeah, absolutely. So this year, a large chunk of our growth did come from ATBS. Last year, there was a bit of tightness in demand for ATBS, which we saw improvement in FY25, and about 25 to 30% volume growth is what we observed in ATBS. Going forward, I'm expecting a similar growth. As of now, we are running at full capacity. And just to address that issue, we are adding 2 new lines of ATBS, in fact. The first line is expected to commission in Q1, like you rightly pointed out, and we should have some added capacity to fulfill the backlog in demands starting from July this year onwards. Post both the lines in completion, our total capacity of ATBS would have expanded by 50%.
Okay, would have expanded by 60%. Vinity, hi, good morning. Prashant here. Could you talk to us a little bit about the core demand and how that is shaping up? Give us a breakdown in terms of volume and pricing both.
So, demand largely for all products has been good in our case. Mostly, again, ATBS, a large chunk of the application that is growing is coming from the oil recovery segment. ATBS, as you know, is used in oil field and oil recovery polymers. We also see a strong demand coming from water treatment and mining industry. My other products, such as the antioxidants, which has grown by more than 50% this year, which goes in the polymer industry. We've seen a very strong demand in India as the polypropylene and polyethylene capacities have increased over the last 3 years. Again, butyl phenols being a feedstock, even that plant, we are running at close to 90 to 100% capacity. We are increasing our isobutylene capacity, which is used in agrochemicals as such in cypermethrin. So demand remains positive and strong, and a lot of it is coming from the domestic sector.
Okay.
You know, you mentioned that you're working on 3 to 4 new products, which will drive the next leg of capex, and these are all based on adjacencies. I mean, with your existing products, could you talk to us a little bit about this? How large are these product segments?
Yeah, so a lot of the new products we are adding in the subsidiary, Viral Organics Private Limited. We are adding a polymer inhibitor. We're adding a product that's used in the pharmaceutical industry. We are adding isoamylene-based derivatives, which go into agrochemicals as well as plastic industry, PTAP, specifically the product. Now, as such, each individual product has a revenue potential of about 100 crores, but total, the basket of 5 products, the total revenue potential becomes 500 crores at full capacity utilization.
Okay, all right. Vinati, give us a few more details. You know, the antioxidants as well as the butyl phenol. If I got it correct, I think it's around 20-25% of your mix. You could correct me on that number. But for this year, I believe, you're guiding for bigger numbers. So between the two, what kind of revenue number could we see for between these segments?
Well, you're right. This year we did about, combining the two, we did about 550 crores in revenue. Next year, this number should cross 700 crores, but that will still remain about 25% of our total revenue, as the growth will also come from ATBS and the new products that I talked about previously.
All right. So for the company on a consolidated basis, what kind of a revenue growth should we look at? In the last quarter, what was positive was your margin surprise. What is the steady state margin range we should work with?
Yeah, so, on a long-term basis, I think over the next 3 years, 15 to 20% annual revenue growth is a fairly acceptable, achievable number. Margins, again, I would expect EBITDA margins to remain about 26 to 27% on average. This quarter, you might have seen slightly expanded margins. That depends on in the quarter where we get more of the custom synthesis products. So those are campaign-based products, and they don't happen every quarter. So it's just a timing issue in that regard.
Okay, all right, Vinati. Appreciate you joining in. Thanks a lot for giving us color on the way the last quarter panned out and the way ahead as well. Well, for the markets, though, well, we're holding with a mild negative bias on the Nifty, but stocks are moving around from the broader markets, and they're moving big time, actually, because the breadth of the market is still in favor of a number of stocks that are advancing. A few stocks to highlight. Banco Products, we mentioned this, that's up close to 20%. The biggest volume buzzer is HEG and Graphite India. We know that these stocks, any kind of supply constraint in the global markets, well, in fact, you see both these stocks take off. And that's precisely what's happened, because there could be some kind of near-term supply downtake. That's why both these two are moving up. But we'll have to hear in from the management. Remember, these are companies that at one point of time delivered margins of 65% that have come down to mid-teens as well. So just keep that in mind. But supply shortage normally holds well.
The Arya power stocks. I think you used that word violent. Yeah. That is absolutely the correct way to describe, because the moves are not small. They're never small. Either they go big or go home. And today, these stocks are moving in a big way. I just want to highlight one name. Cochin Shipyard has lost $200 from the day's high. And it's still the number one volume-led gain. Actually, it's now it's a loser, but it's got humongous volumes. And look at what has happened. Maybe the market paying heed to that conversation with Sanjeev Prasad. I think Sanjeev did use Cochin as an example. I mean, he was, of course, not talking about Cochin and what you should do with Cochin, but just was basically saying that many of these names, purely based on valuations, it'd be hard-pressed to justify. And actually, it's similar.
Even Mazgaon,
same was the case with Data Patterns. Data Patterns, the high was 3,141. It's again dropped about 150 rupees from the day's high. Look at this. This is all almost similar kind of price pattern. Look at Paras Defense. High was about 1945. Stocks at about 1850. So again, about 100 rupee drop coming through from the day's highest point. The one name which is still holding on with decent gains is Premier Explosives. But again, here the high was 580 and it's dropped about $30 from the day's highest point. Actually, there is one more. Look at Astra Micro. High was about 1120 and stock is about 60 rupees off the day's high to about 1,070 rupees or so. So just, that defense space, very much the focus of conversation here, even on Bazaar for the last 2 hours or so. Lots of views. You heard from Sanjeev, you heard from Deepan, etc. Coming off the day's highest point. Sudeep Shah is with us with some technical views, SPS Securities. Sudeep, good to have you with us here. Good morning. What would you recommend? Nifty and then stocks?
Morning, Prashant. Prashant, see what's happening with Nifty is now post that move in the last week, that big 500-point move on Thursday, Friday, as well as today, we are seeing some kind of consolidation happening, and that is quite acceptable given the fact that the moves were very strong in the previous week. Now, from here, we feel that 24,850, 24,900 would act as a key support until this zone holds. The upside up to 25,300, 25,550 looks quite visible. For the bank Nifty, what is important is the 54,900, 54,800 zone will act as a strong support till this zone holds. We feel that the bank Nifty has been, if you see bank Nifty, that has been consolidating in this 1,000-1,200 points since last 10 to 13 sessions now. So a breakout here is quite likely in the next couple of days. And that is the reason we feel that on the lower side, 54,800, 54,900 should act as a strong support. Till this holds, we feel that with the breakout, the index can scale up to 56,300, 56,600 levels in the coming few sessions.
Okay. All right. Got that, Sudeep. What about individual stocks? Any advice? And maybe throw in a word on some of these defense names as well. All of them, including the bigger names like HAL, Mazgaon, all of those stocks are finally cooling off.
Yeah. What is defense names the last 6-7 days, right from the day Operation Sindoor has concluded temporarily. What we have seen that all these names have just spiked up, giving the if you see the technicals here, they have all gone into an overbought zone and have sustained there for the last 4 or 5 days, and finally they are cooling off. So while the uptrend, a medium to long term uptrend looks still strong, we feel that in the extreme short term, these stocks can cool off, and dips should be used to accumulate these stocks and not chase the stocks at the current prices and the current valuations. So we feel that one should just step aside from the defense names for at least next 4 or 5 days, let them consolidate, let them cool off, and then take a call on these stocks post the consolidation.
Okay. All right, Sudeep, thank you very much for joining in. Appreciate your call. We need to take a very quick break. Come back on the other side. We'll focus on some individual stocks as well as on commodities. Welcome back. So day of consolidation, at least a morning of consolidation for the market in the equity sphere. Let's find out what's the latest in commodities. We have Manisha with us now in the studios. Manisha, so what's the Monday headline?
Well, you know, everything seems to be buzzing, and on the higher side, we've seen buying return for many of these commodities. But I want to talk about copper because we have very contradicting fundamentals coming in for this one, and there is a lot of disruption in the global markets as well. Having said that, we've started on a positive note for this one at this point. Most of the metals are holding well post the short-term truce between China and US there. And when you look at that report card, as you can see, the best of the gains in this year till time have been in case of copper. At one point in time, we were up by nearly 27% as well, but clearly copper has come off that. But after that also, we are holding those gains. Aluminum, zinc down between 3 to 10% on your screens. Iron ore is down 3.5% as well. Steel prices, while are at double digit on the positive, but that also is because China has been saying that they will cut production going forward in 2025. That perhaps seems to be supporting steel. But in the non-ferrous space, copper clearly is the king there. If you look at the US markets, and this is what the street continues to talk about, that US and China, the two major producers and consumers. So when it comes to US, well, 40% of the refined copper demand comes in via imports. And that is the case with aluminum and steel as well, where we already have seen tariffs come in from US. 70% of primary aluminum that US uses or consumes is imported. 20 to 25% of steel that US consumes is imported. So it's going to be quite an interesting to watch on how tariffs and how much and how long do we see here and the impact of that on those metals as well. Come to China then, and Chinese numbers have been quite on the stronger side, even as there has been tariff concerns and we've seen slowdown concerns. When you look at copper movement within China, that has been quite on the positive. Refined copper production is near record levels. China imports for the month of April were quite on the higher side at a record 3 million tons yet again. And then the Chinese smelters are paying to process now. If you look at the treatment charges, they are negative of $57. So that tells you that the Chinese demand has been very strong when it comes to copper. Take a look at the global inventories now, and there's not so much change as compared to last year. We stand at 500,000 tons. But interesting to see is that much of this copper clearly has moved to US ahead of those expected tariffs. So US is looking at an 8-year highs in sense of copper inventories, 81% up in this year. In contrast to that, LME inventories have declined by 40%. They're trading at a 1-year low. And the lowest of the inventories are in China, where you are looking at strong demand. So the Shanghai inventories stand at just about 89,000 tons there. Also, you have the International Copper Study Group telling you that you're looking at a surplus of copper this year and the next as well. So those numbers look on the stronger side as it is. The uncertain only is on whether or not the US will put 25% tariff on copper like it has done for aluminum and steel. And the last plate tells you on the expectations on where the copper prices can be for the rest of this year now. Well, the most bearish of views comes in from Citi. They expect the copper prices to decline to $8,800 a ton in the second half, but it is between $9,200 to $9,500 that you have JP Morgan, Citi and Bank of America talking about copper. Currently, copper is trading at around $9,800.
All right. Manisha, thank you very much for that. So that's commodities in focus there. Well, let's move on. Stocks on the move. Protein e-govern is locked in lower circuit. Vinny's here with the story and, of course, the news flow driving it. Vinny, over to you.
Hi, morning. So yes, Protein eager was under pressure today. Why? Because now the company has not been shortlisted for PAN 2.0 by the Income Tax Department. This was going to happen in somewhere in August. They had gotten some requests for proposals. Now they have not been selected for this. Now, what does this mean? PAN services account to around 50% of their revenues. So this is an important one in terms of going forward, the growth story that comes in for the company, right? If PAN services doesn't come in for them, then the growth in FY26 or FY27, we could see a muted growth coming in on that front. Now, government had plans overall to spend almost around 1,440 crore budget for this PAN 2.0. So that is something they may be missing out on. Equirus has highlighted that this is negative because obviously, like I mentioned, 50% revenue comes in from this. Segment has historically been generating a lot of free cash flows, which had helped fund their new initiatives. So now that may take a bit of a back seat as well if there's not enough free cash flow. They've downgraded the stock to a sell from a previous ad, cut the target price to 900 rupees from 1,730 rupees. Also, Anand Rathi is also highlighting that in the near term, this could be a challenge for the company, but they expect limited impact overall, given that core business for PAN comes in from offline. But nonetheless, today we're seeing pressure coming in. PAN services is the major segment for the company, and that is why locked in lower circuit.
Okay, all right, got that. Big hit on the stock this morning. Thanks for that, Vinny. We'll take a break on that note. On the other side, it's our special segment, it's the economy. Today, Lata speaks with Rajiv Radhakrishnan of SBI Mutual Fund and Madan Sabnavis of Bank of Baroda to discuss how big will be the RBI's dividend and what could be its impact.
Welcome to It's the Economy. This week, markets are keenly awaiting the Reserve Bank of India's dividend. As per the budget estimates, it should be around 2.5 trillion rupees versus only 2.1 trillion in FY24. But there is a widespread feeling it is going to be more than 2.5 trillion. Reserve Bank, CNBC-TV18 did a poll of economists, and that poll indicated the dividend may be 3 trillion rupees. Now, here's why the market is expecting a bigger dividend. Reserve Bank of India data shows that RBI has sold a whopping $415 billion in FY25, that is from April 2024 to March 2025. This compares with a gross sales of only $153 billion in the previous year. Now, every time the Reserve Bank sells a dollar, it will be at the current price, and in FY25 it works out to between 84 and 85 rupees. But its purchase price is the average price of all its reserves, and that works out to about 78 rupees according to some experts. So the Reserve Bank is making about 6.5 rupees every time it's sold a dollar in FY25. This means the Reserve Bank has made 6.5 rupees multiplied by $415 billion. That is 2.7 trillion rupees in FY25 compared to only 1.2 trillion rupees in FY24, because then it sold only $153 billion. So only on dollar sales, the surplus of the Reserve Bank of India in FY25 would have been 1.5 trillion rupees more than in FY24. And that's why we come to this figure of 3.5 trillion rupees dividend. Now, how much is the reserve market expecting? How much is factored in? What will be the impact if this is actually the announcement? For all that, I have with me two guests, Madan Sabnavis, the Chief Economist from Bank of Baroda, and Rajiv Radhakrishnan, CIO, Chief Investment Officer, Debt at SBI Mutual Fund. Madan and Rajiv, thank you very much for your time. Madan, your math, I think when I did the poll, Madan's entry was 2.5 trillion. But do you think that it can also be 3.5 trillion?
See, I think it can go probably towards 3 lakh crores. So 2.5 is more conservative. So In fact, I have not looked at this particular calculation which you have put on the screen. So I think if it does work out that way, we could go closer towards 3 lakh crores. Because we should also remember that interest rates have also been high last year, which also means that the RBI would have been earning higher income in terms of interest income on all the treasuries which were purchased by it. So on the whole, I think it's a very positive sign for the government, because any kind of income for the Reserve Bank of India, given ceteris paribus conditions for expenditure, would actually mean that there would be a larger surplus. And to that extent, it will be helping to shore up the fiscal deficit. And in case things go according to plan on fiscal deficit, I think this will be a kind of a buffer which it has for any kind of contingency expenditure which could come up during the course of the year.
Okay. Rajiv, you want to come in on dividend? What are your calculations?
Yeah. No, as you said, the budget numbers are somewhere close to 2.2 or so. When you look at RBI, 2.2 to 2.5 possibly is what is there in the budget. But the market is clearly looking at around 3 at least. So I think any number below 3 trillion should be a disappointment from a market perspective. And more so after last week's announcement where the RBI was supposed to have relooked at this buffer, there is clearly an expectation of a number which is around 3.5 trillion. So I think that's the range of numbers that are floating around in the market at this point in time.
Okay, no, Rajiv, the expectation was the 2.2 trillion you say is right, because in the budget entry it is 2.56 crore
2.5, yeah.
for 2.56 lakh crore for RBI plus PSU bank dividend.
Yes.
So, I mean, the estimate both of you are mentioning per budget is correct. But if you look at this dollar sales, it is whopping. And especially in Jan and Feb, each month they have sold something like 80 billion, 60 billion. So it clearly looks like once the budget was getting ready, the RBI was preparing to sell more dollars, and they buy back the same amount every month. So it is clearly intended, or so it seems, to show a higher dividend. Madan, would you say that right now, even if you monetize the deficit to such a large extent, 3.5 trillion, there is no worry because inflation is anyway low?
Yeah, I don't think there's any worry. In fact, I think it provides a lot of comfort to the government because whenever a budget is drawn up, it's drawn on very conservative basis. And there are always these expectations that there could be slippages. It could be on capital expenditure. It could be maybe on some additional expenditure which may have to be incurred. So that's why we have these supplementary budgets coming up during the course of the year. Now, even in terms of revenue, if today we are talking of GDP growth in the region of, our forecast is 6.4 to 6.6, which is again very, very conservative. Now, if there's any slippage in terms of GDP growth, there could be a shortfall in terms of tax revenue. So now when we're talking in terms of the Reserve Bank of India contributing to, say, or 3.5 lakh crores, anything above, say, 2.2, 2.3 lakh crores is definitely going to be a bonus for the government. It becomes that much easier to handle the overall fiscal numbers, given the fact that the government has said that it's committed to the 4.4% number. So the slippages which could possibly arise on account of revenue shortfall or expenditure being higher than what was projected is actually buffered once you get this kind of an amount from the Reserve Bank.
Yeah. Actually, with what is staring us in the face is a higher defense expense. Every day, our correspondents from Delhi are reporting that replenishment of resources expenses are soaring already. And the three chiefs of Army, Navy and Air Force have been given enough powers to requisition more of spares in particular. So maybe it will come. I mean, I'm putting all this together to justify this 3.5 trillion rupees. But Rajiv, what is factored in? If it indeed is, say, on May 23rd, the RBI announces 3.5 trillion, do you expect bond yields to fall further?
Yeah, so with 3.5, I think after last week's statement from the RBI that the board has reviewed the framework, clearly 3.5 trillion, north of 3 is something that the market possibly is looking at. And with 3.5 trillion, I think that should be a positive news. But, very clearly, a lot of that is possibly there in the price, right? With the benchmark, the new benchmark almost close to 620 odd today. I would say a number close to 3.5 trillion is clearly there in the price.
Okay. Well, I think that point needs to sink in. We are seeing the new 10-year at as low as 6.2. And I think that is a number we saw, what, in 2019 or 2020, isn't it? Isn't this a 5-year low?
Yep.
Okay. Well, Madan, what's your sense? How low can the 10-year go, not just now, but this year? What are you looking at?
So actually, it will all depend upon how low the repo rate goes. Now, we are looking at another 50 basis points cut in the repo rate. That is, we go to 5.50. And that is based on the premise that we have an inflation of 4%. So even though I think this 3.2% number, which came for April, has made a number of analysts feel that the inflation could probably be much lower than 4%, I would still think it will be in the region around 3.8, 3.94%. And going by the RBI's thing of real rate of 1.5%, so 5.5% looks fair enough to me. And if I have a 5.5% repo rate, I think it looks likely that the 10-year yield could go up to 6%. So, but I think in case there's any acceleration in terms of accelerated reduction in the repo rate, or maybe more than 50 basis points, which we don't believe will happen, but yes, it's definitely a possibility, then I think we can even go less than 6%. But as of today, looking at 50 basis points cut in repo rate, by March, I think the 10-year yield should be in the region of around 6%.
Okay, what's your sense, Rajiv? There is the expectation, that the Reserve Bank on June 6th will even lower the inflation forecast from 4 to 3.8, because the first 4 months are giving us, an average way below 4%. And it's expected to be even lower in the coming months because of the high base as well. So what is your total repo rate end rate, and therefore your 10-year expectation?
Yeah. So I think that's a very important point, because our earlier expectation was clearly that the policy repo rate should top off at 5.5 in this cycle. But as you mentioned clearly, I think it's an evolving situation where on the growth side, if any, you possibly have downside risk. And when you look at where the inflation numbers are likely to pan out, quite possibly that the RBI may at some point look to revisit their inflation number of 4. So I wouldn't be surprised if that were to happen over the coming few months. So with a 5.5 estimate of where the policy repo rate should go in this cycle, somewhere close to this 6.10 should have been the range where I could have said that this is where I think the 10-year will bottom out in this cycle. But I think the important thing is to know that as we go forward, quite possibly the policy rate cut expectations can get reset in terms of how much further we can go in this cycle. So I think that's something that will clearly be a factor that we need to look at over the next. And I would be surprised if
you're not buying 3 rate cuts already, Rajiv?
No, right now I think it's still 5.5 for me, but I think we need to see some more data, which possibly would lead us to revisit where the policy rate goes in the cycle. Okay. So I won't be surprised if it can go even lower.
3/4. Okay, 5 to 5/4. How much will be the US yields a factor, Madan? US yields are stubborn at 4.5, and the bill that is pending before the House and was not passed is only going to increase the debt burden of the United States. So if the US yields continue to be at 4.5, the 10-year, the benchmark, will that be a factor at all?
Yeah, in fact, I think that's going to be one factor which is going to ensure that the 10-year yield in India doesn't go significantly, doesn't really crash to something below 6%. Because what we have seen is that historically we have seen a difference of 250 to 300 basis points being the difference between the US Treasury and the Indian 10-year yield. But today we're talking of this thing actually getting narrowed down significantly. So this 4.5% will remain, I think, in that particular region. We're looking at 4.3, 4.4 for the US Treasury until there's more clarity in terms of the entire tariff episode, which started in April. And as long as we remain in this region of 4.3, I think our 10-year yield will probably continue to be in this region of 6.10, 6.2, and maybe towards the end of the year we go to 6. But definitely this thing of 200 basis points, the difference between, moving away from 250, 300 basis points is not something which can be sustained for a long period of time. We will finally have to gravitate to that. Either the US yields have to come down, or our yields will have to stabilize more in the afternoon.
Okay, Rajiv, would you agree with that? Because until now we gave a lot of importance to this interest rate differential. But now two things have changed. Our inflation rate is not very different from the US inflation rate. It's only 1 percentage point higher. Time was when it was 5 percentage points higher. US was going at 0 and we were going at 5% at least. Plus, have you noticed any change in FPI bond investments because of this interest rate differential declining? They seem to be coming all right.
Right. I think I would not really attach, too much of importance to the interest rate, differential that you just mentioned. It's of course a factor to the extent that now we are more open to bond investments, given the FAR, the route which is quite clearly available for overseas investment. But in a situation where the 10-year treasury yields stay where they are, given the fiscal and other issues that the US is facing at this point in time, you should not really expect that you will see large, debt flows into our markets. So that's not something that is, I would say, very, very important in terms of determining where our bond yield eventually go to. Because I think that's going to be largely a function of domestic growth inflation dynamics and domestic demand supply dynamics as they pan out. So that is quite favorable at this point in time in terms of where our bond yields are likely to move. So I'm not really so sure that this interest rate differential really sort of matters in terms of where our bond yields should eventually settle.
Okay, at the moment, of course, the US is also grappling with the downgrade of debt. Not that it was new, it was already done by the other rating agencies. A third one has followed. Out of time, but thank you very much. The key takeaway is that we could have a higher dividend and we could see the Indian 10-year go all the way to 6%, and some are even expecting it to go below 6% by the year end. Wrap up on Bazaar on that note. Chart bus is coming.
Device Labs climbs nearly 6% on a strong fourth quarter performance where the margins are at a multi-quarter high. Profits grow 23%. The management in the conference call say the company is eyeing double-digit revenue growth in FY26.
Delivery zooms nearly 10% following a good operational performance in the fourth quarter. The company has reported a profit in comparison to a loss in the corresponding quarter last year.
Protean e-government tanks 20% after it informs the exchanges that it has been not considered for the next round of selection process for the PAN 2.0 project by the Income Tax Department.
Graphite India and HEG climb after major Japanese graphite electrode manufacturer Resonec halts production in China as well as Malaysia. The street believes that this will create some kind of a supply shortage globally, which could push up prices.
Credit Access slips more than 5% on the back of its fourth quarter numbers. Dispersals come down nearly 20% year on year. Net profit declines 88% from a year ago.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, the headline index is as flat as can be on this Monday morning. However, the broader markets is still showing some strength. And that's why you have the number of stocks advancing to the number of stocks declining. Well, that ratio is 2:1. So pretty good looking screen, Mangalam.
Pretty good looking screen, Nigel. You know, we've seen that happen on Friday as well. After a big surge that we saw on Thursday, that day, you know, the frontline indices moved, not so much the broader markets. Now, perhaps the street believes that it's time for the frontline indices to consolidate around that 25,000 mark for the Nifty and around that 55,000 to 56,000 zone for the Nifty Bank. Whereas the broader markets, which had been underperforming versus the last time the Nifty hit that 25,000 mark, has some room for up move, and that exactly is taking place. Let's get in Vinay Rajani of HDFC Securities for a quick technical check on the market. Vinay, your thoughts on where the index is headed, but more importantly, individual stocks. What are your calls there?
Good morning and thanks for having me on the show. So index is into a clear-cut uptrend for last two trading session. As you said, it has been into consolidation of 100 points. But if you were to look at the broader markets, they are doing excellently and the returns have been generated and the kind of momentum we can see in the broader market is quite good. So overall trend is very strong and 24,500 becomes a very strong support zone. And in any case, if we see any intraday correction or correction in a running correction for next 2-3 session, 24,500 should be the stop loss in trading long position. And immediate resistance we see is around 25,200, which happens to be the 76.4% retracement of the entire fall which we saw from the all-time high. So 25,200 is the immediate resistance, and above that we can expect Nifty to hit an all-time high. So overall view is bullish. Broader markets are very strong and one should continue to participate. Sector rotation is going on nicely. So it is a good market. I think if index remains like this into consolidation, it would be better days for the mid cap and small cap. So one should try to capture the broader markets rally right now. And as far as stocks are concerned, we are basically bullish on the PSU bank. So IDBI Bank has given a fresh breakout. So it is trading around 90. So if somebody is looking for the trading, one can go along with a stop loss of 88. On the higher side, we are expecting a target of 95. This is for the short term. The another space which we like is the real estate space, which is DLF. So DLF is the large cap real estate stock which is doing good. So 730 is the price around which one can go long. 715 should be the stop loss, and on the higher side we can expect a target of 755.
Okay, all right. Thanks a lot, Vinay, for joining in, giving us your take on the markets as well as your individual stocks. For the time being, we slip into a short break. On the other side, we have the management of KRBL that will be joining in to detail their past quarters numbers as well as the way ahead.
Welcome back. Let's talk about KRBL. The company is on our radar on the back of their fourth quarter numbers. We have the management joining in. They've seen a profit growth year on year, and we have the exports that grew a lot more. Ashish Jain, who's the CFO, joins in to discuss these numbers. Thanks a lot, Ashish, for joining in. Always a pleasure speaking with you. Now, let's talk about the exports part of your business. The fourth quarter, they contributed about a third of your overall revenues. They've seen an increase. I'm not sure how much of that is on account of increase in realizations and how much of that is on account of your own, product mix doing a lot better there. On that account itself, if you could give us a sense on what the FY26 looks like for you, for both domestic and exports in particular, and what kind of prognosis that you have when it comes to growth.
Thank you, and happy to be here. As far as exports is concerned, our Q4 really had two underlying trends. One is in terms of our key markets for branded exports, as we mentioned earlier, we were facing some distribution challenges. We had mentioned that we will use the last financial year to address those. So I think that process has begun. And what you are seeing on the branded side is an outcome of that, where our volumes in some of the key markets have picked up. The second side of the export business is the private label business. Now, that was slow for us in FY24. We had again mentioned at the beginning of FY25 that that's going to fare better. So that's also stepped up. So both these things combined have led to the growth. As far as the domestic business is concerned, our volume growth on the branded basmati side is in line with what the category growth is during the year. However, over the last 1 year, we've seen, impact on the rice prices. Broadly speaking, rice prices have been down about 20 to 25% year on year. And as we compete with the loose and the unorganized sector, that's impacted our realizations as well. So on domestic side, while the volume is in line with category growth, it's really the realization impact coming through, leading to a low single-digit growth.
All right.
As far as FY26 is concerned, we see the trend on exports continuing and in fact strengthening. On the domestic side, our current view is that the prices have settled down. So the realization, which was the key factor for the business in FY25, should help us to enable better growth next year.
All right. Hi, Mr. Jain. Good to see you, Ben. Nigel on this side. So good to hear that you expect realizations to move up from here on. Give us a few more details, though. Saudi as a percentage of your business, how big is it? And also, I think the distribution challenges were in Saudi, right, which you were looking to iron out in the next 3 to 4, in the next few quarters. Could you clarify on that?
So we don't give out country level details, but Saudi is a top export destination for basmati from India, and so is it for us. In terms of our performance in this market, I think we are still doing a fraction of the volumes that we did earlier, but it's been picking up. Sorry, what was the second question, Nigel?
The distribution, there were some distribution challenges even in Saudi, right?
That's right. So that was the main market where we had distribution challenges, and we've been able to address those. At least the process has started.
All right. And in the next couple of quarters, you're hoping to iron out things?
Yes.
So how long before you go back to historical volumes in Saudi?
See, it's a consumer-based business. So, in terms of getting back to earlier levels, it's difficult to predict a timeline. But what I can say at this point is that the process has started.
Okay. All right. What about your market share? If you could tell us, what is your market share in general trade, modern trade, as well as e-commerce? What is it currently, according to your analysis? And do you see scope for you to go ahead and grab a higher market share?
Yeah. So, if you look at the domestic market, which I guess is what you're referring to,
Yes.
FY25, I think we've recorded gains across the channels, and we've reported exact market shares in our investor deck. But across channels, we've been reporting gains. And I think we are fairly positive that we'll continue to build on that in the current year as well.
When we speak about your business, it's largely rice, but over the last few years, you've been moving into non-rice as well. You had a target of 10% revenue coming in from non-rice products or value-added products as well, as it were. Where does that number stand at? What is the growth here likely to be?
Yeah, so I think you're right. What we'd mentioned is that over the next, I would say broadly 3 to 4 years, we wanted that number to be around 10% of our overall revenue. I think we're headed in the right direction, although the number currently is small. So we've taken a couple of steps. One is that we have, for the last 2 years, we've been focusing on the non-basmati market. We believe that that's a very large opportunity in India. We did about 220 odd crores in FY24. The FY25, we did about 190 crores in that business. We are recalibrating that business, for focusing on the varieties that offer large potential along with margins. So that is underway right now. Q3, Q4 is when we've kind of recalibrated it. So you should see that business growing back. In terms of other areas that we're focusing on, recently we got into healthy edible oil segment. We believe that both our brand as well as the supply chain that we have lends itself very well to the healthy oil opportunity, and that kind of fits in with our portfolio. So I think we are in line in terms of what we committed earlier in terms of non-rice revenue.
6,000 crores by FY26 in terms of a revenue, above 6,000 crores, is that possible? And exports contributing what, 1,800 crores over what, 1,350 crores that you did last year, is that possible?
That's what we are aspiring for.
All right, and margins?
Should be an improvement over the current year.
By how much?
We don't give out guidance, but I think a Q4 is a good indicator.
And I think you said that realizations have improved. As on date, what is the realization, uptake that you've seen, say, today in comparison to the average you've seen the last couple of quarters? How much higher is it?
Yeah, Nigel, I would just clarify. I think what we are seeing is that the realizations are finally stabilized. Against year-on-year drops, in fact, continuing till the early months of Q4. We are now seeing that they've stabilized, and our view right now is that they should remain at this level for the rest of the year.
Okay, all right. Stabilize, then revive, and then thrive. I guess that should be the way you're looking at it. Thanks a lot, Mr. Jain, for joining in and filling us in with all of those details. Wishing you all the best for the remainder of this year. But for the time being, the street likes your Q4 numbers as well as the outlook ahead. Stock up close to around 5%. Well, time to slip into a short break. As we do that, though, there is some good news coming across for all our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store, or just scan this QR code that's up for you on the screen.
Welcome back. A bunch of stocks doing extremely well. We have Jubilant FoodWorks up around 2% from the lows, currently at the high point of trade. We're seeing some traction in Strides Pharma as well. Astral is the other one, which is up around 5%. That's the broader markets. The frontline indices are consolidating. We do have a bunch of stocks which are spiking. Even in the cash market space, we have Yatra Online, which is up 6%. We have Office Solutions, which is up around 4.5%. And we are seeing some traction in names like Rallis India, which continues to buzz with a gain of 4%, having put behind it a good month so far. In the month of May itself, Rallis India, after a good set of numbers, has rallied about 28%. That's in the month of May so far, and currently moving up to the high point of trade as well. But what's really done well over the last couple of weeks have been the defense stocks. Data Patterns and Zen Technologies are in focus after reporting their fourth quarter numbers. Ria joins in to tell us more about that, but more importantly, the outlook for these companies. Ria.
Well, yes, both Data Patterns and Zen Technologies have both been in focus once again today after reporting a very healthy set of numbers on Saturday. For Data Patterns, the revenue has gone up by around 117% on a year-on-year basis. EBITDA and net profit have both jumped up by around 61% over the previous year. Margins, however, have contracted to about 38% in this quarter versus 51% that we saw in Q4 of last year. For FY25, they've surpassed their revenue growth guidance of 20 to 25%, and they've also surpassed their EBITDA margin guidance of 30 to 35%. The order book, however, that has been weak for the company, coming in at just about 730 crores in this year versus 1,083 crores that we saw at the end of FY24. The order inflow guidance has also been missed. They had a guidance of rupees 7 to 800 crores for FY25, but the order inflows have only been about rupees 355 crores in this year. Going ahead, they do expect a revenue growth rate of 20 to 25% and EBITDA margins to be in the range of 35 to 40% for FY26. And today, the company said to us in an interaction that the order intake, although that has been weak in FY25, but that is expected to pick up going ahead. And they also expect an order book of rupees 1,000 crores in FY26. The stock was trading higher, up about 8% in early trade, but has pared some gains post that. Moving on to Zen Technologies, this stock has been in an upper circuit of 5% for the 7th consecutive session today. Revenue has gone up by around 130%. EBITDA is also up by 174% over the previous year. Margins have also have expanded to 42.5% versus 35.6% that we saw in Q4 of last year. The total order book for the company is healthy at rupees 691 odd crores. For FY25, they surpassed their guidance on all fronts for revenue, EBITDA margins and PAT margins as well. Going forward, they do expect to execute an order from the Ministry of Defence for integrated air defence combat simulators for the L-70 gun in FY26 itself. And today, the company also told us that operating cash flows are expected to turn positive in FY26. They're also expecting a revenue growth CAGR of 50% over FY26 to 28, and they're expecting cumulative revenues of rupees 6,000 crores over the next 3 years. So overall, very positive updates for both of these stocks, trading higher in today's session.
Thanks a lot for that, Ria. Well, let's focus on our graphite electrode companies. And Graphite India and HEG, they are buzzing in trade. The key reason is over the weekend, Resonac, that's formerly known as Shova Denko, they have halted graphite electrode production in 2 of their geographies, that is in China as well as in Malaysia. Now, the reason they have cited is that the business is facing margin pressures. This is very, very important for the global graphite electrode industry. Why is that? Because Resonac has approximately 210,000 tons of capacity. That equates to close to around 30% global market share, that's ex of China. And reports are suggesting that China as well as the Malaysia shutdown can impact a third of Resonac's capacity. So basically, the street believes that Resonac's shutdown will result in lower supply in the global markets. That in turn can boost graphite electrode prices as well as profitability. Just to give you a rough number, 210,000 will be around 30% of the global market share. If a third of that is going to get impacted, will be roughly around 60,000 tons, which, if you take it on a global basis, it should be closer around 3.5%. That's including China as well. It could be, back of the envelope calculation suggests, it could be roughly around 3.5% of global capacity, which in turn is pushing these stocks up. They've got badly beaten down because of pricing. Now it seems they've got a bit of a tailwind in store. So both these two buzzing in trade.
Take that point, Nigel. Thanks a lot for that. So that's about graphite and HEG. Just keep an eye out on delivery. That continues to do well. In fact, right from the word go, the stock was higher. And today, currently at the high point of trade as well. And after a spate of underperformance, the stock has reported good numbers. At least the street is believing that, the operating leverage in their part truckload business is playing out. Part truckload business basically is where, you don't have enough stuff to fill the entire truck. So the companies, book part trucks from a lot of various companies, and that actually is more margin accretive than the other businesses for delivery. So in part truckload business, the revenues grew by 24%, volumes grew by 19%, and margins jumped from 3.2% all the way up to 10.8%. And that's reflected in their overall numbers as well, where the revenues, which grew just about 5%, had actually seen an EBITDA growth of over 150%, 119 crores, as against 45 crores. And the bottom line was further boosted by their change in depreciation method. About 3 quarters ago, they changed their depreciation method, by which, there has been a savings of 60 crores on the recognized depreciation out there. And that has further boosted their bottom line. E-commerce, which accounts for most of their revenues, is actually soft this time around. So volumes have grown by just 1%, revenue growing by just 3%, tells you the weakness in the channel itself. Quick commerce is growing, e-commerce not so much, and out there margins have compressed too. But here the trigger is scaling up of the acquisition that they've made of Ecom Express. So that will play out for delivery, and that's something we'll watch out for. In terms of cash, they have about 5,500 crores on their books, so no real worries out there. The only fly in the ointment with delivery is that with every subsequent rise, the risk of supply increases because the shareholders, a large amount of big institutions holding delivery, waiting to offload. So any good news in delivery typically is bad news when it comes to the supply of the stock situation. But that's for another day. Today, the stock rejoicing on these numbers.
Okay, all right. Thanks a lot for that, Mangalam. Well, I think on that note, we can slip into a short break, or I think we've got another stock. Ekta is joining in to tell us about a pharma company that she's tracking in today's trading session. Ekta, tell us more about Divi's Laboratory.
Well, yes, Divi's Labs are a good set of numbers, and it's reflecting really in terms of the stock performance. So the revenue growth was around 12% this quarter. It was in line with estimates. We had the margins, which came in at around 34.3%, and that was versus estimates of around 32%, and profits of over 660 odd crores, much better than what the street was anticipating. What really stood out this quarter was the performance operationally, where the margins came in at a multi-quarter high. It's the best since Q2 of FY23. Now, in terms of a couple of key takeaways from the conference call, they have indicated in terms of guidance that they would look at double-digit growth going forward for FY26 as well. They are seeing more requests for proposals and quotes to come through because of the Biosecure Act as well as China Plus One. Interestingly, they are not going to be working in terms of generics when it comes to GLP-1. So semaglutide is not an opportunity that Divi's would be a part of, but they would be working with innovator companies when it comes to GLP-1. Cash on books remains high, 3,600 crores plus. Now, in terms of valuations, that's probably the only dampener because it's trading at over 60 times FY26 and over 50 times FY27. Now, a lot of the brokerages were quite positive in terms of the numbers. Jefferies maintains their hold. They say Q4 is largely in line with the balanced growth. They maintain a hold, however, on near-term patent challenges and high valuation. Goldman is neutral. They've raised their FY25-28 estimated EPS by up to 5% to factor in Q4. And Morgan Stanley, overweight with a target price of 7,225. They think the oral GLP-1 intermediate opportunity could be $100 to $175 million per year upon commercialization.
Right, Ekta, thanks a lot for that. That's about Divi's Labs. Let's go across to Sudarshan as well. Sudarshan has an update on Hyundai. Sudarshan, results were slightly better than street expectations, as was the management commentary.
That's correct. So earnings were slightly better than expectations, but the outlook given in the analyst call is looking largely, I would say, majorly positive. On the domestic growth, companies saying that it will grow in line with the industry, but export growth is going to be better. And here growth range is seen in the range of 7 to 8%. Also, companies said it will like to maintain EBITDA margin in double digits. Also, by FY30, companies looking to launch 26 products, and out of them, 6 will be EVs. Most of the brokerages remain positive on the stock. CLSA has outperformed call and target is 2155 per share. It believes that company is going to gain market share in FY27. JP Morgan too has an overweight call and here target is 2060 per share. It believes that domestic outlook is muted while export outlook given by the company is better. Nomura has a buy call and target is 2291 per share. It has raised FY27 target multiple to 25 times from 23 times, and Macquarie 2 has an outperform call and target is 2100 per share. So overall, all the brokerages are positive on the stock after company has given the positive outlook for FY26.
Okay, all right, sir. Thanks a lot for giving us that update. For the time being, we'll wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.
Good morning. It's time for Trading Hour. You're watching us live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me is Vinny Motiwala. Vinny, good morning. The week has begun on a slightly cautious...
It's a dull starting, right? I think Mondays, everyone wants to relax. Seems like the market also is feeling like, let's just relax, except for the mid and small cap.
Oh, yes. And the Monday blues, of course, for the... We can't really call it blues, but of course, after the week that we had last week, especially Thursday, we're seeing a bit of consolidation on the index. But the good part is that the Nifty is still holding on to levels of 25,000. And as Vinny mentioned, there is plenty of action in the broader markets, be it the mid caps, the small caps. There are earnings reactions, there are news makers, there are plenty of movers as well. The mid cap index 0.6% higher, the small cap index even better, 1% higher as we speak. And of course, as we mentioned, there are a lot of earnings reactions that we are tracking. But the top two gainers on the Nifty 500 though are Graphite India and HEG, where Graphite India is now up 14%, HEG is up 11%. So strong showing from both of these names. Nigel was mentioning earlier in the day that a key producer of graphite electrodes has stopped production, citing margin pressures across China and Malaysia, and as a result of which there is this pricing, this up move that has come in HEG and graphite, Vinny. But what are some of the other movers that you are tracking?
Absolutely, and mid and small cap, that is something that catches everyone's eyes, right? And on that front, because of a lot of earnings coming in as well, we have seen a move coming in on that front. Advance decline ratio today clearly in the favor of advances versus declines. And sectoral gainer, let's look at that. Realty among the top sectoral gainers today. Pharma, that is doing well. So pharma is also among the top sectoral gainers. Specifically in pharma, we had DVs also that came out with its numbers on Saturday. We had the con call highlights. So DV is also something that's buzzing in trade. Other than that, Kaplan Point as well as Alembic Pharma are the other pharma names in the Nifty 500 that are among the top list and top movers in today's trading session. Railways, that continues to be a trend as well. So Titagarh Rail, RVNL, Jupiter Wagons, all these railway stocks are buzzing. Along with that, defense names continue to see that buzz up as well. So Zentech or whether you look at data patterns, that is also buzzing in today's trading session. On the back of earnings and moves that we've seen coming in delivery, that's also the one that has been buzzing in trade. So that's something to watch out for on the broader end of the market. But on the flip side, we have protein eager governor that is under pressure today. That is down and out. It's locked in the lower circuit. Why? Because now what has happened for the company? In August, somewhere around, they had said that, the income tax department has asked for some proposals coming in from other companies as well, and including Protein Eager for PAN 2.0. That was supposed to have a budget outlay from the government side of around 1,440 crores. Now, obviously, they are saying that now they have not been selected as one of those players. So they are down and out. So that is why we're seeing that there's pressure coming in. 50% of the revenue for the company, for Protein Eager, is from the PAN services. This means if PAN 2.0 doesn't come in, then what is the outlook in terms of growth? Your revenue growth coming in. Maybe muted growth is what one could see coming in FY26. That's what Aquarius is highlighting as well. FY27 maybe could be muted as well. And they said that this side of the services were generating free cash flow for them. So that would lead to better new initiatives. Now that could also maybe be a bit of a threat. That is what Aquarius has highlighted. That's why they've downgraded the stock to a sell and cut the target price also. So that is something that is creating a bit of a pressure today coming in for Protein eGov. Not bit, Hormuz, but lower circuit is what we're watching out for right now in terms of Protein eGov today.
Big names in the shareholding list as well for Protein eGov, with the likes of Ramesh Damani and a lot of the other public sector banks as well, including SBI and the likes, also having stake in the company. As for the latest March quarter shareholding, if you could see, Canara Bank, Bank of Baroda, PNB, State Bank of India, Axis Bank, all of them have stake in Protein eGov. Nippon Life AMC also has a close to 4% stake. Suti has a close to 5% stake as well in Protein eGov. So big names, part of the shareholding. The stock is also off its 52-week highs, which is close to around 1,500 plus as well. So not a good day for Protein eGov, a 20% lower circuit. But the other earnings reaction that we are tracking today is Divi's Laboratories, 6% higher on that stock as well, continuing to move from strength to strength. Of course, SBI Caps in its note had mentioned that the company company does not have any further margin triggers or margins to move higher from current levels. Of course, they were multi-year high margins, but 6,600 on the stock now at Divi's Laboratories, a former Nifty 50 constituent, and up 6% in today's trading session. Of course, as Vinny mentioned, Titagarh, railway names continuing to do well, 6% higher on that stock as well. Of course, mind you, the stock is in the F&O ban, so we need to keep that in mind as well. Titagarh 968 on the stock. But take a short break here on a trading hour. Up next, we get to what's buzzing in the commodity space. Manisha Gupta joins in.
Welcome back to Trading Hour on CNBC-TV18. A quick look at what the market is doing, right? Again, it's come back about the 25,000 mark. So, we've seen it go up and down from the red and green, swinging between that. 25,000 is what it's managing to hold on to as of now. So, that is something we're watching out for. In terms of contributors today, obviously the banking side. So, private banks, you have HDFC Bank, ICICI Bank, and on the financial front, Bajaj Finance managing to hold on to and contributing to the Nifty 50. Flip side, we have IT that's not doing well today. So, Nifty IT is among the top sectoral loser, and that's why you're seeing Infosys, TCS among those names which are clearly under pressure. Nifty IT as of now is 0.7%. So keep an eye out on the IT pack as well. Now, other than that, in terms of some of these moves that we've seen coming in, today we have BEML, so the defense side, that's managing to hold on to gains. Then we have seen something like even Blue Star, that is managing to hold on to very strong gains of around 4.9 to 5% in today's trading session. A lot of move and volumes coming in from Graphite, Delivery, HEG and DVs seeing very, very high volume. Apart from that, we have seen just not only high volumes, a sharp jump up in the stock price as well. But we do have the management of Inox India who's joining in with us to talk to us about the numbers. They've seen good numbers coming in from the company. Highest ever revenue, EBITDA, order inflow and LNG order inflow as well. Revenue surged around 33.6%, while EBITDA also is seeing a rise coming in. We have Siddharth Jain, the promoter and a non-executive director at Inox India, joining in with us to discuss about the numbers, what is the outlook of the company going forward as well. Siddharth, good morning. Thank you so much for joining in with us on the show. Strong quarter. There's nothing to complain in terms of Q4. What are we watching out for in terms of FY26 guidance for the year, the full year of FY25? Seems like a bit of a moderation and the growth was at 15%. What are we watching out for in FY26? What is going to be aiding your growth and driving your growth?
Oh, thank you for having me on my show, first of all. It's nice to be here once a quarter and update you on what's going on. We basically had a great last year, of course, as you mentioned in your numbers, we had over a 30% growth in Q4. Our EBITDA grew by 50%. And even although in the last quarter, although for the full year, we had moderate growth between 15 to 20% across our top line EBITDA and PAT. Going forward, we clearly see our three verticals all, increasing at a rapid pace, whether it's our industrial gas, LNG, our cryoscientific, as well as our new beverage containers division. We've seen some great tailwinds from the energy sector globally. Our strategy that we had laid out over 2 years ago during the IPO time of focusing more on export jobs has also played out, as you can see from our backlog numbers as well as our revenue growth numbers. Going forward, I certainly see this year as a big year for LNG. We are seeing, a greater adoption of that fuel, not only in India, but across the world, across, different segments. So we're very excited about the next couple of years in this vertical.
Right, you're excited about the growth, but does that mean we'll see that 20% growth coming back, which we saw before in FY23 and FY22? Is that something we're watching out for in FY26 again?
I certainly hope so, but we don't look at it on a year-on-year basis. We look at it on a blocks of 5-year basis. A lot of our jobs are non-standard jobs, EPC-driven jobs, which extend beyond a year. We also have variability in orders, dispatches on a quarter-on-quarter basis. We're here for the long run. We certainly feel over the next 5-year block, we should be able to definitely match the growth of the past 5 years, if not beat it.
Siddharth, good morning. Thank you for joining in. The number of tailwinds that you highlighted in your first answer, does that or do all of those tailwinds translate into further margin upside for you in FY26? Do you remain in that 21 to 23% range, or do you see it going higher considering all of these tailwinds? What's your medium-term outlook on the margins? And if you could also tell us the margin differential between the end-user applications as well, Siddharth.
Sure. So, I feel, as you rightly mentioned, the margins being in the early 20s, I think are very healthy margins. The strategy and the focus of our company is to grow our top line while maintaining our margins. That's something that we mentioned during our IPO as well, that the aim is not to expand our margins, especially in our sector, which is the capital goods sector. It's not normal to see now margins of this sort. The reason we're able to achieve it is because of the superior technology that we have, and we're able to command a premium in the international markets and domestic markets for our product because they perform a lot better than everybody else's product. So going forward, we would like to focus on capturing larger market share, doing more first of its kind products, being a leader in the cryogenics industry globally, rather than see margins expand too much. Coming to your question on the three verticals and the difference in margins, clearly we have industrial gas, which is our legacy, LNG, which is, has been going for the past 10 years, and then we have cryoscientific. The highest margins always come from the cryoscientific division, followed by LNG and then industrial gases division. So this is to do with the complexity of the, of the projects that we do, the equipment that we make. It's obviously the most complex for the cryoscientific division, which focuses not only, on space, nuclear fusion, and many other verticals as well. So, I'm happy to inform you that the reputation that Inox India has built in the global market, especially in the CST division, which is the toughest to break through, and there are hardly any competitors in the world. I'm really happy to inform you that, we have a formidable position there. It continues to grow great.
Siddharth, paucity of time, so I'm just clubbing two questions into one. You ended FY25 with an order inflow of 1,500 crores. What are you expecting this year? And part two is your orders in your backlog as well in LNG has been very strong, but that has not translated into execution. Why is that so, and when does that pick up? Very quickly, if you could tell us both of them.
Yes, absolutely. We certainly, I can't give you exact numbers on what we're going to expect the year at, but we hope to certainly, continue our growth pace and order inflow as well. And in terms of LNG, most of the LNG jobs are non-standard jobs which take a longer time to execute. So you're not going to see that entire backlog flow into order inflows immediately. An example is in Bahamas, we got this huge order of a mini LNG terminal. This takes anywhere from 12 to 18 months to execute in a phase-wise manner. So while it shows up in the order backlog, you're not going to see that convert to revenue immediately.
Okay, Siddharth, thank you so much for joining in with us this morning, giving us a quick take in what we could be expecting from the company, and hope to see you more often on the channel, not just a quarterly basis. But Inox Wind, as of now, managing to hold on to gains of almost 1.5% in Inox India, I beg your pardon, managing to hold on to gains of 1.4% and 5% in today's trading session. But let's move on, and we have Manisha who's waiting by to tell us what's happening in the world of commodities. And starting the week with some sweetness, Manisha, sugar, what's the update there?
Well, yes, very contradicting fundamentals when you look at around the world. But what really seems to be supporting right now is that we have enough and ample sugar in various global markets. For example, you have Vietnam and Brazil being the major sugar producer, and the production there is on the higher side. Is the reason you're looking at the global sugar prices falling below 18 cents a pound there, with the market suggesting that in this year as well, it would perhaps be a range of around 16 on the lower side to 18 on the higher side, 19 perhaps, that you could be looking at sugar. This is the data that has come in from the International Sugar Organization, which tells you that the production is lower than the consumption, and they are talking about a deficit for this year. And much of that is because various sugar-producing countries did not see enough production happen in this season. And that's inclusive of Brazil and India to a point as well, where we are looking at sugar production, the lowest in 5 years, at around 261, 262 lakh tons. The sugar season is near ending. And while we opened this year with a stock of around 8 million tons, the closing seems to be at around 5 million tons, with a near 1 million tons of an export as well. And then you are also looking at sugar diversion for ethanol. That comes in on the higher side at around 33 lakh tons also. What really is the market factoring in right now is the next season, really, because in the next season, the expectation is that you could be looking at higher sugar production, not just from Brazil, but from India as well. And from around of a level of around 261, 262 this year, you could be looking at a level of around 340, 350 lakh tons next year. So we're looking at a much higher production in next year. The sowing almost has been done, and the numbers is something that the street is working with right now. And with the expectation that's going to be enough sugar availability in the next season is keeping the prices right now under pressure.
Too much sugar, not good for prices, not good for the body either. Manisha, thanks a lot for that. We take a short break. The Nifty continues to remain around the 25,040 mark. We continue corporate conversations. Then the management of Kalpataru Projects joins in on the other side. Stay tuned. Welcome back. Now we're being joined by the management of Kalpataru Projects after their fourth quarter results. Revenues were up 17%, EBITDA was up as well, but margins remained flat from last year. Execution pickup was also seen in the fourth quarter, but the FY25 top line growth of 14% was below the initial guidance of 20%. Amit Uplenchwar, who is the of Kalpataru Projects, is joining us right now. Amit, good morning. Thank you for joining in. You ended FY25 with a top line growth of 14%. Now that if you compare with your initial guidance of around 20%, What led to the miss on the top line front, and do execution worries still persist despite the pickup that you have seen in the fourth quarter?
So hi, first of all, a very good morning to you and all your viewers. We had recalibrated our guidance around the Q3 of last year to between 10 to 15% because primarily one of our segments, which is the water, across the board for all contractors, there was monies held up because of election, and then after that there was a little slowdown in the sector. But having said that, if you look at all our other divisions, whether it is transmission, whether it is building and factories, whether it is oil and gas, all of them grew, in excess of 20-25%. And except for the water, which was a bit of a miss, which is more of a timing issue, I don't see any structural issues with the segment as such. We have a healthy order book, and hopefully this year that'll get normalized.
Right. Amit, good morning. Winnie joining in the conversation as well. So yes, you're saying that you had revised your guidance. 15% is what you spoke about for FY25. But now FY26, then again, could we come back to 20% if things are coming and becoming better? Also, in terms of order inflows, what is the outlook on there? What is the order momentum shaping up like? Your guided range was around more than 25,000 crores for FY25. Would FY26 be something similar?
So, Winnie, in terms of our order book guidance, I think we met our order book guidance last year of 25,000 crores. And, we are looking at a similar kind of order booking at the rate of around maybe 28,000 crores for this year, given the fact that we're already sitting at a 2.5 years order book. So that keeps us in a comfortable position. Second, so far as your, growth is concerned for revenue, we are quite confident this year. Factoring the slowdown in the water that could persist for a quarter or two, we are still looking at a good 20% growth both on standalone and consolidated basis for the company.
Right. Amit, one more question. Apart from water, when I'm checking your revenue also, railways also seems to be a bit muted for FY25. So while water, you're saying couple of quarters maybe could be muted, what is the issue with railway side, railway revenues?
So any railway revenue was muted, and that was a planned muted revenue because the competitive intensity has gone to, on an average tender, there are 20 to 30 people bidding. And we've said this at the start of last year beginning that we are going to be cautious with railways. We are focusing on finishing our current order book and very cautious on how we take orders. We promised the street that we will look at margin improvement. And if you look at our Q4 numbers last year, we've had a phenomenal Q4 with highest ever revenue, highest ever PBT, and highest ever order book closing. And we are quite, happy with that performance. And going forward, that is exactly what we want to continue further. I mean, today, if you look at our balance sheet, we are the strongest ever. We've got lowest ever debt on our books. We are literally about 1,100 odd crores on a standalone basis for a 18,900 crore thereabouts revenue. One of the lowest in the industry. So for next year, our focus is, whilst we will grow at 20%, to also increase our margin profile going forward from 4.5% to 5% PBT, which we guided last year. And we achieved that. Next year, we want to cross 5% as our PBT on a standalone basis.
But Amit, since you are very cautious on the railways business, is there any plans of divesting it, considering the competitive intensity that you spoke of, and focus on other business segments that you are doing well in?
So, divestment is not a question. Today, if you look at all the EPC players in the country, there is nobody who, is spread across 75 countries in the world as the presence of a EPC business. So today for us, we may have competitive intensity in India for water or railways. But, if you look at our geographical expansion, today we are looking at water businesses going international. We've bid for quite a few projects, and hopefully we get one or two this year converting into order wins. I don't know which quarter that will be exactly. And we intend to do the same with railways, right? So we have the ability to go overseas with other divisions, which other people may not. So diversification, absolutely not. From a viewpoint of railways, yes, diversifying geographically, but no question of divestment at all.
Right. And since you mentioned you met your order inflow guidance for FY25, what about Saudi? Has there been any execution slowdown there or capex slowdown there, considering the fall in oil prices? What is the kind of on-ground tendering or the order activity that you're witnessing from that geography?
So, it's a great question. If you look at the results that Saudi Aramco gave this year, just as a, data point, Saudi Aramco's revenues far exceeded all the other 5 top oil companies put together as an aggregate. So I think they're, even at current oil prices staying, above $50 a barrel, I don't see a slowdown in Saudi. In fact, they've got a huge pipeline of orders that they've planned for the next 24 to 36 months, both in upstream, midstream, and downstream segments. And, we've got a very, very large presence in Saudi now in the ONG space, all the way up from north of Saudi, going down up to the border in Yemen. So we are very well placed in Saudi Arabia. Our teams are now established. We have a huge presence in terms of plant and machinery. And hopefully that will help us in catching a part of that business, which looks very, very robust in the years to come.
And Amit, just the last what I want, you did highlight a bit in terms of debt. Obviously, we've seen that reduction coming in the net debt for the company. I want to know the outlook going forward. What are we expecting in FY26 on terms of debt and net debt reduction?
So I think, Vinny, we will keep our debt in line with our business needs. We've always looked at 2 very, very significant metrics. And we've looked at net working capital days. And last year was one of our best. We've had at that base less than 100 days. And in Q4 was even less than 90. So I think we need to continue that trend of having a net working capital days of less than 100. And we keep our interest costs, under 2% of our revenue, which keeps our debt to equity levels very, very low, which keeps our ratios very low. And given the fact that our order sizes are increasing significantly and going towards EPC in nature rather than from what we were 5 years ago, our ROS is also improving steadily. And that is our focus for the next few years to come as well.
All right, Amit, thank you so much for sparing time joining us today. Wish you good luck for FY26 as well. By the way, choppy moves now in the markets. The Nifty is almost slipped into the red now, but still holding on to that mark of 25,000. Take a short break. A quick chart check from Aditya Agarwala from Invest for Edu. Oh, we'll be just before we take that break. Aditya Agarwala is indeed joining us now for a quick chart check. Aditya, good morning. Thank you for joining in. Very choppy after the moves that we saw last week on the index, but 25,000 continues to hold for the Nifty. Do you expect this consolidation to continue? And couple that up with your stock recommendations as well.
Hi, Almas. Good morning. Thanks for having the show. I think this consolidation is likely to continue for sure. 25,000 though is holding ground, but I'm not too sure if it will, even if it breaks, there is too much of a disturbance that's going to happen in the markets. I don't think so. The only index that is on my radar and I'm closely monitoring is the VIX. If you notice, the VIX is almost up 4% in trade today. So that is telling me that markets, even though are up in trade today, it can see some bit of a choppiness as the day progresses. So for me, what is important is the market continuing to consolidate with the key support levels holding on to the Nifty, which is somewhere between 24,800 or 24,600 on the downside. On the upside, clearly 25,300 is acting as a hurdle. In between all of this, Bank Nifty is something which is showing enormous strength, led by the PSU Bank Index. And I think Bank Nifty is poised to head higher from current levels, give or take some volatility in the Bank Nifty as well. I think 56,000 is something that in the Bank Nifty that will be taken out in few trading sessions. So one should clearly focus on the banking stocks, be it the PSU or the private sector banks. And along with that, power sector is something which is seeing good traction. So I think power is also something which will see a good bump up in next few trading sessions. So it's more of a sector rotation rather than money flowing out of the markets, clearly. And just to add on to stock trading ideas for the trading day, I've got a couple of buy recommendations. One is from the banking space because clearly banks are standing out. So Axis Bank for me is the buy. It's broken out from a fresh pennant pattern. So for a target of 1280 on the upside, I'll be a buyer here in Axis Bank, place a stop loss somewhere around 1180 on the downside. The second stock is ICICI Prudential. Again, this entire gamut of insurance plays, be it life insurance or general insurance, is looking excellent to me. And ICICI Prudential is something just given a fresh breakout from a rounding bottom. So at current levels, I'll be a buyer in the stock for a target of around 665, 670 on the upside. place a stop loss somewhere around 610 to about 615 on the downside.
Okay, Aditya, thank you so much for joining in with us, giving us a quick take in terms of the markets as well as the stocks that you like in the trading session as well. But on that note, we're going to slip into a very short break. But here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Trading Hour on CNBC TV18. Now moving on, and earlier on in the day, we spoke to Sanjeev Prasad, MD and co-head of Kotak Institutional Equities, about the current valuations of the defense companies. Listen in to what he had to say.
We were just buying anything and everything without looking at, whether the nature of what was going to the same as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make really, very little sense to me, at least, if I look at, let's say, something like a potential shipyard, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores. You can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Cochin Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores here. To take 10% PAT margin, you will make about what 5,000, 6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier. And that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PV of the 5,000 crores of that opportunity which Cochin Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there is no way you can justify this kind of valuation.
Okay, on that note, now let's focus to an IT company that's in focus, and that is Nucleus Software. They reported a strong set of numbers in terms of Q4 FY25. Rupee revenue was up by 11.3% on a quarter-on-quarter basis. Stock is right now buzzing away in trade with more than 12% of gains. So let's dive into the latest numbers. What is the outlook? What's driving the momentum? And will we see this continue? We have the CEO of the company, Parag Bhise, joining in with us to talk to us about that. Parag, good morning. Thank you so much for joining in with us on the show. Good quarter coming in, right? Last 3 quarters, we've seen subdued growth. Q4 overall, 11.3% growth on a quarter-on-quarter basis. One, could you highlight what has led to this jump up in terms of the growth in Q4? Was there any sort of a one-off? And also the outlook that you have for FY26, because FY25 as a year as a whole, you saw a growth of around just 1% or so. So what is the outlook there, and what led to this growth in Q4 as well?
Firstly, thank you so much for inviting me on your program. Really honored. So first, I'll talk about the Q4 growth. Look, we you know that we are essentially a product company. We have implementations which go on. So one is we did acquire a few logos in earlier quarters or Q4, and that gave a little boost to the Q4 revenue. But more importantly, our projects are milestone based, right? So if we complete some significant milestones in a particular quarter, so then that has a positive impact on. So it's a combination of these and some existing customers also putting in more faith in us and giving us extra incremental orders which we were able to execute. Is contribution. You'd remember a month or so back we had talked about one particular. There was a press release about one particular customer in the Middle East. That was significant because from order to execution we completed that in a very short time frame of 3 months. So that also contributes. So these are the factors which contributed to the Q4 growth.
What about FY26, Parag? 1% in FY25. Do you see that improving to say mid-single digits in FY26?
Look, the intent is always to grow and improve our margins, but you would know very clearly that we don't give any forward guidance. So on that, I would not be able to talk about the numbers. I can, however, talk about that the traction is good. The customers we're dealing with, we're getting good traction in India market, in Middle East. We're trying to grow to other markets, and our investments in significant both on the personal side as well as investment in technology will continue. So that I can definitely talk about.
You may not want to give an exact number, Parag, but a yes or no answer. Definitely better than 1%?
I can't say, but of course the intent is that 1% is not the kind of growth that we would like to be happy with. So sure, the intent is always that, but as a policy, we don't talk numbers, forward numbers that you're well aware of.
Okay, Parag, your thoughts coming in on, the focus on AI powered as well. With Middle East also, there was an announcement that came in on that front, right? So I just want to understand, how are you looking at this, the AI powered banking? What are the products that we are watching out for? Anything that you could highlight in the next year or 2 years? What could we see there?
No, 2 years is, I think, for AI and all is a very long time frame. The need is today, here and now. So we have started to build in use cases in our products. They are already rolling out in the market. So we have a list of use cases that we want to build both on the lending side, whether it is credit assessment, collections, various areas. How can, just as an example, how can we can make the statements more understandable by end customers who may not understand English or whatever. So there's so many use cases. So we are slowly and steadily building in use cases, both in our retail lending, transaction banking products, and this will continue. Also, AI in our own development, while we give that benefit to our customers, but we also have to benefit from use of AI in our own software development. So those work is also happening. So it is definitely a focus. There's no doubt about it.
And Parag, just a quick one. Order book in Q4, what was that looking like? Q4 FY25 and pipeline, if you could give us an highlight in terms of that.
I'm sorry, specific numbers I won't be able to give. I can only say that the traction is good. And yeah, we did have 4 new logos in last year I can talk about, and three new logos in the Q4. So that can give you an indication of the traction. We've been focusing a lot on going into the market and getting new logos. So I can talk that much.
Margins at 32%, Parag, sustainable or not in FY26?
Look, I'll again answer, while the attempt is always that, but investment focus is also there, right? So we would rather continue our focus on investments, and based on that, whatever margins come in, I think we always play long term. We don't talk about quarter and quarter, year and year, but definitely time for investment into our people, continued investment in our people and technology, and that can have some impact on the margins, but that is more important for us.
Okay. Thank you so much for joining in with us this morning on CNBC TV18, Parag, and giving us a highlight in terms of the company's outlook going forward. So that was the management of Nucleus Software. But on that note, we're going to slip into a very short break. Up next, we'll discuss market fundamentals with Mukul Kochar from Investec Capital Services. So don't go anywhere.
Welcome back. The Nifty has just slipped into the red now as we speak, still trying to hold on to that mark of 25,000. Currently, nothing to worry about, of course, absolutely at the flat line is the index, but a lot of earnings reactions. Credit Access Grameen has now extended its losses, 6.25% down on the stock. PB Fintech too is down 3.5% as we speak. A lot of cautious commentary coming in from the brokerages after its quarterly results. Godfrey Phillips was down 5% last Friday. It's down another 4.5% in today's session as well. So not good going for Godfrey Phillips. Although delivery slightly off the highs of the day, still holding on to gains of around 11.5% at 358 is a delivery, but of course still well below its IPO price of 487. Taking the market conversation forward now with Mukul Kochar from Investec Capital Services, who is joining in. Mukul, good morning. Thank you for joining in. Before we get to other sectors, I'd like to start off with the flavor of last week, right, which has been defense. A lot of contradictory reports have come in with the long term, yes, that there is going to be increased defense spending, so on and so forth. But now, of the kind of moves that you have seen, almost 30-40% in a week, valuations look stretched. So how are you positioning yourself in this segment, and what are you telling your clients?
No, this is, I mean, undoubtedly valuations are very expensive. If you look at it honestly, defense capital expenditure in India on equipment is probably $10 to $15 billion. Yeah. And most of these companies, if you look at it, and maybe that goes higher after what we saw recently, most of these companies that you see have significant top lines already. So growing based on Indian defense expenditure, honestly, these will not be high growth companies in most scenarios. And the multiples that are getting ascribed to them, they're excessive at this point, given the kind of growth that comes through. That all changes if Indian, defense equipment is globally accepted and, we become major arms exporters, which we are in certain segments. But, for certain segments like shipbuilding, etc., that's still a little while off. So I would sort of agree that, as a segment, it's an attractive segment. We need to spend internally. We are spending more internally. But, the pie right now is not big enough for these to be hyper-growth companies.
Okay, pie is
which
not
the
big.
multiples are.
Absolutely. Very, very expensive multiples that are there for these defense companies. Mukul, good morning. This is Vinny joining in the conversation. Just a thought in terms of the market as well first, before I dive into separate sectors. We've seen that comeback coming in and a bit of a recovery coming in from the 22,000 level for the market. But there's a lot that is happening on the geopolitical front, right? Tensions between India, Pakistan, you don't know where that is going right now. You don't know what is happening with the tariff front as well. So what are you keeping an eye out on? Do you expect better scenarios coming in overall on the fundamental front?
This is a very good question. Honestly, if you look at it, and I've spoken about this, I think, on your channel only before, that fundamentals of the economy are pretty good. Forget about some stocks being overpriced, depending upon most scenarios of growth that are out there. But the fundamentals of the economy are per se very good, and there are enough cheap stocks to pick from. In fact, I'll talk about Nifty valuation later, or even BSE 500 valuation later. But I think the biggest catalyst, and you said, what are you keeping your eye on, is the fact that our external situation, which is our essentially BOP, and before that our current account. I think we are in sight of having a structural positive or structurally neutral CAD at least. That actually changes a lot of things for India. So for instance, if we have a structurally neutral CAD, then we get away from our historical twin deficit problem, because of which RBI has been rightfully so running a tight monetary policy throughout for the most part. They can loosen up on that, and evidence of that's already started coming in. The April OMO that the RBI did, the 10-year bond yields, which are the lowest in the last decade or two outside of the COVID crisis. So a lot of it actually is already sort of starting to show through. It's the beginning, which is that fixed income yields in India are going down. And that has a lot of implications for equities, largely positive. In the context of the low 10-year bond yields, and this is where I said I'll come back to valuation. When you look at Nifty is actually very well priced. In fact, the earnings yield spread, which is inverse of PE for Nifty, and the spread between 10-year bond yields, which is where they get priced off, is the lowest it has been in the last decade, and this makes equities attractive. So there's always expensive and cheap stocks, and that's where the stock selection takes place. But broadly, the Indian markets are looking attractive, and that's what's holding us up.
Then why FII is not coming in the full-fledged form that one should expect them, right? They've just come back recently, but do you think that will also see a point of comeback at some point of time?
Yeah. So that's the part of the equation that actually sort of is important, because when I say that your current account becomes attractive, that is one leg. Then additional flows gives you more liquidity, and that is what gives RBI comfort to keep monetary policy easy. Now, when you talk about FIIs, that's largely a relative game. So they should find India attractive versus other markets. These equations stopped playing last year because India itself was undergoing a little bit of a slowdown. Valuations had gone to another extreme, and suddenly China became attractive. And a lot of flows went from India to China. If you look at it, everything in this equation has changed. China has gone into a trade situation with US where earnings looks to get downgraded, even though there's a sort of a compromise in the near term. Nobody's saying that trade war is over between US and China. US itself has gone through a little bit of a growth slowdown. On a relative basis, India therefore is looking attractive, where the kind of pocket of slowdown that we went through post-elections, we are pulling out of that. So growth is accelerating in India. Stock earnings growth is accelerating in India. The rest of the world is going into a downturn. So I think the flows here, which have just recently started turning for the month of April or May, are going to sustain for India.
Mm-hmm. So in this attractive Indian market, Mukul, where are you putting your money to work?
So broadly, let's put the attractive in context. With a 6-year bond yield at 6%, if I'm getting 12% return, I think my cost of equity is fulfilled. I mean, I make 12% in India. I'm really good with that. So in that context, financials look fairly okay. I think there's a little bit of upside that may come from consensus building really low profit growth in FY26. I think consensus may actually get surprised on that. So financials, banks look pretty attractive. Within financials, there's some capital market plays which look quite good today. Healthcare as a pack looks good. I would say pharma, diagnostics, all of them are showing good earnings, and that in the context of the valuation, the prices that they trade at, they're looking quite good. Within autos, we have a few picks over there, which companies have corrected, and we see enough earnings momentum there. Even within consumers, for the first time, we are able to get some stocks because we've always thought consumer was very expensive, but post some correction and some earnings momentum, we are able to find. So we are able to find, value. I would say India has never been a value play, but I would say adjusted for growth, some reasonable plays in the market today.
Okay, Mukul, thank you so much, for joining in with us, giving us an insight in terms of the markets, global scenario, how India stands as well, in terms of your sectors as well, which you like. Thank you so much for that. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere after the break. We have the management of Sharda Cropchem joining us to talk to us about the Q4 numbers.
Welcome back. Shifting focus back to earnings conversations. Then in Sharda Cropchem is the management that is joining in on the show. The company saw its consolidated revenue surge nearly 40%, while EBITDA increased 16%. Margins, however, were under pressure. To discuss more on the quarter gone by and the road ahead, Mr. R.V. Bubna, the chairman and managing director of the company, is joining in. Mr. Bubna, good morning. Thank you so much for joining in. With the kind of FY25 that you've had, what is the kind of growth that you are penciling in for FY26 on the top line and the bottom line front?
We are expecting further 15% growth, and bottom line also about 15 to 18%.
Okay, 15 to 18% growth is what you're expecting in FY26, right, Mr.
Yes, yes, madam.
Okay, sir, morning. Thank you so much for joining in with us also. And, what I want to understand, in Q4, in your non-agri business, I just want to know, in terms of realization, what was the drop there and why was there a drop in Q4?
Madam, this is just seasonal, or there's no particular reason for it. Okay. It is usual.
Mr. Bubna, what have been the realizations in the Cropchem segment? If you could shed some light on this, and is that trend expected to improve going forward into FY26 as well?
Well, first question is realization is very good, and the trend is going to continue in the FY26.
If you could quantify that for us, sir?
Put your question once again, please.
What would be the realizations in absolute terms, if you could give us a number for FY26, and what was the number in the fourth quarter as well?
I'll have to look for it. Let me check up. We can go to the next question.
Okay, right, sir. Sir, overall, could you talk to us about different geographies as well? Europe, NAFTA, LATAM. What is the outlook here going forward in FY26? The growth also that you're expecting in terms of volumes, sir?
Madam, this quarter, our growth in NAFTA has been excellent. And the next is Europe. Third is Latin America. And fourth is rest of the world. And I feel the trend will continue.
And since you mentioned all of these geographies, are there plans to expand into other geographies as well, Mr. Bubna? And part two, if you could also share your geographic mix when it comes to domestic and exports. What is the kind of mix that you have currently?
Domestic, Domestic, we don't have any business in Sharda Cropchem. There's a very small business in one of our subsidiaries, but that forms around 1% or less compared to the Sharda Cropchem.
And what about expansion plans for other geographies, Mr. Bubna?
Sir, I have covered the entire world when I say NAFTA, Europe, Latin America, and rest of the world.
Any specific geography that you would want to lay your emphasis on, focusing more on Europe, focusing more on NAFTA?
Our emphasis is always in Europe and NAFTA. So these are the geographies where the rule is followed and the registrations have a very good value and the prices are also good.
Sir, you have also said that in FY26, you're looking at around a 400-450 crore capex, right? So where is this you're going to be deploying? What are you going to be expanding? Where is the use of this capex?
Madam, this is for the entire geography. There is no specific, but our main emphasis is in NAFTA region. US registrations are the most expensive, and so are the registrations in Europe.
What would you be using these funds for? Expanding capacities for R&D? If you could share a breakup of that, sir.
No, sir. These expenditures will be mainly for receiving registrations of agrochemical products, which is a very expensive and time-consuming process. These are going to be intangible assets and not tangible assets.
Okay, so mainly for those registrations which are expensive, so that is where it will be used, this money of 400-450 crores.
Yes, please.
Okay, and sir, could you talk to us about, are there any new generic molecules that you're looking at to enter, anything on that front?
Madam, generic molecules are not of much interest to us because there's a lot of competition. Okay. We always concentrate on the products which are restricted and where the entry barrier is registration. There the competition is very minimum and realization and margins are also very high.
Any price hikes on the annual, Mr. Bubna? And if so, what would that impact your gross margins? They were at around 30% around about, and so would that remain in FY26 as well?
It should remain. Maybe it will grow up a little bit, maybe 32%.
All right, Mr. Bubna, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. There is a management there of Sharda Cropchem on the road ahead for the company. Well, the index continues to remain where it is. There's no significant movement on the index, but look at Graphite India now, 15% higher, the top gainer on the Nifty 500. Delivery continues to hold on to gains. HEG continues to hold on to gains, 10% higher there as well. The other stock that has sprung up on the list of gainers is Kaplan Point. It reported results last week. That stock is up 6.25% there as well. Some of these mid-cap pharma names are springing up among the list of gainers. You just mentioned Kaplan Point. Alembic Pharma is one as well, 5.5% higher on that stock. So good going for a lot of these mid-cap pharma names, and of course can't not talk about the railway stocks as Vinny just highlighted earlier in the show. Of course, look at RVNL, look at Titagarh, look at some of the other railway names. Jupiter Wagons is one of them, 6.75% higher there as well. So railway stocks continuing to move higher, although defense has taken a bit of a pause in today's trading session. But with that, we call time on this edition of Trading Hour. From Vinny, me and the team that put this show together, thank you so much for watching. Halftime report for the next 60 minutes.
Stocks see range trade as the market digests positive and negative global and local news. Realty and healthcare are the big gainers. IT is the big drag.
Divi's Labs brings a positive surprise with operating profit margins at multi-quarter highs. Strong inquiries for business also promises double-digit growth in FY26.
Bajaj Auto's overseas arm raises debt of nearly 566 million euros and plans a 50 million euro infusion via convertible bonds into the KTM arm. The move is seen helping the Australian two-wheeler maker stave off bankruptcy.
Defense gear makers Zen Technologies and Data Patterns surpassed quarterly expectations with a strong show, but stocks of some like HEL, Mazagon Docks and Cochin Shipyard slip on valuation concerns.
Delivery reports a strong quarter with significantly higher margins riding on strong volume growth in the part truckload business, even as express parcel vertical sees a slowdown.
Hello and welcome to Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a session of consolidation at this point in time, at least for the frontline indices. But we have a lot of stocks which are in focus on account of news. So we have a lot to take you through in the next 60-odd minutes. Hi, Mangalam.
Hi, Ekta. Absolutely. We're seeing a big traction in some of these individual names. So the Nifty PSU Bank Index is the one that should come up for you. Seeing a big up move on today's trading session. In today's trading session on big volumes. Then you have, earnings related reactions. You spoke about Divi's Labs. There's Bajaj Auto. The two-wheelers are on fire as well. And alongside that, we have some traction that we're seeing in a couple of these cash stocks, which are seeing a fair amount of an up move. We have a big traction that we've seen on names like Nucleus Software, which is up around 11%, defying the weakness that we're seeing in the IT pack. Otherwise, Park Hotels is the one that sprung up with a big up move, up around 7% on that counter. HEG Graphite because of lower supply in the world. But the latest F&O entrant, Delivery, is doing well after reporting a good operational performance in their fourth quarter, where we saw their revenues grow by about 5.5%, but the EBITDA actually jumped by over 150%, 160% to be precise, and that is largely because of their part truckload business, which is a margin accretive business, seeing benefits of operating leverage coming in out there. And the bottom line of the company had actually improved on the change that they had made in their depreciation method, by which they will recognize lower depreciation as against what they did earlier. This has been going on for the last 3 quarters itself. More importantly, the part truckload business, which was the driver of the business this time around, had a 24% revenue growth, 19% volume growth, and we did see margins improve from nearly 3.8% to about 10% on that in that segment. What's not doing well for them is the mainstay, which is the e-com express business, where we saw nearly 3% revenue growth, just 1% volume growth, and margins also compressed on account of operating deleverage out there. Here, the question is whether their acquisition of e-com express can be scaled up and added to volumes and revenue out here or not. They are comfortable on the balance sheet, close to 5,500 crores of cash. So Delivery is doing well.
Okay, all right. Delivery is delivering.
Delivery is delivering.
So any which way, that's one particular stock in focus. That stock is up around 11%. But let's get talking to Emami. That's the first management on the show. They reported what was a good set of Q4 numbers in what is a challenging environment with high single-digit revenue growth and underlying volume growth at 7%. The management is expecting a gradual pickup in consumption FY26 onwards. To talk more about the earnings and the demand environment, we have with us Mr. Anish Bansali, who's the CEO of Finance Strategy and Business Development and the CFO of the company, joining in. Mr. Bansali, thank you very much for taking the time out. So just take us through a more nuanced answer about the 7% volume growth that you clocked in this quarter. Tell us about the trends that you are seeing in terms of demand this time round, and what are you now projecting going into FY26 when, 1, it comes to demand, and 2, hence volume growth?
Yeah, so at the outset, my apology as I have a bad throat now, but still I'll try to answer your queries. So the volume growth had been very good for the fourth quarter, as you have witnessed, of 7%. And we expect with the good summer winters, we expect the good volume growth to come in the times to come. Though there has been some moderation in the initial months of April and so, But going forward, there is still some time, some few weeks ahead, and we expect volume growth to be a little better.
So 6 to 8% volume growth for the entire year would be a broad range. And since you spoke about your throat not being too well, I may attribute that to maybe unseasonal rains. That brings me to my second question, Mr. Bansali. What about summer? You saw
so
some
while it has
moderation there.
impacted
Yes.
somewhat the offtakes, it has also impacted the health.
Exactly. So, summer accounts for nearly 40-45% of your overall sales. We did see some traction in Navratna and Dermicool in the fourth quarter. What's the outlook for the first quarter? And if you could give us a broad range for the volumes for the entire year.
Yeah, while Talcs has been, because the last year, the first quarter had been good for them. And we expect to deliver a good volume growth on the top of it. Oils has been relatively much better compared to that. And so broadly, as I said, looking at the kind of trajectory we feel, and we are little optimistic in terms of the remaining 6 weeks. And so we expect a good growth there.
Okay. Your Kesh King brand was a bit weak this time round. I think there was just about a marginal decline, or it was just about flattish in terms of a performance. You're also planning to relaunch this particular brand. So take us through what went wrong with Kesh King and what is the plan in terms of relaunch and what are you then projecting?
So it's not with the brand. In fact, the category has not been favored a lot by the consumers. And we have recently, in fact, since last few months, for more than 6 months or so, we have inducted BCG to advise us on the hair care and hair care and skin care portfolio, which includes the Kesh King as well. In fact, the decline had been higher, but this quarter, the decline had been arrested, and we have lot many strategic initiatives we have undertaken. And we expect this to come to the growth path because there are so many things we are doing strategically on this. There is a 360-degree strategic move which we are doing in terms of marketing to positioning to the distribution and everything. And so we expect the second half of this quarter would be very important, and we expect a sea change there.
What do you mean when you say sea change? What's your target here? What are you targeting in terms of quantitative growth and absolute revenue from Kesh King over the next, say, couple of years?
Yes, we are expecting a good growth rate. The growth is a problem statement which we need to address. And so it would include the growth from the same category and also from the adjacencies and from everywhere. And in terms of the channels, channel optimization, everything.
So what kind of adjacencies are you looking at? And, the other category where you have shown remarkable improvement is the male grooming category, where, Fair and Handsome has now been revived into Smart and Handsome, new products, and that's shown in growth. 7% growth is what we've seen in the fourth quarter. How much more are we likely to see from here on as this gathers more steam? Are we looking at early teens in terms of male grooming range this year?
Yeah, we are hopeful of that because we have completely, and so our, as you might have witnessed, so we have now from the fairness claims, we have moved on to the male grooming completely. And with this repositioning and relaunch, we expect at least a double-digit growth in the times to come. And the early green shoots has been very good. It has been accepted very well in the market. And so that is it. So because this category also under pressure since few quarters, and that initiative of repositioning has played well, and we are optimistic about that.
Okay. So net, what does this do for the entire fiscal, Mr. Bansali? 6.5% growth is what you clocked in for FY25 with a 10% or 11% profit growth and margins of around 27%. Tell us, what is FY26 going to look like on all these three parameters? Revenue growth, EBITDA or margins, and profitability.
To give a very summarized reply, no, it would be a better growth. If not similar, it would be better.
So when you say similar, if not similar, better would be...
Looking at the peers and the kind of environment which we are passing through. And so because there are so many uncertainties in terms of the seasonality as well.
So are you assuming it's going to be a sub 10% growth but better than 6.5%, or is it going to maybe be a plus 10% growth?
Internally, we expect a double-digit growth, but depending on the seasons as it may fall and the kind of environment, it could be a little lesser, but we are expecting a double-digit growth.
And what kind of profitability expansion are you expecting? A margin expansion of, because you are relaunching, so obviously that would mean higher ad spends, etc. as well, right? 100 basis points improvement in the margins, or margins will be stable?
We expect margins to be stable. In fact, our A&P ratios has been in the range of 17 to 18%, which is highest in the industry. And so we will continue to invest behind the brands very aggressively as we have done in the past. And despite this, we have the highest EBITDA margins.
And this double-digit revenue growth that you're targeting, how much of that are you targeting via volumes and how much of that via price realizations or premiumization?
Generally, price growth has been around 3% or so. So rest would 3 to 4% maybe max.
So high single-digit volume growth and low double-digit revenue growth is what one can look at. Any other acquisitions that you're looking at? Because we've seen some moderation in the Man Company and Brillare last year. You are targeting high double-digit growth this year after all the changes that you've made. Any other D2C platforms which are on the block for you to look at? Any particular categories that you're eyeing?
So we are always on the lookout for inorganic acquisitions, be it full-fledged acquisitions or investments behind the startups. So inorganic growth has always been is one of the important pillars of growth for us. We keep on looking at it.
Okay.
So we keep on evaluating them.
Okay. What is the size of the acquisitions that you might be looking at, and which segments specifically?
So we would continue to remain in the personal care and healthcare segment. So that would remain. We will remain in the place where we are already. And as if you look at our financials, we have a cash on balance sheet of around 750 crore, despite paying dividends of 10 rupees, 1,000% dividend. And so we have a lot of huge cash on the balance sheets, and despite very high dividends, capex, and investments behind the strategic investments. So all taken together, there is no constraint if there is a right opportunity, and we would always look out for a good inorganic opportunities as well.
When you say personal care and healthcare, in healthcare specifically, can I ask you if you guys are looking at nutraceuticals, preventive healthcare, wellness, in terms of any sort of food items also? Is that on your cards? Are you looking at healthy snacking, healthy foods?
So we would be there in the health means which has a health potential, which is really good for the health. So not really kind of a snacking kind of, but if it has some good health value, health proposition, then we may look at it. So in fact, last year we had invested in strategic investment made in aloe fruit. It is a juice-based product, a juice company with aloe as an ingredient and based on the health. And we also invested some stake in taken some stake in True Native earlier, which was a nutraceutical and this company vitamins.
Yes, we do know about True Native. We were just wondering whether you were looking to increase some stake out there and increase your offerings in the protein and other nutraceutical segments out there.
We keep on evaluating the right opportunities, and we nurture them.
Thank you, Mr. Bansali. Thank you for giving us an outlook. Maybe FY26 is a lot better than FY25, but more importantly, the next time we speak, your throat and health is a lot better than what it is right now as well. Take a short break. On the other side, the management of E-Clerks joins in to discuss their fourth quarter numbers, even as the numbers of Dodla Dairy flash at the bottom of your screen.
Welcome back. Well, you're still tuned into Halftime Report on CNBC TV18. E-Clerk Services posted what was a good set of Q4 numbers with the rupee revenue up around 5.18% on a year-on-year basis. The top 10 clients saw growth sequentially, but emerging clients remain subdued. To talk more about the earnings, we have with us Srinivasan Nadadhur, who's the CFO of the company. Srinivasan, hi. Thank you very much for joining in. Well, let's start with a broader question about FY25. Your constant currency growth has been steady at around 11 to 12%. What are you targeting in FY26? Do you think that you can probably maintain this 11 to 12% or possibly better it?
The ambition is certainly to try and do better. But a lot depends on, and to that end, I think the pipeline is good. We're looking at good growth in all of our segments. But a lot also depends on how the external macro environment plays out. And there's a lot of uncertainty on that front. So let's put it this way, that internally we are geared to deliver strong growth in FY26, but there may be some things which are outside of our control.
Okay. When you talk about the uncertainties, what would you think is top of mind when it comes to the uncertain environment for you? And if you could just give us a sense in terms of the top key issues that the company is probably going to deal with in FY26, and how do you probably look to navigate it?
Right, sure. So to my mind, there are about 2 or 3 key issues. One of them is the tariffs that the US has imposed and what effect that might have on our clients, especially in the retail segment. So we may see some second or third order impact of that. Already we are seeing that some of our clients seem to be refocusing their energies on dealing with tariffs and managing that. So a lot of their time is getting consumed on that front. So that's one. The second is something out of left field, like the India-Pakistan conflict. That might have an effect because it's really unpredictable, and that may lead to a lot of nervousness on the client side. And the third is how we are able to use technology and stay relevant for our customers. And that continues to be the case for us all the time. We often think about it. We often think about whether we are doing the best we can in terms of using AI and other technology to deliver the absolute best for our client.
We were thinking of asking you about AI a lot later in the conversation. We will ask you about that. Hold on to your thoughts there, because attrition in the fourth quarter has been very high as well. Q3 it was 18.8%, fourth quarter was 24%. So wanted to know if there was something, structural out here. But as far as this year is concerned, if you could give us a sense, last year you grew between 11 to 12%. Your deal momentum was fairly high in the fourth quarter. So whether that sustains or not. And this 24 to 28% margin band, you're at the lower end of that for the last, I think, 3 or 4 quarters, so to say. Do you maintain that band, and what part, the lower end or the higher end of the band, would you achieve in this year? So on your revenue, deal momentums and margins, if you could give us some sense.
So deal momentum continues to be strong, as you have noted, and there has been a significant shift in the last couple of quarters in particular. So if conversion happens as earlier, then things should go pretty well for us. On the margins, I think for now we are sticking with the 24 to 28% range for EBITDA. And given the fact that we've opened a couple of new centers in Lima and in Cairo, there is going to be some amount of downward pressure on margin, and therefore we'd like to stay within this range and see how things turn out.
What is this range? If staying within this range is what range?
24 to 28, which includes other income, actually.
Okay.
Revenue, 11 to 12%, possible?
Let's see. I mean, it's kind of hard to predict, and we normally do not give guidance. Therefore, I am sort of refraining from giving a number.
Okay, I just wanted to circle back to the uncertain environment that you were talking about when it comes to tariffs. Geopolitically, yes, we probably haven't seen the impact as of now. But with regards to tariffs, are you already seeing any kind of impact in terms of your client wins, in terms of, say, closing contracts? Is that already coming into effect for the company?
No, not really, not at this moment. Although what we are seeing is that some of our clients in retail, high tech, etc., they are having to devote more of their time in trying to understand and mitigate the impacts of tariffs for their own businesses.
Okay.
may lead to some amount of slowdown in decision making for us, but no significant impact seen at the moment.
So what are you predicting when it comes to, say, your top 10 client growth and as well as your emerging client growth, which I think top 10 grew around 7% on a sequential basis. Emerging clients grew over 4% Q on Q. Are you replicating that kind of growth going forward every quarter?
So we'd like to focus more on our emerging, and some of the things that we want to do is to have more discipline around the sales operations, try and cross-sell our services into all our large and medium-sized clients. So it's hard to say whether top 10 will grow faster or emerging will grow faster, but the long-term objective is for us to drive more growth in emerging.
Right. What about, attrition? It's higher in the fourth quarter. What caused that? And the corollary question is artificial intelligence. Everyone's been talking about, how they're looking to lay off a lot of people because the low-end jobs would be replaced by artificial intelligence. What is your company's policy here? And what's your outlook here?
So attrition for us operates in a certain range, and I think Q3 was a little lower than usual. Q4 maybe a little higher than usual, but we're not really concerned about it as long as it stays within a certain range.
What is the range?
So excluding the bottom quartile, I think between 20 to 30 is okay with us.
20 to 30 is quite a range. I mean, that's either a fifth of your employees or a third of your employees. Just trying to figure that one out. And artificial intelligence.
So on AI, our objective is, the way we look at it has always been that it is more of an opportunity than a threat. And what we are trying to do is to try and embed Gen AI and Gen AI features into all the productized services that we are performing, therefore allowing clients to use the best that AI has to offer. So,
okay. If we were to have this conversation, say, a year from now and discuss AI, how much of it do you think would be contributing to your business as compared to now?
So today's number is very small, and that's because there's a lot of pilots happening. Clients are in the midst of decision making. Hopefully that number next year when we talk about will be a lot larger, but hard to put a figure to it.
All right, take that point. Hopefully we have a lot more in terms of visibility when we speak next. But for now, the key takeaway is that you're striving for growth this year, irrespective of the environment, with deal momentum continuing to be strong and margins in that wide band of 24 to 28%. Thank you so much for joining in. Wish you good luck for this year. Take a short break, come back, get you more on the markets, a lot of stock-specific action on the other side. Welcome back. You're looking at the market data coming in right now, which indicates there is a fair amount of consolidation at lower levels, but at the same time, there is a lot of purchase that we're seeing in the broader market. So if you look at both the Nifty as well as the Sensex, absolutely flat. At lower levels, Nifty is seeing some purchase around the 25,000 mark is where it's fulcrumed in today's trading session and the Friday's trading session. Sensex absolutely flat too. The reason why the Nifty is flat despite the Nifty Bank doing well is because the tug-of-war between Nifty IT and Nifty Bank. So that's what's playing out right now. The Nifty IT index down about 1%. Broader markets, no problems. Typically, this happens when the street believes that the lower level for the market is protected. Nifty mid-cap index is up 0.6%, 1% higher for the small-cap index. Wide range between the green and the red lines, the wide difference between the green and the red lines makes your portfolios feel a lot better today. As against what the index would tell you, just keep an eye out on the India VIX. Even as the index is consolidating, India VIX is spiked slightly, so I'll watch out for that. There is a fair amount of writing on both the 25,000 call and the 25,000 put, telling you that the street believes that the market will continue to remain fulcrumed around this level for the next couple of days until this expiry. And the range, the broad range would be 24,700 at the lower level to 25,300 at the upper level itself. A lot of short covering is what we're seeing on delivery backed by good numbers. Divi's Labs is seeing some long positions being added. I'm just watching out for LIC Housing Finance. Still a fair way away from hitting the threshold of entering the F&O ban, but the ferocity with which open interest is being built up, I wouldn't be surprised if not today then tomorrow the stock goes into F&O ban. So that's something we'll watch out for. Take a short break. Come back on the other side. We have management of South Indian Bank joining in to tell us about their earnings.
Welcome back. Well, for the markets, it's holding up at this point in time for the mid-cap. So the mid-cap index is up around 0.5%. We do have one bank which is on our radar. South Indian Bank, in fact, is doing well. That stock is up around 4.5% post its numbers. Asset quality has improved as the gross NPAs declined on a Q-on-Q basis, and so have the slippages. To discuss more about the earnings and the quarter gone by, we have with us Mr. Seshadri, who's the MD and CEO of South Indian Bank, who's with us now. Hi, sir. Thank you very much for joining in. So let's start with that positive piece of information where your slippages, we do understand, have reduced on a sequential basis. Give us the absolute figure in terms of slippages this quarter. I think it came in at around 213 crores versus, say, around 300 crores in the previous quarter. What led to the lower slippages and what was recovery like in terms of this quarter gone by?
Slippages were the lowest that I can remember. Our slippages came in at 206 crores for the quarter, which is 24 basis points. And if you annualize it, we dropped below 100 basis points for the year. Recoveries were north of 500 crores, so there was significantly higher quantum of recoveries than there were slippages, which therefore helped our financial outcomes very significantly.
Right. You did say that FY25, the last time you joined us, will see advances of between 10 to 12%, 10 to 11%. That actually is something that you've missed mildly, if you must. 9.8% has been your advances growth in the previous quarter. Wanted to know what your target for this year is when it comes to loan growth, advances growth, and what are you targeting in terms of spreads and NIMs?
Okay. Actually, last year we were telling, our stated objective was to get a 10% advance growth. And the finalized numbers show approximately 9% growth, but that's after a 900 crore charge off.
Right.
A write-off of 900 crores. So if you take that into account, we have hit the 10% number that we stated earlier. This time around, we want to be north of 12% advance growth. Deposit growth, again, to be north of 10, 11%. On the NIMS front, I'm a little hesitant to give a number right now because of the situation where the cost of funds are dropping far slower than the other side of the balance sheet. And therefore, it's an area of active management from our point of view. But we are reasonably confident that the profit momentum that we've shown will continue to be present, at least for in the foreseeable future.
So when you say uncertain for NIMS, what exactly is it that you mean? Is it uncertain to see an expansion on NIMS, or do you believe that you don't have a bottom when it comes to, the NIMS compressing? Or would you just about maintain NIMS at these levels? I'm just trying to understand what this uncertainty entails.
The NIMS will actually shrink.
Yes.
The shrinkage is something that we are studying. As of this moment, we don't have a view as to how much it will. The advantage that we do have is that a very large portion of our book is very short tenor assets. So we tend to do a lot of corporate business, which is 30-day money and 60-day money and so on and so forth, which we should be able to reprice. Approximately 40% of our book is linked to external references like repo and T-bill and so on and so forth. The rest is not. So at this juncture, we think that we should be able to manage NIMS. There will be compression. The exact quantum of compression is something that I'm hesitant to put a number on.
So are you saying that you can maintain this maybe 3% mark, at least in terms of net interest margins? You closed FY25 with around 3.21%. Where does that go from here? Is it just a few basis points in terms of compression that we're seeing?
I would think that a 10, 12 basis point compression is something that we should see, but we are doing our best to manage it and have the outcomes reverse. So if you see Q4 results, our NIMS actually grew 2 basis points. So from Q3 to Q4, we grew 2 basis points.
Okay.
So as of this moment, I'm a little hesitant to give that number, but the trend is that it's going to be, the NIM will be under pressure.
But are you seeing that kind of hesitance, or when it comes to the asset quality guidance as well? Because you did 206 crores in terms of slippages, your recoveries were north of 400 crores. Those were two excellent parameters for you this quarter. But are you going to sustain that kind of performance in the coming quarters?
So we think that our asset quality, across every measure on asset quality, we've done very well over the year. Our SMA2 number came in at 30 basis points at the end of Q4. So we are feeling very comfortable from an asset perspective at this point in time. And we think that the total NPA accretion that we will have will be substantially lower than what we had this year. So we are very comfortable there. The NIM is an area of some concern, which we are dealing with.
Would you be comfortable giving us a ratio that you're targeting for both your GNPAs and NNPAs?
The GNPA as of this moment is 3.2, and the net NPA is 0.92 as of this moment. So I don't want to, I'm a little hesitant to talk about future technical.
Got it. The other thing that stood out in your numbers, in fact, the primary, positive, apart from the other things that we saw, was the big jump that we saw in your operating profitability. Your cost-to-income ratio saw a sharp dip, just above 52%. Where does that number settle at?
Here, our cost-to-income is about 57%. We've been very disciplined on the cost front. So I think we are one of the institutions on the street that have managed costs very well this year. We were very candid with the street as well that cost to income is a ratio that we want to attack. So we actually went very slow on hiring. We cut back on branch growth. In fact, we consolidated branches a little bit, and we focused on productivity increase in all the branches that we did have, And that led us to a year-on-year decrease in cost to the extent of 431 basis points on a cost-to-income ratio perspective. We think that trend line will continue. We'll take out another 200, 250 basis points more during this year. And at that point in time, we will be reasonably cost competitive. So we started off having significantly higher costs than our peers. And that is something that we would have corrected by the end of this year.
So would you have a target on ROEs and ROAs? Because you're hesitant on NIMs and GNPA and NPA. With the cost to income ratio coming down by about 200, 250 basis points, that would mean better profitability. Do you have a target here?
Yes, our profits for the quarter was about 110 basis points, and for the full year was at 105 basis points return on assets. In the early part of the year, we think that we would be near about the 100 basis points mark. Latter parts of the year, we want to get to about 115 basis points or thereabouts. So if you were to average that out, you'll get the actual number.
Okay. Just before we let you go, just wanted your entire outlook on the MSME loan space. You also, I think your book is, over 9,000 odd crores. Just give us a sense in terms of how exactly that book is doing when it comes to asset quality, and what is the growth that you're projecting within MSME and the SME space.
So this is the year where we step on growth. Last year we did 10% growth. This year we'll do 12 plus. Majority of our growth will come from MSME and retail. In fact, the proportion of the corporate book will actually decline through the year. We think that the MSME piece, we should be in a position to grow 20+%. The portfolio is doing quite well. We did have strains in the past. Those have all washed through the balance sheet. We have a clean book at this point in time, and we have now new underwriting tools, which we think will hold us in good stead as we go forward.
Okay, all right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the management of South Indian Bank. As you can see, the stock has actually moved up higher. It's up around 6.5%. So maybe the street likes the commentary coming in from the management at this point in time. We'll take a short break, but here is some good news for our viewers. India Business News Leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at just your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. You're watching us here on Halftime Report. There's an important update coming in from Protein eGov saying that they've reached out to the Income Tax Department in regards to the request for proposal. This is for them being excluded from PAN 2.0. They're saying that they see no immediate impact. It's not about the immediate impact, of course. PAN 2.0 is a future business prospect for them, and PAN accounts for nearly 50% of their revenue. So if future growth doesn't come by, that's what the street is more worried about than the immediate impact. Them being included for this would be a big positive. But for now, they've said that they are looking at having a conversation with the IT department. The street unperturbed, the stock down 20%. Let's talk about another stock which is buzzing on the back of a good performance. That's Divi's Labs. Ekta, the margins.
Well, yes, absolutely. So the revenue was in line with estimates. It was up around 12%. Margins came in at a multi-quarter high at around 34.3% and profit of over 660 odd crores. Now, a couple of key takeaways. I listened into the call over the weekend, and what they have indicated is that they would always look at double-digit growth. When they were asked about what the guidance would be in FY26, they mentioned that they would be looking at double-digit growth and it would be in line with what the historic growth rates have been for Divi's. They are seeing a little more when it comes to RFPs, which is requests for proposals, due to the Biosecure Act as well as China Plus One. So more, queries coming in. They are interestingly not working with generics in the GLP-1 space. So they are probably not going to be a part of the semaglutide opportunity when it goes generic. Instead, they are working with innovators when it comes to GLP-1. Cash on books strong, 3,600 crores plus. But what probably, dampens a bit of sentiment for Divi's is definitely the valuations. I mean, definitely not today, but nonetheless, over 65 times in terms of FY26 and over 50 times when it comes to FY27. So it's expensive stock there. Brokerages, Jefferies maintains a hold. They've said that they maintain a hold on near-term patent challenges and high valuation. Goldman has a neutral. They've raised the FY25-28 estimated EPS by up to 5% to factor in a Q4 beat. Morgan Stanley's overweight. They think the oral GLP-1 intermediate opportunity could be around $100 to $175 million per year upon commercialization.
All right, so that's about Divi's Labs. Let's move on. Let's talk about another stock or another set of stocks, defense stocks, which have been surging lately. Also reported a good show in their fourth quarter earnings. Ria joins in to tell us the fine print from some of the key defense stocks, some earnings expectations as well, and what the street is anticipating when it comes to orders. Ria.
Well, yes, even amid all of these valuation concerns, the earnings growth and the outlook ahead for all of these defense companies continues to remain strong. We saw HAL coming out with its numbers last week, and in the earnings call on Friday, they've said that they have a very healthy order pipeline of over rupees 1 lakh crores. They're also going to maintain their EBITDA margins in the range at 31% over the next 3 to 4 years. For the LCA Mark 1 aircrafts as well, they've said that they are going to deliver 12 of these aircrafts out of the total 83 in FY26 itself after supply chain concerns have eased off from General Electric. For Garden Reach Shipbuilders, the results were above estimates. Net profit margin was above the guidance of 8% for FY25. For Cochin Shipyard, although the revenue growth was slightly below estimates for quarter 4, the revenue growth of 35% on a year-on-year basis was much higher than the 5% revenue growth that we saw in quarter 3. Net profit was also above estimates for this company. Other players like Zen Technologies and Data Patterns on Saturday have reported a very strong set of numbers. For Data Patterns, the revenue growth rate for FY26 will be around 20 to 25% and margins will be between 35 to 40% for the next year. Order intake, although that has been weak for the company, is expected to pick up over the next year going ahead. For Zen Technologies, OCF is expected to turn positive in FY26, and they're also expecting a revenue growth CAGR of 50% over the next 3 years with cumulative revenues of around rupees 6,000 crores from FY26 to 28. Going ahead, BEL and Mazga Dock are also expected to report a good set of numbers in this year and in quarter 4. So overall, the earnings strength and the visibility going ahead remains very strong for these companies.
Right, and a whole host of two-wheeler stocks. We were talking about that, right? Before we go to Sudarshan, just keep an eye out on Zydus Wellness. 15% jump in their profits. Revenues up 17%. This is a company that makes a whole lot of FMCG products, which include the likes of Glucon-D. And you have, very recently, they've gone ahead and acquired Max Protein as well, a small part of their overall business, and a lot of other consumer brands, including that of Complan. But let's go back to Sudarshan. Two-wheelers doing extremely well. Sudarshan joins in to decode this move. Sudarshan, they've been revving up ever since commentary coming in from managements in their con calls.
That's correct. So over the last 3 sessions, all these two-wheeler names have moved higher in the range of somewhere 7 to 8%. There are reasons to it. First, the commentary from both Eicher Motors and Hero MotoCorp were positive. Eicher Motors had indicated that positive sentiment is returning in urban area, which has been a concern for the last few months. And second, Hero Moto, which is leader in the entry-level segment, has indicated that it will keep seeing a healthy growth even in FY26 and will outperform the industry. There is another reason to it. Vahan data, registration data, if you see for month of May 2025, that is from 1st May to 18th May, it indicates that 2 segments that have seen a growth in registration data YOY, those are 2-wheelers and 3-wheelers. So total registrations in May so far are up nearly 1%. For 2-wheelers, it's up more than 3%, and 3-wheelers, it's up almost 3%. Apart from these 2 segments, all the other segments have seen a decline. Now, apart from all the other 2-wheeler names, there is one specific reason for Bajaj Auto, which is top Nifty gainer today. So KTM had filed for insolvency in November of 2024. After in February of 2025, creditors had approved the restructuring plan for KTM, and under that plan, Bajaj Auto International Holdings was needed to secure 548 million euro of loan before May 23 of 2025. Now, over the weekend, news has come out. Bajaj Auto has disclosed to exchanges that its wholly owned subsidiary, Bajaj Auto International Holdings, secured 566 million euros of loan from a consortium of banks. Now, what will this help KTM? It will help KTM to get back to growth path, and that because of that, KTM has been basically struggling over the last few years because of financial problems. Now, with this loan, analysts believe that it will help them to get back on the growth path, and that's the reason Bajaj Auto is top Nifty gainer.
Okay, all right. Thanks, Sudarshan, for that. Well, we need to take a short break, but Zydus Wellness is on your screen. EBITDA growth of around 17% for that particular company. Margins of around 20.8% versus 20.7%. Stock is holding up with a gain of around 2%. We'll take a short break. On the other side, Manisha Gupta joins in. She has with her Maringuela Hungaria of Brazilian Agricultural Research Corporation. Stay tuned.
Welcome back, and let's now connect with Dr. Maria Angela Hungria. She's microbiologist at Brazilian Agri Research Corporate and a winner of World Food Prize 2025. Dr. Hungria, many congratulations on the World Food Prize, first of all. And you have worked on dozens of biological seeds, increasing yields of major stuff like wheat, maize, rice, common beans, soybeans, etc. What has been the experience like?
I still cannot believe that I'm the winner. You know, I come here from a city in Brazil, in the south of Brazil. It's not a big city. It's an agriculture state. So to be elected the best in the world, I cannot believe it. But I think that it was because my career. You know, when I went to the university to study agronomy, well, since I was a child, I wanted to be a microbiologist. But I was very sad when I saw people not having food on the streets. And then I wanted to produce food and to associate that with microbiology. So I went to the university to study agronomy, but it was 45 years ago. So the mentality was just chemicals, chemicals, chemicals. And there was, everybody did not believe in biologicals associated with great yields. And so, but I had this in mind that I really wanted to study biologicals in agriculture and that it was possible to have high yields associated with biologicals. Everybody said that I was crazy. It was really very hard. I did not have much money for research because all the money was on the chemicals. Even jobs, I was offered several jobs in the chemicals that paid much more, but no, I wanted to continue in public research doing biologicals. And then I'm very grateful to my institution, Embrapa. It's a governmental institution that always supported me in my ideas. And then I dedicated my life to the biologicals, but always with this thinking that I had to reach the farmer, just saying, look, you are going to have high yields, but you will replace partially or fully the chemicals by biologicals. And then in 40 years, I was able to develop several technologies to all these crops that you said. And they are really very important for the country. I can say I work here at the Soybean Center. Brazil is today the first world producer and exporter of soybean. And I can say to you that this would never be possible if it was not for the biologicals. Brazil imports today 85% of all chemical fertilizers used in agriculture. It's really crazy because agriculture is very important for us, and we have this dependence on importation of chemical fertilizers. So the technologies that we develop, soybean needs zero of nitrogen fertilizer, can be fully supplied by the bacteria.
Wow. And you also worked extensively on soil treatments that help crop source nutrients, significantly increasing yields of these major crops as well, while reducing the use of synthetic fertilizer, as you said. So, well, India in some sense also seems to be going towards microbiology. How do you look at the scope and input cost and, of course, the cost efficiency itself?
Yes, but what I think that it was different in our approach is that I cannot reach the farmer here in Brazil, especially the small farmer, and say, look, let's improve soil health, let's improve the environment of the planet, but you will have to sacrifice and produce less. Okay, I'm going to give you a technology, you are going to produce less, but it's going to be very good for the soil and the environment. No, I cannot ask this, especially to the small farmer that really needs the money to survive and not leave the farm and go to the city. So I have to develop technologies that I can say to the farm, you are going to produce as much or even more than use chemicals, and you are going to improve soil health and help the planet. So that's the approach that we have to do research for and to explain to the farmer.
Oh, absolutely. I can see that what you're doing here. So from soil health to including biological, you seem to be ticking all boxes, Dr. Hungria, with sustainability while avoiding more than 180 million tons of CO2 equivalent as well emissions per year as we see happening there. What's your sense going forward from here on? What do you have your eyes set on?
Yes, and you said one word that's very important, stability. And we demonstrate this for the farmers a lot. We do not go just 1 year and do a demonstrative plot and show the results. Because many times, if you go there and you put lots of chemicals, 1 year you can produce more. But no, when you see like for 3, 4, 5 years, there's no doubt because the use of biologicals gives more equilibrium to the system. And so the resilience and the stability are much higher. So if you, we have a series of experiments like, and we proved in several regions here in Brazil that in 10 years, if you use the biologicals in 10 years, you have like 1 extra crop when you compare with the use of chemicals. So this is stability. And for the farmer, it's not interesting to 1 year have lots of money and the other year do not produce anything, okay? So stability in the production is very important, especially for the small farmers that depend on that money to survive.
Dr. Hungria, thank you so much for joining in and taking the time out for us. So, when I tell you about her, Mangalam, she's been working for 40 years now, and she's been awarded 2025 World Agri Award, which consists of $500,000. I mean, that's one part of it, but the prestigious award itself says volumes about this whole thing.
Absolutely, and she's trying to, normalize farmers' incomes, but more importantly, increasing the yield of all the crops. So we'll keep an eye out on that as the need of the hour from, humanity standpoint and solving the hunger crisis standpoint as well. With that, we'll take your leave on this edition of Halftime Report. On the other side, we have Business Lunch, taking all the market action ahead. Thank you for watching.
Stocks trade in a narrow range as the market digests positive and negative global and local cues. Realty and healthcare are the big gainers, while IT is the big drag. Divi's Laboratories pings a positive surprise with the operating profit margins at a multi-quarter high. Strong inquiries for business also promise double-digit growth in FY26. Bajaj Auto's overseas arm raises a debt of 566 million euros and plans a 50 million euro infusion via convertible bonds into its arm KTM. The move is seen helping the Austrian two-wheeler maker stave off bankruptcy. Defense gear makers Zen Technologies and Data Patterns surpass quarterly expectations with a strong show, but stocks of some like HAL, Masgao Dock and Cochin Shipyard have slipped this morning on valuation concerns. And Delivery has reported a strong quarter with significantly higher margins riding on strong volume growth in the part truckload business, even as the express parcel vertical sees a slowdown. Good afternoon, you're with us here on Business Lunch on CNBC-TV18. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormis Fatakia. Well, it's a day of consolidation for the markets, if you could call it that. It was a similar session on Friday as well, and we seem to be following that pattern going into today's session as well. An absolutely range-bound trading session, a range of what? Almost 70 to 80 points all through the day, 24,980 being the lows, at 25,050 being the highs. So around a 70-point trading range is where the Nifty has continued to meander all through the trading session in today so far. But pull up the Nifty Bank as well. That too continues to remain quiet. And it is also, although it's a slight outperformance compared to the Nifty, 0.5% higher there on the Nifty Bank and 270 points higher on the index. But the broader markets are the ones where the action lies. The mid-cap index, the small-cap index, the mid-cap index continuing to trade with gains of around 0.6%. The small-cap index doing better on the gains front, 1% higher there as well, continuing to hold on to those gains. Some stock-specific movers, we just mentioned Delivery in the headlines, 11% higher on that stock after its results. The change in depreciation method aiding its profitability. So 11% higher on Delivery, of course, still significantly below its IPO price of 487. But the two movers that have been the top gainers on the Nifty 500 through the day, HEG and Graphite India. Graphite India is now up 16%. HEG continuing to hold on to gains of around 11%, and Nigel has been reporting this since the morning that a key producer has stalled production in a couple of countries, leading owing to margin pressures, and that has seen a positive rub-off on both HEG and Graphite India, and these are the two that are outperforming in today's session. What is not outperforming though are the outperformers of last week, and those are the defense names. Be it the Masgao Docks, the Cochin Shipyards, the Garden Reaches, all of them have come off opening highs, seeing some bit of profit booking in today's trading session as well, barring the likes of BEML actually, all of them trading in the red currently. BEL of course at the flat line, set to report results anytime now. So sticking with the defense space, the Defense Acquisition Council has granted the Indian Armed Forces emergency powers to procure necessary equipment. Parikshit is joining in with more details on this. Parikshit, tell us, what are you picking up?
Well, this confirms a CNBC-TV18 news break that the government is all set to go in for emergency procurements and replenishment procurements as well. We had reported a few days ago how the industry expects orders to the tune of 39,000 to 40,000 crores for all equipment and ammunition that was used up during Operation Sindoor, and to replace that as well. Now we have confirmation that the Defense Acquisition Council met recently and gave its approval to authorize the armed forces to go in for emergency procurements. Now this is for loitering munitions, anti-tank guided missiles, counter UAV systems, including drones, and also artillery ammunition for the Indian Army. Now the acquisitions will take place for all three services. Each vice chief has been empowered to order weapons and ammunition to the tune of about 300 crore rupees each. We are yet to get an exact number as to what will be the quantum of procurements by the government, but we are told that the upper cap is 15% of the defense modernization budget, which is 1,60,000 crores for FY26. So 24,000 crores is the upper limit. We're told that the numbers could be slightly less than this because deliveries have to be made within a year. So what are we looking at? Well, we're looking at contracts to be finalized in the next 40 days from now. This will include both domestic and foreign suppliers, and we're looking at acquisition of Scalp and Hammer missiles as well. Those will require consent of the Ministry of Defense because they are foreign purchases. Secondly, after finalization of contracts within 40 days, deliveries have to be made within a year. So this may not be all. There may be more acquisitions that the government may be looking to do in the next few months.
Interesting, Parikshit. Thanks a lot for that update. And sticking with defense companies, is they are also increasing capacity and are sounding bullish on order prospects. Listening to what the managements of HAL, Zen Technologies and Data Patterns had to tell us earlier in the day.
अब हमारे पास करीब 65,000 करोड़ का LCH का ऑर्डर जो हाल ही में आया था, बिगेस्ट ऑर्डर इंडियन डिफेंस हिस्ट्री में है। ये एक बड़ी ऑर्डर है 156 LCH। दूसरी है जो अभी 83 LCA Mark 1A जो एग्जीक्यूशन में है, और 12 Su-30 जो हम बनाने वाले हैं वो एक ऑर्डर था, और 240 Su-30 इंजन्स। कुल मिला के आज के दिन 1,90,000 तक ऑर्डर बुक है, और ये अगले साल में और ज्यादा होगा। एग्जीक्यूशन में दो हमारे प्रिंसिपल्स है। एक है कैपेसिटी एक्सपेंशन। तो हम जैसे देखिए LCA के लिए 2 लाइन बैंगलोर में है जो 8 ईच बना सकते हैं 16। तीसरा लाइन अभी नासिक में बन रहा है, और उसका पहला एयरक्राफ्ट शायद हम सोच रहे हैं जून में पहले उड़ान भरेगी वो। तो एक तरफ कैपेसिटी एक्सपेंशन LCA के लिए, दूसरी है 240 इंजन्स जो कोरापुट में बन रहा है, वहां पे कैपेसिटी एक्सपेंशन हो रहा है, और तुमकुरू प्लांट जो है हेलीकॉप्टर्स के लिए, वहां पे LUH बनेगा, LCH। तो हर जगह पे हम कैपेसिटी में इन्वेस्ट कर रहे हैं।
As the industry, whole of the industry's been discussing with the armed forces, we have also been very much engaged with them, and we do expect some fast action to happen in this regard, but the quantum and the time is unknown at this point in time. And we currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. We were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. We should be getting those orders. But with the new situation, I think the order book position will be substantially higher.
We expect more than about 1,500 crores contracts to happen this year in terms of new orders. So our revenue guidance remains 20-25% on top and bottom line growth. We expect in the first half we should get probably 600 to 800 crores of contracts, and the rest about 1,000 crores orders we expect during the course of this year. So the contracts have got delayed, but this is likely to happen in the next 5-6 months' time. We may take some 1 or 2 strategic contracts with lower margins, but that is to build the competency in the company and address large markets going ahead.
There was a management of a lot of these defense companies that spoke to us earlier in the day, and Ria is here for a summation of the performances of these defense companies and now how are the valuations shaping up after an up move of last week. Ria.
Well, yes, we're seeing a sharp pullback across the entire defense pack today after the incredible rally that we saw from the 7th of May. Today, the top losers include HAL, Midhani, Mazagon Dock and Paras Defense. Some pullback is seen in some other names like Data Patterns, Cochin Shipyard, GRSE and Bharat Dynamics as well. Although Premier Explosives and Zen Technologies continue to remain higher in trade today. Now, in terms of valuations, all of these stocks out of the defense pack that we've looked at are now trading above their 3-year average PEs. In terms of the prices, some of these stocks are off 2 to 7% off their 52-week highs, which include Mazagon Dock, BDL, Paras Defense, Astra Micro Products, Solar Industries, and Bharat Electronics as well. Some others are still off around 11 to 33% off their respective 52-week highs, which include Idea Forge, Cochin Shipyard, Zen Technologies, MTAR Tech, and DCX Systems as well. Now, after the earnings call of HAL on Friday, Morgan Stanley today has come out with a note on the company downgrading it to an equal weight rating with a target price of rupees 5,092. They've said that the margin and new order outlooks were strong for the company, but the market may be concerned about muted execution guidance going ahead. Even the FY26 revenue growth guidance of 8 to 10% was a little bit lower than analysts' expectations, so that is why we're seeing a little bit of a pullback in these names today.
Someone that has not been very convinced of this rally in defense names. So, by the way, Riya, thanks a lot for that. But someone who has not been convinced of this defense rally is Sanjeev Prasad of Kotak Institutional Equities, and he voiced his concerns over the valuations in the defense space, as Riya was just highlighting. Hear out what he had to say.
People just buying anything and everything without looking at whether the nature of what we're going to say as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you're paying for whatever you're buying, and you look at some of the numbers they make really, very little sense to me, at least, if I look at, let's say, something like a potential shipyard, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores. You can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Cochin Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores. Yeah, to take 10% PAT margin. Yeah, you will make about what 5,000, 6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier, and that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PV of the 5,000 crores of PAT opportunity which Cochin Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there is no way you can justify this kind of valuation.
Sanjeev Prasad there of Kotak Institutional Equities. Slight pullback in the markets now below the mark of 25,000, 40 points lower on the index, around about 150 down on the Sensex as well. We take a short break, but when we return, all eyes will be on the dividend from the Reserve Bank of India. The big debate in the money markets is how much dividend is the RBI likely to give the government. We give you a deep dive on this on the other side. Stay tuned. Welcome back. Now, the big debate in the money markets is how much dividend the RBI is likely to give the government this time around. Now, a CNBC-TV18 poll sees that figure at 3 trillion rupees. Lata is here to explain why the dividend may be even more than the poll. Lata.
Well, this week, markets, especially bond markets, are keenly awaiting the Reserve Bank's dividend. as per the budget estimates, it should be around 2.5 trillion rupees. In fact, a little less, versus 2.1 trillion that the RBI declared last year. However, there is a widespread feeling in the market it will be more than 2.5 trillion. So we did a poll, and a poll of economists, which indicated that the dividend may be 3 trillion rupees. Here's why the market is expecting a bigger dividend. The Reserve Bank of India data shows that RBI has sold a whopping $415 billion in FY25, that is from April 2024 to March 2025. This compares with sales of only $153 billion in FY24. Now, you know, every time the Reserve Bank sells a dollar, it will be at the current price, at right now 84 or 85 rupees, but its purchase price is calculated as the average of all the reserves that it has accumulated. Right now it works to around 78 rupees, according to experts. So the Reserve Bank had made about 6.5 rupees profit every time it sold dollars in FY25. That means the Reserve Bank made 6.5 rupees multiplied by 415 billion, that is 2.7 trillion rupees. In FY24, if you saw the math, the Reserve Bank sold only $153 billion, and therefore it made only 1.2 trillion rupees. So only on this count, on dollar sales, the surplus of the Reserve Bank in FY25 would have been 1.5 trillion rupees more than in FY24. Last year's dividend was 2.1 trillion, so this year's can be 3.6 trillion rupees, according to this math. However, there are two other important components of the RBI's income, and they are interest income on foreign securities that they hold and Government of India bonds that they hold. Now, RBI's foreign securities holding as of March 31 was a whopping 48.6 trillion, but that's only marginally higher than what it was last year as of March 31, 24. It was about 48 trillion. While Reserve Bank of India's India securities, Government of India securities, was 15.6 trillion in FY25 end, slightly higher than 13.6 trillion last year, that is FY24. But because of rate cuts in the year gone by, total interest income from Government of India bonds this in FY25 would have been slightly lower than last year's. In short, RBI's income is expected to be 1.5 trillion more than last year, largely because of profit on dollar sales. Now let's come to expenditure. As for RBI's expenditure, the big change, a changing element, if you can call it, is how much Reserve Bank transfers to the contingency reserve fund. You know, salary and all that remain the same. Now, the Jalan panel requires that RBI has to keep 5.5 to 6.5% of its balance sheet as reserves. In FY25, an RBI panel reviewed the rule. But we don't know if they changed this 5.5 to 6.5 requirement. As of March 2024, Reserve Bank's reserves were at 6.5% of the balance sheet. Now, RBI may exercise its option and bring down the reserves to 5.5%. That is still within Jalan Committee rules, given that there are higher defense expenses for the government this year. Also, there is no fear that higher money printing will increase inflation, because this year CPI inflation is expected to remain below 4% for the entire year. Hence the expectation that the Reserve Bank may declare a 3.5 trillion rupee dividend this year.
Very interesting. All eyes on the RBI dividend. Lata, thanks a lot for that. But the big breaking news flashing at the bottom of your screen that the Supreme Court has dismissed Vodafone Idea's petition for the waiver of the AGR dues. Remember, Supreme Court, the Vodafone Idea had filed a writ petition seeking an urgent hearing on seeking relief of up to 30,000 crore rupees worth of AGR dues, and that petition has been dismissed by the Supreme Court. The Supreme Court has gone on to say that they've called the petition shocking and have deemed deemed it misconceived, and you can see the nosedive that shares of Vodafone Idea have taken after the plea has been dismissed. 9.5% lower on the stock. Also see if there is a reaction on Bharti Airtel, because following Vodafone Idea, Bharti Airtel too had filed a petition in the Supreme Court saying that if there is relief that is granted, it should be granted on an equal basis to all license holders without any discrimination. And Bharti Airtel, no significant reaction there, but the bigger impact has been felt on Vodafone Idea. Almost 10% lower now on the stock. Vodafone Idea, remember, had warned last week that if there is no further government support that has been given, and so in that case they will not be able to continue beyond FY26. That was the warning that Vodafone Idea had given, and as a result of the fall in Vodafone Idea, a cascading impact, as you can see, on Indus Towers as well. 3.5% lower on that stock as well. At the lowest point of the day is Indus Towers. So the big story as of now is that the Supreme Court has rejected Vodafone Idea's plea for a waiver of their AGR dues. We'll get Ashmit on the line in just a bit, but for now, that's the story that's breaking on your screens. Indus Towers, Vodafone Idea, both of them seeing an impact. Remember, Indus Towers had just begun to receive a lot of these dues that were pending from Vodafone Idea's end. That had driven a re-rating of the stock in anticipation that once things get better with Vodafone Idea, Indus Towers will be able to repay its shareholders in the form of dividend and so on and so forth. That has not transpired, in at least for this quarter so far. They formed a committee of sorts to investigate or to evaluate whether they would be able, or what kind of reward that you should give to its shareholders. But as of now, that's the big story. The Supreme Court has dismissed the writ petition. They've called that petition shocking. They have deemed it misconceived, and as a result of which, you can see the nosedive in Vodafone Idea shares. Remember, Vodafone Idea is now trading below the mark of 7 rupees, and that is almost a 35% downtick from its FPO price. Remember, they had completed that FPO, the largest in the country, just last year. They had raised around 18,000 crore rupees from that FPO. Then there was a further promoter infusion. They had issued shares as well on a preferential basis. They raised close to 20 to 25,000 crore rupees in equity. But they have mentioned that despite this, the support from banks there has been a lack of support from banks when it comes to debt, and as a result of which their position still remains precarious. And Vodafone Idea, that is, of course, they're now trading around about 35% below its FPO price of 11 rupees. And if you take the 2024 peak, which was around 19 rupees that the stock had made, that stock is now down almost 60 to 65% from those levels. So that's Vodafone Idea for you, the stock of the afternoon so far. The big news flashing on your screens is that the plea for the waiver of the AGR dues has been rejected. We'll get you more information on this as the day goes by. We'll get Ashmit on the line in just a bit as well. He's been on top of this petition. No significant impact on Bharti Airtel. Of course, they had, following Vodafone Idea's footsteps, had announced that they had also filed a plea in the court saying that if there is any relief that is granted, it has to be on a non-discriminatory basis. But of course, Bharti Airtel in a much better financial position compared to Vodafone Idea. They have also prepaid a lot of their previous spectrum dues. Of course, remember, Vodafone Idea, the government has now converted a lot of their pending dues into equity, as a result of which the government now owns 49% stake in Vodafone Idea. But the bigger share, of course, a lot of the retail shareholding in Vodafone Idea in percentage terms will of course be around 4%, but around 60 lakh shareholders currently have shares of Vodafone Idea. So as of now, 8.5% lower on the stock. We take a short break here, but more updates follow on the other side. Stay tuned. Welcome back. Staying with the big story that has been breaking on your screens with regards to Vodafone Idea. Ashmit is now joining in with more details on this. Ashmit.
Well, this was clearly an attempt being made by at least two companies, Bharti Airtel and Vodafone Idea. However, the Supreme Court has come heavily on both. The Supreme Court is of the view that these petitions are entirely misconceived, that these petitions are being filed despite there being very clear, explicit Supreme Court orders which have denied relief earlier, and that this is not something that the apex court will be kind to. This is not something that the Supreme Court will allow, and towards that end has made it abundantly clear that it is rejecting, it is dismissing the application. Now, the reason this is significant is because both these players, Bharti Airtel, but more Vodafone Idea, had made this a plea of last resort, so to speak. Vodafone Idea, we understand, had also made representations to the government seeking some relief. The ominous outlook that Vodafone Idea had given to the government is that if this relief doesn't come their way, then it will result to the company going into NCLT, into insolvency. It cannot survive beyond FY26. Very ominous figures is what Vodafone Idea had shared with the government. And this, they had come to the apex court because the government had said that our hands are tied. We cannot allow the relief on account of previous Supreme Court judgments. And it is a revision of that was sought as a part of this petition. However, the Supreme Court saying that we will have none of it, the petitions being dismissed, and therefore, in a way, trying to close the chapter as far as securing AGR relief from at least the Supreme Court is concerned.
Ashmit, stay on because we also have some reactions lined up as well. Mr. H.P. Ranina is the senior advocate of the Supreme Court, and Shiju PV, the managing partner of India Law LLP, are joining us now for a quick reaction. Mr. Ranina and Shiju, good afternoon. Thank you for joining in. Mr. Ranina, first to you. It was almost as if it came across as if Vodafone Idea was trying to delay the inevitable here. But what do you make of this now? What lies ahead for Vodafone Idea after the dismissal of this petition?
Well, this petition had to be dismissed because it was a review petition based on what the Supreme Court had already taken a view. So unfortunately, they keep on going to the court on a review petition. Review is only to be done in an exceptional case where there's a fundamental error in the order of the Supreme Court. But this is not a subject for review petition. So now the only solution is you cannot go to the Supreme Court anymore. Supreme Court has shut its doors on you. Only thing you can do is appeal to the government. Government can then give you some relief. Government can give you time to pay the HAR. Government can reduce it if they so wish. It is entirely a government is concerned now. If government wants to support the telecom sector, then they have to take certain action.
Shiju, what does, as Mr. Ranina said, right, the court has now shut the doors for Vodafone Idea, and now they'll have to go to the government to seek more support. But what more can the government do here? Because they already have 49% stake in the company. They still have around significant amounts still due to them. What next for them?
See, basically, it is a classic case of government is taking a very reactive action and letting the court to make the policy decision. You all know Supreme Court is not a policy-making body. And see, whether the questions like whether a duopoly is justifiable or good for Indian consumer interest, that is something a government has to decide. We already have a duopoly in the airline sector. Now another major telecom infra is also going to a duopoly side. So these are the policy decisions government should have taken. Telecom sector government should have taken a decision. It could have made the policy whether the penalty and also the interest and all can be regulated or can be justified. Because around 75% of the due amount is towards the penalty and interest. So these are all the policy decisions. Government has enough sufficient time to take a call on this thing. So it is purely on the part of government now to take a call on this.
The onus lies with the government, right? But Mr. Ranina, does the government have any recourse to reach out to the courts, or the doors are now, or any legal recourse is finally is shut completely for Vodafone Idea now?
Yes, my view is totally shut. In fact, the Supreme Court will be very upset or angry with if they ever go back to the Supreme Court on the same issue. The only thing is government has to act now. Whether how they do it is their problem. But if the government doesn't want to give them relief, then they have to pay up. And they will have to pay up at the appointed time. And then it's a question of business ventures. How they run their commercial activities, their problem. But nothing can be done at the judicial level. Let this be very clear.
All right, Mr. Ranina, Shiju, thank you so much for sparing time and joining us with your views on this issue there. Ashmit, thank you for joining in as well. The big story of the afternoon that the Supreme Court has dismissed Vodafone Idea's writ petition seeking urgent relief for AGR dues. The stock 8.5% lower, and as an impact of that, Indus Towers too has slumped to the lowest point of the day. Both Mr. Ranina and Shiju in a consensus view saying that the ball now lies in the court of the government and that any legal further recourse for Vodafone Idea appears to be shut. So that's the story that we are tracking this afternoon. But we take a short break here on Business Lunch. From me and the team that put this show together, thank you so much for watching. We leave you with the market still consolidating around that 25,000 mark. Mid-cap radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Doria and with me is Vivek Iyer. Good afternoon to you, Vivek. Actually, right now the Nifty has managed to slip below the 25,000 mark, but the broader end of the markets is doing quite well.
That's right. Good afternoon, Vamakshi. The story of the last half hour has been the telecom stocks. So both Vodafone as well as Indus are under significant pressure. We'll move on the show, discuss that maybe a little later on. Let's start off with the top headlines. Stocks see range trade as the market digests positive and negative global as well as local cues. Realty and PSU banks are the big gainers, while IT has been the big drag. Defense stocks take a breather, mid-caps outperform.
Graphite India and HEG climb after major Japanese graphite electrode manufacturer Resonac halts production in China and Malaysia.
Protein eGov tanks 20% in trade after it informs the exchanges that it has not been considered for the next round of the selection process for the PAN 2.0 project by the Income Tax Department.
Delivery reports a strong quarter with significantly higher margins riding on strong volume growth in part truckloads business even as the express parcel vertical sees a slowdown.
Credit Access slips more than 6% in trade on the back of Q4 numbers. Dispersals come down nearly 20% on a year-on-year basis. Net profit declines 88% from a year ago.
Well, the markets have been flip-flopping between the red and the green. For now, the Nifty has slipped in the red. It is down nearly 30 points, marginally lower, but the mid-cap end of the market is looking quite vibrant. As of now, the mid-cap index is seeing an uptick of almost 0.4%. Apart from that, when you look at the small-cap index, that too is holding up quite well. As far as some sectoral indices are concerned, most of them are in the green. Nifty Realty is seeing an uptick of over 2%. Nifty PSU banks especially are also doing quite well. Pull up the charts for PSB, that is Punjab and Sindh Bank. That stock is trading higher by over 5%. Central Bank too seeing a gain of over 5%. IOB, Maharashtra Bank, that is Bank of Maharashtra, as well as UCO Bank, all are seeing gains upwards of 4%. What's not doing too well is the IT pack. Nifty IT has taken a knock in the trading session today, largely led by some mid-cap names. Emphasis is down almost 2%. So is Coforge, down almost 1.6%, and lots of earnings reactions as well, right? When we look at some numbers that came through, there are some stocks that are reacting negatively to their numbers. That includes Bharat Bijli, Mukan, Credit Access too, seeing a downtick of almost 6% in trade today. On the flip side, some good numbers coming in from KRBL, Divis Labs, as well as EIH Associates. Vivek, the screen as of now in the mid-cap space looks quite vibrant.
That's right. Vamakshi, we'll not waste any more time. What we'll do is we'll go to the first management of the show, Premier Energies. Remember, company saw very, very strong FY25. But the question that lies on most investors' minds is whether this particular performance can sustain in FY26. The company, remember, has also given a very strong guidance in terms of capacity addition for FY26 till FY28. So joining us now is actually the management, Vinay Rastogi, Chief Business Officer at Premier Energy, joins us now. Thank you so much, Vinay, for joining us. First up, FY26, very, very strong here for you. As far as FY26 is concerned, give us a sense of where do you expect to end the year in terms of order book. So what will be the order inflows for the year? What is the guidance in terms of top line, EBITDA margins, as well as PAT? On a year-on-year basis, I believe EBITDA margins almost doubled for you.
Well, to start with, Vivek, thank you for having me. You're right, we've had a very good year. In terms of outlook over the next year, so we already have an order book of about 8,300 crores, close to 5.3 gigawatt, which is all booked out basically for the next 12 to 14 months. So we expect that we should be able to report about a 15-20% kind of uptick in the revenues from what we have seen in the last year, while maintaining our margins at the same levels.
Sure. And, can you help us understand the kind of demand that you're seeing on ground? Hi, Vinay, this is Vamakshi joining in. Is it still strong? And, because players have been indicating that there have been some delays in setting up of solar power, as well as some concerns with regard to land availability. So could you help us understand what is the demand trend on ground looking like?
Sure. So I think, overall, the demand environment looks very, very robust and strong. And when you say that there are some delays in land and transmission, that's correct. But the good thing is that there are multiple segments in the solar sector. So, for example, there is the residential rooftop solar segment, where the government has a target of 1 crore installations. There is a separate segment for agricultural solar or KUSUM scheme. And then we have the corporate market. So if you look at across these 3 or 4 different markets, inevitably there is slowdown in one segment or the other, but then the other segments are firing at full speed. So overall, we had a bumper year last year in FY25, where we saw a record capacity addition of 24 gigawatts, and we expect this capacity addition demand for solar modules to increase at least about 15 to 20% year on year.
Got that. Vinay, what I want to understand from you is, I believe at the end of FY25, the EBITDA margins were northwards of 28.5%. So when you say you will maintain margins at the current levels, is that the range we should work with? And consequently, given the fact that there has been debt reduction, what will be the PAT that you're expecting for FY26? Or if you could help us with the PAT margin, even that works.
Sure. So Vivek, just to be very clear, when I say we don't give out any guidance for future, so I'm only indicating the revenue and EBITDA margin for the next year basis the order book that we already have, which is firm and tied up. So which is in the same kind of pricing and margins that we have maintained in the last year. So on the basis of that, yes, we do expect the EBITDA number or the margin to kind of stay there in the current ballpark. But on the PAT number, unfortunately, I'm not able to give you any guidance based on company policy.
Sure, and help us understand how your order book is also shaping up. How would you divide it in terms of the opportunity in the domestic market as well as the export market?
So, the domestic market is looking very attractive in terms of demand, as I said, because all the four segments we are seeing record demand. So much so that, as a company, we have been focused on meeting domestic demand first before we look at any export markets. Like I said, the government is very, very committed to Make in India. There is more and more the share of domestic modules as a percentage of the total market demand is increasing year on year. So not only is the solar demand going up every year, but the share of domestic market is going up, which means we are seeing a substantial jump in the domestic module volumes being shipped out in the market.
Understood that. Vinay, we get that completely. Will you look at the export market percentage of exports, or especially to the US market, given the fact that realizations there are much higher? That is the first part of the question. The second part of the question is, when you're looking at the capex of close to 1,250 crore, you've mentioned that most of it will be met by internal accruals, but will you require to take on more debt? You have significant capex plans and capacity addition plans for FY28. If you could help us year-wise, what will be the capacity addition?
Yeah. So sure, Vivek. So I think your first question was about the US market, right? So you're right that prices do tend to be much higher and more attractive in the US. Having said that, of course, you also know that there has been a little bit of uncertainty in the last few months in relation to tariffs applicable on Indian exports. And some of these changes, there have been a lot of changes around these tariff rates as well. Equally, we do expect a trade treaty to be announced between India and US, which will have an implication on, what is the potential of the US market for Indian manufacturers. So I think for the time being, most customers in the US as well as the Indian module suppliers are being a little bit cautious on the US market. We are waiting for more clarity to emerge, including ourselves. And as and when, that clarity is there, we will be ready to make the maximum use of that opportunity. In fact, we do have a plan to set up a manufacturing plant in the US, and we will action it, depending on how the trade discussions evolve.
And is that plan, part of the capacity addition that you've given in the presentation?
It is very much so, yes.
So what will be the total size of the plant in the US market?
The size that we're anticipating right now is 1.2 gigawatts of cell capacity out of the total 10 gigawatt that you see on the screen.
One particular problem that a whole host of players have highlighted, the fact that especially when it comes to the domestic market, there has been significant announcements made by a whole host of major players. So you have names like Reliance, you have names like the Adanis, who are entering the solar cell and module, the entire ecosystem. Going forward, how do you expect realizations to pan out given the tailwind of ADD that is there? And do you expect some moderation as far as realization is concerned, especially when compared to a bumper FY25?
Yeah, so I think that's a very interesting question and is obviously at the top of everybody's mind. What I will say is that one, like I said, demand is increasing. Second, a lot of players have announced an entry into this segment. But this remains a very complex and capital-intensive business. So we have to see how much of these announcements actually get converted into real projects on the ground and capacity and shipment volumes, right? So I think, our view is slightly moderated based on, what we see on the ground. And we believe that over the next 2 to 3 years, demand supply will remain largely in balance. In future, beyond that, I think it is difficult to foresee how it will play out. But the key thing is, again, this sector, given some of the dynamics that I just pointed out, the performance will eventually depend on 3 factors, which is, what is the scale of the company's operations, what is the backward integration, and what is the technology adaptation. So I think based on these 3 parameters, we believe, particularly given the Mission 2028 that we have announced, that we do stand on a very strong footing. And whereby we will be able to maintain our competitive position as well as realizations and margins.
Understood that. A sense of the capacity utilization across the cells and modules facilities. Also, very interestingly, you've announced an entry into BESS, right? So what are you seeing, a slight deviation from what you've been doing? So what kind of returns are you seeing there, especially given the fact that there have been a few tenders of higher rates that have been cancelled in that particular space?
Yes, so Vivek, that's correct. But the fact is that, irrespective of what is happening in these tenders on a short-term basis, demand for storage is very, very strong in India and is going to increase in future because you do need a lot of storage to balance out the intermittency of renewables. There are more and more tenders coming demanding more storage capacity. The government has said that storage has to be mandatorily installed with every solar project to be able to provide more firmness to the grid. So as a result of that, we do see a very attractive demand side environment. And we've announced a foray into this market, scaling up to 12 gigawatt hour over the next 2 years. In terms of margins, we do expect, based on the current market assessment, EBITDA margins of somewhere between 12 to 15%. But that again, will depend on how the market evolves.
Well, thank you so much, Mr. Rastogi, for joining us after your Q4 numbers. We wish you luck for the quarter as well as the year ahead. But that's time for a very short break. Up next, we will be joined by the management of Barmer, Lorry & Co. to discuss their Q4 numbers. Don't go anywhere. Stay tuned. Welcome back. You're watching Midcap Radar on CNBC TV18. From one management to another then, Barmer Lorry is the next management on the show. Revenue and EBITDA margin came under pressure. Do note, company is engaged in various businesses of industrial packaging, lubricants, chemicals, logistics and travel services. To discuss more, we are joined by Adeep Nath Pal Chaudhary, who is the chairman and MD at Barmer Lorry & Co. Well, good afternoon to you, sir. I'd first like to start off by asking you about your outlook for FY26. In the fourth quarter, we understand that the top line has grown by just 5.5% on a year-on-year basis. So what is the kind of growth that you expect in FY26?
Firstly, thank you for having me here. We are having a fairly positive outlook for the current financial year. So the previous year, we ended with around 7% high on turnover and 12% plus on PBT. So we expect the numbers to be stronger in the current financial year, and we are looking at a turnover of something in the neighborhood of 3,000 crores maybe.
Thank you so much, sir, for joining in. So from close to 2,500 crore, we're expecting the top line to grow up to 3,000 crore. What can we expect, will be the corresponding EBITDA margins and PAT? And which segment of the business do you expect will actually go ahead and help drive business forward?
Yeah. So our EBITDA as a percentage, actually, we had an uptick. We did 14.73% this year as compared to 14.16. And however, with the focus on turnover, we may not be able to hold on to that EBITDA, but we are still going to end up with a good profit figure. Now, the growth primarily are going to come from three fronts. One is the logistics as a cluster. We are having three businesses: logistics services, which is the freight forwarding, logistic infrastructure, as well as a cold chain. So logistics as a cluster, I think, is going to give us the maximum growth. Travel and vacations has been very strong in the last couple of years, expecting good numbers from there as well. And manufacturing, especially industrial packaging and grease and lubricants, should help us round up the figure to the estimate that we are expecting for the current year.
Sure, and you mentioned the logistics services and logistics infra business that will be your growth drivers for FY26. But profitability out here has been quite weak. So, can you help us understand what is the reason behind this? Is it because probably there might be some increased competition out here, which is putting a drag on your margins?
See, there are two separate businesses. One is the logistics infrastructure, where we are actually having these container freight stations, where historically what has happened is that the government has done many kind of initiatives in order to ease of business. And that has actually put, because the focus for the government is in the efficiency of the port ecosystem, and that has put the margins of this particular business under a little pressure. Logistics services, which is freight forwarding, I think at this point of time is going through a little kind of volatility, given the fact that ocean freight has been volatile. Various kind of challenges, like, for example, the war, the tariffs, etc., puts a lot of pressure on the buying of the ocean freight and also air freight, whereas where our customers are mostly contractual. So that is where we are seeing a little pressure, but I think we'll be able to overcome that with new initiatives that we are proposing.
So, one question that a whole host of investors, generally tend to ask us, especially with a large PSU like yourself, is that you actually have quite a large land bank in prime properties, across quite a few major cities as well. FY26, can we see sale of some of these properties? Will you look to unlock value there and thereby, further strengthen the balance sheet?
Now, this has been oft asked question. Right. And the answer to that is that we do not actually have a lot of land bank. Okay. So the question of unlocking value through sale of land assets does not really arise. Not in this financial, probably never ever, because we don't really have too much of a land bank.
Sure, and let's also talk about your greases and lubricants segment. How has that done in FY25? And we've seen that crude prices come off the highs that we saw last year. So will this impact your business out here, and what would it be?
So grease lubricants has been a strong business for us. In the current year, we fell a little short in terms of output as compared to the previous year. That was because we rely a lot on the base stock, base oil, which is our feedstock, and that typically comes from the various oil marketing companies, refineries. So we've had a long shutdown of HPCL and other refineries, which prevented us from sourcing enough of bright stock, which is a key ingredient. In the coming year, we are not anticipating any such shortage, and hence we should be able to do very well. Our profitability in this particular business has significantly improved over the last 2 years. And we expect this business to be a very, very strong business for us, especially if we are able to grow well in the automotive and the bazaar trade.
So one final question from our end. Expected capex outlay, if you could give us even a 3-year plan that works for us, and operating cash flow, how do you expect that to trend over the next couple of years?
Very good question. The capex actually will it's likely to move up significantly in the coming years, not necessarily in this year, because we are making a significant foray in rail logistics. So this year we're going to commission 3 rakes, and that is going to help us take cargo from our contractual customers from the steel plants from the eastern part of the country to the northern part. So that's going to be a fantastic business that we are just getting in. And as we stabilize that business, we are expecting to invest in a big way in rail-related logistics. That could be rakes as well as potentially Gati Shakti cargo terminals. But having said that, the current year, the capex is going to be in the neighborhood of around 200 crores, which also is expected to involve the capex for a large IT project, which would be the S4 HANA migration from where we are right now.
Sure. Thank you so much for that, Mr. Pal Chaudhary. Thank you so much for joining in after your Q4 numbers. That was the management of Barmer Lorry. The stock as of now is trading with a minor gain of 0.4%. The management said that they have a positive outlook for FY26 and a turnover of almost 3,000 crores is what they're expecting going forward. Now, as we slip into a break, here's some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at just your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Midcap Radar on CNBC TV18. The Nifty continues to be range-bound in trade today. The index is just 25 points short of the 25,000 mark. The Midcap index, though, continues to do well, up almost 0.3%. So is the small cap index, up almost a percent or so. Nifty Bank also holding up quite well. But with that, that's all we have on Midcap Radar. From Vivek, me, and everyone who put the show together, big thank you. Don't go anywhere. Your Stocks comes up next.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. Markets as of now, again, we're seeing that flip-flopping between the red and the green. So right now, the Nifty is trading a bit on the red, just slightly below the 25,000 mark. Will be important to watch out for where it's going to be headed in the next couple of hours. But as of now, down 0.2% is what the Nifty is trading at. Sensex 2 is down 0.2%. Day's lowest point is what the Sensex and the Nifty are trading at. So not much of strength that we're seeing coming in. Other than that, the mid and the small cap, the outperformance, that is what is continuing on the broader end of the market. Last week also we saw it. Today also the outperformance continues for the broader end of the market. IT, top sectoral loser, so keep an eye out on the IT pack, or whether you look at a TCS, Infosys, all these big IT companies are also under pressure today. On the flip side, we have Realty as well as Pharma that is managing to hold on to gains. So they are the top sectoral gainers in that front. And we have a lot of pharma names that are doing well, like DV is on the back of its numbers. Caplin Point came out with its numbers last week as well. And that is what is managing to hold on to gains. But this is a show where we solve all your stock-related queries, and that is what we'll be doing in the next 20 minutes or so. We have our experts joining in with us, Richard Jain, Vice President, Equity Technical Research, Wealth Management at Motilal Oswal Financial Services, as well as Parthiv Shah, Director at Tracom Stockbrokers, joining in with us to just do that. Richard as well as Parthiv, thank you so much as always for joining in with us. And Richard, just a quick check in terms of the markets for the Nifty as well as the Bank Nifty. What are the levels that we are keeping an eye out on? And if we close below 25,000 today, is that a bit of a worry for the markets?
Yeah, hi, very good afternoon. Well, if we look at the lower time frame charts, then we do have about a negative crossover in the RSI, which indicates probability of some pullback move in the Nifty. But the daily and the weekly charts are still positive, and we have seen that in last few trading sessions, the market breadth has been very good. Considering that the mid caps, especially the mid caps and the small caps, have been showing an outperformance. So, whenever such situations arrive with the lower time frame charts indicating some corrective phase, then we usually get a pullback move within an uptrend. So, I think all the broader trend remains positive. We could see some pullback in the Nifty towards 24,800, 24,700 kind of range. But this remains a buy on dip market, and in case if we get any dips towards the support zone, one should use that as a buying opportunity.
Okay, that's the view coming in on the markets of there. But let's get started with the queries then. The first query for today is coming in from Savan Kumar, who's writing to us from Bangalore. He's asking if it is a good time to enter Zen Technologies, and he's asking what level should he enter at. Firstly on the fundamentals, Parthiv, your view for Zen Technologies. And actually, all these defense companies have seen the run-up, right, in the recent time as well. They were already trading at higher valuations. After the run-up also, they become a bit more expensive. Do you think it merits entering any of these defense names, and specifically Zen Technologies?
Good afternoon, Ruchit and our viewers. It's a very interesting company, Zen Technologies. And no doubt, I think recently, due to the geopolitical issues, I think we have seen most of the defense names, I think, go up even after the war. So more importantly, I think this company is into a lot of drone-related aerial warfare, where they make simulators, and I think that is the future. And we did witness in the recent wars how much of importance the drone has played. The company has a very strong liquidity position of almost 1,000 crores, and they have very good order intake, and they maintain a very good, healthy working capital cycle. More importantly, I think they recently also acquired some strategic assets, where they acquired a company which is into component manufacturing for drone systems, and also they acquired a company in the robotic system, which is more dedicated towards the defense-related products. So I think very interesting things the company is doing, and no doubt on a trade basis, the company is very expensive at around 60 trade multiple. But our sense is that this company has very good ingredients to grow in the long term. They've shown very good healthy growth, and probably that's why the market is rewarding it richly. But I would suggest the viewer to stay on the sideline, not immediately jump the gun and buy at these elevated valuations. Whenever we see market correction, even the defense pack tends to correct. That is where I think if with a better entry point of 1,500, 1,600 zones, if he's able to enter Zen Technologies, I think that would be a better prudent level for long term.
Okay, right now don't jump into entering it. Maybe when you see that some bit of a correction coming in for Zen Technologies, that's when you can enter. But otherwise, the company on the fundamental side is doing well. And, it's an interesting company right now is what Parthiv is highlighting. Richard, on the technicals, what is your view coming in? 7 consecutive days of upper circuit, right, for Zen Technologies. There's no stopping it right now, it seems like it. So what should one be doing?
I have a similar view that the overall structure for many of these defense space looks quite positive, considering that the recent price volume action have been such we usually see a good trended up move. So I believe that in mid to long term, these companies would deliver very good returns. Zen Technologies technically has recently given a breakout above 1550, 1600, which was its 200 DMA resistance. So I think on any dip now that 1550, 1600 would become a support zone. So buy on dip should be a strategy in case if we get any kind of decline in the near future. I think some other defense names such as Bharat Electronics, Solar Industries are also looking quite positive. But again, as I said, the stocks have already seen a good up move or run up in the last few days. So one should keep a buy and dip strategy in these stocks.
Okay. Keep an eye out on those levels over there for Zen Technologies. Maybe wait a bit, maybe for the correction. But let's move on to the next query for today. We have the next query on AB Capital and AB Fashion. We have Gautam, who's writing to us from Mumbai, and this is with an investment query. So he's asking for both these Aditya Birla Capital as well as Aditya Birla Fashion and Retail. Should they look to enter the stock? What is the view coming in for the next 6 to 8 months? So I don't think it's a long-term story that they're waiting out for. But in the next year, maybe if they're looking to hold, does it merit entering the stock right now? Parthiv, your view on both these?
Very frankly, I think both these companies from the Kumar Mangalam Birla stable have been like lackluster for creating shareholder wealth. Firstly, if I have to start with ABFRL, I think we know that there is a demerger in this company where Madura Garments, which houses a lot of brands, which are very good, healthy, cash flow generating brands, and which have been supporting the lifestyle business, which has been draining cash for the company. I think that is why probably the market was a little excited in terms of the demerger move, which will give investors chance to play the pure cash generating brands. But our sense is that, I think it will take some time. And more importantly, looking at the current consumption theme, I think in also looking at the past few quarterly numbers for ABFRL, I think things have not really looked up well. And more importantly, there are other counters, other peers who have been taking a lot of market share from this play. So I think I would suggest won't suggest an entry at ABFRL. Talking about AB Capital, again, ever since this company was demerged, I think it has not created any value. I somehow recollect that it was demerged at levels of 250 bucks, and this is maybe upwards of last 7-8 years. And the company is quoting at around 200 bucks. A lot of times the management has guided that they're trying to restructure the NBFC book and trying to clean up things. But I think somehow it's failed to deliver value, despite the fact that it is also a holding company and holds other financial services assets like the insurance play, like even the AMC play. So again, this is a counter I would suggest to avoid.
Okay, so both these names right now is something you would suggest to avoid as of now. Ruchit, on the technicals, does it merit entering the stock? Because they're looking at just around a year of holding, not more than that. So, is there anything of a short bounce that one could expect in the next 6 months, 8 months time?
I think ABFRL would continue to consolidate within the range. In last, I think 1.5 years, we have not seen any kind of trended phase coming in the stocks. But yes, off late, some recovery signs have been there in AB Capital, where price up moves have been supported by good volumes. A high top, high bottom structure is there. On the high side, the previous swing highs were around 245 kind of level. So I think in a pullback move, towards 245, 250 could be expected. So ABFRL does not look much positive, but AB Capital, in case of any dip towards the 200, 205 mark, can be bought for potential targets around 245.
Okay. So ABFRL, avoid coming in from both our experts. Technical front, maybe AB Capital, keep an eye out on those levels Richard mentioned where you can look to enter as well. And 245 is maybe where you can book your profit. So keep an eye out on that. Let's move on to the next query for today. We have S. Jaykumar, who's writing to us from Tamil Nadu. He's holding 1,000 shares of Reliance Infra. Price is 266 rupees per share. Currently, the stock is trading at 279. He's asking if he can hold the shares for the long term. Reliance Infra, part of your view on the fundamentals, what is the outlook for the company?
I think it's a very difficult call, and probably the gentleman who's interested in this counter would be aware of the risk that this company and this group brings. Because I think the past hasn't been very good, but of late, there's a lot of chatter and a lot of ground level work done in terms of trying to clean up the company. And what you're seeing is that there has been substantial reduction in debt, substantial reduction in a lot of liabilities, and they certainly have some very, very good assets. Case in point being something like BSES, the transmission distribution asset. I think that can be valued at almost the current market cap of this company at which it is available. It has some very good road assets, some EPC contracts, and even in the infra space, they have this track record of managing airports and metro. Even in defense, I think they have some good joint ventures, though the execution has been at a very snail's pace, and also a lot of offset clause that they get along with the Dassault Aviation. So our sense is that there is value. It will all depend upon how well the company executes. So strictly, I think it's a company for somebody who understands risk and takes some high risk appetite. But if the company is able to execute all the business parts well, I think then a lot of value can be created from there.
Okay. That's a view coming in on the fundamental side. But on the technicals, Reliance Infra, what's the view? Because the stock has run up, right? In the last 1 year, I'm seeing around 60-65% uptick. So does it merit entering right now? If fundamentals are fine, technically, what is it looking like?
Really, it seems that the stock is still into that consolidation phase of 300 to 220, where it is traded within this broad range since last 4 to 5 months. And if you look at the volumes, the kind of move that the broader markets have shown in last 1.5 months, we have not seen any kind of volume-based buying as of now coming in Reliance Infrastructure. So I would suggest to wait for some more time, maybe a breakout above 300, or in case of any kind of good volumes coming along with the price up move, then those could be the signs of start of a new uptrend. But for now, it seems that the stock would continue to see some consolidation.
Okay. Maybe some consolidation is what we could be watching out for from Reliance Infra on the technical front. Next query for today, LR Gopal Krishnan is writing to us from Kerala, holding 500 shares of Cholamandalam Investment and Financials at a price of 1,518 rupees. They're making a profit on this one right now. And he's asking if he should hold the shares for 1 more year or book out the profits he's making. Your view, Parthiv, on Chola?
Yes, I would suggest that the investors' appetite not only hold on for the next 1 year, but also for the next 3-5 years. This has been one of the finest NBFCs in terms of wealth creation for the shareholders. The reason being that, how the management has grown the book, how they have managed the asset liability, and more importantly, if you see even the recent quarter where I think it was a little challenging because the CV segment was not firing on all cylinders. I think they've disbursed, loans at almost 26,000 crore, which is a 7% growth. And also overall FY25, they've grown the asset under management of almost 25%. They have also guided for similar growth rate over the next couple of years. And I think if you look at the internals in terms of the ROA, it is one of the industry best at 3.6%. The ROAs at 22% are one of the industry leading. And most importantly, I think the cost of fund for this company always tends to remain low because of the higher credit rating that it deserves. And all the verticals, whether it is the vehicle financing, LAP, or the home financing, SME, I think they've never seen any major problems in terms of the asset quality. So very well-run company, and we certainly like it and would suggest for a 3+ year view.
Okay, that's a view coming in on the fundamentals, but on the technicals, what's your view coming in, Ruchit? Is this something that interests you? Last 6 months, we've seen it move up from around 1,200 levels to 1,600 today. So what should they be doing?
So I think the trend still remains positive, and we can clearly see that in this last leg of the downtrend, which we saw in the markets in the month of March until mid-April, there were pockets which were making newer lows, but Cholamandalam had formed its bottom of the corrective phase in the month of January itself, and since then it has been making that high top high bottom structure. So I think when the markets were correcting, there was a relative outperformance that was seen in the stock, and that outperformance is still getting continued. In any declines, the stock is not breaking its crucial support. So I think overall trend remains positive. Maybe a slow and gradual up move, but yes, NBFC as a space looks quite positive for next couple of years time frame. And within this, Cholamandalam could continue its gradual up move. So I would recommend to continue to hold on the positions.
Okay, continue to hold is what the view is coming in on the technical front for Cholamandalam Investment and Finance. But on that note, we're going to step into a very short break. And as we step into the break, here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to your stocks on CNBC TV18. We still have with us Richard Jain as well as Parthiv Shah on to solve all your stock-related queries. Let's move on to the next query for today. We have Raghvendra Rao, who's writing to us from Hyderabad. He bought 160 shares of BSE at a price of 465 rupees per share 3 years ago. Today trading at 7,427 rupees. He wants to know, he's a long-term investor and wants to know if he should continue to hold it for 3 more years. Parthiv, your view coming in for BSE, right? This capital market play, we've seen all these stocks run up and BSE has had a wonderful run up in just 3 years, from that 400 level he's bought today, it's at 7,000. Do you think there's more room for upside and continue to hold this?
What a brilliant run for the investor. And whenever the investors made such multi-bagger returns, I'm always tempted to suggest that no harm removing your principal, and enjoy the free money that is invested. And obviously, I think it has made very, very good returns over the last 3-4 years. And what we like about BSE is that they have really garnered very good market share. And quarter on quarter, if we see the transactional income, I think that has been going up. And more importantly, I think it's also attributed to the fact that one of its unlisted peer, which is National Stock Exchange, has also gotten re-rated in the unlisted market. And as for the last trades that we had heard, I think it's almost quoting at a 4 lakh crore sort of a market cap. So BSE had a lot of catch-up to be played, and they've done extremely well in the last 2 years. And I think the consensus chatter is also that whenever NSE were to come out with an IPO, it will get listed on BSE, and that will also drive a lot of institutional movement and activity on BSE. Same is the case with NSDL. If NSDL were to come up with an IPO, which is in the pipeline, that would get listed on BSE. So I think a lot of positive momentum ahead. No doubt, the current trail valuations of BSE are extremely expensive. So market will probably try and observe the next few quarters how it pans out. But I think the investor can stay put in such investments.
Okay, can stay invested. Yes, you can always book out your capital, enjoy that and enjoy the free money that's coming in as well. That's also what Parthiv highlighted. And there's no harm doing that. But Richard, your view coming in on the technicals for BSE. Well, I mean, there's no way for me to say percent. Doesn't make sense. We all know the run-up that is there. So how much more? Are you still expecting an upside in the near term?
There is no doubt about the trend for the stock that within the entire capital market segment, this has been the outperformer over last few months. So still the support base is shifting higher now. I think 6,400, 6,500 has become a new support base for the stock. So I think the best way to ride such trend is to keep trailing stop losses method. And in case still the stock is holding above that 6,400 mark, I don't think he need to worry much. And rather than looking at how much upside could be there, since his time frame is more of a 2 to 3 year time frame, even from current juncture, I think keep a trailing stop loss and continue to enjoy this trend.
Okay. Keep a stop loss, enjoy your, uptrend as well, that is there. So yes, continue to hold the stock. That's the view coming in on BSE. Let's move on to the next query. Rahul Taneja is writing to us from Mumbai. He's holding 300 shares of Yes Bank. This is at a price of 20 rupees per share. Wants to know if he should remain invested in the stock or switch to something else. Your view on Yes Bank, Parthiv?
I think recently the fund infusion by the Japanese bank, I think certainly lifted up the spirits at Yes Bank. No doubt, I think it will take some time for this bank to show very good ROA, ROE numbers. But the levels at which the investors entered, I think I don't see a reason why he will lose a lot of capital from there. It's a turnaround story. The bank is doing reasonably well. And more importantly, with such fund infusion, I think it's an initial stake that they've taken. And going ahead, if they were to infuse further capital and increase their stake, I think that will certainly help and give a strong backing in terms of with the governance standards also at Yes Bank. So I would suggest a hold. It's a contra view, no doubt. There are other very good banks available in the market, but the rate at which the investors entered, I think, makes me feel that one can stay put here for the next 2-3 years.
Okay, keep an eye out on Yes Bank over there on the fundamentals, but on the technicals, your view, Ruchit?
So we have seen a pullback move supported by good volumes over these news flows in last few days, and the stock has even surpassed its 200-day after a long period of time. So I think as of now, one can continue to hold the long positions, but the follow-up move would be very important to see whether, after this news-based move, whether follow-up buying is there later or there or not. So around maybe 23 to 24 would be the resistance zone as per the recent historical data. So keep holding at current levels, but take a regular review on the stock. Maybe around 23, 24 would be a good phase to take review again.
Okay, surely keep an eye out on those levels over there for Yes Bank. Take a review again at 23-24 of what's happening over there and where it could maybe be heading from there on. Let's move on to the next query. This is from Ginu George, who's writing to us from Kerala. He is holding 3,000 shares of Mascow Dock. Price is 220 rupees per share. Wants to know the strategy moving forward and if he should continue to hold or book profits. Partha, this is one of those other cases where we're seeing, such a good amount of profits. We've seen the run-up coming in for these stocks in the last few years as well. Mascow Dock in those shipbuilder defense side has done absolutely well. So what should one be doing now?
Yes, I think still a performance for the investor. And again, a similar answer, I would say rather take back your capital. And the management of Mascow Dock in their con call, they do acknowledge the fact that the business they're into requires very, very long gestation period. They're sitting at almost 34,000 crore worth of order book. And I won't be surprised over the next 5 years, this as a company would be managing order book of upwards of 1 lakh crore because the type of order they get, it might be lumpy quarter on quarter, but once they're eligible technically for a lot of orders in the pipeline where they hardly have any competition, I think they tend to really see a swelling order book. And especially, I think the government's data in terms of, the defense ministries want, more uptake of orders in the submarine segment and also in the shipbuilding segment where the government wants to reduce the foreign dependency. I think companies like Mascow Dock definitely tend to do well. But yes, I think recently the stock has run up a lot. It's a very low float because most of it is owned by the government, almost 84% owned by the government. So they might come back into the market with some supply to reduce the stake to the statutory level of 75%. But on any declines, I think this is an interesting bet and hold on to the position.
Okay, and Ruchit, your view for Mascow Dock, technicals, what's the story? Near term, are you still expecting some bit of an up move or should we watch out for some correction consolidation?
So we spoke about a good uptrend in most of the defense stocks which we have seen recently, and I think Mascow Dock has been one of the outperformer within this entire space, where the price moves have been supported by good volumes and do not see any kind of volume-based selling coming in the stock. So I think overall we could see a continuation of the uptrend even in the short term. So the price-wise downside seems to be very limited from here on. So I think this is a good stock to continue to hold on and ride this trend.
Okay. you can continue to hold and look to ride this trend. That's the view coming in from NASDAQ Talk. But Richard as well as Parthiv, thank you so much, for joining in with us as always, helping our viewers solve their stock-related queries as well. So thank you so much for joining in with us on the show. And viewers, thank you so much for sending us your queries. But remember, you can always send us your queries and email us the queries on the ID that will be flashing on the screens as well. But with that, we'll wind down this edition of Your Stocks. Thank you so much for tuning in. Up next, your closing bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index is down 0.8%.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years.
The Nifty support stands at 24,738, the 40-hourly exponential moving average.
The new, situation, I think the order book position will be substantially higher.
It's 25,000 on the Nifty. It's Nifty Bank, which is starting at about 55,357.
Even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there's no way you can justify this kind of valuations.
We expect more than about 1,500 crores contracts to happen this year in terms of new orders.
We're seeing a bit of consolidation on the index, but the good part is that the Nifty is still holding on to levels of 25,000.
Well, this confirms a CNBC-TV18 news break that the government is all set to go in for emergency procurements and replenishment procurements as well.
The Vodafone Idea had filed a writ petition seeking an urgent hearing on seeking relief of up to 30,000 crore rupees worth of AGR dues, and that petition has been dismissed by the Supreme Court.
Nifty has managed to slip below the 25,000 mark, but the broader end of the markets is doing quite well.
That was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Surbhi, Prashant and Nigel. The boys will also be joining us on the show. For the market, Surbhi, per se, it's been a quiet session of consolidation, though there is a bit of a downward drift as we speak. The Nifty is now down close to about 80-odd points. The Sensex is down nearly about 300 points. As you can see, we're now at the day's low, and the markets, which were largely sideways till about 130, are now seeing some amount of selling pressure. Again, not too much to worry considering the 4.5% gain that we had on the benchmark indices last week, and lots of individual stories doing very well. So whether it's the two-wheelers, whether it's the PSU banks, look at the way the Nifty PSU bank is rallying today.
Absolutely, and I'd say this is not a bad performance at all.
considering the fact that we are dealing with a bit of a global caution this Monday afternoon. If you're looking at most of the markets, I'm checking. Let's start by looking at US futures. The futures, for instance, Nasdaq futures are down as much as 2% right now. Even the others, S&P 500, Dow, all the futures are down. So there's general caution because of this Moody's downgrade of US government debt that happened. Many of the Asian markets ended weak as well. By the way, the US 10-year yield has moved up considerably. I mean, that's something you can't ignore. We're looking at 4.5% on the 10-year again after a good 3 months. I mean, I was looking at the chart backdated. The last time the 10-year was at this level of, we should pull up the US 10-year yield. Yeah. The US 10-year at 4.53, almost 5.4 now. The last time we were at these levels was 3 months back, 20th of February. So there's a general sense of risk aversion out there in the market. By the way, in the UK, there's a lot of talk about this reset, quote-unquote, reset of relations between the UK and the EU, perhaps because of what's happening with, of course, the tariff talks around the world. They're looking at some sort of a, deal on various aspects. That because of that, the pound has rallied quite a bit. So there's a lot going on globally. The Chinese data points that we got today, they were not the best because both retail sales as well as industrial production in China, it's come off in April versus the month of March. So in general, short point, there's a bit of a global caution out there. And against this backdrop, perhaps the Indian performance is not too bad. Hi, Nigel and Prashant.
Well, yeah, that's right. I think the broader markets, though, continue to outperform, which is at least something that we'll take away from today. But I think we have Mitesh back with us, who's joining in on the show. Hi, Mitesh. I think we have Rahul Sharma, in fact, of JM Financial, who's joining in. Hi, Rahul. Good afternoon, and good to see you in. What do you make of the Nifty's moves? Today we're pulling back a little bit, 60, 70 points lower as we speak. But otherwise, the trend has been up. At what point of time does this trend get nullified?
Yeah, very good afternoon, Nigel. So, like rightly said, the major trend of the market is still up, and this is still a buy on dip market. Dips, there's a lot of money which is waiting on the sidelines, which is ready to be deployed. And what we feel is 24,800 as an immediate support and 24,500 as a major support should be the key levels to keep an eye on for the next 3-4 trading sessions. And considering the way some of these sector rotation is happening across the market, we feel that it's only a matter of time that eventually Nifty will see the dip get bought into. So I think positionally this is still intact for a possible target of 25,500, 25,600. It's just that we're spending some time after hitting the big landmark of 25,000, post which we should see the momentum coming back.
What about stocks, Rahul?
Yeah, so one space that we are very positive on is the Nifty Reality Index. So the Reality Index has come out of the consolidation. Today we are seeing a breakout happening. It has crossed, the index has crossed its 200-day EMA. A lot of stocks are coming out, from these sideways structures. So one can take a basket approach for the reality space, the likes of DLF, Godrej Properties, Lodha, Shobha. These are the top 4 stocks which we feel can pack a punch. So over the next 1 to 2 months time frame, we feel that there can be a 14-15% upside that can be had in this basket. And at an index level, we could be very well sitting at a 10% kind of an up move in the very short term. So reality is the space to go for. A basket approach is something that we've recommended clients, and we feel that this is one sector which should play a catch up over the next last 10-12 days, especially of the May series, and in the June series also we expect the momentum to continue.
Thank you very much for that. Lots of mid-caps in focus. So Graphite India and HEG, as one company, has halted the production of graphite electrodes in China and Malaysia. Resonac Japan. Nigel will talk more about it. Railway stocks continue with their optimism from last week. RVNL has surged another 5.5%. IRCON is gaining on large volumes, a 4.5% pop on that. PSU banks are active and excited. Central Bank of India, IOB, Bank of Maharashtra, UCO Bank. All these stocks are boasting of gains of about 4.5%, 5% on some. And then you've got earnings reaction. Something like, Delivery is the one which is topping the charts. But the big story of the afternoon is on Vodafone Idea, where the Supreme Court has dismissed the writ petition filed by Vodafone Idea and Bharti Airtel for exemption from AGR dues. Ashmit has been on top of the story, joins us for more. Ashmit.
Well, a big shock coming in for telecom companies, Bharti Airtel, and particularly Vodafone Idea. The reason being, the Supreme Court saying that their petition seeking relief on account of AGR dues, relief of waiver of interest and penalty dues, is a shocker, is misconceived, and therefore the Supreme Court has rejected their application. The Supreme Court expressing shock as to how they could seek this relief when this has explicitly been denied in a very clear judgment, and then subsequently review and curative petitions were also dismissed. So the Supreme Court saying, we will have none of this. The petitions deserve to be dismissed outright. Now, this comes as a huge setback. Bear in mind, Vodafone Idea had knocked on the doors of the DOT before coming to the Supreme Court, and they had given a very bleak picture, saying that there is no bank funding coming, there is no relief that is coming from the government. Without any government relief, the company could very well head into insolvency. It will not be able to survive FY26. It won't survive the winter. That's the bleak message that was given by Vodafone Idea. And what's important is that the government is very, very clear in its view. The government had rejected that call for relief by saying that, look, our hands are tied on account of the Supreme Court's AGR judgment. So with that, we understand the government is saying that our hands are tied. We can't do anything until the Supreme Court tells us to do it. The Supreme Court saying we will not have any of it and dismissing the application. So in a manner of speaking, closing the subject, closing the door on AGR relief, and that coming in as a huge, huge setback for telecom companies and particularly Vodafone Idea.
Thank you very much for that. The Supreme Court finding the writ petition shocking, but the verdict per se, the fact that Supreme Court has rejected it, doesn't come as a shock, as Ashmit said. It was anyway a moonshot by Vodafone Idea to go ahead and appeal under the new Chief Justice of India. It's been denied. The stock is down 10%, and Indus Towers has fallen in sympathy. That's lower by nearly 4%. Prakash Diwan is now with us. Prakash, the story goes on and on. What now for Vodafone Idea?
Good afternoon, Rima. So, as I mentioned on Friday, when the statement from Vodafone came about its inability to service all these dues in the absence of bank debt, this seems to be like, as I said at the beginning, of the end for this issue. It's not the end for the company; it's the end of the issue that's been kind of a big overhang for the last many years now. But what seems to be happening is we are in a very positive state as far as the expansion of the business is concerned. It's just that the balance sheet issues continue to weigh very heavily down on Vodafone. So some solution will have to be brought in because, there was no point bringing it to this stage where it started expanding, doing well. They placed orders for newer towers. The expansion to 5G's, the rollout has been much more aggressive than what we thought. But with these significant subscriber base that it manages and being a respectable third player was the objective, right? The government always had a 3+1 kind of objective. And if that were to be met, there has to be a solution out. So I don't know what form and shape and time the solution will emerge, but it's kind of difficult to write it off from this level. So all the downside is in the price for sure. I will just have to wait for it and painfully it will grind upwards as some sort of a solution emerges.
Okay, all right. We actually have now Vinny joining in on another stock that's been in the focus today, and the news has not been the best. I'm talking about Protean e-governance, and it's been locked in a lower circuit, 20% lower. And that's because I guess the market is disappointed about what could have been a great opportunity. And I'm talking about PAN 2.0. So Vinny, it's very clear, right? The company held a conference call. They're not eligible for the PAN 2.0 that the income tax department will roll out?
Absolutely. So they're not eligible for it, though they said that they have written an application or a clarification from the income tax department, and they're waiting for some revertal from there that why are they not eligible for it. But as of now, yes, they're not eligible for it. Now, in the con call, furthermore, what they highlight that, when you're talking about the service, PAN 2.0 was mainly a tech revamp service, which was going to be there in the income tax department, where they had applied for a request for proposal for this service. Now, this was around outlay of around 1,440 crores in terms of the government budget that was there coming in. But the company is saying currently this will not have an impact on the company's business which they're doing. They are mainly into the business of processing and providing services in terms for distribution services for PAN card. So most of the business, 3/4 of the business as of now in terms of PAN still comes in from these distribution channels. People and citizens still require, a lot more in terms of assistance that comes in from even the company or even otherwise in terms of distribution assistance for the PAN business. Now, PAN 2.0 was a tech business is what they're highlighting. So as of now, near term, it may not be an impact, but PAN 2.0, it will take a couple of years to get launched. Suppose that they'll have to watch out for, what's going to be the impact. Near term, no impact. Long term, they are also waiting out and watching out for what the decision is and what the decision will come in at that point of time.
Okay, all right, got that, Vinny. Thanks very much. Let me go back and ask Prakash about this. Prakash, hi, good afternoon. So this is the kind of casualty that kind of comes out of nowhere, right? For all those who've been talking very well about Protean, an institutionally run company and all of that, the great opportunity with the ONDC and a lot of the back-end work that they're doing, digital infrastructure work, suddenly they're disqualified for the next wave. What did you make of this, and what should investors be doing?
Good afternoon, Supreet. No, so I also am equally guilty of the fact that I believed Protean eGov was a brilliant business model, and the moat was so strong and things like that. And, it has been kind of consolidating in this 1,200 to 1,500 zones for quite some time. But the fact of the matter is that the business of issuing PAN cards is significant in terms of contribution to revenue, almost 40% plus, if I remember the numbers correctly. If that were to not come to the company, in whichever way and form the residual work around it comes in, it's not going to be the same as managing the whole PAN issuance business, right? So it's a significant part. The scale is very important, and they could do it at incrementally very good margins and costs. So it is a setback. So there's no doubt the market has read that right and this. But if the clarification brings in some sort of a hope that they'll probably be able to do some part of the value chain and restore some revenue visibility, things could look very different subsequently. But I mean that's just conjecture. I don't know how that happens. Interestingly, we need to understand what is it that has caused this omission for Protean not to be eligible for this particular RFP. So. And remember, it's at RFP stage, so there could be lots of things that could change. You can't write off things. You never say no for what could happen. But my sense is, for the moment, the setback is real, and until that clarity comes, I don't think there could be any point in buying into the stock. So people who have it, of course, will continue to buy, keep it, hold on to it with the long-term future of digitization and all intact. But in the near term, this could definitely be a setback.
Okay, all right. Hi, Prakash. Good afternoon. Good to see you. And Prakash, I wanted to ask you about Nalco. I recall you were quite positive on the stock. Then we had a collapse in alumina prices. It went down. And then I recall, I think at around 140, 145, you said you believe that bulk of the bad news is already in the price. And the stock actually has done a quick fire 140 to 180. That's predominantly because also in Guinea, there is going to be a bauxite shortage, which in turn would supply some alumina. So there'll be a bit of an alumina shortage, and that's why we're seeing some pre-buying. Last I checked, I think alumina prices were back trending towards $400 per ton from a low of around $330 per ton. At around 182 rupees, what's your view on Nalco?
Oh, absolutely. I'm so happy you recall the conversation we had. And, at those levels, the lower levels, one of the things that I highlighted was the salience of the dividend yield that was emerging. And even if somebody were to buy it at that level for the express purpose of dividends, it was brilliant. Look at what's happening to Hindalco. Look at what's happening to parts of the Vedanta business. Aluminium overall, I think, is getting into an upcycle, which intermittently you will keep having these ups and downs given issues related to tariffs and all of that. But otherwise, on a global consumption pattern, I don't see any reason why alumina would probably, again, soften down too much. The Guinea shortage notwithstanding, I think it would probably be very stable and consistent towards a higher band. And if that were to happen, Nalco definitely benefits a lot, Nigel, as you know. And, it's a business that's got lesser risk and more reward potential at this point in time. So from a risk-reward perspective, even at these levels, it's worth holding on to. If somebody hasn't added at 220, 230, which was around Diwali time, you'll probably still be nibbling into it at lower levels. So it is a long-term story for sure. It's still unfolding. I don't think it's yet done, but definitely very positive even now.
Okay. Prakash, delivery, that's been a big mover, strong numbers, and it went through a long period of underperformance. The 52-week low on delivery was 236, and now the stock is at 349, so it's gone up 50%. Is there more steam from here in delivery? Its 52-week high, just for reference, is about 447, and the all-time high is 708, and the stock today is at 350.
Yeah, so remember the all-time high seems like a misprint of sorts, and I think it was that exuberant, rara days of new age businesses getting listed back to back, and everybody was willing to buy them as if there's no tomorrow. It's exactly half of that, but it's still kind of not close to what the 52-week high is, for the simple reason that this is one quarter where the turnaround is very clearly evident in the numbers. Even the last quarter, and post that, there was an interview on the channel where you guys had quizzed the management about whether this was going to be consistently continuing with this trend. And that's exactly what's happened. My sense is this progress will actually strengthen it and consolidate even further favorably, which means there will be allocations which will come afresh. Because it's a great business, difficult to replicate. What's happened is in the difficult times where e-commerce slowed down, the competitive intensity went up. A lot of the other smaller players are out. Where even if you look at some of the other names which have gone into this express delivery this thing as well, you have a lot of them struggling to make money. So delivery's gone through the tougher part, and the reason why it's turning profitable is the diversification and not just dependent on certain channels or segments. So that's where things are looking up, and they could probably start doing more of the right things, which have resulted into this turnaround. I'm quite positive. In fact, after these numbers, you'll probably see the stock attracting much more allocations in portfolios, especially institutional portfolios who have to look for new age businesses also as part of their portfolios. And you don't have much of comparable businesses available, so difficult to compare it on a P multiple, but unfair also at the same point in time because it's got a different trajectory. But yes, the PTL business is what's kind of working, and they'll probably do more of that.
Okay, so Prakash there, seemingly happy with delivery, at least what they've done in the fourth quarter. Got that. Thanks very much, Prakash, for joining in. Always a pleasure having you on. Looking forward to the next call soon. We'll take a break on that note, come back on the other side, and we'll have Aditya Sood, fund manager at Incred Asset Management, joining in with some thoughts.
Okay, welcome back. 100 points lower, 24,920 is where we are at. So it's a full 100-point cut now coming through. Aditya Sood is with us, fund manager, Incred Asset Management. He's with us now to take us through what he's making of things. Aditya, good afternoon. Good to have you here with us. And it's always an interesting conversation because we end up talking about specific names, and through specific names understand your thought process about at least a bunch of industries as well. So many of what we've discussed in the past in terms of specific ideas have been in the news one way or the other. Newland Laboratories, saw a sharp move recently on the, Tejas Network, not exactly defense, but we've discussed this stock in the past. On the hospital side, Indraprastha Medical. What's keeping you busy? What looks, out of what we've discussed, and about 5 or 6 names on my radar, I'm gonna throw it open to you, Aditya. What looks very attractive? Because broadly markets have come up very sharply. Although there are individual names, of course, where things will be attractive and you can justify based on valuations and the story, etc. Go on.
Thanks for having me on the show. Essentially, so if I have to sit back and think about markets today, I think so. There are certain themes which are very, very long theme stocks. The story might, play out over a 3, 5, 10-year period. Obviously, there have been, temporary hiccups in, companies like Newland because that, but, I think so. The management amply clarified that this year is going to be, essentially very, very subdued for them in terms of performance. So what we have been doing essentially is we are trying to understand how deep the moats are getting. If you look at the CDMO space in India, we clearly like that space. This is the first time in last at least 10 years when we have seen all the 6 big pharma. So that comprises obviously of, biggies like, essentially Merck, Eli Lilly, Roche is returning to India. That is what I've been told by industry sources after 10 years. And the biotechs. Obviously, the biotech trends in the US are, sort of accelerating at this juncture. So we like a CDMO as a theme. What we are trying to figure out is that, let's say if China is a key competitor, which is essentially, WuXi, and WuXi, as you are aware, is having, more than 50-60% market share in all the new drug development in the world. What we are trying to understand is which are the real capable companies. Obviously, we saw, DV's announcing a very large deal with Eli Lilly for GLP-1. So we believe that Indian companies are capable. There is a 3 to 5 to 10-year runway in this story. Valuations, I would say, are still very, sort of reasonable in this space, particularly for a company like Newland. Essentially what we have liked, and we have been, holders for Newland since, 1,200 rupees upwards. The second question here is that, what happens to cost of production? So this is China +1 for sure, but this is also Europe +1. So this is one theme that we like. We also continue to like the hospital sector, particularly, Indraprastha Medical and the HCG that we hold in the portfolio. We believe that, valuations are a bit challenging in this space, and that is why we have resorted to owning, stocks wherein we see limited scope for P multiple re-rating to come through. And we like the product space, on the IT services bit. IT services obviously is getting, sort of disrupted. So we like, companies like Intellect. What we have seen in the previous quarter is that, they have reported the highest margin ever in their history, which was like, closer to 28%. This used to be a 20% margin profile company for the longest period of time. 6 quarters, they were stuck in that margin range of, 20%. And that is why we have seen such a sharp re-rating in the stock.
Aditya, just a quick word on HCG. Where are valuations at compared to other? It's a cancer specialty hospital. But where are, and of course now there is the financial investor changed hands recently. Where are valuations? Is it an efficiency story here? What's the play?
I think so. Cost takeout obviously is a play. Capital allocation is obviously a play here. If you look at, they can possibly, look at a divestiture one of the businesses here, which is the fertility side of the business. Obviously, they have done one divestiture in the past. So we see the financial investor, being super focused on margin improvement. If you look at, the valuation of HCG, and if you compare it to, let's say mid-sized hospitals, what we find very interesting here is that, it could be a very credible play going forward. Obviously, the average revenue per occupied bed or the ROCs are not as high as a full-scale, full-service hospital. But we believe that there is significant room for return on capital employed, at least 5 percentage point over a 2-3 year period to come through. And this should be coupled with margin improvement as well.
Aditya, hi. We've spoken about Tejas Networks in the past. You've liked it. You've explained why you like it. The stock is corrected now post the Q4 earnings, the big loss that it reported. So stock fell from 900 down to 700. Did you buy the dip at these levels? Is that a good opportunity now, the current price?
Yeah, so we do believe, we have obviously bought the dip. We do believe it is a very credible and a good opportunity for very simple reasons. If you look at the loss that they reported in the previous quarter, a part of that loss was a write-off on inventory, which was a fairly large number. It was like in the vicinity of, 150 odd crores that they reported. I would like to believe that this is a one-off, because if a company which has, sort of generated 4,000 crores of incremental revenue in last 3 years, possibly, writes off inventory essentially because of obsolescence, I would like to believe that that was a one-off. Secondly, one has to look at the R&D spend that they are currently incurring, because, part of that gets capitalized. Our view is that, and thirdly, there is a ESOP cost also, which is very heavy in the case of Tejas Network. So our belief is that, this has become a stock wherein the market would like to believe that, they have an order book that needs to be backfilled. And our understanding, as far as our understanding goes, we believe that there are 3 critical elements of order book going forward. One is the, obviously the additional rollout from 1 lakh sites to possibly, 2 lakh sites for BSNL to be very competitive for the, 5G offering. I think so. It is all a question of time. The telecom minister has clearly said that there is no need for India to look at foreign equipment as far as the BSNL rollout is concerned. So that is point number 1. This could be a 12 to 14,000 crore opportunity. There is a 4G, 5G upgrade opportunity, which could be a 4,000 crore opportunity. There could be a BharatNet opportunity. Interestingly, Tata's acquired Tejas because of the BharatNet opportunity, but we have not seen Tejas declaring any orders from BharatNet. We have already seen system integrators declaring orders like, Nagarjuna or some of the packages in Tamil Nadu, what we have seen. So essentially, our belief is that there is a tangible opportunity of 15 to 20,000 crore, if not more, coming through, wherein, Tejas has a right to win. Obviously, there is no significant competition here. So our belief is that, the stock should bounce back. Another thing that I would like to point out today is that, if you look at the market multiple of Tejas, which is essentially in line with the market multiple, which is like 20 PE. Our belief is that, going forward, it is very difficult to lose money in PE derating. And as the earnings trajectory of this company changes, now the good thing is that, they continue to reinvest very heavily in R&D. You have a R&D headcount of 1350. So last 4 years, practically, they have trebled the R&D headcount for this company. That tells you that they are building serious capability for next 3 to 5 years.
All right. Hi, Aditya. Good afternoon. Got that point with regard to Tejas. You continue to remain positive on the prospects on various aspects. Big pool. They could win some orders out there as well. Got that on Tejas. Let's talk about one sector that's been the hottest, because of the skirmish we had with Pakistan on the border. That is the defense pack. I recall in the past, you had one stock that had some exposure out there, was BEML. This could be a few months or so ago. How are you all playing this theme, defense? Because suddenly, a lot of interest out there, plenty of stocks are running away. Something that you all have caught?
Yeah, so BEML is something that we are structurally very positive on. I think so. They have got capability both on the defense, mining, the transportation side, all the 3 themes that we like. There is a cost takeout play here. A lot of employees are getting, sort of retired every year, and what we are keeping a very close, watch on the employee headcount here. On the other defense names, we are of this view that, the rally has been very sharp, and we are looking at second derivative plays here, not necessarily pure play defense companies, because most of these companies continue to trade at, anywhere from 10 times revenue to 20 times revenue. Obviously, we have seen a very sharp up move in companies like IdeaForge, wherein obviously Street continues to believe that, orders should significantly ramp up going forward. But our view is that, it is better to play defense through EMS plays. We have Sensex Electronics in the portfolio, which is obviously a very credible play on both defense and space. Obviously, the stock has done well.
That's BEML. Let me ask you about those second order plays. Aditya, hi, good afternoon. Surbhi here. So you're saying that you'd rather look at second order plays, not the obvious names that have run up. So if you could just expand on that, what do you mean? I mean, how else would you look at playing the defense opportunity?
So Centum is one such name. If you look at what is the problem in the defense business, obviously it is the lumpiness of the business. We have seen this 40,000 crore of, sort of emergency procurement coming into play. So Centum is obviously qualified as far as aerospace and defense. Obviously, you need to see the capability of these companies. The good thing about, the EMS plays here is that essentially it is a combination of, the ITAR approval. Very few companies would have that approval in terms of, either servicing it to, essentially Boeing or Airbus over a period of time. So I think so EMS is a better play indirectly to play today. And once we see, some bit of correction, clearly defense names need to be bought on correction. But one needs to be very careful about the lumpiness of, the balance sheets. Working capital completely tends to get stretched. Clearly, we like, BEML or BEL, as a forefront defense player.
Okay, BEL and BEML. Got it. Good conversation. Thank you very much, Aditya, for being with us today and taking us through some of those interesting themes. We do have to take a quick break, come back on the other side. As always, a check on dealing rooms. We'll have Nimesh joining in with all the D Street chatter. And of course, then some final half-hour trading ideas coming up.
Welcome back. Well, the Nifty was down 100 points. It's cut its losses a little bit because the Nifty Bank from moving trading in the red. It's actually moved into the green. I think the big boy HDFC Bank, that's woken up. So that's always helps. And I think ITC is the other one that was trading in the red. That's moved into the green. So both those two should come up for you on the screen, HDFC Bank as well as ITC. But it's that time of the day when we have Nimesh who joins us to help us out with what he's picking up in D-Street Chatter. Nimesh, what's it?
Well, Nigel, after a big move last week, a day of consolidation, so to speak. Yeah. But again, the individual stocks are doing good. The broader markets have done well today. But from a flow perspective, it's quite muted and soft. So not much participation from larger institutions. And also the fact that there are so many large blocks which the supply is going to come. So, that will attract a bit of capital as well. So that's overall. The sector which is consistently doing well is the PSUs. And now it looks like the focus is shifting from the defense names, which have rallied pretty hard, to lower end of the PSU stocks, like the small PSU banks, the small PSU across the board stocks are seeing a bit of traction now. So that is one space which might see a bit of a trading bounce in the days to come, the smaller PSU names. That's overall feedback. The other sector which has done well today is the rate sensitive. So autos have done well, especially the two-wheeler names, and so is the real estate stocks as well. So it looks like there's a bit of shift towards the rate sensitives, because anyway the sense is that at least there are 2 more rate cuts which are likely. So that space has done well today. But as I said, quite a day with even flows quite muted from larger institutions.
Okay, all right. Let's talk about individual stocks. Then, Nimish, what are you picking up?
Well, I'll continue with the theme of large blocks, Nigel. So the first stock on my list is PB Fintech. Ever since the earnings and the con call, the stock has been under pressure. There is selling pressure from larger institutions because of valuation concerns. But now there is a strong buzz or an indication of a large block as well in PB Fintech. So that's the first name. Second stock is SRF. After a long time, some bit of buying seems to be back. And also I understand the selling pressure from a large FII seems to be largely over in SRF now. So that's the reason why that stock is buzzing in trade. Third, couple of auto names, which is Bajaj Auto and Hero MotoCorp. Both are buzzing in trade, and there are delivery-based buying in the two-wheeler auto stocks in today's market. So that explains the delivery-based buying in both those names today. The last one is Varun Beverages and Info Edge. Both are under pressure, but there is consistent selling on, especially on Varun Beverages in the last many days now, and that trend continues in Varun Beverages even in today's markets. Expect very high delivery volumes in Varun Beverages, and add to it, even Info Edge is selling a lot of selling pressure today from larger FIs.
All right, got that. Nimesh, thank you very much for all the action on this, as always. Let's go across to Rahul Sharma once again and get some final trades in. Rahul, there's been a more range-bound session, very specific in terms of individual stock action. What's your final advice, trades on Nifty, Bank Nifty, or any other stock?
Yeah, I think I'll go stock specific here. Reality has been doing well today. DLF is one stock that we like. So for a BTSC trade, one can look to go long in DLF. One can even consider the 740 call options in the range of 16 to 18 rupees. Stop loss can be placed at 10.5 and about target of around 32 rupees on the upside. So real estate is the place to go. DLF is one stock that we are liking on a BTST perspective.
Okay, all right, Rahul, got that. Thank you very much for all the trades. You have a good afternoon, and we'll look forward to connecting again soon. Let's go back to the big story on defense. Now, the defense sector has been in focus recently, and sources are now telling us that the Defense Acquisition Council has granted the armed forces emergency powers to procure equipment. This equipment would include things like loitering munitions, counter UAV systems, ATGMs, and other ammunition. This is all being done to replenish equipment that was used recently in Operation Sindoor. 15% of the defense modernization budget can be used for emergency procurement, and deliveries are to be made within 1 year. Remember, the defense modernization outlay for FY26 is 1.6 lakh crore rupees, and the upper limit for the emergency procurement is 24,000 crore rupees. However, the actual expenditure is likely to be a little less than this upper limit, so maybe a little lower than 24,000. But the caveat is that all these deliveries need to be made in the next 12 months. So that's emergency powers for procurement going to the armed forces. Well, with that, let's actually get you a view that we got on this big rally in defense stocks. Is it sustainable? Is it too late to jump onto the bandwagon? What should investors be doing? Sanjeev Prasad of Kotak Institutional Equities voices some concerns on the huge run-up and the current valuations. Hear him out.
We were just buying anything and everything without looking at whether the nature of what we're going to say as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very high margins this company is reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make, really, very little sense to me, at least. If I look at, let's say, something like a potential PR, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores.
Okay, let's move on and get to Ria now. She's going to tell us how the valuations are shaping up for each of these companies after the astronomical run-up that we've seen.
Well, defense stocks are in focus once again, although today we're seeing a bit of a pullback across the entire defense pack after the very sharp rally that we saw since the 7th of May. Today, the top losers include HAL, Midhani and Mazagon Dock. We've seen pullback in other names as well, like Data Patterns, Cochin Shipyard, GRSE and BDL as well. Although today, Premier Explosives and Zen Technologies do continue to trade higher. Premier Explosives is up around 16 to 17% and Zen Tech is at an upper circuit of 5% for the 7th consecutive session today. Now, in terms of valuations, all of these stocks that we've looked at across the entire pack are now trading above their respective 3-year average PEs. Some stocks are still off around 2 to 7% off their 52-week highs, which include Mazagon Dock, BDL, Paras Defense and Bharat Electronics as well. Some others are still down anywhere between 11 to 35% off their respective 52-week highs, which include the likes of Idea Forge, Cochin Shipyard, Zen Technologies, MTAR Tech and DCX Systems as well. Now, for HAL, Morgan Stanley has come out with a note on this stock after the earnings call on Friday. They've downgraded the stock to an equal weight rating and they've said that the margin and new order book outlooks were strong for the company, but the market may be concerned about the muted execution guidance going ahead. Now, even amid all of these valuation concerns, the earnings growth and the outlook remains quite strong for these companies going ahead. For HAL, they do have a very healthy order pipeline of rupees 1 lakh crores, which is expected to materialize within the next 1 to 2 years. For Garden Reach Shipbuilders, the results were above estimates. Net profit margin was above the company's guidance of over 8% for FY25. For Cochin Shipyard as well, we saw a good set of numbers, although the order book numbers still remains to be seen for this company. Over the weekend, we also had Zen Technologies and Data Patterns reporting their numbers. For Data Patterns, although the order intake was weak in FY25, that is expected to pick up going ahead, and they've maintained the revenue growth rate guidance of around 20 to 25% for the next year. For Zen Technologies as well, the OCF is expected to turn positive in FY26, and they also have a cumulative revenue expectation of rupees 6,000 crores over the next 3 years. So all in all, a good set of numbers for all of these companies, and the outlook also remains quite strong. Going ahead, we also have BEL and Mazagon Dock that are expected to report their results over the coming few days.
Okay, well, defense companies are increasing capacity and are also sounding bullish on order prospects. So we actually spoke to a bunch of managements over the last 24 hours or so, HAL, Zentech, Data Patterns and more. Listen in.
अब हमारे पास करीब 65,000 करोड़ का LCH का ऑर्डर जो हाल ही में आया था, बिगेस्ट ऑर्डर इंडियन डिफेंस हिस्ट्री में है। ये एक बड़ी ऑर्डर है 156 LCH। दूसरी है जो अभी 83 LCM Mark 1A जो एग्जीक्यूशन में है, और 12 Su-30 जो हम बनाने वाले हैं वो एक ऑर्डर था, और 240 Su-30 इंजन्स। कुल मिला के आज के दिन 1,90,000 तक ऑर्डर बुक है, और ये अगले साल में और ज्यादा होगा।
As the industry, whole of the industry has been discussing with the armed forces, we have also been very much engaged with them, and we do expect some fast action to happen in this regard. But the quantum and the time is unknown at this point in time. And, we currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. We were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. We should be getting those orders. But with the new, situation, I think the order book position will be substantially higher.
We expect more than about 1,500 crores contracts to happen this year in terms of new orders. So our revenue guidance remains 20-25% on top and bottom line growth. We expect in the first half we should get probably 600 to 800 crores of contracts, and the rest about 1,000 crores orders we expect during the course of this year. So the contracts have got delayed, but this is likely to happen in the next 5-6 months' time. We may take some 1 or 2 strategic contracts with lower margins, but that is to build a competency in the company and address large markets going ahead.
Okay, let's stick with the theme then. Bharat Electronics will be reporting its Q4 results later today. Ria is joining in to tell us what's the street expecting from BEL. Ria?
Well, yes, BEL is all set to report its Q4 numbers today. So let's take a look at what the street is expecting. We're expecting a revenue growth of around 6% on a year-on-year basis. EBITDA and net profit are both expected to go up by around 1% each. And the EBITDA margins are expected to contract by around 114 basis points versus Q4 of last year. Now, it's important to note that the company has already reported an FY25 revenue of rupees 23,000 crores in its FY25 operational update. But this was X of the other operating income. They've also reported order inflows are worth about rupees 18,715 crores in FY25, and they've fallen short of their yearly guidance of rupees 25,000 crores. Now, some key things to watch out for in today's result will be that the revenue and EBITDA margins are expected to be muted, coming off of a high base and a less favorable product mix as well. Some other key monitorables will be the outlook on the FY26 and 27 order intake, especially the large size ticket items like the QRSAM and MRSAM orders. Ramp up of non-defense and export businesses will also be something to watch out for, in addition to the execution of orders like for LRSAM and the electronic warfare projects as well. And lastly, we'll also be looking out for any spillover orders from FY25 to the next year.
Okay, absolutely. BEL is a big one, almost a key player in almost virtually every big defense system we have out there. And numbers are tomorrow. Thank you very much, Ria, for that. Looking out for this. Let's move on and talk about the two-wheeler space, because actually today on a down day, two-wheeler stocks have been doing rather well. Let's actually pull them up. Let's see how they're doing. Last I checked, between 2% and 3%, and included all the names. Bajaj Auto, by the way, is up 4%. That's Hero up 1%. And Eicher, it's cooled off from the morning highs, about a 0.5% gain. But Bajaj is the best one of the lot with a 4% up move. Now, these stocks have been buzzing around on the back of strong management commentary that has come through. And it seems early indications are that sales so far in May have been pretty okay. Sudarshan's joining in with more details. So tell us more.
That's correct. So over the last 3 sessions, all these two-wheeler names have moved higher in the range of somewhere 7 to 8%. There are reasons to it. First, the commentary from both Eicher Motors and Hero MotoCorp were positive. Eicher Motors had indicated that positive sentiment is returning in urban area, which has been a concern for the last few months. And second, Hero Moto, which is leader in the entry-level segment, has indicated that it will keep seeing a healthy growth even in FY26 and will outperform the industry. There is another reason to it. Vahan data, registration data, if you see for month of May 2025, that is from 1st May to 18th May, it indicates that 2 segments that have seen a growth in registration data YOY, those are two-wheelers and three-wheelers. So total registrations in May so far are up nearly 1%. For two-wheelers, it's up more than 3%, and three-wheelers, it's up almost 3%. Apart from these 2 segments, all the other segments have seen a decline. Now, apart from all the other two-wheeler names, there is one specific reason for Bajaj Auto, which is top Nifty gainer today. So KTM had filed for insolvency in November of 2024. After in February of 2025, creditors had approved the restructuring plan for KTM, and under that plan, Bajaj Auto International Holdings was needed to secure 548 million euro of loan before May 23 of 2025. Now, over the weekend, news has come out. Bajaj Auto has disclosed to exchanges that its wholly owned subsidiary, Bajaj Auto International Holdings, secured 566 million euros of loan from a consortium of banks. Now, what will this help KTM? It will help KTM to get back to growth path, and that because of that, KTM has been basically struggling over the last few years because of financial problems. Now with this loan, analysts believe that it will help them to get back on the growth path, and that's the reason Bajaj Auto is top Nifty gainer.
Thanks a lot for that, sir. Well, let's hop across to Sudeep Bandyopadhyay, Group Chairman of Indie Trade Capital, who joins us on the show. Hi, Sudeep. Which bike are you jumping on? What do you like from the two-wheeler SPAC?
Well, I may not be jumping into any of them now, but as far as the entire sector is concerned, I do like Hero MotoCorp at this stage. I think rural consumption, there is a bit of a turnaround scenario. Monsoons are expected to be good. The number of marriages, dates of marriages is significantly higher in the forthcoming months. So I'm looking at Hero MotoCorp from just a pure short, medium-term point of view. Valuation-wise, also, it's, I think, reasonably priced compared to peers.
Got that. Sudeep, what about Industars? First, there was that dividend disappointment. It didn't come through with the numbers. It's still possible that they'll announce it in the subsequent meetings. Before now, there is no dividend disappointment. And now the fate of Vodafone Idea also hangs in a balance. Was Industars ever a part of your recommendations to clients?
Well, we have been a little careful because they are dependent on Voda Idea and, to an extent. And Voda Idea fate was completely uncertain. And we always believed that, investing in Voda Idea was like a gamble. A lot of things can go right, but things can go wrong as well. And that script is getting played out as we speak. I think, beyond this entire AGR dues and whether it's going to be waived, government is going to consider favorably certain concessions or not, I think it's completely in the realm of speculation. But unfortunately, on the other side, which is operational performance, there, while the 5G rollout and all that is happening, the customer retention is not really good. They are losing customers month on month, and I think that's not good. Post the FPO, we were expecting that the drain or exit of customers will be stopped, but that hasn't really stopped, and that's a little unfortunate. So whether you look at it operationally or you look at it from the balance sheet point of view, I think Vodafone Idea is in a pretty precarious position. And under the circumstances, the tower company which services them, I think we have to be a little careful. Yes, they have other clients, Indus Tower I'm talking about, but Voda Idea also is a client and they are in a precarious position. So it's better to watch this space rather than start getting into there because the correction has happened or some more correction may happen. It's better to wait and watch.
Okay, all right. Wait and watch on Vodafone Idea. Stock down about 8% today. We'll take a quick break. Sudeep, stay on. We have more questions coming up for you. But as we take this break, let's tell you a little more about our latest offering. This is some good news coming in for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. You can download the CNBC-TV18 app from the Apple Store or from Google Play. Just scan the QR code on your screen and you can get to it straight away.
Welcome back. Well, let's keep an eye out on a couple of stocks then. And from the broader markets, actually the ones that we highlighted earlier today, Graphite India as well as HEG, both of them are spiking up because there is that talk that could be a potential supply scarcity that could emerge because, you have one of the largest graphite electrode makers globally. That's Shobha Denko. That used to be known as Shobha Denko. Now it's Resonect. They, in fact, have gone ahead and said that they're going to be shutting down production in China as well as Malaysia. And because of that, there is this talk of shortage, and which could in turn push up prices. Sudeep, any view on HEG and Graphite India? They react very violently, both to positive as well as negative news. Both the stocks are up 15% odd. It's captured this piece of news?
Absolutely, Nigel. You captured it pretty well. They react violently, both on the upside as well as the downside. But fundamentally, I think if you are have a little patience and you want to remain invested for long term, I think these are good buys. Look, globally, I think most of the countries are moving out of production of graphite electrodes, and HEG and graphite has. Their product has a strong demand in manufacturing of steel, and it will continue to remain there. So they will continue to have a great opportunity, and the opportunity size will keep increasing. So I'm reasonably confident about these stocks in the medium to long term. Yeah, short-term volatility one has to withstand based on news flow, based on what's happening to other graphite electrode manufacturers globally. I think prices widely fluctuate, and you have to be ready for this volatility if you are entering these counters.
Got it. Okay. All right. Well, Sudeep, I wanted your view on a couple of other notable movers today. Just throwing a few at you. Nucleus Software, you have KPI Green. The stock last week, I think, was at 350. Today, it's at 480. So big move is what we're seeing. These are earnings reactions. KRBL as well. Some of these stocks saw a sharp correction, but they pulled back. Nucleus, KRBL or KPI Green. Do you like any of them?
Nucleus, I do like. I think they have been doing a lot of work quietly, and they're very focused on the verticals they are working. They have a strong, steady, stable management for a very, very long time. And, they understand their clients. I mean, I will say that having spoken to multiple of their clients, I think they have a good reputation on ground, and I think they are sticking to the, core competencies. So the performance has been good, of course, in this quarter, and I do like that. Software has a lot of challenges, a lot of volatility in the current environment, but I think some of these companies who are sticking to the core, sticking to the niche areas have good opportunity going forward. Other result I liked, Nigel, is delivery. I think finally performance has started improving. And what is more interesting is in PTL, partial truckload segment, which is where they have started getting traction. Of course, express parcel was a bit subdued, but I'm sure that will pick up with e-commerce picking up.
So the PSU banks, that index is the best performing sectoral winner today, 1.5% higher. Bank of India, UCO Bank, Indian Bank, Union Bank, across the board, big gains. What's driving the optimism today? And is there a pick that you like?
Well, I do like State Bank of India, and it's not in the list you mentioned. But I think if somebody wants to play safe, I think SBI is a very good bet, even at current levels. Overall, we know the argument. PSU banks are relatively better valued compared to private sector banks. They used to have a lot of challenges, and that's why the valuation was always significantly lower compared to the private sector leading banks. But a lot of improvement has happened over the recent few years, and things have started looking up in some of the public sector banks as well. And I think time has come for them to be a bit better valued compared to where they were. So when the market picks up, and that's what we have been witnessing over the last few days, I think they have started going up. BFSI overall is something which pretty much everybody is banking on for carrying the next leg of the rally. And PSU banks will definitely do well if that kind of logic holds.
By the way, as we're getting ready for the close, on a lackluster day like today, again, railway stocks have been doing well. RVNL, Aircon, all these stocks have done well. And this month, many of them are up between 15 to 20%. Sudeep, very quickly, final thoughts. Railway pack buzzing again. Anything you're picking up? I mean, any thoughts here?
I'm a little careful as far as the railway stocks are concerned, not because of anything else, but the valuation. I think even now when I look at the valuation and try to justify them vis-a-vis their earnings and performance, I find it a little challenging. So I prefer to stay a little away from the railway stocks. IRFC is something which can be looked at because financing opportunity is significant, and they're moving beyond railways as well. And that's what they've stated categorically. So if somebody has to look at, they should look at IRFC at current valuation, but keep 1 year plus time horizon, at least when you enter the stock.
Okay, all right. Stay with us, Sudeep. What we're going to do is just wrap out the market and then come back to you for more. So it's not going to be, it's a 0.3% cut on the Nifty after a 4% rally last week. So keep that in mind. And broader market, by the way, still far more stocks higher than lower. So about 1,800 stocks up and about 1,000 stocks lower. That's the final tally that we will see at the end of today's session. So on the downside, actually just three names with 2% plus losses: Grasim, Zomato, that is Eternal, and Infosys. That's it. Actually, the IT pack underperformed. With the small losses, Tech Mahindra down 1.3, TCS down, Wipro down, but all with in excess of 1% cuts. On the upside, on the Nifty, there was only one noticeable big mover, that is Bajaj Auto, and Bajaj did very well. There was also Shriram Finance and Power Grid with gains in excess of 1%. So it was a pretty subdued kind of session, but no such problems for the broader market with lots of movers and shakers.
Well, IT's had a rough day today. Remember, the US futures are pointing to a negative start after Moody's downgraded the US economy. So that's having some impact on IT names like Infosys, Tech Mahindra, TCS, Wipro, all down over 1%. Grasim is the top loser, and that's seen a cut of nearly 3%. And other drags included Tata Consumer, Asian Paints, Dr. Reddy's, and even big boy Reliance Industries dragged 8th feet.
Absolutely. It was quite a lackluster day for the large cap screen. Mid caps, if you're looking out for some gainers, then there were the result players like Delivery. What a move from that stock, 10% higher. Divi's, NBCC, all these stocks were neither on earnings or positive news flow. They did fairly well. But then on news flow, you had the casualties of the day. Protean down 20%, Vodafone Idea 8%, Credit Access Grameen 7%. And of course, the cooling off on a lot of defense stocks. Examples being Paras Defense ending about 5% lower. There was Mazgaon Dock down about 2.5–3%, Cochin Shipyard, Solar Industries, Data Patterns. Many of these stocks losing some ground, not falling too much, but down 2–3% for sure. So that's how it has played out. The gainers tally included some more names like Alembic, something like Aarti Pharma, Suven Life Sciences. So a couple of these names managed to buck the trend. But otherwise, a fairly cautious day of trade and a quiet start to the week. Well, with that, it's curtains on this edition of Closing Bell. Many thanks for watching, but don't go away because we have Markets Forward coming up next.
Okay, Dalal Street trades in a narrow band amid weak global cues. Nifty and Sensex and 0.25% lower. Nifty fails to hold 25,000. Broader markets fare better. Mid-caps in the green.
Supreme Court rejects Vodafone Idea and Bharti Airtel's plea seeking waiver on interest and penalty on adjusted gross revenue dues. Calls the petitions misconceived. This pretty much closes doors to any further legal recourse for the telecom companies. The Supreme Court decision comes as a huge setback for Vodafone Idea. The stock nosedives 8%.
Divi's Laboratories rally 6%, springs a positive surprise with operating profit margins at a multi-quarter high. Strong inquiries inquiries for the business also promises double-digit growth in FY26.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key highlights of the day gone by and, of course, the key data points that you need to gear up for the next session. I'm Surabhi Upadhyay and with me on the show is Vinny Motiwala. Vinny, quite an interesting day for the market. Very quiet, sort of subdued start to the week. But then, hey, we've rallied a lot already.
Absolutely, we've rallied a lot already. An interesting day, and Mondays maybe everyone's keeping it chill. I think the market was also keeping it chill, but thanks for that, Surabhi. And yes, we've got you covered for the next 20 minutes with all the big news and the key developments on Dalal Street, top corporate voices and events to track as well in today's trading session. So that's what we're going to be watching out for as well. So Surabhi, but an interesting day coming in.
That's true. And actually, it's probably not too bad considering the global backdrop. And the global backdrop today was one of caution. So you can see the Nifty. Disappointing, yes, if you're a bull, because it was a gentle slide down. We didn't have too much of the buy the dip play out today favorably for the bulls. But look at global markets. All of Asian markets were down. US markets, futures that is, were trading down between 1% to as much as almost 2% on the NASDAQ. Now, why is that? This whole downgrade that we've seen by Moody's, that definitely is playing through the system. It's nothing new. But it had an impact on the bond prices. The yields on the US 10-year, they were rising quite rapidly by the time we were trading around the afternoon time. The US 10-year yield touched 4.5%. In fact, 4.54 to be precise, as we were shutting shop for trade. And the 30-year yield was soaring 10 basis points as well, as the market sort of digested this news of the dead downgrade coming in. So that was caution. We had some not so enthusing data come out of China as well today. The retail sales number and the industrial output growth in China, both they have decelerated month on month. If you look at the April numbers compared to where the growth numbers were in March, there is a deceleration. And on retail sales, there was a very clear miss. Industrial output at about 6.1%, also lower than 7.7% in the previous month. So generally subdued. By the way, very interesting moves on the currency side when it comes to the British pound versus the dollar. That's because the EU and the UK are looking to, quote-unquote, reset their trade and economic relationship. And that was seen favorably by the currency market. So the pound was a mover on the upside. So given that it was a day of consolidation across global markets, we had a subdued session today for a change. Actually, even mid-caps, they didn't have the kind of flair that we saw last week.
Absolutely, not the kind of flare that we saw last week. Absolutely right on that terms as well. And obviously, looking at the Nifty, that ended at almost near the day's lowest point. A mid and small cap ended in the green, but like you're saying, missing that flare from last week, nonetheless outperforming the benchmark indices as of now. Advance decline ratio today was, yes, in the favor of advances versus declines, and that's why the mid and small cap still ended on that positive front. Let's talk about some of these sectors that are doing well. Realty, that is managing to hold on to very, very strong gains at the end of the day as well. Nifty Realty was up almost 2% in today's trading session. Apart from that, PSU banks, that was managing to hold on to good gains. Like Nifty Bank overall, yes, not much of a gain, but PSU Bank side, if you look at that, that was doing well and managing to hold on to gains of more than 1.4%. IT was a drag in today's trading session, so big names like Infosys, TCS, that didn't do well. And railways, the trend is continuing even today, Surabhi. We're seeing defense, yes, some bit of that fall has come in from last week's highs, but nonetheless, we're keeping an eye on that. But here's an exciting lineup for you all, what we have in store for you all today. So we'll start with the top movers and shakers for the day with Vivek. And, well, the stock of the day, which we'll talk about, are going to be Zentech, Paras Labs, as well as Divi's Labs. We'll join to, give you the key reasons as well, which is in focus. And last but not the least, we'll tell you which are the key market events to watch out for in tomorrow's trading session as well.
Okay, so then let's kick it off then with the movers and shakers of the day. Vivek, over to you.
Well, thank you so much for that. Another session where you actually saw advances outpacing the declines, but towards the end of the trading session, you actually saw the convergence coming in, given the fact that you actually saw quite a bit of selling pressure emerge in the last hour of the trading session. But let's have a look at, what are stocks that made the moves today. In the list of gainers, Bajaj Auto, this particular name, you can't really miss this particular name, given the fact that, number one, timely access to credit facility, along with that Vahan data being quite encouraging. Bajaj Auto, one of the top gainers in the session today, ended the day higher by over 4.5%. The other set of stocks that did quite well were the electrode names, the names like Graphite as well as HEG. These stocks did very well. This on the back of a global update where global major Resonac, based out of Japan, actually halted graphite electrodes production both in China as well as Malaysia. Remember, it's a significant player in the market, and both of these stocks rallied quite significantly. The other stock on the back of very strong operational update as far as Q4 is concerned was Delivery, one of the top gainers as far as the F&O space is concerned, given the fact that there was a significant increase as far as the profitability metrics were concerned. One stock from the capital goods space, it was a day of weakness, but Siemens managed to hold out in the green. News reports are indicating that the company has emerged as the lowest bidder in a JV partnership, and this for a system contract for a Mumbai-Ahmedabad bullet train project. And lastly, one stock from the broader end of the markets, which was KRBL, did very well in the session. The management joined us earlier today. They spoke of much better export opportunities as far as FY26 is concerned. And the street clearly liked the commentary, almost 8% higher. But a whole host of laggards as well. You cannot look beyond Protean eGov, given this particular stock was pushed at the lower circle. The management held a conference call for analysts during the course of the day today. But the fact that the company did not get shortlisted for the PAN 2.0 project by the income tax department is something that the street did not like and is seen as a derating event. IT stocks, the entire spectrum, saw quite a bit of profit booking throughout the session. Names like Infosys, TCS, even broader end of the names, names like Coforge, Emphasis, these were stocks that did see selling pressure from the IT pack. When you're talking about the defense team, select defense stocks today, they saw a bit of profit booking emerge. HAL after the results, you saw the shipyard stocks, so names like Cochin Shipyard, Maersk Dog, Bharat Dynamics, all of them did see some selling pressure emerge. After that, one stock from the NBFC pack, LIC Housing, saw two downgrades coming in from brokerages, both Jefferies as well as Motilal Oswal, not liking the commentary. This stock ended low by over 3%. And the FMCG pack continued to see moderation, and this amongst this particular pack, you did see quite a bit of selling pressure come across names like Patanjali as well as Tata Consumer. So the FMCG pack not in the pink of health. Overall, a good session as far as the broader end of the markets are concerned, but still you did see quite a few laggards as well.
Absolutely, Vivek. Thank you so much for rounding up the top stock movers and what happened in the market today. But let's go across to our guests for today. We have Jay Thakkar of ICICI Securities as well as Sandeep Bandyopadhyay, Group Chairman at IndiTrade Capital, with us to talk to us more on the markets and individual stocks going forward as well. Jay, I just want to talk in terms of levels that we're keeping an eye out on, right? Today, Nifty is not closed above the 25,000 mark. How important is that level? And now what are we watching out for? Maybe some bit of a side move is what one could keep an eye out on right now.
Hi, good afternoon to you, Vinny. I would say that, overall in the short term, as you rightly said, that yes, 25,000 levels now is acting as a short-term hurdle, Vinny, and, until we don't get a close about those levels, there can be some consolidation. See, mainly what has happened is we saw a good recovery in the markets earlier backed by the, banking pack, mainly because that has the highest weightage, and thereafter the second highest weightage which we have is in the IT. Most of the sectors have performed quite well, maybe, IT or maybe pharma or metals or maybe auto even now. So sectorally, most of the sectors have participated and helped Nifty to inch to the levels of 25,000, 25,100 levels. But from here on, I think that there can be some consolidation unless we don't have a meaningful close above 25,000, 25,100 levels. But I don't even see much of selling. Rather, I would say that at the lower levels you would be seeing that good buying interest coming in the range of 24,500 if at all Nifty falls until those levels. Interestingly, from here on, Vinny, I think that Bank Nifty, which had gone sideways or maybe which had actually gone into a sideways range, is likely to provide a breakout. I mean, we have seen Nifty PSU Bank Index trading quite positive today, and I think the private sector banks are also likely to start their short-term uptrend. And once it surpasses the levels of say 55,600, the straightaway target on the upside could be 57,000 to 57,500, and that Bank Nifty up move can definitely help Nifty to climb higher at least until 25,500. So not much of consolidation, mainly because of the Bank Nifty, which is likely to provide a breakout on the upside, I think.
Okay, yeah, that's an interesting view, Jay. You're saying that banks will go back to providing leadership to this market. Interesting. Let's see what the next couple of days hold. But right now, moving to a big story coming in from Delhi. This is, of course, the latest legal update on Vodafone Idea. The Supreme Court has rejected Vodafone Idea as well as Bharti Airtel's pleas seeking a waiver of interest and penalties on adjusted gross revenue dues. However, the court has also said in its observations that it will not intervene if the government wants to help these companies. Ashmit is joining in with more details. Ashmit, help us understand what this means. I mean, is it pretty much the end of the road for Vodafone Idea specifically when it comes to getting any help?
Well, the situation is certainly bleak for the telecom players in question, and specifically for Vodafone Idea. Bear in mind that the Supreme Court is saying that it's shocked, rejecting this application. What's important to understand is that there have been at least 4 previous judgments which have either confirmed this demand or have rejected demands for relief. Now, what we understand is that it is on the back of that that the Supreme Court observed that this petition is entirely misconceived, rejecting it outright, not allowing for any scope for intervention as far as this particular case is concerned. And what makes it particularly painful for Vodafone Idea is that just before knocking on the doors of the Apex Court, Vodafone Idea had written to the Department of Telecom saying that if the government relief does not come their way, they will not survive the winter, they will not survive beyond FY26, they will be heading into insolvency at the NCLT. Now, what's important is that in response to that letter by Vodafone Idea, the government had said that, look, our hands are tied on account of the Supreme Court judgment, and importantly, that same position was also echoed by the government today before the Supreme Court of the country, that we are in no position to consider this representation by Vodafone Idea seeking a waiver, given that there are previous Supreme Court judgments that our hands are tied. But nonetheless, before pronouncing the final dismissal order, the Supreme Court did give the observation that, look, if the government wants to help, we'll not come in the way. But nonetheless, we don't want to be a party to it. That was an observation that came from the Supreme Court. But importantly, it's not a part of the formal order. It does not carry the same weight as the formal order. So that situation, that status quo, we understand, is likely to continue. No relief coming Vodafone Idea's way. And important to understand that the government on previous occasions, of course, has said that it is in no position to act to give any relief, given as how its hands are tied with the Supreme Court's judgment.
Absolutely, Ashmit. Thank you so much for that. So yes, Vodafone Idea, other telecom stocks also are going to be in focus. But we had what was in focus, the defense bank. That continues to be the focus. Now we have Zen Technologies, Data Patterns that reported a good set of numbers in terms of expectations. But HAL, Mazagon, Cochin Shipyard slipped on valuation concerns. Ria is here with the defense stock performance and how valuations are shaping up now. Ria.
Well, yes, we're seeing a sharp pullback across the entire defense pack today after the incredible rally that we saw from the 7th of May. Today, the top losers include HAL, Midhani, Mazagon and Paras Defense. Some pullback is seen in some other names like Data Patterns, Cochin Shipyard, GRSE and Bharat Dynamics as well. Although Premier Explosives and Zen Technologies continue to remain higher in trade today. Now, in terms of valuations, all of these stocks out of the defense pack that we've looked at are now trading above their 3-year average PEs. In terms of the prices, some of these stocks are off 2 to 7% off their 52-week highs, which include Mazagon, BDL, Paras Defense, Astra Micro Products, Solar Industries, and Bharat Electronics as well. Some others are still off around 11 to 33% off their respective 52-week highs, which include Idea Forge, Cochin Shipyard, Zen Technologies, MTAR Tech, and DCX Systems as well. Now, after the earnings call of HAL on Friday, Morgan Stanley today has come out with a note on the company downgrading it to an equal weight rating with a target price of rupees 5,092. They've said that the margin and new order outlooks were strong for the company, but the market may be concerned about muted execution guidance going ahead. Even the FY26 revenue growth guidance of 8 to 10% was a little bit lower than analyst expectations. So that is why we're seeing a little bit of a pullback in these names today.
Okay, all right, Rhea. Thank you very much indeed. It's been a spectacular rally, and today was a day of some profit taking. We did catch up with a lot of these companies, spoke to them after their fourth quarter performance on the order books, on the whole replenishment outlook, and how the P&L will look. Hear out a lot of the different views that came in from the likes of Hindustan Aeronautics, Zentek, Data Patterns, and others.
अब हमारे पास करीब 65,000 करोड़ का LCH का ऑर्डर जो हाल ही में आया था, बिगेस्ट ऑर्डर इंडियन डिफेंस हिस्ट्री में है। ये एक बड़ी ऑर्डर है 156 LCH। दूसरी है जो अभी 83 LCA Mark 1A जो एग्जीक्यूशन में है, और 12 Su-30 जो हम बनाने वाले हैं वो एक ऑर्डर था, और 240 Su-30 इंजन्स। कुल मिला के आज के दिन 1,90,000 तक ऑर्डर बुक है, और ये अगले साल में और ज्यादा होगा।
As the industry, whole of the industry's been discussing with the armed forces, we have also been very much engaged with them, and we do expect some fast action to happen in this regard, but the quantum and the time is unknown at this point in time. And we currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. We were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. We should be getting those orders. But with the new situation, I think the order book position will be substantially higher.
We expect more than about 1,500 crores contracts to happen this year in terms of new orders. So our revenue guidance remains 20-25% on top and bottom line growth. We expect in the first half we should get probably 600 to 800 crores of contracts, and the rest about 1,000 crores of orders we expect during the course of this year. So the contracts have got delayed, but this is likely to happen in the next 5-6 months' time. We may take some 1 or 2 strategic contracts with lower margins, but that is to build a competency in the company and address large markets going ahead.
So, Deep, your thoughts coming in on the defense side, right? Valuations are, even after this tiny correction, or you may see some bit of a correction, still very high. What are your thoughts from here on for these companies, even if orders come in, and does it merit entering the defense side?
I think, Vinay, the whole issue is execution. I don't think there'll be any dearth of orders. Look at HAL. I think they have 1,90,000 crore of order already in hand, and they're expecting 1 more lakh crore worth of orders during the current fiscal. So, there is enough and more orders, but the challenge is execution. If you look at same HL's, execution guidance, that is unsatisfactory. And that's the reason why the market is a little worried. The whole issue as far as these, at least the big defense companies are concerned, is the question of execution and execution excellence. It all depends on that. The valuation today which they're getting is, I would say, for lack of better word, stretched. And, probably the performance doesn't justify the kind of valuation they're getting. So I'm a little careful in picking up defense stocks. BEL, defense electronics, is what I like. And if I have to pick one PSU large defense stock, that will be BEL. There were challenges in terms of their orders not being as per the guidance during the last fiscal, and the profit margins also not going up significantly. But I think they're doing a slow and steady job, and I think the opportunity they're staring at is humongous. So I will probably pick BEL, but companies like HAL, companies like some of the shipyard companies, considering the valuation, I'll be a little careful and not advise a buy in them.
Okay, all right, got that point. Sudeep, thanks very much for the update there. Divi's Laboratories soared almost 6% today. This after the company sprung a positive surprise in Q4 earnings with its operating profit margins at a multi-quarter high. Ekta is here with more details. Ekta, so tell us what really worked for Divi's this time around.
Well, it was definitely the operational performance for Divi's this time. So revenue was up around 12%. It was in line with estimates. Margins came in at 34.3%, best levels that we've seen since Q2 of FY23. And the profit was up around 23% on a year-on-year basis as well. Now, the company, in terms of the conference call, did give positive guidance. So they did indicate that they would always look at double-digit growth. And so that's probably what they are aiming for in FY26. They are seeing more queries come in due to the biosecurity Biosecure Act as well as China Plus One opportunity. They are currently not working on generics in the GLP-1 space. Interestingly, they will be working with innovators. Cash on books is around 3,600 crores. That continues to be positive. Now, in terms of FY26 PEs, trading at around 65 times, FY27 around 54 times. Brokerages positive. Jefferies maintains its hold with a target price of 6,200. The hold is on the back of near-term patent challenges and high valuation. Goldman has raised its FY25-28 EPS by up to 5%. They are neutral on the company. Morgan Stanley overweight with a target price of 7,225. They think the oral GLP-1 intermediate opportunity could be $100 to $175 million per year upon commercialization.
Thanks so much for that, Ekta. But let's talk about two-wheeler stocks. They are also in the fast lane and were in the fast lane with a whole host of them soaring on the back of positive management commentary. Sudarshan is joining in with us to give us details on that front. Sudarshan.
So in the last 3 to 4 sessions, all the two-wheeler stocks have seen a move somewhere in the range of 7 to 8%. There are a few reasons to it. So last week we saw two major companies, Eicher Motors and Hero MotoCorp, announcing Q4 earnings, and those earnings were better than expectations. But what has helped these companies post see major uptick in the stock prices are the commentary. The commentary from Eicher Motors saying that positive sentiment is returning in urban area, and Hero MotoCorp saying that it will not only see the growth in FY26 but will also outperform the industry, has helped all the two-wheeler stocks see a healthy gain. Also, Vahan registration data, if you check for the month of May, from May 1st to May 18th, it shows that total registrations are up somewhere in the range of 1%. Two segments that have outperformed are two-wheelers and three-wheelers. Two-wheelers as of May 18th have seen registration increase almost 4%, and three-wheelers have seen an increase up to 3%. And apart from these two segments, all the other segments of four-wheelers have seen a decline. Now, apart from this, there is one positive news related to Bajaj Auto, which has helped the stock gain almost 4% today and was top Nifty gainer. And that is related to, over the weekend, basically in November 2024, KTM had filed for insolvency, and after that in February of 2025, creditors had approved restructuring plan, and as per the plan, KTM was supposed to secure loan of 548 million euros, and that was supposed to be done by May 23 of 2025. Now, over the weekend, Bajaj Auto has disclosed that Bajaj Auto International Holdings, that is a wholly owned subsidiary of Bajaj Auto, has managed to secure loan of 566 million euros. Now, analysts believe that after this loan, the company has secured the loan, it will help KTM, which has been struggling over the last 1 to 2 years, now will come back on the growth path, and that was the main reason that Bajaj Auto was higher 4% today.
Okay, Sudarshan, thank you so much for that. But on the flip side, we had Protein EGA, which was in under pressure today. 20% lower circuit is what it was. Why? Because obviously over the weekend they said that they are not shortlisted for PAN 2.0 by the Income Tax Department. 50% of their revenue comes in from PAN services. The company in their con call highlighted that this will not impact them immediately. There's no impact on their PAN business because their PAN business as of now involves processing as well as distribution. And this new PAN 2.0 was mainly towards a tech side, a tech revamp that Income Tax Department wanted to do. So immediate basis, there is no impact coming in. But what analysts have highlighted that, going forward, FY27, that's when we'll start seeing an impact coming in when PAN 2.0 actually goes live, and when it's launched, that's when we could start seeing an impact coming in for the company in terms of their revenue. I'll come to you, Jay. What's your thought coming in quickly in terms of Protein EGA? What are you watching out for in terms of levels over there?
No, really, I mean, see, what has happened is, as far as this stock is concerned, it has hit its lifetime low. Technically, I would say that definitely that clearly indicates the weakness in the stock. In fact, the stock was trading within a very narrow range, I would say, of 1450 to say 1250. I mean, that was 200 points range, which has got broke now on the lower side. So if you just superimpose it, or maybe calculate the same on the lower side, then the short-term target should be 1050, 1000 levels. So I think that those would be the levels wherein stock can at least find some support. Now on the upside, till 1250 levels aren't taken off, the overall trend should be down negative, at least in the levels of 1000.
Okay. All right, Sudeep and Jay, thank you very much for joining us with your perspective on all the individual stocks and the market itself. Thanks for joining in. We need to take a very quick break. Back with all the key events to watch tomorrow. Welcome back. Let's quickly take stock of a lot of the corporate commentary that we picked up during the course of the day. First up, Keynes Technology. The company has guided for revenues of around 4,500 crore rupees this year. It expects exports to surge and is anticipating a 50 basis points expansion in margins. That's not all. It says revenue from its outsourced semiconductor or assembly and the test facilities, as well as its printed circuit boards business, is projected to be between 50 to 100 crore rupees for FY26, and it will scale up significantly then in FY27.
Okay, and next up, Nifty Organics, a specialty chemical manufacturer, is currently operating at full capacity and has added 2 new production lines. The first set is to be commissioned in the first quarter of FY26. A significant portion of this year's growth was driven by acrylamide, which was a form of acid, on the back of improved demand from the company. The company expects momentum in volume growth for this segment to continue into FY26. Nifty Organics is also expanding its product portfolio with strong domestic demand for specialty chemicals. It has guided for an annual growth of 15 to 20% over the next 3 years.
All right, before we wrap, let's get you some of the key events to watch out for tomorrow. Upasana is here with the details. Upasana.
Okay, first up, let me start with the global economic cues. Back to US, FOMC member Bostic speaks. He may give some clues in terms of future monetary policy. That is why it's an important data. Europe will be reporting its consumer confidence data for the month of May. China, People's Bank of China monthly decision is scheduled for tomorrow on benchmark loan prime rate. And back home, that is back to India, domestic economic data will be released. That is the infrastructure output for April is scheduled to release tomorrow. Now let us look at the key stocks that will be on focus on the back of corporate action. SBI will be in focus as the board meeting is scheduled to evaluate fundraising of up to $3 billion via offshore bonds. Ugro Capital will also be in focus on the back of fundraising. Now let us look at the key important results that will be on our radar. Hindalco Industries, United Spirits, Dixon Technologies, JK Tyre, NHPC, Torrent Pharma, Whirlpool India, Zydus Life Sciences, all these companies will be reporting their Q4 FY25 numbers tomorrow. And lastly, Borana Weave's IPO opens for subscription tomorrow. So that's also an important thing that we'll be closely watching out for. And Piyush Goyal is in US for key trade talks. So we'll be tracking closely that as well. So all in all, looks like quite an eventful day tomorrow.
Okay, Upasana, thank you so much for that. But with that, we'll wind down this edition of Market Forward on CNBC-TV18. Thank you so much for tuning in. Up next, and more news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end a range-bound session with marginal losses amidst weak global cues. Mid-caps outperformed the blue chips. The Supreme Court rejects Vodafone Idea and Bharti Airtel's pleas seeking waiver of interest and penalty on adjusted gross revenue dues. Calls the petitions misconceived. The decision comes as a setback for Vodafone Idea. The company had cautioned the government that it won't survive beyond FY26 without relief. Commerce Minister Piyush Goyal is in the U.S. as trade negotiations are expected to gather pace. Goyal will meet U.S. Commerce Secretary Howard Lutnick and trade representatives Jameson Greer. Government authorizes emergency procurement of weapons for the armed forces worth up to 24,000 crore rupees. Defence stocks see profit booking after the recent rally amidst concerns over steep valuations. The Enforcement Directorate arrests former UCO Bank CMD Subodh Kumar Goyal in connection with the 6,210 crore rupee loan fraud involving a steel company. ED alleges Goyal sanctioned large credit facilities and received substantial illegal kickbacks. The Supreme Court rejects Madhya Pradesh Minister and BJP leader Vijay Shah's apology days after his derogatory remarks against Colonel Sophia Qureshi. The court calls his remarks crass, thoughtless and orders an SIT probe, but stays his arrest. Uber partners with ONDC for an in-app feature to book Delhi metro tickets. Uber is also bringing back food delivery with a new logistics push. Global CTO Praveen Naga says Elon Musk's vision of self-driving cars could be the future of transport. That's an exclusive. Former U.S. President Joe Biden diagnosed with aggressive prostate cancer. His office says the cancer appears to be hormone sensitive, which allows for effective management. Prime Minister Modi extends his best wishes to Biden for a quick and full recovery. Well, let's start with the day's market action. The markets closed today mixed, with the benchmarks underperforming the broader markets. Nifty failing to hold on to the 25,000 mark after top blue chip stocks underperformed in today's session. That's the Nifty down by about 74 points. The Sensex lost 270 points. But the Nifty Bank and the Nifty Mid-Cap Index closing flat, though in positive territory. That's the story as far as our markets are concerned. But let's go straight to the top story this evening. Now, the Supreme Court has rejected writ petitions that were filed by Vodafone Idea and Bharti Airtel seeking a waiver of interest and penalty on the adjusted gross revenue dues. The court has called the petitions misconceived. The court has already dismissed curative petitions filed by these companies. Vodafone Idea stock lost nearly 9% after the ruling came in. Now, Ashmit joins us to explain where this leaves Vodafone Idea. Ashmit, take us through what the court order says. And has Vodafone Idea essentially exhausted all legal options now? What could possibly be next?
Well, at least on the question of AGR relief, all doors appear to be shut, at least as of right now. Bear in mind, the Supreme Court dismissing this petition outright. In fact, at one point, Justice, who was heading this bench, expressing shock as to how such a petition could have been filed even after a curative petition was dismissed. The Supreme Court saying that this petition is misconceived and deserves to be rejected outright. So a definite setback for all the telecom companies involved, but particularly for Vodafone Idea, because bear in mind, just days before approaching the Supreme Court, they had knocked on the doors of the government asking for further relief, giving a very bleak picture of that, saying that if the relief is not granted, then this could very well lead to a situation where the company is heading into insolvency. It won't survive the winter, they said. They won't survive beyond FY26. But the government stance has been to Vodafone Idea in that letter. And today, before the Supreme Court, it has been consistent. The government just cannot consider this representation for relief. Their hands are tied, given that the Supreme Court has given a very clear, explicit AGR judgment. So that appears to be the view that the government is taking. So that door appears to be shut. The Supreme Court saying that we certainly don't see it as a fit case for granting any relief, rejecting that application. So a definite setback for Vodafone Idea. The only caveat, perhaps, that we need to add, perhaps, is that Justice Pardiwala, while hearing this matter, made an observation that if the government chooses to help out the telecom companies in question, the Supreme Court will not come in the way, but it does not want to be a party to that ongoing consideration. But the Supreme Court is quite clear. That was an observation. It does not find mention and does not carry the same legal weight as a formal order.
Yes, well, we will have to wait to see now what the next course of action will be for Vodafone Idea. Certainly, more trouble there for the beleaguered telecom company. Ashmit, many thanks for joining us. Now, Moody's has downgraded the credit rating of the United States from the highest level, citing deepening concerns over the nation's fiscal stability. The U.S. government's credit rating has been downgraded from AAA to the second highest rating of AA1. This is the first time Moody's has downgraded America's long-term sovereign credit rating, and this places the U.S. on par with other advanced economies, including Austria, France, and the United Kingdom. Meanwhile, the U.S. Treasury Secretary Scott Bessent dismissed Moody's ratings and called it a lagging indicator. Take a look.
That Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. Larry Summers and I don't agree on everything, but he said that when they downgraded the U.S. in 2011. So it's a lagging indicator. And just like Sean Duffy said with our air traffic control system, we didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. You know, we inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
Well, that's Treasury Secretary Scott Bessent. And Moody's downgrade of the U.S. credit outlook has also pushed oil prices lower. Fears of falling demand after China's industrial output slowed in April, also weighing on prices. Meanwhile, the ratings downgrade also boosted safe haven demand for gold. The softer dollar also pushed the yellow metals prices higher, so gold back on the up move. President Trump's sweeping tax cut bill has been approved by a key congressional committee. This would be Trump's first big legislative push in his second tenure. The measure would extend Trump's 2017 tax cuts and reduce taxes on some tips and overtime income. Non-partisan analysts say the bill would add $5 trillion to the nation's already ballooning $36 trillion debt over the next decade. A possible vote on the bill in the House of Representatives could take place later this week, so that's going to be an important piece of legislation to watch. Now, President Trump has also criticized retail giant Walmart after Walmart warned that it may raise prices because of the tariffs on imports. The U.S. President said that the retail giant should stop trying to blame tariffs for raising prices throughout the chain. In a post on Truth Social, Trump said that Walmart should bear the rising costs. The company said that it will work to keep prices as low as possible amidst the reality of small retail margins. And staying with the U.S., Commerce Minister Piyush Goyal is in the United States and is all set to meet U.S. Commerce Secretary Howard Lutnick. Sources have told us that Piyush Goyal will assess progress made by delegation-level talks over the last 2 months. Speaking to Fox News over the weekend, President Trump repeated his claims on India charging high tariffs, saying it's impossible to do business there. When asked if a trade deal with India is close, Trump said, and I quote, "I'm in no rush. Everybody wants to make a deal with us," end of quote. Abhimanyu standing by now to take us through what we can expect from the Commerce Minister's Washington visit. Abhi.
Commerce and Industry Minister Piyush Goyal is in the United States. He's going to meet the U.S. Commerce Secretary Howard Lutnick and the U.S. Trade Representative Jamieson Greer during his visit. Also, today onwards, talks between the negotiating teams of India and the United States are going to begin. They are slated to go on from the 19th to the 22nd of May. Several issues are going to be discussed, while the minister's visit is going to provide the necessary political level steer to over 2 months of BTA negotiations. An interim agreement on trade and goods could take place as part of early mutual wins in case both the sides agree. Also, the initial focus would be on issues pertaining to goods and non-tariff barriers. It remains to be seen whether issues like rules of origin and services may also figure in the talks, even as both the sides are looking to conclude the first tranche of the agreement by the fall of this year. Also, there is a 90-day pause in the imposition and the levy of tariffs by the United States, which is going to go on till the 9th of July. And both the sides are sounding confident as far as clinching a deal before that date is concerned. It remains to be seen how early a deal could be reached by both the sides, even as sectoral level engagements are also expected to take place. And India's proposal to levy retaliatory tariffs on steel and aluminium may also figure as part of discussions between both the sides, in which several issues are going to be discussed. But any finality would only be attained only when a deal is inked. So clearly all things till now are not as clear as they should be as far as any finality to the negotiation is concerned.
Abhimanyu, many thanks for joining us. Now, the government has authorized emergency weapons procurement worth up to 24,000 crore rupees for the armed forces. Sources tell CNBC-TV18 that the procurement will include loitering munitions and counter-UAV systems. Parikshit is standing by with more. Parikshit, what can we expect in terms of the emergency procurement by the armed forces?
Well, this confirms a CNBC-TV18 news break that the government is all set to go in for emergency procurements and replenishment procurements as well. We had reported a few days ago how the industry expects orders to the tune of 39,000 to 40,000 crores for all equipment and ammunition that was used up during Operation Sindoor, and to replace that as well. Now we have confirmation that the Defence Acquisition Council met recently and gave its approval to authorize the armed forces to go in for emergency procurements. Now this is for loitering munitions, anti-tank guided missiles, counter-UAV systems, including drones, and also artillery ammunition for the Indian Army. Now the acquisitions will take place for all three services. Each vice chief has been empowered to order weapons and ammunition to the tune of about 300 crore rupees each. We are yet to get an exact number as to what will be the quantum of procurements by the government, but we are told that the upper cap is 15% of the defence modernization budget, which is 1,60,000 crores for FY26. So 24,000 crores is the upper limit. We're told that the numbers could be slightly less than this because deliveries have to be made within a year. So what are we looking at? Well, we're looking at contracts to be finalized in the next 40 days from now. This will include both domestic and foreign suppliers, and we're looking at acquisition of Scalp and Hammer missiles as well. Those will require consent of the Ministry of Defence because they are foreign purchases. Secondly, after finalization of contracts within 40 days, deliveries have to be made within a year. So this may not be all. There may be more acquisitions that the government may be looking to do in the next few months.
Parikshit, many thanks. Now, India's top defence companies are eyeing a bigger order book this fiscal. Prime Minister Modi, in his address to the nation last week, had highlighted that Operation Sindoor was the Make in India moment for the Indian defence sector. We spoke with top executives of India's top defence equipment companies to get a sense of their projected order book. Take a look.
अब हमारे पास करीब 65,000 करोड़ का LCH का ऑर्डर जो हाल ही में आया था, बिगेस्ट ऑर्डर इंडियन डिफेंस हिस्ट्री में है। ये एक बड़ी ऑर्डर है 156 LCH। दूसरी है जो अभी 83 LCM Mark 1A जो एग्जीक्यूशन में है, और 12 Su-30 जो हम बनाने वाले हैं वो एक ऑर्डर था, और 240 Su-30 इंजन्स। कुल मिला के आज के दिन 1,90,000 तक ऑर्डर बुक है, और ये अगले साल में और ज्यादा होगा।
We currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. We were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. We should be getting those orders. But with the new, situation, I think the order book position will be substantially higher.
But defence stocks saw some profit booking today amidst concerns over valuation. Shares of drone maker IdeaForge trading at a price-to-earnings multiple of 124 times, even as it remains 33% away from its 52-week high. Almost all defence companies are trading at a PE multiple of more than 30 times. Sanjeev Prasad of Kotak says valuations are not adding up.
We were just buying anything and everything without looking at, whether the nature of what we're going to say as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you are paying for whatever you're buying, and you look at some of the numbers they make really, very little sense to me, at least, if I look at, let's say, something like a potential PR, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores.
Well, a question mark on valuations there as far as the defence stocks are concerned. Now, the Enforcement Directorate has arrested Subodh Kumar Goyal, the former chairman and managing director of UCO Bank. The ED said Goyal was arrested on the grounds of money laundering in an alleged bank loan fraud case. Ritu standing by with more. Ritu, take us through the details of what has transpired. Why this arrest?
Well, Shireen, Subodh Kumar Goyal, who's the former chairman of UCO Bank, has been arrested on money laundering charges in this bank loan fraud case, which involves more than 6,200 crores. That is linked to a Kolkata-based company that is called Concast Steel and Power. Now, the arrest was made on the 16th of May, and he's been remanded to ED custody until the 21st of May. Now, according to the ED statement, during Goyal's tenure as the CMD, UCO Bank had sanctioned a large credit or large loan to Concast Steel, which was later siphoned off by the borrower group, and in return, Goyal allegedly received substantial kickbacks that were routed through a complex web of shell companies, dummy individuals, family members to really disguise the origin of this criminal money. Now, this included cash, luxury goods, immovable property, high-end hotel stays, and so on. The ED has said that it identified several assets that were tied to these shell entities and directly linked them to the diverted loan funds. The ED has also said that it found incriminating materials that detailed these illicit transactions during searches that were conducted in April at Goyal's residence and those of his associates. Now, earlier in the same case, we already saw that the ED had provisionally attached about 510 crores worth of assets that belong to Concast Steel and its promoter Sanjay Sureka, who was arrested in December and remains in judicial custody, and further investigation in this case is ongoing. Now, Subodh Kumar Goyal has had a long career spanning public sector banks like Bank of Baroda, Allahabad Bank, including his stint as the CMD of UCO Bank around 2007. Interestingly, as the Chief Vigilance Officer at Bank of India around the time of 1999 to 2002, he also is said to have played a role in unearthing the Ketan Parekh scam. And so the irony of his arrest coming in now isn't really lost on the financial world.
Ritu, many thanks for joining us. We will head into a break, but up next, Uber partners with ONDC for an in-app feature to book Delhi Metro tickets. Uber is also bringing back food delivery with a new logistics push. More on that when we return. Welcome back. You're watching Business 360. Israel has ramped up attacks across Gaza, carrying out at least 30 airstrikes within an hour. At least 28 were killed during those strikes in the southern region of the territory. This is Israel announced it will allow a basic amount of food to enter Gaza to avoid what it called a starvation crisis. Prime Minister Netanyahu's office said the move was made to support the army's renewed military offensive against Hamas. From one war-torn region to another, Russia has launched its largest drone attack on Ukraine since the war began. This comes ahead of an expected phone call between President Trump and Russian President Putin. Ukrainian officials said that Russia launched over 270 drones in one night, largely dominating central Kyiv. The attack killed one woman and injured 4 others. The United Kingdom is poised to reset trade and defence ties with the European Union after Britain's exit from the European bloc in 2020, according to a CNBC report. A security and defence partnership has been concluded. Reciprocal access to fishing waters has been agreed upon until the 30th of June 2038. The Global Power has also reportedly finalised a deal on energy cooperation. The deals were made as UK Prime Minister Keir Starmer hosted European Commission President Ursula von der Leyen in London. Well, here's CNBC-TV18 exclusive. Uber has partnered with ONDC for an in-app feature to book Delhi metro tickets. The company's global CTO, Praveen Naga, said Uber is also bringing back food delivery, but with a new logistics push. He also added that Elon Musk's vision of self-driving cars could be the future of transport. Take a look.
We have already a courier product, right? Through that, we actually get a sense of what the needs are. We actually see our consumers trying to get something from the businesses, like go to the store and get some things and so forth. So we already see the product being utilized that way. So it's a natural fit to expand into it while through this. Now, what makes it very interesting is ONDC is actually helping us tap into the sellers and the platforms, which is the hard part of building this out, right? But now ONDC is enabling it, so it's easiest for us to get started. Starting with food deliveries, right? I think then you can imagine the possibilities here, which is pharmacy delivery, or like grocery delivery, or having healthcare products delivery, retail stuff, right? All these things are very much possible. We already see this in our market. As I said, consumer products, people are already mimicking those things to get it, so we can now naturally do this. But it's very interesting with ONDC, what will happen is we're able to get all the small merchants into the platform. Autonomous cars is going to play a big role in a mobility ecosystem. It won't be the only play. It will be one of the modes of transportation. Now at Uber, we strongly believe in it, and we partner with several partners who actually work on autonomous stuff. We launched in Austin, and we're going to launch in Atlanta with Waymo. And we have partnerships with 14 other partners around the world. We launched in Abu Dhabi as well. If the autonomous tech is successful in India, Uber will be the first one to bring the tech.
And you can catch that conversation with Uber's Chief Technology Officer, Praveen Naga. That's coming up for you at 6 p.m. tonight. Walmart-owned e-commerce company Myntra is going global. The fashion retailer's forayed into Singapore, aiming to cater to the Indian diaspora. The launch is part of a broader global strategy to tap into new customer segments and build brand affinity. The CEO of Myntra, Nandita Sinha, explains why the company chose Singapore for its international foray. Take a look.
There is a large Indian diaspora that lives across the world, and we want to tap into that diaspora. We chose Singapore first because it's a country where already, around 5% of the Indian diaspora already, visits Myntra, the Myntra platform. Why we wanted to get into this venture was because of the fact that almost 10 to 15% of our traffic on the web actually comes from international markets. So we knew that there was an opportunity where consumers were looking at us.
Well, that's Myntra going international. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. We're back in a moment after a very short break. Stay tuned.
India works. We may not agree with it driving through Bombay traffic and all of that, but it does work.
Manufacturing is the road to ultimate prosperity, right?
We are not a smaller Asian economy where you cater to 5% of global demand and it changes your whole world. We are as big as China.
How should investors understand rural India, and are there any opportunities here?
Smaller cities, other cities across the country are growing very rapidly. You go to any state capital, the real estate market, even in the slowest state, is very, very strong because of migration.
Is earnings growth becoming a real problem?
It is. If you look at the tone of earnings that have come out so far for the March quarter, or the likelihood of earnings in the coming quarter, it's just not going to be great. How do you make money in this market? Is by being patient.
Welcome to another episode of Market Cafe. I'm here with another guest with another conversation. And my guest today is Sanjay Mukim, who is the head of research India at JP Morgan. Sanjay, I can't tell you how happy I am to manage to sort of pull you out on a working day from the office and sit down for this conversation. So thank you so much for coming over.
Thank you for having me. It's a pleasure being here, Surbhi.
It's very simple. The agenda is very simple. We want to nitpick your brain and figure out how to make money in the Indian market. It's as simple as that.
We'll try our best.
No, but on a serious note, the world's getting more and more confusing, and the whole purpose of these conversations is to kind of take a couple of steps back, not just one, but a couple, to keep the slightly bigger picture, in perspective. And I know that over our conversations over the last many months, I know that your team has been doing so much work on looking at the manufacturing opportunities, specifically what's happening in rural India, very specifically trends like population changes and the demographic dividend. So why don't you start and tell us what is exciting you as you look at this vast landscape of India and research within it right now?
Well, let me take a 60,000-foot comment and start with that. India works.
Okay.
Right? And that's, we may not agree with it driving through Bombay traffic and all of that, but it does work. And that's one of the reasons that India's valuation premiums tend to be justified. Okay. And let me sort of explain in a templatized format what I mean by this. If you look at the countries that have successfully industrialized or have gone from low income to medium income or a high income even, one of the basic criteria is to migrate your labor force from an agrarian, agriculture-dominated industry to either manufacturing or through services for the very simple arithmetical economic model that the productivity of a person in manufacturing or services is significantly higher than being in agriculture. So when you take your masses out of farming and you put them on an assembly line or you put them in a service sector, your overall productivity improves dramatically. It may surprise people. In the late 1700s or early 1800s, the US was 80% farming. Right? Today, it's less than 5% farming. So that transition is what drives the higher productivity. It's what drives the higher GDP, the standards of living, etc. And this is a template that has worked for even the Asian tiger economies that have done it. If you look at the Japanese migration sort of chart, they had a steady sort of flow of migration of people leaving farming to go to other manufacturing services. But at the end of the Second World War, that pace accelerated dramatically. We had a very rapid migration. The same things happened with China, the same things with Great Britain, everywhere. And we have these charts in our notes. India, actually, that net migration out of farming started only in the 70s, not when we gained independence. Actually, the proportion of farming was going up because the population was going up. So we are doing the exact same thing as everybody else has done. We are also now transitioning people out of farming into others. Our pace is more American than Asian tiger.
Slower.
The US took 150 years to do this, right? Japan did it much quicker. We are at the pace of the let's say the more developed countries today. Than the Asian tiger economy.
Let me come in over here. Sure. So what you're saying is basically what has been established around different economies across the world, that manufacturing is the road to ultimate prosperity, right? If I go back and look at numbers, I think the last couple of quarters, every time the GDP numbers have come out, there's been a bit of a disappointment on manufacturing. The fact that the pace of growth, if you're looking at manufacturing as a percentage of the country's GDP, etc., those numbers for many are not moving up as fast as one would have hoped for.
Yes.
Your thoughts on this?
We've done work on this, Surabhi. So if you look at the data across 200 countries and through time, if you have a country which is not exporting, right, where gross merchandise exports are not, or net merchandise exports are not a very big number, then 20% odd of labor force employed in manufacturing is sufficient to cater to domestic demand. Broadly, this is not a very scientific.
If you're not an export-focused economy,
then you need only 20% of your labor force in manufacturing, okay, not more. And very few countries without exporting have gotten to a higher intensity of manufacturing.
That's very interesting because we have been a more domestic-facing, local-looking economy, inward-looking.
And as long as you stay that way, you will struggle to employ more than, say, 20% of people in manufacturing because they produce so much, you don't need more than that.
You don't need more than that.
So the only way you go to, let's say, a 35, 38%, which China sort of peaked at, is if you are a big exporter to the world. Okay. Now, why in that transition from farming to other things, why is manufacturing preferred? It's because it's easier, right? If you're on an assembly line, you don't need as much skilling. You just need to do a repetitive task, which is probably low value, but it's still better than farming. And therefore, it's easier to take your millions out of farms and put them into a repetitive assembly line, which is what a lot of countries have done. The big plus and minus for India at the moment, Surabhi, to go more bottom up, is that there is a restructuring of global supply chains happening, right? Whether organically or inorganically because of what has the US administration has now chosen to do, there will be a redesign. A lot of manufacturing will leave China. Some of it will go back onshore to US and other developed countries. The low value stuff cannot go back onshore. So
I'm hearing you say that you know, and it's sounding ironical because you need to have more exports if you want to grow your manufacturing base. In this environment for the next 4 years, I don't know how anybody can grow their exports given the absolute chaos around us.
Possibly, right? But I will not be as despondent because let's take a step back. While the US is saying that we need to reduce trade deficits with every country, we need to bring manufacturing back, the US is still labor tight. They don't want to immigrate. And there are lots of low value manufactured goods that probably do not fit the US economy today. So
which hopefully they'll realize and accept.
And this is economics, right? Because you do need to consume clothing, you do need to consume footwear. If you don't want to buy Chinese clothing or footwear, then it has to be produced somewhere in the world. India is one of those destinations which, if we show up to the table and if we do a good job of attracting those supply chains, we should be able to gain a bigger share of at least the low value, high labor manufacturing industries moving to India.
Is the market sufficiently capturing it? Because yes, I mean, we are hearing this and it sounds logical that if they want to move away from China for whatever reason, that business should come to India, that manufacturing business. A, do you believe we'll see this real serious shift? And B, is the market sort of capturing it enough in terms of stock prices?
There are two answers to that question. Yes, it will happen. Right? Because there logically is not enough capacity in the rest of the world to take up some of this manufacturing. Okay, but the second, and look, there will be lots of businessmen in India who will do well on the back of it. There will be new companies that will grow. As example, the entire solar manufacturing chain has been created in the country in literally the last 5 years. With government support and tariffs that have been placed elsewhere, the Indian solar industry has prospered. Okay. And this can be repeated in many other small industries. They may not necessarily be listed on exchanges today, but eventually will be at some point. The question on the other hand is, will this be enough to drive my economy from say 6.5% to a structural 8 or 9%? That is where you become a little bit more skeptical. Because we are not a smaller Asian economy where you cater to 5% of global demand and it changes your whole world. We are as big as China. Okay, we need the kind of manufacturing output or intensity that China did over the last 2 decades. That is a more debatable question, Surabhi, right? Does the world need another China? Probably not. So the way to approach this is, yes, we will gain some. Some Indian businesses will do very well. There will be lots of employment hopefully created on the back of it. But it may not still be sufficient for me to change my GDP growth outlook for the next 5 to 7 years.
So for someone who is looking at investing in Indian equities, and is willing to play that patient cycle, at least 3 to 5 years. So traditionally, textiles, footwear, pharmaceuticals. These have been our main export-oriented industries. Which are the new pockets that you see emerging as this shift happens?
Well, I think there are a couple where I would, at least start to explore. Engineering goods look interesting, and this does not need to be very rocket science engineering goods, but just let's say auto parts or diesel generators or electric pumps or stuff like that, where data in India has already been strong for a few years. These are not technology hostage industries, right? You do not need to invent or learn, or these are very standard manufacturing. And Indian companies are capable enough to be able to do this. So that's another area which is probably less focused on, which I think Indian companies can do well on. Appliances similarly, again, not very technology sensitive, but it requires a lot of effort putting it together. So those are industries which should do very well.
Electronics, we had Mr. Tim Cook overnight say that half the phones that Americans are going to be consuming iPhones, they will be coming from India. So I guess, we're seeing the signs of that. So that's manufacturing, and you're sounding reasonably optimistic. That's a big theme that we cannot afford to ignore if you're looking at the market 3 to 5 years. Let's go back to the agrarian story, which is where we started, right? What is happening? Because when I, traveled, so I went for Mahakumbh, by the way. I traveled through UP, and I've seen the pace of infrastructure development that's happening over there. I'm seeing people's aspirations rise. People do want to spend more, even the local folk. But I don't know if it's being replicated everywhere. So what should, or how should investors understand rural India, and are there any opportunities here?
Oh, I think so. And this will tie back to the few comments I made earlier, right? That ultimately what I need to do is to take people out of farming and stick them into a higher productivity industry, either manufacturing or services. We spoke of manufacturing, but think of the service economy. And service economy doesn't necessarily mean just an IT job, right? Services could be you are an auto repair technician, or you are an electrical, electrician, or a plumber, or any of that. A service industry or a service economy, by definition, cannot happen in a rural setting. Because if you did train yourself and you became an auto mechanic, how many autos will you repair if you're stuck in your village? So by definition, if you want to be a service-oriented economy, you need to urbanize. Okay, you need to take your smaller conglomerates of, let's say, smaller 70 house, 80 house villages, put 10 of them together and become a 700 house, 1000 house settlement, where a service economy can then develop, right? For example, and there is a stat which I think is broadly correct. I think the Indian government says that there is a primary school now within 1 kilometer of 95% of households in India, right? But the primary school is up to class 7. What do you do after that? Can you build a college or a high school in every single village? You cannot, because there's not enough people, there's not enough kids. So you need to build urban centers, and that doesn't mean people coming to Mumbai.
Yeah, because that's what it's always meant. You leave the village and you come to one of these big cities, mega cities.
But that's where what the developments of the last few years are very encouraging, because smaller cities, other cities across the country are growing very rapidly. You go to any state capital and you can have a view on the economy in that state. Doing well, doing badly doesn't matter. The real estate market, even in the slowest state, is very, very strong because of migration. right? So this urbanization is a very strong driver of India's economic growth, and it is what will support the migration of labor and drive a services economy as well. If you look at, let's say, the US, which is an ultimate service economy right now, I mean, they want to go back to manufacturing to some degree, but this is it's not everybody doing technical jobs. It is teachers, doctors, nurses, government administrators. Those are the bulk of your jobs in the economy. And again, that cannot happen in a rural setting. So what I think India has been doing and will probably be a bigger driver of growth than manufacturing deltas, which should still be positive, is the urbanization theme in the country.
Urbanization.
Right.
And how do you play that? I mean, I understand the concept, but what kind of companies are the best play? Because it sounds pretty vast, the whole theme. Yeah.
And there's a lot of associated things that should benefit from urbanization. One, of course, very obviously real estate. There is this data from a few years ago. If you look at the per capita constructed space in India, not land per person, but floor space of residential, all India per person is about 10 square meters, 100 square feet. It's like a jail cell. Okay. Tokyo, which is the densest urban city in the world, is twice the India average.
Wow.
Right. China is 4x the India average.
Okay.
And I won't even tell you what the US is. Right? Because we have not built enough homes for a variety of reasons, right? Policy and culture or whatever you call it. But if you were to take that 10 square meters Surabhi and grow it to 15 square meters, still lower than Tokyo, I would need a bare minimum $2 trillion worth of steel and cement.
Wow.
It's
just
massive.
to build so much of real estate, so much housing.
Yes.
Okay.
There is almost infinite demand for all of this. So real estate, housing construction can be a very big theme in India, and it drives growth because as you demand more cement, as you demand more steel, as you demand more appliances, that drives other demand in the country as well. Okay. So I think that can be very, for a longer term investor. Of course, the debate will be which company is doing it, which is not doing it, those are other issues. Education is a very, very strong growing sector in the country. The data, top-down data on household spends on education are very robust. Okay. Very difficult to find stock plays.
Yeah, stock plays, because in the
market.
listed universe.
Yes.
Yeah.
But when you look at the category spend, education is doing very well. Wow. Healthcare similarly is very, very robust. Now, because of sampling issues, you will assume that everybody goes to private hospitals. No, the penetration of private hospitals, even in urban India, is extremely low. Okay, a majority of people still use the public healthcare system. And as incomes rise and as the country urbanizes, you should see the services of private healthcare continue to grow at a very high compounding rate as well.
Okay, so let me recap this. So the ways to play the great Indian urbanization story, real estate could be one straight, materials, steel, cement, which will be used in building that whole piece, and healthcare services.
Healthcare
and education services, you say.
And I will throw in one more, which we may be ambivalent on how we approach it, is the consumption of processed foods.
Oh, okay.
Right. Now, people who've evolved to a certain degree of income realize that processed foods are bad.
Nothing out of a can, as they say.
Yes. But as incomes rise at the lower end of the income cohort, the aspiration for processed food is very high. Because I could not afford a packet of chips when I was younger, I will provide it to my kid. Right. And this is a conversation I've had with doctors in rural India, that they're facing malnutrition problems because the kids are now consuming a lot more junk food. So again, like I said, you will be ambivalent about how you think about it, but the consumption of processed foods in India is growing.
And in rural India, it's really growing. It might be peaking in urban centers.
That's right. So there are a variety of ways that this urbanization, the J curves that are hit when incomes reach a certain, there's a variety of categories that do very well.
This is amazing. I mean, and it kind of reminds us again that there are many Indias within the India. So you have to decide which India you want to play in and how. So this is making me feel actually quite optimistic on at least the medium term, next 3 to 5 years. But now I have to come to a little bit of here and now as well. Because here and now, when we look around, I mean, one is this whole global tariff issue. That's one we've discussed it. But even otherwise, X of tariffs, when I hear commentary, whether I talk to market participants, investors, or people linked to the market, one concern seems to be an immediate slowdown in India. whether it is consumption. Most of our large FMCG companies are barely able to do 2-3% volume growth. They're flat, sometimes it's down. IT services, again, because of various global issues, not growing. So, in the here and now for the listed market, is earnings growth becoming a real problem?
It is. If you look at the tone of earnings that have come out so far for the March quarter, or the likelihood of earnings in the coming quarter, it's just not going to be great. Okay. And look, if there is a sentiment problem globally because of the uncertainty around tariffs, that percolates to India as well. So corporate sentiment, who is going to set up, commit large capex in this environment? Very few people will want to do that. They'll want to wait and see how these things develop globally. Consumer sentiment is impacted similarly because of the headlines that you read on TV. Oh, if you're an IT employee, are you expecting a big bonus this year? Perhaps, maybe you dilute your expectation, right? Yeah. Which then feeds into your consumption patterns and you become a little bit more cautious. So the Indian economy will feel part of that shock. We'll feel less of a shock than the rest of the world, but we will feel that impact nonetheless. Okay.
But that's the global part of the shock that's kind of percolating through. What about domestic? We were supposed to be a very resilient domestic economy. Then why is there sudden concern about local earnings, domestic earnings as well?
So if you take a, let's say, 10-year historical view, on an index level basis, large cap index, we've never actually delivered dollar earnings faster than EM. So this assumption that, India will have a beta to EM on earnings, it's never actually played out in the last 15 years. So the question I get from a lot of my investors, why am I then paying this multiple premium if you've never actually delivered growth? It goes back to everything we've discussed originally, is because there is an assumption of longer growth in India. Right, that you will get this growth for the next 15 years and therefore the valuation is still justified on a DCF, whereas in other countries you may still be looking at a 2-3 year growth period.
So instead of bursts of sharp growth,
exactly,
this is, higher for longer.
Higher for longer, a duration of growth. Okay. Therefore, to go back to your question, how do you make money in this market is by being patient. If you think that...
Everybody who came in after COVID in the market, please listen to this. It's all about patience. Yes. Please continue.
So, because again, to your point, to take it seriously, right? After COVID, people have made a lot of money, right? Because there've been this huge mid-cap rally. The growth was we were printing nominal GDP growth of 25%, which showed up in earnings when, the equity market straight-lined it and put a multiple on it and all that. That is not how equity investing works. Because I'm looking at more of a duration of growth than a premium to growth, the way you make money in this market is buy at a right price. If you can get a good quality company at reasonable valuations, sit tight, good, well-executed companies in India will deliver compounding returns over time. This is not necessarily true for most countries, but it is true for India.
This is very interesting. So instead of forever searching for the burst of 9% and hit the headlines, which we people in the news love to do, we love our headlines, right? Instead of that, maybe compounding 6.5%, maybe 7% for a prolonged period can lead to prosperity. That's what you're saying.
Yes. Be patient. Don't try to find the next multi-bagger. I mean, if you can, please go ahead, right? Success rates on that are actually lower than people expect it to be. Everybody believes that they are the one that has spotted this multi-bagger well. But it's easier to find large compounding companies. Invest, be patient, you'll do well.
So what would the advice be for investors who are looking at this market for the next sort of 3-year perspective, if not longer? How should they look at their portfolios?
So again, quality and large cap, right? Okay. Because what has happened is even though several smaller stocks and mid caps have come off post the recent correction, they have not come off enough. So if I were to do a very simple mathematical analysis, sort of, and say which company today is back to 2019 P's. Not even say, I don't even say I'm greedy and I want them cheap or I want them, to fit a DCF or something. I think which company has given up its COVID premiums, X financials, that set is still very narrow. So despite the correction, I have not getting stuff at reasonable valuation. Today, with whatever is going on in the monetary policy and the RBI turning accommodative, the outlook, let's say from a 2-year or 3-year view on financials is still reasonable and they are still available to me at multiples that make sense. Okay. So any India portfolio needs to start off in a large cap mindset with a allocation to financials. The other themes we like power because the power sector is tightening. There's a lot of changes happening with the prevalence of solar. We think the battery world is very interesting because, I was skeptical of it 3 years ago and it won't work. Now it makes economic sense to set up batteries in the country. We've liked cement for a while because, it was undershooting and now it's catching up. Real estate should do well, as we spoke of. But the only challenge there is we need real estate which is more mass market rather than the...
And rather than the 20 CR apartments selling in 6 hours.
I think 20 CR also nowadays is...
Now it's history. That's true,
That's
actually.
right.
Yeah.
But yes, so you need that kind of exposure. Within the consumer space, we think companies that are taking initiative, not necessarily only defending their margins, but which are stepping out and saying, here's some promotions, here's my sales effort, here's a discount for consumers, providing value to the consumer. See, the Indian consumer is not dead. I think the Indian consumer is just looking for value. So if companies take the initiative, they should get their volumes back.
Even if it's at a cost of profitability or margins in the near term.
So this is a debate for senior management at consumer companies. What do you prefer? Do you prefer being a 2% growth company with a huge margin, or do you want to participate in India's ultimate growth, gain market share, drive volumes, but at a lower margin?
Wow. Fantastic perspective. Absolutely awesome. Before we sign off, just a little more about you, because you keep crunching all this data, all these numbers day in and day out, and like, how do you keep yourself balanced, sane?
My wife will differ with you if you're on that sane part, to be honest. We've been married 20 years now. But look, to be serious about it, look, it requires a lot of reading. And one of the joys of our jobs is that I am paid to do it. Right? I'm paid to know things, to read things. And, I've stumbled into this role and I enjoy it every day.
Very, very interesting. And I think lots of food for thought over there. Sanjay, it's been a pleasure of a conversation. We should try and, maybe make it an annual event, if not more regular. But this has been a very, very good one. Thank you so much for taking out the time and joining in. Really
Thank
appreciate
you for having me.
Thank you.
Hello and welcome to News Centre. I'm Parikshit Luthra. The government has drawn up a list of lawmakers across party lines as it gears up for a strong global diplomatic campaign to project India's national consensus and resolute approach to combating terror in all forms and manifestations. 7 all-party delegations are set to visit over 30 nations to rally support for India in its fight against Pakistan-sponsored terror. 3 of these 7 delegations will be led by MPs belonging to opposition parties. However, the list has not been without its share of controversies. Congress MP, former Minister of State for External Affairs and former diplomat Shashi Tharoor is leading one of the delegations. The Congress has said that his name was not nominated by the party. The Trinamool Congress, meanwhile, withdrew the name of Yusuf Pathan. Party Supremo Mamata Banerjee said the centre cannot decide the name on their own. Minor issues aside, there has been a broad consensus along party lines on the need to put forth India's views on the world stage. Joining us right now is Lieutenant General Sanjay Kulkarni, defence analyst, and also senior journalist Sanjeev Srivastav, also with us on the program. Let me go across to General Kulkarni at this stage. General Kulkarni, do you think sending politicians across the party lines to different foreign capitals does serve India's purpose of winning the propaganda war? Pakistan has been indulging in a propaganda war against India for many, many months now. Do you feel it's very important for India to tell its side of the story and what the objectives of Operation Sindoor were? And also the fact that because of Pahalgam, it was Pakistan which is the original aggressor.
Parikshit, thank you very much. I think, yes, definitely there's a need because Pakistan has an excellent PR work. They are excellent in hospitality. They're excellent in gifting. They're excellent in line. All of it, Pakistan masters it. And Pakistan has all their people at the right places trying to convey what Pakistan is not the perpetrator, but is a victim of terror. On the contrary, India has always been a rather, I would say, very straightforward, just doing their work and wanting to prove that, yes, the work alone shows everything. At this point of time, when we have zero tolerance for terror, it is very important because these delegations go to various capitals and each one of them is standing and telling them as to what it is all about. And they have queries, they have questions to ask. They ask questions on IWT, they ask questions on so many issues. Why can't it be settled? And when they really get to know, because it is said, a picture is worth 10,000 words. You've been reading about it, you've been listening about it, but here you have a delegation in front of you trying to answer all your questions, and they can't be better because they're diplomats also, and there's a Muslim representative also. So it's a fantastic composition which has old diplomats, ministers, you have Muslim leaders, all of them. So it also portrays and shows India in an excellent scene that yes, this is a democracy, a vibrant democracy where all of these people from all communities, religions, everybody are being represented, and therefore should that be rather than having a state like Pakistan, which is supposedly a democracy, but doesn't work like a democracy, is absolutely autocratic, has been for the last, ever since independence, either under the military or remotely controlled by the military. So there's a lot that can be conveyed, and we have excellent people representing. I think a very nice thing, 59 leaders, 32 countries going all over, telling them, I think a zero tolerance for terror could be better.
Okay, let me get in senior journalist Sanjeev Srivastav at this point. Mr. Srivastav, what do you think is the significance of this move? Will this help in creating awareness about India's campaign, also Pakistan-sponsored terror, and how India has been a victim of this, not just in Pahalgam, but many more years before that as well?
Yeah, I think, Parikshit, first of all, very good evening to you and the viewers, and of course, my fellow panelists, Lieutenant General sir. I agree with most of the things Lieutenant General Kulkarni said, that, see, Pakistan is very good at this PR game, and they have always managed to win friends and punch much above their weight as far as these PR exercises are concerned. And India has been kind of staid and laid back. But on important occasions, like there have been an instance when Mrs. Gandhi did request Atal Bihari Vajpayee, and there have been other examples also when there have been all-party delegations and senior leaders from the opposition going to present a case. So it helps project a united face of a country, that it is across political spectrum, everybody's talking the same voice, and that we are a thriving democracy. And at the same time, because one thing we have to realize that somewhere during the 5-day Operation Sindoor, Pakistan did succeed in taking the focus away from the terror attack and bringing the focus to somewhere on Kashmir and the India-Pakistan issue and long-standing rivals and nuclear powers in South Asia. So the terror issue somewhere very wrongly and unfortunately for us, did get into the background. Also, another thing which we have to remember is that whether they can be counted on their fingertips, but there were countries which openly came out in support of Pakistan. Whereas while we may claim that we had a support of a number of countries, but nobody was as vocal, say, as a Turkey or as even a Bangladesh or China for that matter. So India needs to conduct a more vibrant, more proactive diplomacy to present its case. And what better than sending an all-party delegation, which gives the right face of unity in diversity and the rich traditions, democratic traditions, which India represents. I think it's a fairly justified move. And it's definitely worth a try. We can never be sure about the outcome, but definitely one needs to keep trying.
Right. That's an important point. Let me go back to General Kulkarni at this point. General Kulkarni, if we want to have an effective campaign, it cannot stop here. How do you think we need to have a more sustained campaign in the months to come? And if we have to win this continuous war, we are at a continuous war with Pakistan when it comes to terrorism. We will not be fighting all the time, but that war is always on in some form or the other. So if you want to win it, how do you make sure that your campaign is effective and more long-term?
Parikshit, just as an example, I didn't hear Sanjeev what he said, but you were hearing both of us. So it's like that. You know, when they have delegations go there, you'll have delegations coming even from Pakistan over there. You'll have delegations going from India also over there. But almost the same countries are going to be listening to both sides. It's very effective because after all said and done, there are lots of fog. You know, not many people really know what is really on ground, what's happening. There are questions. There are certain people who will be more inclined, and the West per se is actually more inclined towards Pakistan for whatever the reasons it may be over the years. Geopolitical interests of America over the years, interests of China, interests of so many countries over there. What Pakistan has been doing. Can you imagine a country which is being bailed out for the 24th or the 25th time from IMF? Who's controlling IMF? So there's so many things how Pakistan puts across its case, how we are putting across our case. So people over there are very wise. Sooner or later they come to know, yes, it's Pakistan, which is the not victim but perpetrator. Pakistan is using terrorism as an instrument of state policy. They also now need to take care that most of the terrorist activities happening all over the world, they have a lead which goes down to Pakistan. So there's so much that is being said. And in the world today, information and keeping people informed, though of course there's so much of media, so much of social, but nothing like people coming there and putting across their case that this is what it is, this is what has happened in Pahalgam. Why is Pakistan insisting on having an international delegation coming to see what it is? Why we are saying that this is what it is? How Pakistan is involved? How neat work it does? These are the leaders. These are the people who are protecting Masood Azhar's family being wiped out. They give a state funeral. Look at all this, what is happening. So there's so much ISI is giving out its own report. So many things are happening at the same time. And most of these people abroad probably are not aware what Pakistan does, what is the modus operandi. And let me tell you, Pakistan is controlled by their military. And the military is professional. They know all the presentations. They know how to go about it. They are tech savvy. They know exactly what it is. So it's all Pakistan is masterminded. Information campaign is totally controlled, and they know what is to be done. It's very important for this Indian delegation, and I think it's an excellent move. It should be done very often, sustainable, so that at all times, even our diplomatic staff must increase in number. The people around the world must be told in no uncertain terms that, look, Pakistan is not a normal state. It is a rogue state which has a nuisance value, and you better be careful. That is why all these things are being done. They will have difficult questions. I'm sure the delegation answers all of it. The delegation is brief, and within this, all party delegations within India also, unanimous views, unanimous viewpoints coming up. Muslim leaders are part of each of these delegations. I think it's excellent, and it should. You're right, absolutely right. It should be continuous, not just a knee-jerk reaction. If Pahalgam happens, we send one, and after that we lie the wood. No, it should be a continuous thing to isolate and expose Pakistan. Yeah.
Okay, Mr. Srivastav, now coming to you, we have been saying, and the government maintains this. If you ask anyone in the government, even today, they'll say, yes, Operation Sindoor is not over. We do not accept the term ceasefire. For this, it's only for us, it's only a pause or a stop to military action and firing between India and Pakistan at the border. What does this message really send out to Pakistan and the world? Because wherever we'll be going, our delegations, a mix of diplomats and MPs across party lines, will be saying that Operation Sindoor is not over. What does this actually convey to foreign nations?
It actually conveys, Parikshit, India's firm resolve on this issue now. So every time a terror attack will happen, India will pay back in the same language as it was deployed in Operation Sindoor. So it is on hold, it is deferred, it is suspended, whatever the term maybe we want to use. But it's not over. So, and that's, while that is very gratifying as a country, and India does need to show a firm resolve, but at the same time, it does put us into a delicate situation. Because like Lieutenant General was just saying, that it is the Pakistani army which controls Pakistan. Like they keep on saying the other countries have an army, and in Pakistan, the army has a country. So all it needs to really upset the apple cart or to trigger off another row of exchanges is another terror attack. And it is impossible to stop it. Let us face it. You terrorists have to succeed only once, whereas the security agencies have to succeed every day. They have to foil every attempt. And the day the terrorists are successful, we are back to the same situation as we witnessed during Operation Sindoor. And the tragedy is that we also don't have any other option. We cannot do anything else. So it has to be a sustained campaign. And the only one thing which I would like to add is, yes, it's a question of awareness. Yes, it's showing India's resolve. Yes, it is taking the message across. Yes, it is telling the world we are the victim. But then there are cases where people already know it. But because of their own self-interest, their geopolitical interests, their locational, their geography, their interests where they lie, you cannot make a person who is already awake open his eyes, because their eyes are already open and they still choose to look the other way and kind of hyphenate India, Pakistan and equate the two, which is the bigger battle which India needs to continue to fight, and this is the way forward.
Okay. All right. We've run out of time, sir.
No gainsaying the fact that it should be done. Yes.
Yes, it has to be done, but it has to be done effectively in a more sustained manner, and there has to be a multi-pronged approach as well. Lieutenant General Kulkarni, Sanjeev Srivastava, thank you very much for joining us on the program. Now, we have seen defense stocks being in focus because, yes, the government is going in for emergency procurements, and there is a belief that government will now acquire more air defense systems, equipment related to air defense, more ammunition, and maybe more drones in future as well. Defense mutual funds are on a sharp upward march after months of lukewarm performance. These funds have delivered double-digit gains in just 1 month. Shivani Bazaz breaks down what's behind this rally and which funds have gained the most.
Well, absolutely. After a quiet few months, defense mutual funds are suddenly back in the spotlight, clocking average 1 month returns of nearly 17.7%. Most funds tracking the Nifty India Defense Index, including those from Aditya Birla, Grow and Motilal Oswal, have delivered 1 month gains between 18.43% to 18.75%. The only actively managed scheme in this entire portfolio is HDFC Defense Fund, which still returned 13.67% in 1 month. This rebound, remember, comes after a choppy 6-month phase. In February, these same funds were deep in the red. Grow ETF FOF was down 4.89%. Motilal Oswal Defence ETF fell 4.2%. And HDFC Defence Fund dropped 8.03%. Even in January, many saw double-digit losses ranging from minus 14.6% to minus 15.1%. So what has changed? First, obviously, Operation Sindoor that triggered a surge in investment sentiment towards the defense stocks and defense companies. Second, the government hiked FY25 defense spending to $20 billion US, with 75% earmarked now for domestic procurement. And finally, stocks like Paras Defense and Data Patterns have soared over 30% in the last 1 month, driving the index performance. Despite being young schemes, defense funds have seen strong inflows. Now, the HDFC Defense Funds now manages 5,400 crore rupees. Remember, this was at 1,000 crore rupees in the NFO period. So it's a 5-fold jump. While Motilal Oswal's index fund has also built an AUM nearly of 2,900 crore rupees in the last 2 years. With retail investors now turning into India's defense push, these funds may no longer be niche bets, but a rising part of thematic playbook in India. Back to you.
And time for a short break, but coming up, the Indian government has imposed fresh import restrictions on Bangladesh. A special discussion with former Indian ambassador to Bangladesh, Veena Sikri, when we're back. Welcome back. A big change in India's trade relationship with Bangladesh. The Indian government has imposed fresh import restrictions on the country. The move comes after Dhaka imposed curbs on Indian goods. According to a report by the Global Trade Research Initiative, India's restrictions will impact 42% of Bangladesh's exports, which amount to $770 million. Many categories of goods won't be allowed to enter India via land routes. This move will be applicable specifically to ready-made garments, carbonated drinks, cotton yarn waste, processed foods and wooden furniture. The specified items will only be permitted through 2 designated seaports, effectively limiting their access via land border crossings in West Bengal. Government sources have told CNBC-TV18 that India's move will aim to restore equality in their trade relationship. They added that going forward, trade relations with Bangladesh will be on a reciprocal basis. For some context, this move has been implemented because Bangladesh continues to enjoy unrestrained access to India's northeastern states, but Indian exports face high transit charges and regulatory hurdles when routed through Bangladesh. We're now joined by Ambassador Veena Sikri, former Indian envoy to Bangladesh. Ambassador Sikri, thank you very much for joining us. You know, government sources have been using some very strong words about the trading relationship with Bangladesh, going to the extent of saying that you cannot cherry-pick terms of trade. You cannot expect northeast of India to be your captive market. And at the same time, you cannot close down market for Indian goods and start subjecting them to very intense customs checks as well. So why do you think India has gone in for this move, especially the timing? If you can tell us more about that.
Well, I think if you go back a little bit to last year, to before August 5th last year, when Prime Minister Sheikh Hasina left Dhaka and Mohammad Yunus interim regime, which is not a legitimate government, but then it's been there since 8th of August last year. Now, before that, India's trade with Bangladesh was completely open and free. And India had given completely unrestricted access to Bangladesh for all their products into India, particularly, for example, items like ready-made garments, where India also has a very active ready-made garment sector, but we had allowed the free import of Bangladesh goods as an effort to boost their exports to India and to make the bilateral trade between India and Bangladesh more equitable and more equal, which has always been a big demand from the Bangladesh side. Together with this, we had a very active connectivity with Bangladesh, a very free and fair movement of goods through the riverine route from India to the northeastern states and to Bangladesh. There was train, there was road, there was all kinds of, it was moving very well. And I must say that Bangladesh's exports to India had increased to reach almost $2 billion, which was a huge increase over the earlier figures. But then we noticed, and we were quite dismayed to see, that the regime led by Mohammad Yunus, which really has the jihadi Islamist parties behind him, they gradually started imposing very stringent curbs on Indian exports to Bangladesh. All kinds of restrictions. For example, actually what they wanted to do was to reduce completely the dependence of the Bangladesh market on Indian imports. Now, the thing is that India's exports to Bangladesh are very high, but all these goods, many of these goods are actually inputs into Bangladesh's own ready-made garments industry, and then those are re-exported with tremendous value addition. So items like cotton yarn, textile machinery, man-made fiber, these are all crucial inputs for Bangladesh's own ready-made garments, and it was a win-win situation, really. But then when Bangladesh wanted to prove that this cannot happen, they started imposing restrictions and said, oh, you can't bring these to the land pause, increasing the price of India's exports to Bangladesh in order to favor imports from Pakistan, from Turkey, from China, and even from USA. But it hasn't worked, really. Bangladesh's ready-made garments industry is in a tremendous mess. It's reducing its exports, and India's Tirupur and other centers of ready-made industries are benefiting from this. But now, you see, we saw that we had to impose reciprocal restrictions. So we too will not allow Bangladesh goods to be imported into India except through Nhava Sheva and Kolkata ports. So no land port.
Do you also feel, Ambassador Sikri, that this has something to do with the kind of stand Bangladesh has been taking against India ever since the fall of Sheikh Hasina? The kind of strong statements that have come in for the Prime Minister, for the Indian government. Also, the kind of support that Bangladesh has given Pakistan during the India-Pakistan conflict recently.
Well, all these issues that you mentioned do not help at all. And certainly it is an indication that the Bangladesh regime led by Mohammed Yunus is not interested in good relations with India. They've tried very hard to build up their relations with Turkey and with Pakistan, and they've restored military relations with Pakistan, which has been a real no-no during Sheikh Hasina's time. So obviously these issues don't help at all. But I think the important factor is the issue of reciprocity, and the fact that Bangladesh cannot try to curb Indian exports to Bangladesh and hope that their goods will keep coming in a free manner. But I think net, of course, this is going to harm the Bangladesh industry very much because, as I said, even if India's exports to Bangladesh are reduced, those very same items can be very well used in India because our ready-made garments exports are booming, and there's a great scope to build this up and to use the goods which were earlier going to Bangladesh. So it would not affect India so much. But I think our Northeast also will benefit because we will develop their industries. They will not be dependent on import of goods from Bangladesh, which were items like, the wooden furniture, the carbonated drinks, and the processed foods, which were really the easy way out. And Bangladesh thought they had free access to Northeast, but they were not willing to give access to Northeastern goods into Bangladesh and being sent into other parts of India. So they were being completely non-reciprocal in this, and I think that this is going to harm them a lot. Their industry is very unhappy with this, but Mohammed Yunus seems to think that this is a very political issue. He doesn't seem to care too much about the prosperity of Bangladesh industry, about the growth and continued welfare of the people, but he's more interested in proving his point in regard to pleasing Pakistan, to pleasing Turkey.
Ambassador Sikri, my final question would be about the fact that we have seen how India, of course, has been turning the screws with Pakistan, taking strong economic measures, apart from diplomatic and military measures, to bring them to book, make them accountable for terrorism. We've also seen a strong rethink vis-a-vis our relationship with Turkey for the kind of open support, the kind of brotherhood they showed with Pakistan post-Operation Sindoor. Do you expect this to be the beginning of more diplomatic and trade-related measures against Bangladesh as well?
Yes, I think definitely that will be so because Bangladesh has shown its complete lack of interest in having a good bilateral relationship with India. And I think that whatever you mentioned about the effect on Turkey, the same feeling is there today from Bangladesh. You've seen how illegal immigrants from Bangladesh are being rounded up and sent back into Bangladesh, including the Rohingyas. There is a great deal of anger because, Bangladesh-India was one of the best relationships going. It was a model relationship. It was based on mutual benefit, and it was really benefiting. Bangladesh had 6% and more growth rate every year. Already in 8 months of imposing these restrictions on Indian exports and trade with India, their growth rate has halved. It's gone down to 3% and expected to fall even further. So I think, it's sad, but the Islamist-backed regime in Bangladesh does not seem to be interested in economic welfare of the people of Bangladesh. They feel that their jihadi objectives are more important, and they don't want to. They think they can get, goods from other countries, which is proving to be very difficult. So I think there is no escape for them. I do hope they will realize that the integrated synergies between India, Bangladesh, Bhutan, Nepal, Northeast India, West Bengal, this is a great sub-region of mutual benefit and growth, and it was proving beneficial to everyone. If they want to rock the boat on that, well, two can play at the same game. If they do think, they do have a rethink, well, I'm sure India will be able to look at it more appreciably. And I think our Northeast has to certainly pick up on its industrial growth to reduce their dependence on these manufactured imports from Bangladesh.
All right, Ambassador Sikri, thank you very much for joining us on our program News Center. With that, it's a wrap on this edition. More news and updates continue right here.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end a range-bound session with marginal losses amidst weak global cues. Mid-caps outperformed the blue chips. The Supreme Court rejects Vodafone Idea and Bharti Airtel's pleas seeking waiver of interest and penalty on adjusted gross revenue dues. Calls the petitions misconceived. The decision comes as a setback for Vodafone Idea. The company had cautioned the government that it won't survive beyond FY26 without relief. Commerce Minister Piyush Goyal is in the U.S. as trade negotiations are expected to gather pace. Goyal will meet U.S. Commerce Secretary Howard Lutnick and trade representatives Jamieson Greer. Government authorizes emergency procurement of weapons for the armed forces worth up to 24,000 crore rupees. Defence stocks see profit booking after the recent rally amidst concerns over steep valuations. The Enforcement Directorate arrests former UCO Bank CMD Subodh Kumar Goyal in connection with the 6,210 crore rupee loan fraud involving a steam company. ED alleges Goyal sanctioned large credit facilities and received substantial illegal kickbacks. The Supreme Court rejects Madhya Pradesh Minister and BJP leader Vijay Shah's apology days after his derogatory remarks against Colonel Sophia Qureshi. The court calls his remarks crass, thoughtless and orders an SIT probe, but stays his arrest. Uber partners with ONDC for an in-app feature to book Delhi metro tickets. Uber is also bringing back food delivery with a new logistics push. Global CTO Praveen Naga says Elon Musk's vision of self-driving cars could be the future of transport. That's an exclusive. Former U.S. President Joe Biden diagnosed with aggressive prostate cancer. His office says the cancer appears to be hormone sensitive, which allows for effective management. Prime Minister Modi extends his best wishes to Biden for a quick and full recovery. Well, let's start with the day's market action. The markets closed today mixed with the benchmarks underperforming the broader markets. Nifty failing to hold on to the 25,000 mark after top blue chip stocks underperformed in today's session. That's the Nifty down by about 74 points. The Sensex lost 270 points. But the Nifty Bank and the Nifty Mid-Cap Index closing flat, though in positive territory. That's the story as far as our markets are concerned. But let's go straight to the top story this evening. Now, the Supreme Court has rejected writ petitions that were filed by Vodafone Idea and Bharti Airtel seeking a waiver of interest and penalty on the adjusted gross revenue dues. The court has called the petitions misconceived. The court has already dismissed curative petitions filed by these companies. Vodafone Idea stock lost nearly 9% after the ruling came in. Now, Ashmit joins us to explain where this leaves Vodafone Idea. Ashmit, take us through what the court order says. And has Vodafone Idea essentially exhausted all legal options now? What could possibly be next?
Well, at least on the question of AGR relief, all doors appear to be shut, at least as of right now. Bear in mind, the Supreme Court dismissing this petition outright. In fact, at one point, Justice who was heading this bench expressing shock as to how such a petition could have been filed even after a curative petition was dismissed. The Supreme Court saying that this petition is misconceived and deserves to be rejected outright. So a definite setback for all the telecom companies involved, but particularly for Vodafone Idea, because bear in mind, just days before approaching the Supreme Court, they had knocked on the doors of the government asking for further relief, giving a very bleak picture of that, saying that if the relief is not granted, then this could very well lead to a situation where the company is heading into insolvency. It won't survive the winter, they said. They won't survive beyond FY26. But the government's stance has been to Vodafone Idea in that letter. And today, before the Supreme Court, it has been consistent. The government just cannot consider this representation for relief. Their hands are tied, given that the Supreme Court has given a very clear, explicit AGR judgment. So that appears to be the view that the government is taking. So that door appears to be shut. The Supreme Court saying that we certainly don't see it as a fit case for granting any relief, rejecting that application. So a definite setback for Vodafone Idea. The only caveat, perhaps, that we need to add, perhaps, is that Justice Pardiwala, while hearing this matter, made an observation that if the government chooses to help out the telecom companies in question, the Supreme Court will not come in the way, but it does not want to be a party to that ongoing consideration. But the Supreme Court is quite clear. That was an observation. It does not find mention and does not carry the same legal weight as a formal order.
Yes, well, we will have to wait to see now what the next course of action will be for Vodafone Idea. Certainly, more trouble there for the beleaguered telecom company. Ashmit, many thanks for joining us. Now, Moody's has downgraded the credit rating of the United States from the highest level, citing deepening concerns over the nation's fiscal stability. The U.S. government's credit rating has been downgraded from AAA to the second highest rating of AA1. This is the first time Moody's has downgraded America's long-term sovereign credit rating, and this places the U.S. on par with other advanced economies, including Austria, France, and the United Kingdom. Meanwhile, the U.S. Treasury Secretary Scott Bessent dismissed Moody's ratings and called it a lagging indicator. Take a look.
That Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. Larry Summers and I don't agree on everything, but he said that when they downgraded the U.S. in 2011. So it's a lagging indicator. And just like Sean Duffy said with our air traffic control system, we didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. You know, we inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
Well, that's Treasury Secretary Scott Bessent, and Moody's downgrade of the U.S. credit outlook has also pushed oil prices lower. Fears of falling demand after China's industrial output slowed in April, also weighing on prices. Meanwhile, the ratings downgrade also boosted safe haven demand for gold. The softer dollar also pushed the yellow metals prices higher, so gold back on the up move. President Trump's tweaking tax cut bill has been approved by a key congressional committee. This would be Trump's first big legislative push in his second tenure. The measure would extend Trump's 2017 tax cuts and reduce taxes on some tips and overtime income. Non-partisan analysts say the bill would add $5 trillion to the nation's already ballooning $36 trillion debt over the next decade. A possible vote on the bill in the House of Representatives could take place later this week, so that's going to be an important piece of legislation to watch. Now, President Trump has also criticized retail giant Walmart after Walmart warned that it may raise prices because of the tariffs on imports. The U.S. President said that the retail giant should stop trying to blame tariffs for raising prices throughout the chain. In a post on Truth Social, Trump said that Walmart should bear the rising costs. The company said that it will work to keep prices as low as possible amidst the reality of small retail margins. And staying with the U.S., Commerce Minister Piyush Goyal is in the United States and is all set to meet U.S. Commerce Secretary Howard Lutnick. Sources have told us that Piyush Goyal will assess progress made by delegation-level talks over the last 2 months. Speaking to Fox News over the weekend, President Trump repeated his claims on India charging high tariffs, saying it's impossible to do business there. When asked if a trade deal with India is close, Trump said, and I quote, "I'm in no rush. Everybody wants to make a deal with us," end of quote. Abhimanyu standing by now to take us through what we can expect from the Commerce Minister's Washington visit. Abhi.
Commerce and Industry Minister Piyush Goyal is in the United States. He's going to meet the U.S. Commerce Secretary Howard Lutnick and the U.S. Trade Representative Jamieson Greer during his visit. Also, today onwards, talks between the negotiating teams of India and the United States are going to begin. They are slated to go on from the 19th to the 22nd of May. Several issues are going to be discussed, while the minister's visit is going to provide the necessary political level steer to over 2 months of BTA negotiations. An interim agreement on trade and goods could take place as part of early mutual wins in case both the sides agree. Also, the initial focus would be on issues pertaining to goods and non-tariff barriers. It remains to be seen whether issues like rules of origin and services may also figure in the talks, even as both the sides are looking to conclude the first tranche of the agreement by the fall of this year. Also, there is a 90-day pause in the imposition and the levy of tariffs by the United States, which is going to go on till the 9th of July. And both the sides are sounding confident as far as clinching a deal before that date is concerned. It remains to be seen how early a deal could be reached by both the sides, even as sectoral level engagements are also expected to take place. And India's proposal to levy retaliatory tariffs on steel and aluminium may also figure as part of discussions between both the sides, in which several issues are going to be discussed. But any finality would only be attained only when a deal is inked. So clearly all things till now are not as clear as they should be as far as any finality to the negotiation is concerned.
Abhimanyu, many thanks for joining us. Now, the government has authorized emergency weapons procurement worth up to 24,000 crore rupees for the armed forces. Sources tell CNBC-TV18 that the procurement will include loitering munitions and counter-UAV systems. Parikshit is standing by with more. Parikshit, what can we expect in terms of the emergency procurement by the armed forces?
Well, this confirms a CNBC-TV18 news break that the government is all set to go in for emergency procurements and replenishment procurements as well. We had reported a few days ago how the industry expects orders to the tune of 39,000 to 40,000 crores for all equipment and ammunition that was used up during Operation Sindoor, and to replace that as well. Now we have confirmation that the Defence Acquisition Council met recently and gave its approval to authorize the armed forces to go in for emergency procurements. Now this is for loitering munitions, anti-tank guided missiles, counter-UAV systems, including drones, and also artillery ammunition for the Indian Army. Now the acquisitions will take place for all three services. Each vice chief has been empowered to order weapons and ammunition to the tune of about 300 crore rupees each. We are yet to get an exact number as to what will be the quantum of procurements by the government, but we are told that the upper cap is 15% of the defence modernization budget, which is 1,60,000 crores for FY26. So 24,000 crores is the upper limit. We're told that the numbers could be slightly less than this because deliveries have to be made within a year. So what are we looking at? Well, we're looking at contracts to be finalized in the next 40 days from now. This will include both domestic and foreign suppliers, and we're looking at acquisition of Scalp and Hammer missiles as well. Those will require consent of the Ministry of Defence because they are foreign purchases. Secondly, after finalization of contracts within 40 days, deliveries have to be made within a year. So this may not be all. There may be more acquisitions that the government may be looking to do in the next few months.
Parikshit, many thanks. Now, India's top defence companies are eyeing a bigger order book this fiscal. Prime Minister Modi, in his address to the nation last week, had highlighted that Operation Sindoor was the Make in India moment for the Indian defence sector. We spoke with top executives of India's top defence equipment companies to get a sense of their projected order book. Take a look.
अब हमारे पास करीब 65,000 करोड़ का LCH का ऑर्डर जो हाल ही में आया था, बिगेस्ट ऑर्डर इंडियन डिफेंस हिस्ट्री में है। ये एक बड़ी ऑर्डर है 156 LCH। दूसरी है जो अभी 83 LCM Mark 1A जो एग्जीक्यूशन में है, और 12 Su-30 जो हम बनाने वाले हैं वो एक ऑर्डर था, और 240 Su-30 इंजन्स। कुल मिला के आज के दिन 1,90,000 तक ऑर्डर बुक है, और ये अगले साल में और ज्यादा होगा।
We currently have an order book position of about 691 crores. But again, we are expecting a few more orders in this and the next quarter. We were saying about 800 crores in the first half of the year, and I think we still stick to that. I think that 800 crores is still very visible to us. We should be getting those orders. But with the new, situation, I think the order book position will be substantially higher.
But defence stocks saw some profit booking today amidst concerns over valuation. Shares of drone maker Idea Forge trading at a price-to-earnings multiple of 124 times, even as it remains 33% away from its 52-week high. Almost all defence companies are trading at a PE multiple of more than 30 times. Sanjeev Prasad of Kotak says valuations are not adding up.
We were just buying in anything and everything without looking at, whether the nature of what we're going to say as in the past is explaining. Second thing, whether the kind of EBITDA margin many of these companies are earning, whether that will sustain in the future or not, and I'm surprised to see the kind of very, very high margins this company are reporting, so that could also come under some question mark. And the third is obviously the valuation part, which every investor has to look at ultimately, right? Ultimately, you're paying for whatever you're buying, and you look at some of the numbers they make, really, very little sense to me, at least, if I look at, let's say, something like a potential PR, since you talked about that, the market cap is somewhere about 55,000 crores. The net worth is only, by the way, 1,300 crores.
Well, a question mark on valuations there as far as the defence stocks are concerned. Now, the Enforcement Directorate has arrested Subodh Kumar Goyal, the former chairman and managing director of UCO Bank. The ED said Goyal was arrested on the grounds of money laundering in an alleged bank loan fraud case. Ritu standing by with more. Ritu, take us through the details of what has transpired. Why this arrest?
Well, Shireen, Subodh Kumar Goyal, who's the former chairman of UCO Bank, has been arrested on money laundering charges in this bank loan fraud case, which involves more than 6,200 crores. That is linked to a Kolkata-based company that is called Concast Steel and Power. Now, the arrest was made on the 16th of May, and he's been remanded to ED custody until the 21st of May. Now, according to the ED statement, during Goyal's tenure as the CMD, UCO Bank had sanctioned a large credit or large loan to Concast Steel, which was later siphoned off by the borrower group, and in return, Goyal allegedly received substantial kickbacks that were routed through a complex web of shell companies, dummy individuals, family members to really disguise the origin of this criminal money. Now, this included cash, luxury goods, immovable property, high-end hotel stays, and so on. The ED has said that it identified several assets that were tied to these shell entities and directly linked them to the diverted loan funds. The ED has also said that it found incriminating materials that detailed these illicit transactions during searches that were conducted in April at Goyal's residence and those of his associates. Now, earlier in the same case, we already saw that the ED had provisionally attached about 510 crores worth of assets that belong to Concast Steel and its promoter Sanjay Sureka, who was arrested in December and remains in judicial custody, and further investigation in this case is ongoing. Now, Subodh Kumar Goyal has had a long career spanning public sector banks like Bank of Baroda, Allahabad Bank, including his stint as the CMD of UCO Bank around 2007. Interestingly, as the Chief Vigilance Officer at Bank of India around the time of 1999 to 2002, he also is said to have played a role in unearthing the Ketan Parekh scam. And so the irony of his arrest coming in now isn't really lost on the financial world.
Ritu, many thanks for joining us. We will head to a break, but up next, Uber partners with ONDC for an in-app feature to book Delhi Metro tickets. Uber is also bringing back food delivery with a new logistics push. More on that when we return. Welcome back. You're watching Business 360. Israel has ramped up attacks across Gaza, carrying out at least 30 airstrikes within an hour. At least 28 were killed during those strikes in the southern region of the territory. This is Israel announced it will allow a basic amount of food to enter Gaza to avoid what it called a starvation crisis. Prime Minister Netanyahu's office said the move was made to support the army's renewed military offensive against Hamas. From one war-torn region to another, Russia has launched its largest drone attack on Ukraine since the war began. This comes ahead of an expected phone call between President Trump and Russian President Putin. Ukrainian officials said that Russia launched over 270 drones in one night, largely dominating central Kyiv. The attack killed one woman and injured 4 others. The United Kingdom is poised to reset trade and defence ties with the European Union after Britain's exit from the European bloc in 2020, according to a CNBC report. A security and defence partnership has been concluded. Reciprocal access to fishing waters has been agreed upon until the 30th of June 2038. The global power has also reportedly finalised a deal on energy cooperation. The deals were made as UK Prime Minister Keir Starmer hosted European Commission President Ursula von der Leyen in London. Well, here's CNBC-TV18 exclusive. Uber has partnered with ONDC for an in-app feature to book Delhi metro tickets. The company's global CTO, Praveen Naga, said Uber is also bringing back food delivery, but with a new logistics push. He also added that Elon Musk's vision of self-driving cars could be the future of transport. Take a look.
We have already a courier product, right? Through that, we actually get a sense of what the needs are. We actually see our consumers trying to get something from the businesses, like go to the store and get some things and so forth. So we already see the product being utilized that way. So it's a natural fit to expand into it while through this. Now, what makes it very interesting is ONDC is actually helping us tap into the sellers and the platforms, which is the hard part of building this out, right? But now ONDC is enabling it, so it's easiest for us to get started. Starting with food deliveries, right? I think then you can imagine the possibilities here, which is pharmacy delivery, or like grocery delivery, or having healthcare products delivery, retail stuff, right? All these things are very much possible. We already see this in our market. As I said, no, consumer products, people are already mimicking those things to get it, so we can now naturally do this. But it's very interesting with ONDC, what will happen is we're able to get all the small merchants into the platform. Autonomous cars is going to play a big role in a mobility ecosystem. It won't be the only play. It will be one of the modes of transportation. Now at Uber, we strongly believe in it, and we partner with several partners who actually work on autonomous stuff. We launched in Austin, and we're going to launch in Atlanta with Waymo. And we have partnerships with 14 other partners around the world. We launched in Abu Dhabi as well. If autonomous tech is successful in India, Uber will be the first one to bring the tech.
And you can catch that conversation with Uber's Chief Technology Officer, Praveen Naga. That's coming up for you at 6 p.m. tonight. Walmart-owned e-commerce company Myntra is going global. The fashion retailer's forayed into Singapore, aiming to cater to the Indian diaspora. The launch is part of a broader global strategy to tap into new customer segments and build brand affinity. The CEO of Myntra, Nandita Sinha, explains why the company chose Singapore for its international foray. Take a look.
There is a large Indian diaspora that lives across the world, and we want to tap into that diaspora. We chose Singapore first because it's a country where already, around 5% of the Indian diaspora already, visits Myntra, the Myntra platform. Why we wanted to get into this venture was because of the fact that almost 10 to 15% of our traffic on the web actually comes from international markets. So we knew that there was an opportunity where consumers were looking at us.
Well, that's Myntra going international. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. We're back in a moment after a very short break. Stay tuned.
Hello and welcome to this special conversation right here on CNBC-TV18. Now, whenever there's a conversation about digital India, about the digital economy, one company that's been a part of this conversation, one company that's been a part of this dialogue in this journey has been Uber. Uber has been one aspect, one company that has become central to lives of very many Indians. To tell us more about it is with us Praveen, the CTO of Uber. Praveen, welcome to this conversation. Welcome to this broadcast on CNBC-TV18. I remember last we spoke to you in 2023. That was as VP Engineering. Today you're wearing a new hat. You're visiting India for the first time as the CTO, and you're coming here on the cusp of a big announcement. So let's dive straight in. Just moments after launch, we're speaking to you. Tell us more about it. We saw the first mention of this when Dara was visiting India last year. He expressed confidence in the digital public infrastructure here in India. Today we see a build on that conversation. Tell us about this integration with ONDC. The latest service that you're offering is booking of metro tickets on the Uber application via the ONDC. From a tech perspective, what does this integration represent? From a user perspective, what does it mean? Will I now be able to go on Uber and book metro tickets?
First of all, thank you. Thank you for having me here. And as you said, Dara, our CEO, was here last year, and he had a first-hand experience of the ONDC and getting to know what it is about and so forth. And he's also experienced UPI, like he paid for his own chai with UPI. And he also spent a lot of time with Mr. Nandan Nilekani, and he got to understand all these things. And when he came back, he told us how excited he was. Right? He wanted really for us to engage in an authentic way. And we signed an agreement when he was here that we will engage and build on ONDC. And today, we are matching our words with actions. We are launching Delhi Metro on Uber with ONDC. I think that's the primary product. And we will be launching 3 more metros by end of the year. And from a tech standpoint, you see now we are able to launch 3 more metros by end of the year. This is possible because of the ONDC.
Sure.
Right? The standardization of the protocol and what's possible there, and becomes a replicatable technology. Right? What's exciting is government of India is able to help do that. That's the tech aspect of it. Now, from the consumer point of view, your beloved Uber app, you can hop onto it, and you can book your metro ticket and get the QR code and seamlessly pay with UPI, which is your payment is exclusive on UPI, and you're able to take a metro as regularly as anything that you're using Uber for.
Wonderful. Directionally, where is this going? Uber already a multimodal system, 4-wheelers, 3-wheelers, 2-wheelers, courier services as well. Now there's integration with the public transport network. Directionally, where is it going? Where can we see the Uber journey in India heading?
So I'll answer this in two fronts, right? One is, as you said, there is first of all, India is a very dynamic and diversified portfolio of mobility products, right? Starting with motor, auto, cars, shuttles, and now with metro coming into the picture, you can see the whole ecosystem is coming together.
Sure.
Now, what we call as true multimodal transportation is now possible, where when you start from your home, you're able to take your preferred mode of transportation, go to the metro station, take the metro, and then go to a point B, the end point B, because usually it's not where you end up, right? So that true multimodal nature is possible now with the missing piece was metro, right? That kind of fits in. So now that's from the mobility standpoint. Now, where this is going is also what we look at as delivery, what we call as Get Anything. We already have a delivery product in India called a courier, where you're able to send or receive packages or parcels from consumers, right? Now, we already see the need for that in the business world, the B2B space, and this is something that ONDC is enabling it. So for us to be able to seamlessly integrate with ONDC and enable B2B is something that's the direction we want to go as well. So we're going to work on that and launch it pretty soon.
You make a reference to courier, which I think neatly dives into my very next question, which is the other big announcement that you referred to, which is the logistics push. Again, you're talking about from personal commute into you're entering a new vertical of business transport. Tell us more about that. What does this mean? The press release mentions that it's going to begin with food deliveries. Is this a rekindling of an old flame? We had Uber Eats. You'd sold that in 2020.
why this new interest, this fresh interest in logistics, in B2B, B2C transport?
Yeah, look, as I said, first we have already a courier product, right? Through that, we actually get a sense of what the needs are. We actually see our consumers trying to get something from the businesses, like go to the store and get some things and so forth. So we already see the product being utilized that way. So it's a natural fit to expand into it through this. Now, what makes it very interesting is ONDC is actually helping us tap into the sellers and the platforms, which is the hard part of building this out, right? But now ONDC is enabling it, so it's easiest for us to get started from that angle. So we'll see where it takes us towards, right? But it's a natural evolution is what I would say.
This plug-and-play logistics system that you're providing using the Uber fleet, which is currently in service, where do you see the demand coming from? You mentioned food deliveries is something, of course, you're keen to begin with, but progressively, where do you see this demand coming? We've seen a quick commerce boom here. Is that something that you're targeting? What's on the cards? Where do you think the demand will come from?
Absolutely. So we're starting with food deliveries, right? I think then you can imagine the possibilities here, which is pharmacy delivery or like grocery delivery or having healthcare products delivery, retail stuff, right? All these things are very much possible. We already see this in our market. As I said, consumer products, people are already mimicking those things to get it, so we can now naturally do this. But it's very interesting with ONDC, what will happen is we're able to get all the small merchants into the platform, right? And we are able to do that. And that kind of, that kindling of this technology from ONDC coming in and this things that's happening is what we are very interested in.
Wonderful. Let's shift course a little bit. Let's talk about some of the larger issues. You've worn many hats. We began the conversation by saying in 2023 you were here as VP Engineering. There's a dramatic change of context between then and now. The geopolitical tensions, we're not going to dive into that right now, but that has shaped conversations on tech as well. We see elements of tech or data nationalism being adopted by various countries. India is one of them. Data localization, we're seeing some aspects of that in the latest data protection framework that we have. With various countries coming out with such forms of data, technology, nationalism, how are you looking at it from an Uber standpoint, especially since there are vast pools of user data that you do manage? How are you looking at it, countries like India?
Well, look, I mean, we operate in many countries, and every country, many countries have rules and regulations, right? And regulations that we follow. Like Europe, for example, has a very strong privacy laws, and we follow those laws. And as usual, if India has something, that we'll of course follow it. And our interest is in shaping the regulations in a meaningful way and working with them.
Is that a deterrent towards innovation when you're looking towards perhaps more collaboration across the geographies in which you operate? These verticals and these silos set up, is that a hurdle that you face for inspiring greater innovation?
So far, we haven't seen that as a deterrent. What we see is as a meaningful regulations that the governments are responsible for their people. They're doing it, and we follow them. We as a global players, we tend to work with the regulators and work with them what's meaningful and get it done.
Wonderful. Let's also, since we're talking about data, one tricky question that I want to throw to you has been that there are some people who, citing their own personal anecdotes, they go to social media, they make references about how putting in the same location, the same destination, same time of day, different devices get different pricing, and Apple will probably get a higher pricing than an Android. A device with lower battery may perhaps get a higher pricing than others. Would you care responding to that? These are questions that often get raised anecdotally on social media, but how would you respond to that?
So I will respond by saying that we categorically do not discriminate with device classes or iOS, Android. Now, that is a fact. There are several aspects of it, of the pricing that gets determined, right? Your place, your location, time of the day where you are, and depending on the traffic conditions, the routing algorithms, where you get routed, all these things comes into picture. So it kind of seems like different prices sometimes where you are. But I would categorically say that we don't discriminate based on device classes.
Wonderful. Let's talk sustainability now. Electrification of fleets is a conversation that's being had across various verticals, across various companies. Can you give us some guidance, some color on how that is progressing? We saw Uber Green some time back. It's kind of fallen off the radar. Why is that? Are there challenges that you're facing in terms of electrification of the fleet? And if yes, then what does the journey ahead look like in India?
Look, I mean, sustainability is one of our biggest priority. We have specific goals that we are dealing with. I think what's most important is it's one thing to say that, hey, we're going to have electric vehicles on a platform. It's the other thing to be able to build the tech that is needed to make it work, right? It's not enough just to plug in. You need to be able to route properly, ingest the charge information, being able to route. Like, let's say if we match you with a ride that is like 20 kilometers, but your battery is just 10 kilometers, that's not going to work, right? That causes a lot of chaos. It's not like gas or petrol station where you can stop and. So these things are building. We are building it out, right? Now the reason probably you're not seeing much is because like probably it's already there and you get used to it. But we have a lot of progress we have made in United States, Europe, and specifically India as well.
Wonderful. Any roadmap, any figures that you're working with in terms of any percentage of the fleet that you may look to transition here in India? I remember from the last conversation you'd mentioned a 2025 target for London. Anything specific that you're working towards in India?
I think we have targets in London for end of the decade, but I don't think there is specific targets in India. But our interest is to be able to scale EVs is better, and we already see the adoption of it.
Let's talk about India in terms of an R&D innovation hub. From earlier conversations where I can recollect, there were conversations about how some of the innovation scene here, India of course provides vast scale, so something works in India, usually works elsewhere as well. Give us some indication, how have things grown from the last time you spoke to us? Is there a larger headcount? Are there more innovations that you'd like to share that have happened over the last 18 to 24 months that have now been replicated elsewhere as well?
Look, I mean, first and foremost, since last we talked, we actually scaled more in India. We have hired more, we have worked with universities to hire new college grads and so forth. India is our second biggest tech hub outside of United States, which is actually one of the reasons why I come here often and spend time here. And I usually bring in my strong team along with me when they come and so forth. And in terms of the work that we do, I usually tell these three categories that we work on. One is the core infrastructure, right? We are a global company and we need a strong infrastructure to scale. And the second is the platforms, like the payments and the customer service and all these things. We build a lot of things in India as well. And the third is the products, right? We build some core products, the core rider experiences, core earner experiences, the vehicle fleet platforms, and so forth. And I think over the last few years, you guys might have seen we have launched very strong intercity products, which we are scaling globally as well. And we also launched Request Any in India, which we are actually scaling it globally as such. So we have taken what things work in India and take it global.
Wonderful. Let's also talk about AI. That's been, I think any conversation on tech is incomplete without AI. From a back end and from a front end perspective, what are some of these applications that you're beginning to see as far as Uber is concerned, and anything that's around the cusp that we can expect?
Absolutely. So this is the top of the mind, and actually AI is one of our big strategic initiatives in the company. And what I usually call as AI generally has to become a fabric, right? Now, there are different types of use cases for AI. One is, how are we using AI in our core software development? The whole life cycle of software development, which part of it is AI being used? Now, we are very strong really leveraging AI for even our software development in terms of IDEs and so forth. And the second is our customer support. Like we use AI to do a lot of customer support stuff, which actually becomes a very high quality product that we build. We are able to answer. And the third is the products that we build. Like there are certain products you might not even realize there's AI being used. Right? In terms of Uber Eats, the homepage and the search and ranking that we do around the world, you might not even know there's AI there, but AI is actually it's a high quality ranking and search that comes up. And then we are able to build AI first products, right? Which are, if you go to Uber Eats, you're able to see around the world where you're able to order in an AI driven way, where you're able to talk to it and so forth. So these are the different ways we look at AI.
Wonderful. I'm nearing the end of this conversation. Just a couple more questions. Last time in 2022, I had a conversation with Tony West, again a part of the global leadership. At the time, he'd given us a headline that Uber is the third largest employer in the country after the Indian Defence as well as the Indian Railways. That figure has grown, I understand, to 1.4 million. When we talk about so many driver partners, how do you then also address the question of congestion? The drive here from the airport to this hotel that we are in gets challenging sometimes, which is a story which many people across cities often share. How do you then address both the questions of having a wider network as well, while also addressing questions of congestion?
Absolutely. The story is still the same as I talked last time, which is we got to innovate with products to be able to share and get more people to share so that we can reduce the congestion. Government is doing their job with transit and metros and so forth, where now we are actually working with them to enable the ticketing. And we're also working on products like Uber Bus, where we are able to help share your commute as such, right? And as we get this more and more, I think we'll start seeing some benefits out of it. Like that's how we are contributing to it.
So you're wearing the hat of a tech officer, so I have to end this conversation by asking you about what the future of transport looks like to you. There are some conversations, for instance, take Elon Musk, for example. He believes that automation and robotics is the way forward. Automated cars, self-driven cars is the future of transportation. Tell us from your perspective, from the way you see technology developing, where do you see it going from here? Is that the reality of the future, that we'll just call an Uber, summon an Uber, it'll be without a driver, it'll be self-driven, will take me to my location? Is that the future of transportation? What would your guess be?
Absolutely. And what I would say is autonomous cars is going to play a big role in the mobility ecosystem. It won't be the only play. It will be one of the modes of transportation. Now at Uber, we strongly believe in it, and we partner with several partners who actually work on autonomous stuff. We launched in Austin, and we're going to launch in Atlanta with Waymo, and we have partnerships with 14 other partners around the world. We launched in Abu Dhabi as well. So this is something that's going to happen. And again, we believe Uber is the rideshare network that can actually scale autonomous vehicles.
Any pilots that we can expect in India to see anytime soon that you're planning?
If autonomous tech is successful in India, Uber will be the first one to bring the tech.
Wonderful. Thank you so much for joining us. This has been an engaging conversation in terms of learning more about Uber and directionally where it's going from here. Thanks so much for joining us, and we wish you the very best.
Thank you so much.
CNBC-TV18 Future Female Forward, co-presented by Cognizant. Close the Gap Knowledge Series in association with the Udayti Foundation.
Welcome back. Let's now focus on the auto sector. India's automobile sector is a major driver of economic growth, contributing 13% to the country's GDP and accounting for 49% of its manufacturing GDP. But for an industry of this size and scale, women make up just 16% of the 8.49 lakh workforce in the NSE-listed automotive companies. Now, and while the workforce overall in the auto sector grew by 22% between FY23 and FY24, women's participation rose by only 3 percentage points. And even within that, representation is significantly higher in auto components than in core automobile manufacturing. Now, when it comes to leadership, the numbers tell a starker story. Women hold only 19% of board of director positions and just 8% of key managerial roles, far below the NSE average of 17%. Now, the lack of visible role models, especially at the plant level, has become a key reason why many young women struggle to envision a long-term career in this sector. Now, one of the root causes is the skilling gap. Only 24.5% of women aged between 15 to 59 have received any kind of vocational or technical training compared to nearly 45% of men. Enrollment of women in industrial training institutes remains critically low at just 6.6% as of 2021 compared to 93.4% for men. Now, limited access to suitable courses at training institutes continue to discourage women from entering the technical or shop floor roles. Now, beyond skilling, infrastructure, mobility and safety continue to be serious challenges. Most manufacturing facilities are located in remote industrial zone, often with inadequate public transport or poor access to secure housing or hostels. Half of all the women working in the sector say that lack of proper childcare facilities is also a major barrier in continuing in these jobs. Now, the data also shows a troubling trend in workplace safety. Sexual harassment complaints per 1,000 women rose from 0.8 in FY23 to 1.2 in FY24. Overall complaints also increased by 44%, but pending cases went up by 1.3 times, suggesting that resolution mechanisms are not keeping pace. Posh complaints rose by 8% in the same period, while workplace discrimination complaints shot up by 5 times. Clearly, the road to gender inclusion in the auto sector is long, and it's paved with challenges that need urgent policy and workplace interventions.
HSBC presents CNBC-TV18 Future Female Forward, co-presented by Cognizant. Close the Gap Knowledge Series in association with the Udayti Foundation.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and joining me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Electric commercial vehicles manufacturer Euler Motors closes its Series D funding round after it secures a total of 638 crore rupees. The funding round was led by Hero MotoCorp along with participation from existing investor British International Investment. The EV manufacturer will deploy these funds to expand the company's sales and service network while advancing new product development.
Automotive company Fox Motors launches an EV-focused fund called Fox Fund with an initial corpus of 500 crore rupees. This alternate investment fund has secured 100 crore rupees in the first close so far.
Automotive company Fashion e-commerce major Myntra forays into the international market with the launch of Myntra Global, marking its first direct-to-consumer expansion outside India. The Walmart-owned company is entering Singapore to tap into new customer segments and build stronger international brand affinity over the next few years.
A young employee of Ola's AI unit, Kruthrim, dies by suicide amid allegations of work pressure. The police register a case of unnatural death and summon the deceased manager for questioning. The company says he was on personal leave and had requested for a leave extension, which was granted.
Uber partners with ONDC for an in-app feature to book Delhi Metro tickets. Uber is also bringing back food delivery with a new logistics push. Global CTO Praveen Naga says Elon Musk's vision of self-driving cars could be the future of transport. That's an exclusive.
All right, into what's brewing today straight away after those headlines. Fashion e-commerce major Myntra has forayed into the international market with the launch of Myntra Global, marking its first direct-to-consumer expansion outside of India. The Walmart-owned company is entering Singapore, aiming to cater to the city-state's sizable Indian diaspora, which is estimated at over 650,000. The launch is part of Myntra's broader global strategy to tap into new customer segments and build stronger international brand affinity in the next few years. For more on this, joining me now is Nandita Sinha, CEO of Myntra. Nandita, a pleasure to have you here on Startup Street. Let's start by, telling us about what the rationale behind choosing Singapore as Myntra's first international market was over larger diaspora hubs like, say, the US, UK, or even the Middle East.
Thanks for having us here today. Myntra Global is really our opportunity to take Indian fashion to the world. This is our foray of made in India brands, built in India, built for the Indian consumer. And how do we really actually increase their exposure and take them to the world? That is what Myntra Global is about. There is a large Indian diaspora that lives across the world, and we want to tap into that diaspora. We chose Singapore first because it's a country where already, around 5% of the Indian diaspora already, visits Myntra, the Myntra platform. Why we wanted to get into this venture was because of the fact that almost 10 to 15% of our traffic on the web actually comes from international markets. So we knew that there was an opportunity where consumers were looking at us.
Got that, Nandita, but what is the size of the opportunity you assess for Myntra in a market like Singapore, and what kind of investments are you going to be making for this global expansion?
So Singapore has around 650,000 Indian consumers. We've not put a market size because this is really a niche opportunity which is there within the large fashion market that is there. It's a growing opportunity, it's a big opportunity, but still is a part of the bigger fashion opportunity. So we've chosen not to put a number on it right now. We will foray into the Indian fashion, so Indian wear, ethnic wear, whether it's home decor, furnishing, etc. We have almost 100 brands right now which are live on the platform, which is myntraglobal.com, almost 35,000 styles which are available, which will expand to 100,000, and we have more brands signing up as we speak. So it is catering to that 650,000 Indian consumer, Indian population. It is a part of their fashion basket.
So, what after Singapore? Sometime in the future, do you have plans to look at other global markets? And how soon will we see you enter these markets after Singapore? And will the focus again remain on the Indian diaspora in these countries, or will you look beyond that as well?
What we are looking at right now is really looking at expanding for the Indian consumer, which is available in the Singapore market. If you look at the other markets where which could be opportunities for us, are really markets where there is a big Indian diaspora. But like I said, right now, this is something we really want to learn. We are a platform which is always exploring new opportunities for fashion, and this seems to be an opportunity. So we are exploring this opportunity, and we are trying to learn from this opportunity what is the right PMF, and then post that go into markets which have a large Indian diaspora.
Okay, so the focus is very much on the Indian diaspora in these countries, but how large could the contribution from Singapore be, say, in the next year or two? It's early days yet, but what is your overall expectation as far as contribution from the overseas business, say, in the medium term would be?
Too early, but I think, when we speak to D2C brands, I think they see a lot of there are some D2C brands where they see like good sales coming from the international markets because brands are available through social media. So there is awareness through social media of the brands, of these brands. And therefore for us, that has been a little bit of an indicator of where we want to go. So don't want to share any numbers because it's too early. But I think the earlier success has actually been shown by some of the D2C brands on where they see part of their growth coming from.
All right, but Nandita, tell us, will brands on Myntra Global follow a different pricing or inventory strategy compared to what you do in India? For instance, will there be premium markups or curated selections or some exclusives that are tailored for that international audience?
For now, the brands are deciding the pricing strategy of, as they always do, they decide the markups and how they want to absorb the tariffs, etc. From an inventory standpoint, I think as we are starting off, brands are dipping into their existing India inventory. And honestly, that is the position of strength that we come from, that we don't need to earmark inventory or selection, especially for the global markets as we start, but we can really leverage what is available for Myntra, which is a very big platform. We have 70 million users, and therefore brands have already a very robust ecosystem to cater to these users. Now they can dip into the same and build the international business in Singapore. And then as we learn and grow, we can, take specialist bits, etc.
This is coming at an interesting time for Myntra. You've just turned profitable in FY24, yet to report FY25 numbers. But how do you plan to sustain this financial momentum while also funding new initiatives? Because it's not just Myntra Global, there's also mNow that you launch. Could you tell us if, financials may take a bit of a hit with these new initiatives, or how the year could pan out?
I think wherever we have with the scale that we have, Ritu, we have the opportunity to go deep into a few opportunities and being able to really see them through and build their momentum. We will continue to drive a sustainable overall business, but with the scale that we have the opportunity to go deep and invest in a few things. And that's what we've been doing. That's what's helped us grow ahead of the market. So this is what this foray will also be. And like I said, we are going to ensure, I think our first port of call is to really not even scale. I would say the first port of call is to get product market fit right, then scale, and then, and continue to look at overall sustainability of the business.
All right. Quickly before we let you go, since we spoke of mNow, how has the pilot fared so far? What sort of business is it generating? And how soon do you plan to expand this to other cities apart from Bangalore?
I think mNow in Bangalore has been a great, has had a great start. We've been there for 3 months, and as we speak, and we will be talking about expansion into a few other cities by the end of the month, end of May. So you will hear from us on that. If I talk about Bangalore in itself, I think we've been able to establish a great proposition.
Nandita, always a pleasure speaking with you. Thank you so much for your time here on CNBC-TV18 today.
Moving on what's brewing today, Fitter has just secured an additional $3 million from Rain Matter, an extension to the $3.5 million it raised last year from Zerodha's investment arm. The company is doubling down on its growth strategy, with gross bookings hitting an all-time high of 106 crore rupees in January. They're also betting big on their wearable, the heart ring, which saw a 60% spike in growth in just 1 month. And now the company is setting its sights on advanced diagnostics. Joining us now to break it all down is Jitendra Choksi, the founder and CEO of Fitter. Jitendra, thank you so much for taking time out and being here with us on Startup Street. You know, Fitter has had quite the journey, from catering to fitness enthusiasts in the pandemic to now pivoting to diagnostic solutions. Can you sort of take us through this journey and talk to us about what you're currently offering?
Right. So we started as a WhatsApp group, as you know, some 9-10 years back. And since then, it's been quite a ride. You know, we were bootstrapped, profitable for 5 years, raised some funds. I went into losing money, sacrificing profitability for growth, and then we are back to being profitable. And thankfully, this time we are growing also. So growth with profitability is the key mantra going forward. And as far as the services are concerned, our primary business is still health and wellness coaching. Then we have recently launched wearables, heart ring, last year, and that product has really seen tremendous growth. We've grown by over 600 times. We went from doing a revenue of 85 lakhs to now almost 6.5 crores, and we are currently at 18 crore ARR for the current year. Right, so that's the latest update.
Right. So a lot of solid numbers there that you've given us, growth with profitability being the key, right now for you guys. You've also secured this additional $3 million from Rain Matter, right? If you could sort of, elaborate on how this extension round will be utilized to scale your operations and enter new verticals.
Right. So one of the things that we are doing at Fitter is we are trying to build a full vertical stack when it comes to healthcare. So basically, there's preventive medicine on the horizon, the medicine 3.0 that everybody's talking about. We are in a pretty good position to shape ourselves as one of the pioneers in this space. And so we are taking baby steps. Wearables is a key part of precision medicine 3.0 or healthcare 3.0, right? So we have coaches. We are soon empowering the doctors. We already have the wearables, and then we are getting into genomics and diagnostics, right? So all of these core pillars form the fundamental for medicine 3.0. And at the center of it, you have AI and you have lots of data. So that's basically what we are doing. And the diagnostic lab is kind of a first. It won't be just blood and urine test, which is what's most common, but it's going to be end-to-end full body testing. So you're talking about DEXA, you're talking about VO2 max, you're talking ultrasound, everything.
Right. So quite a few offerings there that you all are focusing on at this point. Your gross bookings reached about 106 crore rupees by January, and you have a target of 130 crore rupees. You had that target for March. Where are you currently at? And, what are the key factors driving this growth?
So we did close the entire year's gross bookings at 128.2 crores. And with INFS, which is our sister concern, we are closing in at 133 gross bookings, right? So that's where we ended the last FY. This FY, we are kind of looking at 160 crore gross bookings.
Right. That's the target for this year. And what about revenues? Where's that at? And what's the target for this year? Are you on track to stay profitable?
Yeah, absolutely. We are going to stay profitable. Our revenues are, again, more than 100 crores this year. And as far as cash basis PAT is concerned, you're looking at 11.5 CR in PAT. And on accrual basis, you're looking at 6 to 7 crores.
Right. And, one of the things you said was your wearable segment, which is going to be a key focus for you guys. So your heart ring saw 60% growth from December to January. So what's the long-term vision for heart, and how central will it be to Fitter's business strategy?
So like I said, there's month-on-month growth, and yearly we've grown about 600% from last year to this year. And this year, again, we are looking at, doing a 3x of this growth. We are currently tracking 18 crores. The long-term plan for the wearable is very simple. People monitor their static test, which is where the diagnostics come in. But along with the static test, you also need to know what's happening in their day-to-day. How much are they sleeping? How much are they walking? What kind of exercise they're doing? All of that data basically feeds into the 3.0, right? So 3.0 is all about taking 2.0, which is the traditional medicine. On top of that, you add a layer of prevention, right? So it basically equips your doctors, your coaches to tailor or personalize plans for you, right? So, and if you look at the current stats, India is home to some of the largest number of diabetics. We're the diabetes capital of the world. We have 28% cardiovascular diseases, right? So
right.
This is pointing out that somewhere traditional approaches are not sufficing, and you need a more novel approach to this, which is where Medicine 3.0 comes in, right? So wearables are going to play a very key role because, see, it all boils down to fundamentals. A lot of people in India, they think they sleep enough, but the fact remains that 90% of the Indians are not getting enough amount of sleep. So the wearables kind of help you get the data. They at least make you realize, okay, I thought I was doing something right, but turns out I'm not. And so once you have the data, you can fix things and improve those things. Without any data, you can't really improve anything. So wearables are going to be key to our long-term Medicine 3.0 approach.
Right. So wearables, diagnostics, and the original, health and wellness being what you're going to focus on at this point in time. All right, Jitendra, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best going forward.
Thank you so much.
All right, on that note, we have to take a short break, but don't go anywhere because up next, a big boost for India's green energy drive. VFlowTech backs $20.5 million to scale its operations. We'll put the founder on the spotlight when we return.
Welcome back. You're still with us on Startup Street. A young employee of Ola's AI unit, Krutrim, allegedly dies by suicide amid allegations of work pressure. The police have registered a case of unnatural death and summoned the deceased manager for questioning. The company says he was on personal leave and had requested for a leave extension, which was granted. Rachna is here with all of those details. Rachna, what do we know as things stand at this point?
Right. It is a tragic incident at Ola's artificial intelligence unit, Krutrim, that has now escalated into a police investigation after the alleged suicide of a young employee, Nikhil Somwanshi. Sources say that Karnataka police has registered a case of unnatural death based on a complaint from Nikhil's family. According to police sources, Nikhil's manager, who is based in the US, has been summoned for questioning. Police have also recorded statements from other Ola employees and have requested for documents detailing Nikhil's appointment, pay structure, hours of work and responsibilities. However, they're yet to ascertain the exact reason why Nikhil took this drastic step and if work pressure was a factor at all. Meanwhile, Nikhil's colleagues and a few former colleagues from Krutrim, who we spoke to at CNBC TV18 on the condition of anonymity, have said that Nikhil joined Ola Krutrim last year as a fresher from IISc. According to people who work closely with him, Nikhil found himself overburdened with work after 2 colleagues resigned recently, leaving him solely responsible for a critical chat project. Sources say the pressure on Nikhil intensified in recent months. He even took a month off as a mental health break. This has been corroborated by Ola in its statement. In a statement, Ola said, and I quote, Nikhil was on personal leave at the time of the incident. He had reached out to his manager on the 8th of April, expressing the need that he needed rest and was promptly granted personal time off. Later on the 17th of April, he shared that he was feeling better but would benefit from additional rest and his leave was extended accordingly. End of quote. However, current and former employees at Ola Krutrim claim there is no concept of weekends at Ola Krutrim. Ola CEO Bhavish Agarwal has said publicly that he does not believe in the concept of weekends, calling it Western construct. Employees also claim that timelines for projects were frequently shifted, adding to the work pressure. Former and current employees at Ola Krutrim say Nikhil's manager was also subjected to verbal abuse by the top management, putting his team under more pressure. We've also learned that a mail was sent to the HR asking to fire remaining members of the team, calling them incompetent following Nikhil's untimely death. According to sources, Nikhil had been working on Krutrim Chat, a feature slated to launch sometime this week. Nikhil's current and former colleagues claim the toxic work culture at Ola fosters an environment where aggression towards subordinates is normalized. Nikhil allegedly confided in work friends about the mounting work pressure that he was under.
All right, Rachna, sad development, and thanks very much for bringing us that story. Our thoughts and prayers, of course, with the loved ones of Nikhil at this point of time. Now, moving on, VFlowTech, which is a provider of sustainable long-duration energy storage solutions, has announced a $20.5 million capital raise to support its strategic expansion into India's clean energy sector. This funding is going to enable VFlowTech to scale its existing 100 megawatt-hours manufacturing plant in India to a gigafactory and supercharge the rollout of its flow batteries in India's rapidly growing renewable energy market. To help us understand this and how the funding is going to boost the company's growth prospects, joining me now is Dr. Abhishek Kumar, the co-founder and CEO of VFlowTech, and also with me is my colleague Arundhati. Abhishek, welcome to Startup Street. Let's start with the $20.5 million fundraise. How much is earmarked for India-specific expansion versus global R&D? And how long is this capital expected to last, given your burn rate?
Thank you for having us here. Since we are a technology company and we believe, we know that India is growing, renewable energy ambition is quite high. The market is here. We took a strategic decision to set up our India factory in 2023, and we have expanded it to about 100 megawatt hour capacity. So we will be using a part of the fund in improving the technology, which is involving vanadium, local production from petroleum cinder. We are working with some of the leading research institutes in India for that particular purpose. We'll be using our electrolyte manufacturing here in India and also scaling supply chain in India. To scale a manufacturing, you will need to scale supply chain. So we'll be using that. And part of the funding will be also used to develop our software, which is a grid management software, and any energy storage makes the use of renewable energy more efficient through this software. So we will be using that funding for that as well. And some production equipment, which will be automation of stack, which will scale up a faster growth for us.
Right, absolutely. Ms. Abhishek, Arundhati here. You mentioned scaling from 100 megawatt to a gigafactory. What's the capex outlay for that? And, by when do you expect to hit full operational capacity?
So we have the pilot already running right now. The capex will be about $10 million. But the more important question is long duration is enabling a net zero solution. So we are looking to work with utilities in India, hard to abate sectors like steel industry. So we are developing a demand for long duration. and the demand comes up. Assembly unit just cost about $10 million to get to a gigafactory. What is more important is to create supply chain, which will be a vanadium, local production of vanadium membranes, and that would require slightly more capital.
Okay, so you're talking about local production of vanadium. What kind of capital will that require, and how will you, what are your plans on expanding on that front?
So vanadium is one of the key component of our battery, and it can be locally produced. We are working with some partners which has petroleum waste, has high quantity of vanadium in it, and that can be recycled and produced locally. So we have done a pilot production for it, where we have shown that we can achieve this. Now we are looking for a $5 to $7 million investment to have a pilot ready, and this will be well timed with our scale-up production.
Right, absolutely. And, what's the revenue contribution from India today? And how much do you expect India to account for by FY27?
So, our plan is to get to about 5 gigawatt hour in 2027. And India, we're looking to have at least 2 gigawatt hour. And 2 gigawatt hour by that time would be about $200 million. Currently, we just set up our line, which was operational in 2024, July, when we started our factory. Still that, we have a revenue of about $1.5 million and expected to grow to about 7 this financial year and to about 70 in next financial year.
All right. And, Abhishek, are you also in talks with the government agencies or DISCOMs for pilot deployments or, subsidy-linked projects under schemes like, say, the National Energy Storage Mission?
So we are in touch with MNRE. So this is a technology which has not been predominantly used. We are one of the pioneers of the technology. The advantage of our technology is that it clubs well with renewable energy. So probably 5 to 8 hours of charging and 10 to 12 hours of discharging, which makes it easily. So the demand is coming up. We are definitely in touch with a few of the DISCOM for a pilot and scale up. Now you will see that last probably 12 to 14 months, the Indian utilities have probably launched a tender of about 17 to 18 gigawatt hour energy storage. These are 2 to 4 hours. There are few utilities companies that are looking to have an 8 to 10 hours where our technology suits well. So we are definitely talking for pilot with government agencies, utilities, and some large hard-to-abate industries.
Sure. And, if you could sort of share details of the pipeline that you have, the 1 gigawatt you mentioned, in potential deployments, how much of that is already under contract or in advanced stages of negotiations?
So we are in touch with few DISCOMs. The tenders that you will see is normal energy storage tenders are in the range of 1.6 to 1.8 gigawatt hour. So in discussion in India, we have a pipeline in advanced stage of about 5 gigawatt hour, and globally it's about 12 gigawatt hour that is in discussion.
Right, absolutely. All right, Abhishek, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best on this journey going forward. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to this special broadcast. I'm Shireen Bhan. Operation Sindoor is the new normal for India's stance against terror, said Prime Minister Modi as he reset the terror doctrine. His address to the nation on Monday was his first since India's military strikes against Pakistan in retaliation to the Pahalgam terror attack. Prime Minister Modi added that India would not fall for nuclear blackmail and that terrorists and their enablers would be seen as one. He also called Operation Sindoor the Make in India moment for India's defence sector.
न्यू एज वॉरफेयर में भी अपनी श्रेष्ठता सिद्ध की। इस ऑपरेशन के दौरान हमारे मेड इन इंडिया हथियारों की प्रामाणिकता सिद्ध हुई। आज दुनिया देख रही है 21वीं सदी के वॉरफेयर में मेड इन इंडिया डिफेंस इक्विपमेंट्स, इसका समय आ चुका है.
Joining us now on the program to talk about where India stands today post Operation Sindoor, the big defense equipment moment. Is this a coming of age of India's defense industry as well as the geopolitical reset that we are currently in the midst of? Sanjeev Puri, President at CII, Baba Kalyani, Chairman and Managing Director at Bharat Forge. Also with us on the show, R. Mukundan, Vice President at CII. Gentlemen, appreciate you joining us here on the program. Mr. Puri, if I could start by asking you, we heard from the Prime Minister in his address to the nation and subsequently when he addressed air warriors at the Adampur Air Base, making it clear that Operation Sindoor is the new normal. It's the new red line for India's response to any future terror activities, whether terror actors directly or enablers of terrors as well. Now, from industry's perspective, how do you respond to what we've seen from the Prime Minister, what we've heard from the Prime Minister, and where India finds itself positioned?
Thank you, Shireen, for having us on the channel. So, first of all, let me start by congratulating the Honorable Prime Minister for his very swift, decisive, impactful, and yet very responsible actions. You know, it started with the targeting of terrorist camps, and then India also responded very effectively against the provocations, caused a significant amount of impact and damage to various strategic sites in Pakistan. So I'd like to congratulate him for the swift action and for demonstrating to the world that India will not tolerate terrorism. It's a zero tolerance. And the new normal, I think, is extremely important because, sustainable growth, quality of life, for them, what is very important is a safe operating environment. And this gives immense confidence to investors and businesses. So the Indian industry really would like to congratulate the Prime Minister, would like to salute the armed forces for their bravery, the professionalism. And I think what is interesting that it has demonstrated the prowess that the Indian defense industry has built over the years. I think it all started again with the visionary leadership of the Honorable Prime Minister, the Make in India program, which has started several years back. And we know from a minuscule amount of exports, we're talking about last year about 3 billion or approximately kind of exports. And the efficacy of all of these equipments were amply demonstrated by the effectiveness of the targeting, the precision targeting, and the extensive and effectiveness of the damage caused. And and this is not merely speculation. This is based on images that have been verified. Not only what we've seen in India, but also by, overseas, media channels where they have access to various satellite images and have very clearly demonstrated the extensive damage that has been caused. So I think it's absolutely Indian industry is in complete solidarity with the Indian government on the actions that have been taken. We welcome it. And I'm sure that this also gives a lot more impetus and energy to the building of the strategic defense sector in India.
Yes, let me take that point forward with Mr. Baba Kalyani, somebody who has, of course, been involved with India's defense sector for very long now. Mr. Kalyani, as I started, is this really in a way a coming-of-age story as far as India's defense sector is concerned? Sanjeev Puri alluded to the export number, and we've seen that export number up 34-fold increase in the last 10 years to over 23,622 crores. But, Operation Sindoor and what it's meant in terms of testing India's military prowess, testing India's defense capabilities, coming out successful on all parameters. We are given to understand at this point in time that we could be talking about replenishment orders worth about 30 to 40,000 crores. And all of this now builds on the indigenization efforts over the past decade. Mr. Kalyani, your first thoughts on what Operation Sindoor has meant as far as India's defense capabilities are concerned, as well as the road ahead.
Well, thank you, Shireen. And first of all, let me share what Sanjeev said and congratulate the Honorable Prime Minister, the political leadership in India, and our armed forces, the National Security Advisor, and everybody else who took part in planning and making this successful. I think what we need to understand, what is very different in this conflict is this has been a technology-enabled and technology-intensive battle, not the normal kinetic war that we were used to with our adversaries across the border in Pakistan. And I think this is what is very heartening for India, heartening for the nation, and what our industry has been able to contribute, both the public sector and the private sector. And more importantly, let's not forget our DRDO, who has been at the backbone designing products and making technology happen. And I think this is a big change that has happened. We all see it in our own businesses where we are making defense equipments. And I think you will see India moving ahead very fast in the technology enabled battle scene that we had in this conflict. Having said that, I just want to caution that this was a short conflict. I think from our side it lasted 25 minutes, if I have heard the media correctly, and we should be prepared that something bigger happens. We are not caught napping, and we are ready with all our muscle power, all our technological capability, and all our hardware. And I think Indian industry is pretty much up to the mark. We are, more than just the business side. I think as Indians, we are extremely elated and very proud of how this has been handled, how our leadership has taken decisions and have made things happen in a very proper fitting manner.
Well, Mr. Kalyani, since you talked about the length of the operation, just to be absolutely precise, it was 23 minutes to be exact, sir. That is how long Operation Sindoor, the first installment of Operation Sindoor, lasted, 23 minutes exactly. But let me bring in Mr. Mukundan into the conversation as well. Mr. Mukundan, just to take forward what we heard there from Mr. Kalyani, in terms of future readiness, future preparedness, he talked about the contribution of organizations like the DRDO, etc., but perhaps a need for even deeper, more robust private-public sector participation, partnership as well, especially on the defense side as we move forward, because at this point in time, in the geopolitical reset that we're seeing, perhaps self-reliance will be of critical importance.
Thank you, Shri. Let me also join my two senior colleagues in congratulating and complimenting our government, our Prime Minister, and our armed forces on a wonderful, resounding message they sent across. And this was a very important message, fundamentally, because ours is a fight for peace. Ours is a fight for calm. And I think this was very important to do the way it was delivered, precise and short, as Baba Kalyani explained. And I think very clearly, in the long run, the point about Atmanirbharta, which the government has been saying, is actually most acutely we need to drive home in the area of defense. Because one of the things I did learn through this whole process is that when countries do export their wares, they actually reduce some of the capabilities of the equipments they sell to others. So I think in that context, if you had to be fully capable and measuring up to any form of threat issues which we will face in future, I think we need to design and develop and ensure that we have equipments and the technology which is right up there, matching with the best in the world. What we have seen is the human ingenuity, the human talent which has come to the fore, but we need to back it up with material goods and technological goods. And we are right there, but we must continue the momentum. One of the things which I would certainly say is that what private sector does bring to the table is its ability to put together a time-bound and also very cost-effective solutions to be delivered in a way that I think it not only caters to Indian needs, but also the needs of India as it begins to project itself beyond the shores of India. So really, the government has taken many steps in the area of defense, especially in terms of public-private partnership, procurement from Indian companies, encouraging joint ventures with the overseas partner. I think that momentum should continue, and I'm sure that more avenues will open up for us. And this defense spending and defense development, as I call it, should be seen as expenditure and an investment in peace. Many of us mistake that, whether it can go into other sectors like education. Certainly those we need to do, but I think this is one of the critical thing. Where development doesn't happen without peace all around, and in ensuring not just peace at home but also peace overseas, I think we need to progress it, and the private sector and public sector should work hand in hand, and government has taken wonderful steps in this regard.
Mr. Kalyani, if I could come back to you, sir, and talk about the road ahead as far as acquisition is concerned. And, I would imagine that we are likely to see another improvement over the previous year's budget. We did see a significant improvement this time around as well on the defense budget, including the acquisition budget. But, the focus and priority, you talked about this having been a tech-enabled conflict. The focus on drones, for instance, the focus on AI-guided loitering munition, for instance. What would you now like to see being prioritized, both from a development perspective as well as an acquisition perspective, sir?
Well, if you closely look at India's response in this conflict, it was a response which was, all the three services put together along with ISRO and other agencies working together as an integrated response. That's where technology comes into play. So if you look at UAVs are going to be a major part of any battle scenario anywhere in the world. If you look at the Russia-Ukraine conflict, Ukraine is making something like 1 million UAVs per year. There are hundreds of companies in Ukraine making UAVs. India has more than 500 companies who make UAVs. So I think we have come of age in this area. What is very important is we are able to do precision strikes. And for precision strikes, you need, the satellite surveillance, you need multiple agencies working together, making these things happen. And I think that was very ably demonstrated in those 23 minutes, as you said, what happened. So I think we have the capabilities. We just need to keep enlarging it, because you can imagine conflicts like the Ukraine-Russia conflict. This is going on for 3 years. Now, we had a conflict that went on for less than half an hour. So if we have a longer conflict, then we need to be far better prepared. But I think we are all there with the policies that the Honorable Prime Minister put into place for the last, let's say, 10 years in the area of defense, and all enabled by our Honorable Defense Minister and the whole user industry collaborative effort that is going on between industry, DRDO, and the users, that is the services. We are all moving forward at a very rapid pace. There are a lot of things that you don't see that are happening in industry, but I can tell you and assure you that we are moving forward at extremely rapid pace. And this is not only good for our defense, but is also good for our overall economic and industrial development.
Why don't you give us a sense of what is happening behind the scenes within the private sector in the defense space, Mr. Kalyani? What exactly is moving forward?
I'll give you, for example, I can't give you specifics, but I'll give you an example. In the artillery sector where we are involved, we have weapons which are far more advanced than anywhere in the world today. That's one. Second, if you look at in armored vehicles, whether tracked, wheeled, India is moving ahead with new equipment designed by DRDO, but produced by Indian industry, and with much higher technical capabilities than what we have today. And all this is with integration, with AI, digital, and everything else that's there anywhere in the world. So I think we are pretty much moving ahead. In terms of electronic warfare, I think whether it's anti-drone warfare, whether it's jammers, whether it's, those kind of things, we are moving ahead pretty fast. There are many companies working in this area. In terms of software-defined radios, again, that's an area where we are moving very rapidly in terms of technology. So every area you are moving in technology up ahead. And the good thing is all this is converging in every equipment that you make. So it's not that in like the old days, you have an artillery gun sitting and firing at the Kargil hill. Now it's all integrated. It is autonomous. It can be controlled without any man being there and controlled by using data from satellites and everything else. So I think things have gone in the last 5-7 years way ahead, and they're going to go even faster.
Absolutely, we are seeing that already in play. But Sanjeev Puri, if I may bring you and Mr. Mukundan into what we are seeing outside of course, what's happening on the battlefront. In the midst of this, we are seeing this global reset, where if I could loosely say trust is being replaced by trade. I mean, here you have a situation where President Trump is now even talking about a possible deal with Iran while he's touring the Middle East. So Sanjeev Puri, as we look at the world today, how India is best placed to navigate on the trade front in a world which is in a geopolitical flux?
So this is a very important facet that you have brought in, Shireen. That I think that, first of all, India is very well placed because of the strengths, inherent strengths that India has got. India has got the capacity to produce at scale economically of world-class quality. India has the talent, and India is also a services powerhouse, a powerhouse of some of these frontier digital technologies also. So India, from its own competitiveness perspective, is well placed. Now, we have seen several policy reforms over a period of time. Several of them have happened that make India a competitive destination. There are several successful examples. I think the world is also looking for supply chain resilience, which becomes even more important in a world where there is, when there are these trade fragmentations and also, the certain geopolitical shifts happening. This becomes very important, and scale can only come from India in many of these areas. So that's, having said that, I think the way to go is what is being done is we need to stitch our own bilateral trade deals in alignment with national interests. And as we do economic integration, I think we have to be cognizant of countries that are also working against our interest. And we have to, certainly CII would encourage its members to move away from them, to reassess. There are countries that supported Pakistan in this conflict. And of course, with one of them, we do have a material amount of trade. And I think it's not in India's interest to, not in national interest for us to pursue that. We should be reassessing what are alternatives that we have got.
Are you suggesting Sanjeev Puri that India break trade relationships with Turkey, with Azerbaijan? Azerbaijan, of course, is too small. Even Turkey, in the larger scheme of things, is about $10 billion. But are you suggesting that we break, trade ties with Turkey?
Look, before the conflict happened, we had a trade of about 40 million with Pakistan, or something of that order, right? It was small. So all I would say right now is that we must reassess, and we must definitely look at alternatives. We should certainly reduce, or if possible, eliminate economic integration with such countries. Why should I? I mean, it goes without saying, why should you be creating economic activity for places that are working against national interest? So national interest must come first and foremost. And I'm very happy to see, a lot of Indian consumers in this true spirit of nation first are kind of canceling their the tourism or the holidays, vacation they wanted to take in some of these countries. That's, I think, absolutely the right thing to do. Why should we be creating economic activity for countries that will work against our interests? That's the principle. India's self-interest is the first, and therefore very strong reassessment and as much as possible realignment, I think, is something that I would encourage everybody to think about. And
yes.
Coming back to what the question that you raised, I think fundamentally in this whole the very hyper dynamic evolving trade scenarios, I think the way to go is to, one, focus on domestic drivers of growth, which the government is very well doing and has done over several years. And the advantage is India is a very consumption driven economy. The second pillar we need to strengthen is our integration with global value chains. Exports is just 12% of GDP. How do we take that number up? And towards that, I think the bilateral trade agreements that India is pursuing, that's the right way to go. I think that's the way to have one-to-one arrangements with countries where there are synergies and where there are mutual benefits. That's the way we should be pursuing those. And I think some of the ones that are in the pipeline now are the ones that will create immense value for the economy.
We spoke the day that the UK agreement was done, the India-UK agreement was done. Mr. Mukundan, talking about bilateral agreements, let's talk about the US. We just had Donald Trump once again reiterate that, in fact, telling Tim Cook that he doesn't want Apple to build more in India. Also suggesting that, look, if you're building in India for India, that's fine, but anything beyond that may not pass muster. Now, that's his point of view. Whether Apple agrees or not is a different story altogether. But what do you take away from that messaging? Also, do you believe that a zero-for-zero tariff policy is the right approach? Again, Trump suggesting that India has offered zero tariffs. He said quite literally, they've said that there will be no tariffs. The Indian government so far maintaining that it's too premature to comment on any deal contours. Do you believe that a zero tariff policy is appropriate?
So firstly, Shireen, I think this is a world of trade partnership, as you mentioned. And I think we've already signed up with UK and FTA, and I think we are looking to sign FTA with the European Union, and I think also some kind of a deal with the US. So I think when we talk about free trade, I think there is going to be some give and take. And if that leads to zero tariff on some tariff lines, I think that is the way the world is going to shape. But that is the opportunity for India. India's opportunity is to be not just the service center of the world, but also the factory of the world, but also the manufacturing center of the world. And all the decks are stacked in India's favor. We have the talent. We don't have an aging population. We have workforce which is actually very productive. And we now have improving infrastructure. You look at it from all perspectives. I think everything is going for us. And really, the basic message which we must be pushing forward in the world stage is India is open for business. And effectively, we are looking for partnerships with like-minded countries. And really, what we want is a progress through peace and progress through partnership. That is really what we want. Even this skirmish which we had with our neighbor was a fight against terrorism. It was not a fight with the neighbor. And I think as long as there are principles on which we stand, I think we should then work with countries, like-minded countries. And I think we would certainly welcome a move from government to enhance our trade competitiveness through networks and supply chain, which we want to build. And it's all going to augur well for us.
The message there from industry is very clear. The answer, the antidote to uncertainty is a strong, resilient domestic economy. And that needs to continue to be the focus of the government and, of course, of the private sector. Once again, a sharp focus on what is happening with our defense industry. The fact that it's the military prowess prowess of the country has been tested and we have delivered successfully. That needs to be built on, and a more robust private-public sector partnership in each of these areas. Sanjeev Puri, Baba Kalyani, R. Mukundan, always a pleasure. Many thanks for joining us here on CNBC TV18 to take stock of where we find ourselves post-Operation Sindoor and what it means for our economy, and more importantly, what it means in terms of the coming of age of India's defense industry. We'll take a break. A lot more coming up. Don't go anywhere. We're back in a moment. Hello and welcome to this special broadcast. I'm Shireen Bhan. Operation Sindoor is the new normal for India's stance against terror, said Prime Minister Modi as he reset the terror doctrine. His address to the nation on Monday was his first since India's military strikes against Pakistan in retaliation to the Pahalgam terror attack. Prime Minister Modi added that India would not fall for nuclear blackmail and that terrorists and their enablers would be seen as one. He also called Operation Sindoor the Make in India moment for India's defense sector.
न्यू एज वॉरफेयर में भी अपनी श्रेष्ठता सिद्ध की। इस ऑपरेशन के दौरान हमारे मेड इन इंडिया हथियारों की प्रामाणिकता सिद्ध हुई। आज दुनिया देख रही है 21वीं सदी के वॉरफेयर में मेड इन इंडिया डिफेंस इक्विपमेंट्स इसका समय आ चुका है।
Joining us now on the program to talk about where India stands today post-Operation Sindoor, the big defense equipment moment. Is this a coming of age of India's defense industry as well as the geopolitical reset that we are currently in the midst of? Sanjeev Puri, President at CII, Baba Kalyani, Chairman and Managing Director at Bharat Forge. Also with us on the show, R. Mukundan, Vice President at CII. Gentlemen, appreciate you joining us here on the program. Mr. Puri, if I could start by asking you, we heard from the Prime Minister in his address to the nation and subsequently when he addressed air warriors at the Adampur Air Base, making it clear that Operation Sindoor is the new normal. It's the new red line for India's response to any future terror activities, whether terror actors directly or enablers of terrors as well. Now, from industry's perspective, how do you respond to what we've seen from the Prime Minister, what we've heard from the Prime Minister, and where India finds itself positioned?
Thank you, Shireen, for having us on the channel. So, first of all, let me start by congratulating the Honorable Prime Minister for his very swift, decisive, impactful, and yet very responsible actions. You know, it started with the targeting of terrorist camps, and then India also responded very effectively against the provocations, caused a significant amount of impact and damage to various strategic sites in Pakistan. So I'd like to congratulate him for the swift action and for demonstrating to the world that India will not tolerate terrorism. It's a zero tolerance. And the new normal, I think, is extremely important because, sustainable growth, quality of life, for them, what is very important is a safe operating environment. And this gives immense confidence to investors and businesses. So the Indian industry really would like to congratulate the Prime Minister, would like to salute the armed forces for their bravery, the professionalism. And I think what is interesting that it has demonstrated the prowess that the Indian defense industry has built over the years. I think it all started again with the visionary leadership of the Honorable Prime Minister, the Make in India program, which has started several years back. And we know from a minuscule amount of exports, we're talking about last year about 3 billion or approximately kind of exports. And the efficacy of all of these equipments were amply demonstrated by the effectiveness of the targeting, the precision targeting, and the extensive and effectiveness of the damage caused. And and this is not merely speculation. This is based on images that have been verified. not only what we've seen in India, but also by, overseas, media channels where they have access to various satellite images and have very clearly demonstrated the extensive damage that has been caused. So I think it's absolutely Indian industry is in complete solidarity with the Indian government on the actions that have been taken. We welcome it. And I'm sure that this also gives a lot more impetus and energy to the building of the strategic defense sector in India.
Yes, let me take that point forward with Mr. Baba Kalyani, somebody who has, of course, been involved with India's defense sector for very long now. Mr. Kalyani, as I started, is this really in a way a coming-of-age story as far as India's defense sector is concerned? Sanjeev Puri alluded to the export number, and we've seen that export number up 34-fold increase in the last 10 years to over 23,622 crores. But, Operation Sindoor and what it's meant in terms of testing India's military prowess, testing India's defense capabilities, coming out successful on all parameters. We are given to understand at this point in time that we could be talking about replenishment orders worth about 30 to 40,000 crores. And all of this now builds on the indigenization efforts over the past decade. Mr. Kalyani, your first thoughts on what Operation Sindoor has meant as far as India's defense capabilities are concerned, as well as the road ahead.
Well, thank you, Shireen. And first of all, let me share what Sanjeev said and congratulate the Honorable Prime Minister, the political leadership in India, and our armed forces, the National Security Advisor, and everybody else who took part in planning and making this successful. I think what we need to understand, what is very different in this conflict is this has been a technology-enabled and technology-intensive battle, not the normal kinetic war that we were used to with our adversaries across the border in Pakistan. And I think this is what is very heartening for India, heartening for the nation, and what our industry has been able to contribute, both the public sector and the private sector. And more importantly, let's not forget our DRDO, who has been at the backbone designing products and making technology happen. And I think this is a big change that has happened. We all see it in our own businesses where we are making defense equipments. And I think you will see India moving ahead very fast in the technology-enabled battle scene that we had in this conflict. Having said that, I just want to caution that this was a short conflict. I think from our side it lasted 25 minutes, if I have heard the media correctly, and we should be prepared that something bigger happens. We are not caught napping, and we are ready with all our muscle power, all our technological capability, and all our hardware. And I think Indian industry is pretty much up to the mark. We are, more than just the business side. I think as Indians, we are extremely elated and very proud of how this has been handled, how our leadership has taken decisions and have made things happen in a very proper fitting manner.
Well, Mr. Kalyani, since you talked about the length of the operation, just to be absolutely precise, it was 23 minutes to be exact, sir. That is how long Operation Sindoor, the first installment of Operation Sindoor, lasted, 23 minutes exactly. But let me bring in Mr. Mukundan into the conversation as well. Mr. Mukundan, just to take forward what we heard there from Mr. Kalyani, in terms of future readiness, future preparedness, he talked about the contribution of organizations like the DRDO, etc., but perhaps a need for even deeper, more robust private-public sector participation, partnership as well, especially on the defense side as we move forward, because at this point in time, in the geopolitical reset that we're seeing, perhaps self-reliance will be of critical importance.
Thank you, Shri. Let me also join my two senior colleagues in congratulating and complimenting our government, our Prime Minister, and our armed forces on a wonderful, resounding message they sent across. And this was a very important message fundamentally because ours is a fight for peace. Ours is a fight for calm. And I think this was very important to do the way it was delivered, precise and short, as Baba Kalyani explained. And I think very clearly in the long run, the point about Atmanirbharta, which the government has been saying, is actually most acutely we need to drive home in the area of defense. Because one of the things I did learn through this whole process is that when countries do export their wares, they actually reduce some of the capabilities of the equipments they sell to others. So I think in that context, if you had to be fully capable and measuring up to any form of threat issues which we will face in future, I think we need to design and develop and ensure that we have equipments and the technology which is right up there, matching with the best in the world. What we have seen is the human ingenuity, the human talent which has come to the fore, but we need to back it up with material goods and technological goods. And we are right there, but we must continue the momentum. One of the things which I would certainly say is that what private sector does bring to the table is its ability to put together a time-bound and also very cost